demand shock for the rest of the world, lower growth and less inflation. So there's going to be also a disconnect between central bank responses. We think the Fed is not going to be cutting rates quickly because of the inflation. We have the first cut in December. But for other central banks around the world, there's a lot of room for cutting rates.
You're saying that foreigners, and especially central banks, are selling US bonds. I mean, that has been happening, Japanese especially.
So we haven't seen it in terms of central banks. Okay. The data is actually
so maybe investors,
mixed. It's actually quite mixed. But you know, you have on one hand the Treasury data, which shows you there's some direct selling from Europe. There's some direct selling that's coming from, let's say, China, Asia, ex-Japan as well. But then you have the safe haven, or the tax haven, should I say, places where you have seen actually buying. So it's a bit of offset. There's no consistency really about it on the central bank space. But certainly on the private side, it looks like something is happening there on the actual asset unwind.
I think that's the interesting thing. I think the central banks around the world have been diversifying away from US dollars, their reserves, for a long time. The new interesting thing is the private sector. Private institutional investors, big lifers, pension funds around the world, are they starting to diversify away from the US?
And the reaction, what we saw was interesting, right? Usually when stocks go down, I mean, bonds go up. But here you had a situation recently when everything was getting sold.
Yeah, long end US Treasuries, equities, it was basically almost get out of the US.
That's so that phrase US exceptionalism, yeah, are we at the end of it? What's your sense?
I mean, I wouldn't push it that far away at the end. I would certainly be saying that it's fading, right? That the evidence we're seeing is that it's fading. But at the end is still quite, you know, I think of a push. It's a push to say that.
Sonal, let's come to India. It seems like we're first in line to get a deal. Would you agree?
Hopefully. I think we definitely have a head start. We started the negotiations ahead. The terms of reference have been finalized. India is a strategic ally. Now, you know, deals take time. Agriculture is a politically sensitive subject for us, but there are other aspects of the agreement on the industrial tariff, parts of the non-tariff barrier, you know, buying more of US products, which can easily be done. So I think if we can get the 26% reciprocal tariff down before the deadline, and our tariffs are lower than our competitors, then really in this world, what you're looking for is a relative advantage. And I think
will we have that relative advantage, Sonal? Because others also will negotiate, right? Others will also, I mean, for example, competitors in various industries like Vietnam, Cambodia, I mean, they'll also want to sort of lower tariffs, their respective tariffs, right? So it's all relative, as you said.
So I think most Asian countries are trying to negotiate with the US. The question is whether what they are offering will be acceptable to the US. One part of the deal is buying more of US products, but for countries like Vietnam, Cambodia, transshipment of China products has been an important reason for the reciprocal tariffs. Also, these other aspects of, you know, non-tariff barriers or whatever we want to call them. So, you know, and right now we are seeing China trying to, you know, also talk to Southeast Asian countries. It's putting Southeast Asia in a more difficult position in terms of choosing between US and China. I think for India, it's a lot more clear-cut. We don't have that transshipment problem. And therefore, I do think, like, relative to a number of our competitors, we do have an upper hand.
How long before we see a deal? I mean, do you have a number in mind? How many days? How many months? With India, US?
No, I think the definition of deal is important. The trade negotiations run into years.
Yeah.
It's a deal on goods, it's a deal on services. This is going to take time.
But this is like the COVID emergency. We got the vaccine. I mean, COVID hit in Feb, we got the vaccine in November. So
I mean, you know, the early tranche on some bits you could probably agree on by the 90-day, but the first tranche, of course, we are planning by September or October. The big deal, the real deal, is going to run into years.
It could be a MOU in the coming months.
The actual order will take time.
Well, interesting conversation there with the top brass at Nomura. Well, for the time being, we've got our pre-open rates and markets have opened up mildly higher, but a lot of stocks moving around. We have Axis Bank, that's actually down close to around 2%. Midesh is back with us. Midesh, what's the 910 call?
I'll go with a buy on persistent for targets of 5 to 8.
Okay. All right. Got it, Mitesh. Thanks very much for that. Since you're talking about persistent, let's bring Rima back in. IT stocks in focus because we've got so many different earnings coming through. Rima, quick wrap up.
Well, I'm focusing on two of them, which you should watch as rates come in. One of them is emphasis on the way up because it's a strong quarter. The company's reported its highest quarter-on-quarter revenue growth in 3 years. Top line growth stands at 2.9%. And to put it in context, most of the IT companies have reported a drop in their revenues in Q4. TCV, that's the total contract value of deal wins, was the highest in the last 7 quarters. Their pipeline is at a record level, and the company's pretty much maintaining margins. They ended Q4 with margins of 15.3%, and the full year guidance for next year is 14.75 to 15.75, and they expect growth to be above industry. So emphasis ticks, pretty much all the boxes. BFSI has done well for them, so that's a positive. Cyient, on the other hand, is a miss on revenues and margins. The company said that there were some programs which were stopped and deferred in Q4, which impacted them, and this might even impact their Q1 performance, which basically means that Q1 is also likely to be subdued. They haven't given a guidance for FY26 as they normally do, citing uncertainty. They say that the uncertainty is likely to last at least through the first half of FY26. And not just that, they've also lowered the margin guidance. So earlier their guidance was on margins 16% over the next 12 months. They're now talking about 15% margins over the next 24 months.
Okay. All right. Got it. Thanks for that, Rima. Indeed. Cyient is a casualty, earnings casualty this morning. It's down about 5%. So is SBI Card, also down 5.5%. Abhishek is here with a bull versus bear argument on it. Abhishek.
Well, to begin with, Morgan Stanley has a bull case scenario, equal weight rating and a target price of 775 per share. Now, this target price has been increased by them. They say that credit cost and bad loan formation have declined sequentially, which indicates a potential stability going ahead. So, Q4 PAT was 15% ahead of their estimate. Lower credit costs are positive. The timing and normalization is still unclear, or, there is uncertainty over there. Bernstein has written on SBI Card underperformance rating, target price of 620 per share. They say that credit cost was all that mattered for SBI Cards moving into these quarterly results, and it has delivered a quarter wherein the credit cost has inched down sequentially. However, management made it clear that 6% to 7% credit cost that remains very far for them. So overall, sequential improvement is seen in credit costs aided by NII growth and an OPEX moderation, which helped SBI Card deliver an ROA of 3.4% and 15.5% in this quarter by them. Back to you.
Okay, Abhishek, thank you very much for that. We'll come back to you with all these banking numbers, etc. as markets open. We've got a couple of seconds to go for the first rates. Nifty, Sensex, Bank Nifty, it's marginally higher, but nothing major at all. So 24,282 is where the Nifty is at, 0.15% higher. Bank Nifty is is down about 1/3%, so that's interesting. Nifty Bank has, I think this is the, now it's flipped back into the green, but if it were to be down today, it'll be the third day that the Nifty Bank has been down. We'll see. Sensex is up about 0.3, the small cap index is up about 0.25%, and I think the mid-cap index will come up on your screen as well. Give you a sense of how we are starting. 24,350 is where the Nifty is at now. It's about 100 points higher on the index. So firming up, absolutely firming up as we get into it. The Nifty heat map will come up on your screen. It'll give you a sense of how we are starting. And a quick snapshot view should come up in a bit. But let's get to individual stocks. Surabhi.
And earnings are driving big individual moves this morning. Prashant, if I look at it, look at SBI Life, 8%. That stock is soaring away in a big way because of that VNB beat. The VNB margin is 300 basis points above expectations, and it's also risen 200 odd basis points over the previous year. And the VNB growth also has been quite solid and ahead of street estimates. The street is absolutely loving it. In fact, it's rubbing off on HDFC Life as well. That's the second biggest winner on the Nifty, 2.5% on the upside. Now, I will, however, flip it over to the disappointments. Axis Bank is selling off quite a bit. Axis Bank, though their margins improved, asset quality was stable, but the stock's reacting quite negatively, 3.5% down as we speak. Tech Mahindra, obviously, that top line miss the street doesn't like. 1.5% decline in constant currency revenue, more than what the street expected. Stocks down about 2%. So those are the sharp earnings reactions. Okay, now let's move on to the rest of the market. TCS up and about, Tata Steel, Shriram Finance, Maruti, these are your gainers. L&T, so some buying in auto. M&M is also higher. Maruti is higher. Maruti is reporting numbers today. There's Coal India, which is nudging some gains. JSW Steel, Hindalco. So basically, metals and commodities seem to be doing quite okay. HDFC Bank is up about 0.7%. ICICI Bank is up 0.5%. The Bank Nifty is absolutely flat. And that's because of the downward drift that Axis Bank and IndusInd Bank are putting on the index. So that's where the weakness really is. Otherwise, the market seems to be okay. Some little bit of buying on names like SBI, Trent, even Eternal I saw. Eternal is up about 0.5%. But the problem is Axis Bank and Tech Mahindra for the Nifty for the time being. Nigel.
Well, that's right. From the broader markets, you have an accident in Cyient. That's down close to 9%. So big downtick is what we're seeing out there. Vare Energy is out there. There's a lock-in that's opened up. So, a lot of those shares are being eligible to trade. So that's why you have that stock that's down close to around 4%. Actually, from the lows, it's seen a bit of a recovery. So we'll keep an eye out on that stock as well. Sterling and Wilson, the stock is down close to around 2.5%. All these stocks highlighting them because they're moving on very, very large volumes. Patel Engineering, well, that's up close to around 5.5%. So big move out there. IEX, the numbers appear pretty much subdued. Remember, this stock has seen a sharp correction from the peak. So you have the stock actually that's opened up the gain of around 4.5% and doing pretty well on large volume. So good move is what we're seeing on that particular name. But clearly the casualty from the Nifty pack this morning is Axis Bank. The low of the day is around 1,160. It'll be interesting to see whether or not we see a bit of a pop from the day's low.
Speaking of casualties, we have lots of result casualties today. You pointed out Cyient, Nigel, which is down 9%. Look at L&T Tech, 6%. Look at SBI Card, down 4.5%, 5%. And then obviously Axis and Tech Mahindra from the large cap space. So lots of oops moments on the earnings front.
No, absolutely. And, Bharti went up that 15% move day before yesterday. It's already given up 10% in the last, between yesterday and today, since the lock-in opened yesterday. So 27.34 on Bharti. It's like yesterday, it's the number one volume-led sort of loser on the NSE. It's a lot of volume action happening here. Axis is down 3. I think the bulk of it we've mentioned. Axis is down 3. Cyient, Loris, SBI Card, LTTS. Sterling Wilson Solar is down about 3%. I guess about E2E has got some volumes in it. Last 2 days, 5% every day. Syngene was the big loser yesterday. Syngene was down, I think, about 10% plus. It's down another 1.33%. Numbers were disappointing. Keynes, Bajaj Housing, K Fintech, Blue Star. Blue Star, by the way, was down 4 yesterday. It's down another 2. Actually, it's come off quite sharply, very, very quickly, right? And you'd think it's the summers. High is 2,100. Day before yesterday, it was at 2,100. It's at 1,800 now.
Down 10% this week, Prashant.
Yeah, there was that. Anyway, we'll talk more about this. Motilal is down about 2%. Reports numbers. Newgen is down about 3%. 361 ever since the deal was announced. Again, the high was 1,068, 1,070. Stocks at 990 now. This is the third day. So deal was announced day before yesterday. Spandana is down about 4%. Spandana had a decently large move yesterday on the upside. So just reversals across the board. And market breadth now a little firmer on the downside. So 1,300 stocks are down and about 850 stocks are higher at this point. By the way, Lodha is up 3.5%, and you'll hear from the management in about 10 minutes' time. So that should be an interesting one. Well, let's welcome in Rahul Arora of Nirmal Bang Institutional Equities. Rahul, good morning. Great to have you with us here. So what are you making of it, Rahul? It's every week is new and varied and entertaining, but prices have snapped back in a very aggressive way over the last 8-9 days.
Morning, Prashant. Thank you for having me on the show. Yes, I think the initial reaction may have been overstated on the tariffs. The pullback is equally surprising. I think what you guys were discussing before we just started our conversation is the reality. We are still in the midst of an earnings downgrade cycle. I think let's put it into perspective, Prashant. We're still in the first month of the fiscal. The whole year awaits us. Let's just break it down. I think if you look at banking, at best we'll do a 10-12% earnings growth this year. Consumer staples will be lucky to do that. Reliance will probably be around that 10-12%. And IT is a big question mark because I think we'll get more clarity in the Q1 results about how the year is likely to shape out vis-a-vis what we've already seen. My sense is this is 75% of the Nifty. I'd be surprised if this 75% gives you 10% plus earnings growth for this year. The balance 25%, even if it grows at 15%, just on a weighted average basis, you'd be lucky to get to a teens earning growth for FY26, which basically means you are still, as I said, in an earnings downgrade cycle. Now, the point is at 27,000 Nifty, the valuations were at whatever, 23, 24 times. It dropped down to 18, 19 times depending on where you were. But I don't think the extent of earnings cuts has been factored in. So it is very possible that in a month or two from now, the valuations, even if they're at 24, start looking very similar to what they were on 27 because the denominator gets cut to that extent. I still think that this is a great rally, honestly, to be selling into. There is no justification for it to have bounced back. I think pretty much everything that the market wants to know, it knows. It knows that the worst of the tariffs is behind. It knows the Fed will probably cut another 50 bips. It knows the RBI will probably cut 50 bips. The US yields have factored that in. The Indian bond yields have factored that in. The one interesting thing, Prashant, we were looking at the data for the last 10 years of which asset classes deliver the best returns. And for as much as people diss gold, 7 out of the last 10 years, it's been in the top 3 in terms of best returns of asset classes. And 4 out of the last 10, it's actually been the best performer. So I think even from an asset allocation standpoint, a little bit of movement into the yellow metal may not be a bad option at this stage. So
even after a 35-40%.
Yeah, so we actually hosted the World Gold Council executive strategist for our institutional investors just after the tariff announcements were made. And he felt that gold could return 15-20% this year. It's up about 8-9%. So you're still talking about a 10% plus growth. Now, superimpose that, can you potentially get 10% on the Nifty from here, which is basically taking you back to new highs? So that's the call you have to take. I'm not saying go all in into the yellow metal. I'm just saying that some amount of diversification, given that valuations don't look as cheap. You were discussing Blue Star. Look at that. Just look at that space and where valuations had gone.
Which is why, Rahul, and now what you're saying, we've actually, in the last 24 hours, 3 or 4 market commentators have made that point as well. Vikas Jain's call this morning, the CLSA call, was exactly that India is benefiting from the TINA factor. Flows are coming in, but the earnings reality is something that people have perhaps ignored. I remember Dheeraj Agarwal from Ambit making that point on the show earlier this week as well. So that question, I mean, what is the earnings reality? And with that in mind, would you expect the market can at least get back to the previous highs? What is the upside from here?
So at the outset, Surabhi, let me tell you, I'm very shocked to see that the market is where it is. So if it goes to new highs, I'll be even more shocked. So it's as simplistic as that. Like I was telling Prashant, I don't think the earnings reality is more than, you'd be lucky to get to a teen number. And I think even if you look at banks, which is the big elephant in the room, I don't think you'll get to a teen number even in FY27. Now, in that backdrop, keep aside IndusInd because of what's happened. If you look at Kotak, ICICI, HDFC, they're all back into that 2.5-3 price to book. Now, for the ROA and ROE profile that they have, this is more than price to perfection. If you're going to look at growths of 10-12%, why should you be paying more than 2.5-3 times price to book on FY27 when you're sitting at the start of FY26? So it is going to be challenging. But then, as you said, if flows keep coming in, it's what took the Nifty to 27,000. I think the tariffs were just an excuse, Surabhi, to reset valuations on the way down. So while the movement may have seemed exaggerated on the tariff news, the stock prices were not misbehaving irrationally. There was a genuine reset required. The market just latched on to that piece of news to reset valuations to a very large extent. That being said, I still don't think they are anywhere close to favorable in consumer staples, in IT or in banks. I think in all these three, you cannot give a screaming buy. IndusInd seemed like a no-brainer after the news because the valuations had dropped to rock bottom and the bank was not going anywhere. It was one, news item or whatever for the size of the bank. But those kind of trades will be few and far between. This rally has been led predominantly by banks, if you see. So the question, I would be more positive on the FSI space, not the B space. So I would look at auto finance, I would look at life insurance, I would look at general insurance, housing finance companies. So anything NBFC, because growth is still there, valuations are not cheap. You were discussing Maruti's numbers today. Take a look at when Chola's numbers come in today. They will be growing 25-30%. So then they will get the valuation. It's as simple as that because market wants growth. So stocks may get mispriced on the way up as well. Look at what AU Small Finance Bank did. Remarkable set of numbers. So in an environment like this, if you have companies that are growing in the FSI space, you don't have to be overweight the B. You can sort of be neutral to underweight and go slightly overweight on the other aspect, is the way I look at it.
All right. Hi, Rahul. Good to hear your thoughts this morning. And clearly, you're sounding a little bit cautious, actually, because earnings are not going to pick up. You've seen a good run. And as you said, maybe this rally could be a good one to sell some stocks into. That said, do you believe that the lows for the year are done? Or do you think we can go ahead and revisit that? Because the globe is still in a flux. And earnings are unlikely to pick up to those mid-teens at least in this year. So do you think we revisit the lows?
I don't think we revisit the lows, Nigel. I think that the low that you had of about 21.7 or thereabouts, that will hold. Okay. I don't think we're going to break that. Now, can you retest it? India has gotten into a bit of a tussle with its neighbor in the last couple of days, so we don't know how that's going to pan out. That's an overhang on, whether there is a market risk associated with that. I was just reading Trump has put a couple of days back 3,521% tariffs on solar imports from the Asian region. So if these kind of irrational statements keep coming out, you may have, gyrations on either side, but I don't think there is a reason to retest those lows. But even if you do, I don't think they will break. So I personally think you're probably going to be in a situation where you'll take out this year in a broad range of 22 to 25,000 on the Nifty. You're at the higher end, which is why I said it's probably not a bad time to be taking money off the table. That being said, it's not all gloom and doom. There are still pockets where money can be made.
So give us a couple of those top buy recommendations. And as you said, you're splitting it up between the B and the FSI. So that's one space you like, the FSI. But if you had to give us a few stocks, top 2-3 stocks that y'all as a house are looking at.
So I think, Nigel, if you look at it top down, I think the only two sectors where we can, apart from the one that I mentioned on the FSI side, the only two where there is revenue growth and visibility is consumer discretionary and defense. Mm-hmm. Rest, nothing else seems like it can potentially give you that kind of returns from a growth and evaluation perspective. So within the FSI space, like I said, AU Small Finance looks good, Chola looks good. Max Financial looks all right. Mm-hmm. Even something like a Lombard or a Star Health. I think that, those are some of the stocks. Muthoot also could potentially be looked at. So I think those are some of the names on the FSI side. On the consumer discretionary, I think Alcobev is going to do really well. I think you've had a good run in UB and UNSP in this rally. Both are up 15-16%. But my sense is that they could still reset another 20% from here. Chalet Hotels looks interesting. We've obviously been positive from Indian Hotels standpoint for a while, but I think on a relative valuation. And in defense, we had upgraded Solar about 2 months back. The stock's done really well in the last 2 months since that upgrade. So I'd probably be forced to downgrade that to a hold, but because valuations, I've seen some of my competitors have initiated at 70p. So, that tells you that you're an irrational domain when you're valuing capital.
Solar
Industries. So, but I think solar is a good structural play. Hindustan Aeronautics. I think the one thing, if you look at the last 2 months, if you combine Army, Navy and Air Force, there is really 1.5 lakh crores worth of orders that's been awarded. So I think, Hindustan Aeronautics would probably be our top recommendation.
Valuation still okay after the correction?
On a relative basis, yeah. I think in order of preference, I think MDL also goes up there and we could even look at a BL or a BML. I think these would probably be the stocks that would probably do well. And from private sector, if you will, probably something like a Data Patterns, but not much else to look at in defense. Because I think all of these companies that I mentioned, we're reasonably confident of them growing between 18 to 25% on our numbers. And they'll have about a 300 to 500 basis point swing on the ROE and ROC. So on that backdrop, we're fairly comfortable sort of buying into these stocks and sectors.
Well, I recall we had the management of Solar Industries when it fell to around the 9,000, 8,500 level. And Mr. Manish, I think he joined on the channel and he said, no, we're confident that we will grow at the clip that the street is expecting.
This is the Pinaka orders, right?
Among others.
By the way, on a lighter note, today is a Friday. Movies, right? Do you guys know what movies coming out today?
No, I don't even know.
I know that Casey.
Oh, I know which one this is. The friend mentioned this. Andaz Apna is re-releasing. See, all these kids from the 90s, all of us would know about this.
It's an iconic one. I don't know if you just...
it's so funny that this movie actually bombed at the box office when it released. As did Agnipath.
Epic of our childhood.
There were so many of these movies that became cult classics later. But I think that's, when you talk about retail, I think it's an interesting one that you raise. Because, we do get asked this a lot as to why, retail and movies are struggling. It's a push and pull. Yeah. So most of these cinemas are in malls. So if the footfalls have dropped, it is going to have an impact on retail. And similarly, if people are not going into shop, they're not going into watch. So it's a push and pull if you see. And both are actually struggling. And if you see even in QSRs, dine-in is struggling, but delivery is not.
Yeah.
So I think there is a genuine challenge getting people out of their houses.
Yeah.
It is getting seen, and you've seen how Trend's numbers have, the way the stock price has corrected as well. So,
last Sunday I was at Phoenix Mall, and which is a lower parade for those who are not familiar with Bombay. I mean, I don't know, planning to watch a movie, but I had 2 hours to kill. I had to, so I went to PVR, saw a movie, an English movie called Sinners. No comment about the movie, but it was, I think occupancy was not even 20%. It was a Sunday. And Sundays at one point it used to be, you'd struggle to get a ticket. It's a decently rated movie on IMDb, etc. So I don't know. I mean, some of these re-releases maybe do better, especially because
I think you guys
content has become an issue, and I think the one thing that has changed, and I think that's the reason PVR stock hasn't done too much, is this release window between theatrical and OTT.
Yeah.
So it's now down to what, 6 to 8 weeks, I think, somewhere around that. People are, unless it's, like for people who have kids,
larger than life
like you have a,
content,
a Titanic or an Avatar or a Bahubali kind of movie or a Sholay kind of movie, which you have to take in the cinematic experience. People are okay waiting. And I think, I was just reading somewhere, of course, this may not apply to the mass it may not apply en masse, but Suits is coming back through Suits LA now, with Harvey Specter back. Now, if somebody is a fan of that, now just imagine the binge watching. I'm just giving you an example. So it's content. Content
I didn't
is
know
not just
this.
getting.
This is a good cue.
So content is not just getting rehashed on cinemas, but even here. So that's probably the only part of consumer discretionary that we'll probably be underweight on, which is the movie space. But who knows? I think
I watched Interstellar last, and I think now this is going to be.
I think you guys should watch Raid 2 next week. If you all want to go, we can go together. And I'll tell you, Raid 2. Raid 2. And I'll tell you all in the break why I'm going to watch it.
He has to say all in the family. There's a disclosure.
Since we're talking about movies, I'm going for sure.
There is a famous line in Khalnayak, right? All in the family. That's what he's going to tell you in the break.
All heart.
All right, Rahul, fabulous conversation as always. You've lightened up our Friday. Thank you for stopping by.
Thank you for having me.
Though, of course, the caution on the market is, of course, very well taken. The market, for the time being, holding on just about 40 points up on the Nifty, but the Midcap index is sliding. Bank Nifty also under pressure, down about 0.3%.
Well, that's right. Well, let's get straight to the next management we have on the show. That's Macrotech Developers. The stocks on our radar, the company reported a pretty good set of numbers, actually. The collections rose by 26% on a year-on-year basis, along with a healthy surge in the profitability. They have guided for around 21,000 crores of pre-sales in FY26. To discuss this and more, we're now joined by Mr. Sushil Kumar Modi, the Executive Director of Finance at Macrotech Developers. Hi, sir. Good morning. Thanks a lot for joining in. The street likes your numbers and the guidance they've given as well. Before we get number specific, tell us on ground, have you seen any kind of slowdown in terms of demand? Have footfalls reduced? Or is demand as strong as, say, what we saw 3 or 4 months ago?
Hi, Nigel. Good morning. Nice to be on your show. Now, as you can see, the last year number itself speaks about the structural strength of our industry and the branded participants in the industry, how the consolidation is playing out, and which is where you would notice that we have outperformed all the matrices on our guidance, be it the pre-sales, which has grown by 14% this quarter to 4,800 crore. And for the year, we delivered 17,600 crore, outperforming our own guidance of 17,500. Embedded EBITDA margin on the pre-sales also came out at 33%, again outperforming against our guidance of 31%. Thereby, the embedded EBITDA on the pre-sales turned out to be 5,900 crore, delivering 35% growth. So, again, if you take it on the business development, we guided 21,000 crore. We outperformed significantly by around 12%, delivering 23,700 crore across 10 projects and obviously across the 3 cities that we operate in. So net, and as you rightly said, the collection represents the execution capability. The pre-sales is one, but the execution capability converts those pre-sales into the hard cash, and that is where our operating cash flow was dot on guidance, delivering 6,500 crore. And if you relate this strength of the operating cash flow and combine alongside the fact that we did significant business development, thereby meaning a significant investment, our investment this year was 7,000 crore plus the construction cost of 4,200 odd crore, means income total 11,000 odd crore of investment, yet we could deliver the very conservative capital structure where the net debt to equity is at around 0.2x, significantly below our guided number of 0.5x. And this is what has kind of enabled us to get to the credit rating of AA, which is at the beginning of the year we were at A+, and now we are at AA by CRISIL. So net, the trajectory of our business in the full year, we are pretty much on track, and that is what has given us the confidence in terms of, as you pointed out, guiding for the next year, growing by 20% to 21,000 odd crore.
Yeah, I'm looking at that guidance, 21,000 crores in pre-sales. Your launch pipeline is 31 million square feet, gross developmental value of about 18,800 crores. Give us some sense also of pricing, Sushil, and margins, because in Q4 your margin improved quite a bit. I think I'm just checking the numbers. I think it came up to 28%, if I'm not mistaken. 28.9%, that's almost 29% margin as you've ended the year. Is this sustainable? And, does the market have some room, some scope for price hikes?
Hi, Survi. Morning. No, you are right. So as I said, we delivered our embedded EBITDA margin on the pre-sales at 33%, and so is our guidance for the next year to be 33%. And this is pretty much in line with what we have, time and again said, that we look for delivering 30% plus of the EBITDA margin. And our industry and the product is such where a reasonable price increase is always being appreciated, be it by the existing owners of the asset or the new buyers, because so long the price growth is more like below the salary growth of the consumer, it only enhances the affordability metrics, right? And which is where the demand gets consummated, which in any case is structurally very strong. So we clearly see that so long the price growth we carry to the tune of 5, 6, 7%, knowing well that the salary growth in any case in our country is more like 8 to 10%. That kind of only entices the demand to consummate, because people find it affordable to consummate their basic necessity, which is housing. So yeah, thereby as you have seen, be it last 3 years, year on year, we have maintained the trajectory of price growth in the ballpark of anywhere between 5 to 6%. We clearly see that similar thing happening, in the upcoming year as well.
Morning. So you're saying price growth of 5 to 6% possible?
Yes, Prashant. Yes.
Okay. So you put out all the numbers, etc., and we can talk more about that, Sushil. But there are two players who are very, very aggressive in the Mumbai market now. Actually new players. One is Adani. They're buying up a lot of land parcels, very aggressive. And the other, of course, is Prestige, again going full tilt. Could you give us a sense of how this is likely to change the landscape? I mean, will it still be volume-led push in terms of growth, or will you recalibrate that a little bit as things go forward? What's your sense? Will it be more consolidation and kind of sort of protecting your margins, or will it be full tilt on volume growth?
Prashant, you rightly used the phrase consolidation. So our industry, post-COVID is seeing a dual consolidation actually. Be it on the demand side, where consumer having burned their fingers big time in the pre-COVID era, buying from tier 2, tier 3 developer, the entire saving potentially has got lost, never even delivered a product. So the consumer in any case is now absolutely gravitated towards only buying from a top-notch brands. That's one. And so is on the supply side. So, even the land effectively end up in going to the top-notch brands like Lodha. So these kind of consolidation on both front is not really been seen across many industries, perhaps to my knowledge. So you can see in any city that in our country, across the top-notch brands are performing good. The people going from one city to another city, that will be an ongoing affair, and obviously that every participant will have different strategy in terms of growth. How many cities that they want to operate. in our mind, the business is, reasonably reasonable, and thereby, we should be going more and more deep into any city that we choose rather than being wide across lot many. So yeah, more the participants that come into any particular geography, and so is, as you know, we have gone to the Pune and then to the Bangalore, right? So that only leads to the consolidation effectively is strengthening more and more. By now, perhaps the consolidation in the industry has already reached to around 30%, and there is no reason that it should not go towards 50% plus in few years' time.
Sushil, one more question specifically on the Mumbai market, and this stems from a note that Nuvama put out, not on you actually, there was a note on your peers, Oberoi Realty, and Nuvama was pointing out the risk of high inventory and whether inventory can be liquidated quickly enough or not. Give us just your overall, pan-India inventory position right now and the estimated timeline for liquidation. And in Mumbai itself, is inventory pile-up becoming an issue?
So we actually, the situation is quite reverse. We, in our industry, typical gestation period to deliver a project, is anywhere around 3.5 to 4 years. And the situation has come to the extent that the inventory levels across the, top 7-8 cities has gone down to below 2 years. Mumbai, perhaps it will be more in the range bound of 15 to 18 months. And so is the journey in, other cities. So really challenge is that, the inventories is only depleting, and obviously we will not be able to comment about any specific participant, how the inventory level with those participants are. But as we know, as a city level, the inventory level has gone down significantly, and which is where the consolidation comes into effect. Because now, from a new supply standpoint, when you look at how the industry is playing out, effectively, perhaps the consolidation in terms of the new supply has gone beyond 50% already.
Sushilji, very quickly, you're not sounding too perturbed with regard to demand, but where is demand better, mass or premium?
See, Nigel, this is across, right? Because housing at the end of the day is a necessity. So, obviously the affordable and the entry-level segment has somewhat got impacted in last 18-24 months because of the rising interest rate, where we know the repo rate has gone up by 250 bips odd. So to that extent, the entry-level did got suffered, but which is where the tailwind now, right? So as the reverse trend on the interest rate has commenced and the 50 bips has already gone down, and perhaps maybe another 75, 100 bips, whatever comes, that will only lead to strengthen this segment of the market, which was so far kind of not fully getting unfolded, and which is where Lodha gets an edge, because we are the only participant who perhaps cater to the entire segment, be it the entry level, mid-income housing, to the premium housing, to the luxury housing. So the business model of ours being so diversified, in terms of the audience, the segment that we cater to, the various locations that we cater to, we delivered 17,600 crore, but more important is we delivered from 642 odd locations, which means on an average, an individual locations effectively delivers 500 odd crore of sales. So that means we are neither dependent on any individual segment, nor are we dependent upon any city, or nor are we excessively dependent on any location. So that brings the resilience and the robustness of the business model that we have, and which is what then gives us the confidence, in spite of whatever global macro playing plus and minuses we reckon that. But nonetheless, we feel that our resilient business model should be able to deliver 20% growth in terms of the pre-sales in the next year.
Absolutely. Sushil, take your point. Diversification, always a good thing. Thank you so much for joining in. Have a good day and good luck with the year that we are in now. Okay, as we move on, now let's take stock of a story that was flashing on the screen just a while back. You saw those ticker lines on rare earth magnets that we are importing from China. And it seems China is putting certain new or additional regulatory requirements for sending those magnets to us. Let's go across to Parikshit to figure out what this is all about and whether it impacts the EV ecosystem. Parikshit, what is this story all about? Tell us more.
Well, we hear from sources that the EV ecosystem in India, component manufacturers have already started getting impacted. They are facing production challenges. This is because these rare earth magnets are a very critical part of traction motors, which go in electric vehicles. So what exactly happened is this. the Chinese government, effective from the 4th of April, has said that every company which is importing these rare earth magnets from China must get an end-user certificate, and that end-user certificate has to be given in a prescribed format. This will, first of all, mention that the magnets will not be given to any third party without the consent of the Chinese government. Secondly, they will not be used for making any weapon systems. And thirdly, they must have a dual authorization, not just from the Foreign Ministry of the Indian government, but also from the Chinese embassy here in New Delhi. So this seems to be a clear non-tariff barrier, which complicates things for OEMs. They will have to get these documents notarized. They will have to go to several levels of approval. We believe that the auto industry and auto component manufacturers have already reached out to the government for help, including the Ministry of External Affairs, and different nodal ministries for the automobile industry are looking into this matter, including the Ministry for Mines, Ministry for New and Renewable Energy, Ministry of Heavy Industry, and all of this is being discussed at the highest level, because clearly if this problem festers, then there could be a slowdown in terms of production and more production hiccups in the EV industry along the way in the next few months.
All right, Parisha, thank you very much for that. So that is the overall sort of China, the trade tensions. And I mean, a lot of this will happen with regards to individual components, and a lot of this, of course, will be posturing, etc. as well, to be able to arrive at specific agreements down the road. So fluid situation, 70 points lower, by the way. And this is, I guess, this seems more, what we have in the market now with a 60-point cut seems more natural as opposed to a 100-point gain today. Even with the 2.5% pop that we saw last night, it just didn't feel, right opening up 100 points. But we'll see if things recover once again as we head into the rest of the day, into the weekend as well. 24,200, 24,183 is where you have what you have on the Nifty at this point. We take a quick commercial break here. We're going to come back and put the focus on the auto space. Sud will tell us the expectations from auto companies, and we'll get into a discussion with the analyst from Macquarie. Stay with us.
Welcome back. Well, let's put the spotlight on Quarter Se Quarter Tak, our special segment where we prep you up for earnings from different sectors. The sector that we're putting the spotlight on today is the auto space. So Darshan is here with the curtain raiser.
So the Indian auto sector has faced a turbulent FY25 with overall sentiment subdued, particularly during the second half of the year. Macroeconomic headwinds, uneven rural recovery, regulatory challenges and shifting consumer preferences have all contributed to the sector's volatile performance. For the last quarter of FY25, that is Q4, divergence in growth projections is becoming increasingly evident, with estimates ranging widely from a modest 2% to a robust 23%, reflecting varied expectations expectations. Let's begin with the reported volume numbers across key categories. On a YOY basis, tractor sales have emerged as the biggest outperformers, aided by relatively stronger rural demand. Earlier in the year, however, on a sequential basis, the same tractor segment has witnessed the sharpest decline, indicating weakening momentum and seasonal moderation. Excluding tractors, most other segments have posted modest year-on-year growth. Two-wheelers and three-wheelers have seen low to mid-single-digit growth YOY, with sequential declines driven by soft rural demand, higher base effect, and limited festive tailwinds. Passenger vehicles and commercial vehicles, in contrast, have reported sequential growth, with PVs benefiting from strong demand for SUVs and new model launches, and CVs gaining from infra construction-related activities. On the revenue front, the overall sector is expected to post around 10% YOY growth. In Q4, however, as with volumes, the revenue performance will be far from uniform. The two-wheeler segment is expected to show the widest range in performance, with estimates varying from 2% at the lower end to 23% at the upper end, depending on product mix and pricing power. Four-wheelers are projected to deliver double-digit growth, supported by a strong mix of premium and mid-segment offerings. Notably, tractor segment is expected to outperform on a revenue basis, with an estimated 20% YOY growth, largely driven by pricing actions and earlier demand strength. Amid this uneven landscape, certain players are expected to emerge as outliers in terms of performance. In the two-wheeler space, TVS Motor and Eicher Motors are likely to surprise positively. TVS is benefiting from urban recovery and premiumization trends, while Eicher continues to gain traction through Royal Enfield's steady domestic and export performance. Amongst four-wheelers, M&M stands out with its strong SUV portfolio, robust order book, and agricultural equipment division contributing positively. Within auto ancillaries, Samvardhana Motherson is positioned to be a sectoral outperformer, aided by global diversification and increased content per vehicle. From a valuation standpoint, the sector appears relatively attractive. With a few exceptions, most auto companies are currently trading at or below their 5-year average price to earnings multiples. And as far as stock performance is concerned, except TVS, Eicher, Maruti, and Ashok Leyland, all the companies you can see on your screen have given negative returns in 2025 so far, with biggest declines seen in auto industry names on the back of global uncertainty. Let's wrap with the outlook. In the near-term, outlook for the sector looks optimistic. The anticipated implementation of the 8th Pay Commission and income tax reliefs are likely to aid the growth for two-wheelers and lower end And for the tractor segment, Met Department has predicted above normal monsoon for current year, and that is likely to boost rural income, leading to an increased demand.
Okay, all right, Sudarshan, thank you very much for that comprehensive wrap. So that's how we're looking at the Q4 season for the sector. Let's take the discussion forward with Ashish Jain, India Mobility and Materials Analyst at Macquarie Capital. Ashish, great to have you on the show. Thanks for joining in. So, in a broader context, this is a market that's hungry for growth, and largely speaking, the auto sector has not delivered large parts of the sector, barring stocks like a Mahindra and Mahindra. And then we've had brief flashes of a great rally, let's say on a Bajaj Auto, but otherwise growth seems to be missing. Do you see that changing anytime soon? Let's start with the PV space, where I don't remember, we've been looking at anemic single-digit to flat trends for the longest time.
Thanks, Obi. Thanks for having me on the show. Like you rightly said, fiscal 25 has been a tough year for PVs. We started off on a slightly weaker footing. We did see a very solid spike during the festive, the 20-25 days of festive, and then things have been southward after that as well. But I would want to contextualize this. If you look at the longer-term growth rate for PVs in India over a 3-year, 5-year time frame, it's been in the range of 5 to 6% CAGR. And some of the slowdown that you saw in fiscal 25 is also because the preceding couple of years were very, very strong. We witnessed 15%, 20% kind of growth post-COVID. And if I look at the data, from let's say fiscal 19 to fiscal 25, we have grown in term with the longer term trends of 5 to 6% growth. So honestly, some of the growth slowdown that we saw, was expected. Yes, it is further accentuated to some extent with slightly weaker demand in the entry segment, which I think is partly a function of income levels, with the entry level customer. But yeah, I would say F25 has been a bit muted, but not very disappointing versus what we were factoring, at the start of the year.
Ashish, on PVs, barring Mahindra and Mahindra, it's been an outlier, best in class. But barring this one today, for instance, Maruti reports numbers, as Hyundai as well. Would you be willing to, look at a buy on any of these stocks, hoping for a revival or a turnaround? We all spoke about this 1 lakh rupees in the hands of the common, taxpayer at the end of the budget, but it needs to show up in numbers, and so far it hasn't.
Right. So, I would approach it very stock by stock. On a top-down basis, we still think fiscal 26 will be low single-digit growth for PVs. We are factoring around 3 to 4% growth for the industry on an overall basis, and that does factor, like you said, some benefit of the income tax cut. But within that, we still like Mahindra and Mahindra. It has been our top pick, and we think it will continue to benefit from model cycle tailwind, which has been quite favorable for them. And now even EVs, EV launches will also add to their volume growth. And in addition to that, M&M also has a tailwind from fairly strong tractor cycle as well. So M&M is what we really like in the PV space as of now.
All right. Hi, Ashish. Good morning. Good to see you on the channel. And thanks a lot for joining in. We have a couple of other sectors of interest as well, like materials. But for the time being, let's stick to autos. We have another IPO that's coming in from the EV space. That's Ather. We know what happened with regard to Ola. There was a lot of interest. And then investors, they bought the brand because things didn't really pick up. Now you have another IPO that the street is looking forward to. A relatively smaller player, but financials are relatively better, I would say. Your take on the IPO, what kind of valuations should investors be looking at? Do you think it'll be far better?
Yeah, thanks, Nigel. Thanks again, and good to speak to you. So clear, honestly, valuations and all is something I would refrain from commenting, but do want to make a couple of points here. One, Ather in the last few quarters have seen fairly strong traction with some of the new launches. If I look at the Vahan data for April month, which is a publicly available data, their market shares have improved to around 14-15%. So clearly, they are seeing strong traction, and we did, kind of attend their analyst meet. One of the very interesting points which the management said is currently nearly 2/3 of their volumes are coming from South versus around 1/3 for the industry. And going ahead as they expand into other regions, their distributions into the other regions, they expect to kind of do well from a volume point of view. So I would honestly leave it at that as far as Ather is concerned, given we are not kind of covering the stock at this moment.
What about other two-wheelers, Ashish? I was looking at the price on Bajaj Auto. It's come off significantly, right? From levels of 12,000 to now, I think last we checked was, we're talking 8,100 this morning. That's a 35% decline from the peak.
Yeah, so in two-wheelers, our top pick has been, TVS, and we continue to like TVS. They have gained market share in scooters, in motorcycles. Exports also have, recovered quite strongly for TVS. And I think it's one company where, in spite of whatever commodities are doing, we are convinced of a margin expansion. So that remains our top pick. Coming to Bajaj, I think two things have happened for Bajaj. One, the traction for their CNG motorcycle has been slightly subpar versus what we were factoring at, at the time of launch. And secondly, even in 125cc, which remains, a very compelling segment for Bajaj, we have seen heightened competition with production normalizing for Honda. So there also they have lost some market share. Having said that, we like their traction in e-two-wheelers. They have done really well to scale up volumes. They're now the sector leaders. So I think, near-term Bajaj stock could remain range-bound. Also, one thing from an export point of view, if you look at the recovery in exports, TVS actually has done much better than Bajaj in terms of the trajectory of recovery. So there has been some disappointing on CNG and exports, partly offset by strong traction in e-two-wheelers. But yeah, we'll stick with TVS for now as far as our two-wheeler pick is concerned.
Okay, so TVS in two-wheelers, M&M in four-wheelers. I go back to that growth question, Ashish, just in terms of a pickup, and we've not even discussed CVs because, again, I don't remember the last quarter, we really saw a move on the CV cycle with the Ashok Leyland's numbers. Stocks completely sort of gone off the radar. Do you see any of these pockets turning around soon? Tractors, absolutely, and tractors have started showing that pickup, which is why M&M is your top pick. But apart from, M&M and tractors, anything else?
Yeah, so if you look at Vahan data for April, it's just like 3 weeks into the year, but still, two-wheeler is showing a decent recovery, on a month-on-month basis. So I think that's the positive sign. Again, too early to call out a full year thing, but for the full year, we are factoring around 7-8% growth for two-wheeler. And we also believe that two-wheelers will be the bigger beneficiary of the tax cuts that goes effective April this year. So we are quite constructive on that space, like I said, led by two-wheelers, led by TVS. And as far as, CVs are concerned, last year was a bit lackluster. I think first half, the bases are low. So that would make the headline numbers look, decent for CVs. But yeah, on a full year basis, we are still sticking to 1 to 2% kind of growth for CVs as a segment. And with commodity doing what it is, we could also see some margin pressure at the margin. And hence, clearly CV is not something which is our focus at this point of time.
All right. Got that. Thank you so much for joining in, Ashish. Good conversation. That's the auto space. But we need to look at the overall market. Look at the market-wide slide. Now, India today, this morning, is standing out as a sore spot in the global context because global markets are soaring. The Japanese market 2%, Hong Kong over 1.5%. China is also up 0.25%. And we are underperforming in a big, big way. So this heady rally that we've seen from the lows, it seems there's a hectic profit taking that's underway. And it's market-wide, like I said. It's across sectors. It's across market capitalization. The Midcap index is now sliding 2.3%. And it's become one of those mornings where the advanced decline ratio is extremely, extremely weak. Let's pull up Midcaps and the advanced declines. You only have 220 stocks advancing in the market at this point in time. Big slide. Let's get the crisscross lines in. It seems, Prashant, maybe, I don't know, book profits, had a great rally, take it home, enjoy the weekend. Monday ko dekhenge. Is that it?
I think so, Surabhi. And there is this, I think there is a real sense of trepidation about what may happen because of the Pelgam attacks as well, right?
Yes.
Will there be military escalation, etc.?
Yeah.
So many people that I've spoken with off the air have asked me whether we are hearing something.
Yeah. Yeah.
And we had Parikshit, of course, sort of with information about what the government is, on what lines the government is thinking about. So there is that. But even, and we, by the way, came into this very, very unfortunate event with the market, which was already up some 12-13%, in the prior 7-8 trading sessions. So prices have snapped right back with no real visibility of earnings improvement or anything. So it's a combination of things. It always is. But we are now down about 300 points or so. Mitesh is with us to run us through just the price action and what he'd do now. Mitesh, your sense?
Yeah. So Prashant, I was talking about the fact that with the GIFT Nifty going up, we might not get an intraday decline today, but that's actually happened. Given the fact that we are heading into this strong support zone of around 23,900, 950, I think this is the area where you would want to venture and take some long positions, slowly accumulate from these levels till about 920. So you have a 40-point window to slowly accumulate long position on the Nifty and keep a stop just below levels of 23,850. So that is the way I'll approach it. I think this is the dip. See, we were quite overbought and there was always a chance of it coming down. But the only thing is that we don't know which day it will happen. I think it's happened today, and now is the time to slowly get into long positions on the index as well as stocks. So that's the view on the Nifty.
And you're saying, Mitesh, this thesis holds. I mean, you take a long trade till 23,850 holds, right? That's your
23,900 to 870 is my support zone. So I'll keep a stop about 20 points below that and slowly accumulate from these levels all the way down till about 23,920.
Okay, so that's the index strategy. What about stocks, Mitesh?
So on stocks also, given the fact that there are stocks which are giving pullbacks, I think this is the time, where you would want to explore and get into some long positions. Disclaimer, we have a position in Mahindra and Mahindra on the call option side, so there's a bullish bias, but this is the dip you would want to buy. Keep a stop just below levels of 28.20, so about 32 points from here, and look for a target in excess of 29.50. The other one which I am looking at is Steel Authority. Steel Authority has also come back from the recent swing highs of 119, 120, around 114, so about a rupee lower from here. Buy with a stop below 112 for a first target of 120, and if we start closing above that, then we can look at even higher levels.
Okay, all right, got it, Mitesh. Thank you very much for that. We need to head into a quick break. Come back on the other side, and we'll have lots more lined up for you. Back in just a moment with all the stocks on the move.
Okay, welcome back. 260 points lower on the Nifty is what you have, 23,990 at this point. That's a sectoral watch, and mostly everything is down between 1% to 3.5%. And the media sector is, of course, very small as in terms of capitalization. But look at healthcare, real estate, those are bigger sectors, and there you have 2.5% cuts. Axis Bank reported numbers, stocks down about 3-4%. Abhishek is here with a recap. Abhishek.
Prashant, to begin with, they saw a weak business momentum on a YOY basis. So deposit growth at 9.8% YOY is the second lowest in last 16 quarters, but 7% quarter on quarter is the best in last 8 quarters. Advances growth were weak at just 7.85% is perhaps the lowest that you are seeing on a YOY basis in last 16 quarters. Sequential growth was just 2.5% over there. So weakness was seen in couple of portfolios like housing finance as well as auto segment for them. Cost to income ratio is at 5-quarter high of 47.8% versus 46.2% in the previous quarter. The good part in the result was the asset quality. Slippages declined on a sequential basis by 11.5% to 4,800 odd crores versus 5,400 odd crores in the previous quarter. Asset quality improved thanks to high write-offs. The write-offs in this quarter was the highest in last 16 quarters. So gross NP ratio came down to 1.28%, which is the lowest that you are seeing in last 39 quarters. A risk-weighted asset to advances ratio, that's the highest in last 5 quarters, meaning that risk in the balance sheet has been built up slightly. So it was at 111.4% versus 109.8% in the previous quarter. P&L with reference to our poll, the NI was in line with our poll, and thanks to lower provisioning, the PAT beat our poll. Back to you.
Okay, all right. Got that, Abhishek. Thank you very much for the details over there. On that note, we'll move on, take a quick break, come back on the other side with our special segment, It's the Economy. Lata will be in conversation with the Krishna Srinivasan of IMF on the steep cuts to Asia's growth forecast by the IMF.
The IMF has just cut forecasts, growth forecasts, that is rather sharply by 0.5 percentage point for world GDP. Thanks to the tariffs and world GDP growth, according to the IMF, will now slow to 2.8% in the current year from 3.3% last year. Asia's growth slows even more sharply from 5.3% last year, 2024, to 4.5% in 2025. Though India is relatively less impacted, IMF has cut India's GDP forecast for the current year to 6.2% from its earlier forecast of 6.5%. Joining me to discuss the IMF's fears and forecasts with respect to Asia is the Director, Asia Pacific Department at the IMF, Dr. Krishna Srinivasan. Let us assume that there are some understandings, negotiations between Asian countries and the US. Do you think this is the worst forecast? Do you think we may perhaps have a better growth rate if negotiations succeed?
So, Lara, if I could just back up a little bit. So we have a growth forecast for the world at 2.8% for this year, and for next year, it's 3%. This is a cumulative reduction of about 0.7 percentage points relative to where we were in October of 2024. Now, these forecasts are based on the tariff scenario which prevailed on April 4th, right? So based on that, these are projections. Now, these projections take into account the trade tensions, the heightened uncertainty, and a tightening of financial conditions. The question, of course, is, since then, there's been a pause in tariffs. So that is something which we don't take into account in this scenario. Of course, if countries reach agreements with the US and so on, then you could see a better forecast, but that would be an upside risk. But there are significant downside risks to the forecast here because there's what we think is very high uncertainty, right, in terms of these trade agreements, how soon they'll be reached, what will be the terms of it, how will it affect various regions of the part of the world. So all that is up in the air. So there's a huge amount of heightened uncertainty. There's a lot of, what I would say, financial market concerns. So all that put together is significant downside risks to our forecast.
That's what I'm worried about. I'm not worried so much about the upside risk. That would be welcome. But what about the downside risks to your forecast? I'll tell you why. Even if we reach negotiations, it appears that the US will go with 10% on all countries. That hasn't been removed. And that 25% on steel, aluminum and autos stands. And of course, bigger tariffs on China. Therefore, if you compare to the pre-April 2nd period, at that time, US tariffs were 2.5%. Now it looks like the average is 25%. That's massive. So do you think we'll get away with even a 2.8% growth for the world and 4.5% for Asia? Or could it be worse?
So one thing is, as I said, these are based on April 4th tariff scenario. And from there, we see significant downside risks. It all depends upon what kind of trade agreements are reached, what kind of, how does it, between countries, how does it affect the whole issue of trade? I think that's all an important factor which goes into seeing how the downside risks materialize. Now, one point which I want to correct, Lata, is for Asia, we have for 2025, we have a growth rate of 3.9%, which is significantly lower than what we had in October, about 0.5 percentage points. And for next year, we have 4%. So if you take the 2 years put together, we have lowered our forecast for Asia under the reference scenario by 0.8 percentage points. And that's a significant markdown. I think I would say this is the sharpest markdown we have for Asia since the pandemic.
Mm-hmm. Oh, yes, that's true, because they were the countries most targeted for higher tariffs.
It's not just the tariff, Lata. The fact is, a number of Asian countries were dependent on export of goods, and many of them had very sharp exposures, significant exposures to the US. If you think of the ASEAN countries, for instance, there were many countries where the share of the exports to the US was as high as 40%, for example, in the case of Cambodia. So those countries are affected quite significantly, on top of the fact that these countries were also hit by high tariff rates. So it's a combination of exposure to external demand and the high tariff rate across many countries in Asia, which explains why our forecast for Asia is even more revised down compared to other parts of the world.
Yeah, by the same logic, India's growth has been cut less, simply because we are not an export-oriented country. But do you think, if not this year, at least next year, we will have some upsides because of investment relocation?
So that's definitely possible. In terms of, if you think in terms of, we've been talking about China plus one for a long time. So if India benefits from that, that could be an upside risk to growth forecast for India. But again, that said, Lata, I think one thing which I would like to point out is we are worried about, even though the numbers for India have been revised on modestly compared to other parts of Asia, I am worried that private investment is still pretty lackadaisical in India. And if you look at parts of private investment, which is, say, investment in machinery and equipment, which adds to productivity in the economy and so on, that's been pretty sluggish. So if you really want to benefit from this, private investment needs to pick up. And for that, there are many things which are needed, including greater trade liberalization, fixing of our labor codes, boosting infrastructure and so on. So yes, India can take advantage of the opportunities, but for that, there has to be a handoff from public to private investment. That isn't happening to the extent that we would like in India.
Oh, yes. Private sector itself has to invest much more. Krishna, let me just zoom out a bit. I'll come back to India. This US bond yields, one thing keeps worrying me. What the US entire strategy of tariffs is not related to the tariffs of the destination countries, but it is more designed depending on the deficit they have with the US. So the US goal is to reduce deficit. Now, if we run a surplus with the US or a lower deficit, we will have fewer dollars with us. And in that case, we will buy, the demand for US treasuries will be less. So do you see a structural rise in US long bonds, bond yields?
So I would like to, I would disconnect between the two in terms of what US is trying to do in terms of reducing its imbalances across countries. separate that from what's happening to the yields. I think the yields are, you have to take into account how the economic conditions are in the country, how the Fed responds, and how markets react to the outlook. So these are the factors which will drive yields. And what we've seen is there's been a lot of volatility in markets and yields, both in the US and elsewhere. So this is something which we have to wait and see to see how markets stabilize and how yields respond to that.
No, I agree. That is logically, that's how yields would go, depending on the interest rates and inflation in a specific country. But the US got a lot of demand from countries like Japan, China, India. We all hold US treasuries because it's the reserve currency. But if we have fewer reserves because we are forced to run a deficit or smaller surplus, then automatically the demand for those bonds go down, isn't it? So I'm wondering if there is a structural rise in US yields that we have to look at. Term premiums.
So I think if you look at the whole surplus and you look at the size of the US Treasury market, there's a huge gap there. So everything on what happens to the yields is not necessarily driven by what happens on the trade side.
Okay.
So there is a little bit of disconnect which you have to take into account. So the size of the market and the size of the US Treasury market, and you compare that with the surpluses in Asia, I think there is a significant gap there. And so that cannot be the only factor which drives. There could be some impact from there, but other market conditions, how the Fed responds, how the market responds to the various aspects there will have a bearing on yield yields.
Okay. Yeah, and let me very quickly come to inflation. You all have cut Asia's inflation marginally by 0.1%, I think, compared to your previous forecast. There are a lot of people who fear a huge disinflation in Asia, because if you're not able to sell goods to the biggest economy, the $4 trillion US export market, those goods will find a home elsewhere and they'll push down prices. Already we are seeing very low core inflation in India and in Asia. It will go down further, won't it? Don't you see big disinflation, bigger than what IMF has forecast?
So we do see disinflation. In fact, we see inflation across many parts of Asia coming to or below target, for sure. In fact, that's where we feel that monetary policy has more room to ease. There's more monetary policy space across many countries of the world. I think where we are really concerned about deflationary pressures are in countries like China, where clearly prices have been have been coming down very sharply. Both headline inflation, GDP deflator has been coming down in China. That has spillover effects into the rest of the region. And in fact, we highlighted that, Lata, in our last regional economic outlook, saying that when deflation risks rise in China, that has significant spillover effects on the rest of Asia, because prices of exports of China come down, and they are much more competitive compared to, say, the price of goods in other countries. So that is definitely a risk. But as far as Asia is concerned, we feel that given where we are today, the output gaps are closing and inflation is coming down to target. And so going forward, if you want to rotate towards more domestic demand, there's more monetary policy space. In fact, there's one point which I'd like to make, Lata. I talked about it at the beginning, that a lot of Asia is based on exports of goods to the rest of the world. And what we would think is that there's a good time to think in terms of a more balanced approach to growth, where there's more domestic demand coming into play. And there, if that idea takes hold, then you have monetary policy space which can help push up domestic demand in Asia. And that's a kind of balance we would want to see in many countries.
Okay. What are the chances of dollar weakness? If the US wants to reduce its deficit, are you going to see more dollar weakness? And also because of this, question marks over safe status of US bonds, does gold continue to rise?
So I can't say much about gold, but what I can say is, if you look at where the dollar is today, it's compared to where we were, say, 6 months ago. So that there has been a lot of movement. So this is one issue which, in terms of how market financial conditions tighten or loosen, has a significant bearing on prospects, including notably in countries in Asia. So I think that's something which we have to watch out for. I mean, it's something where you have seen a lot of variation in the exchange markets. It's not been so much compared to, say, the past. If you look at financial markets in Asia in response to what's happening to the whole trade tariff friction, you've seen a lot more movement in equity markets. if you look at currency markets or bond markets, there's been a lot more stability there compared to equity markets. So the question, of course, is how will that all unfold going forward, something which we have to wait and see.
Okay. Well, running out of time, just a last quick question because we have a big market audience. The consensus in India was that the RBI would cut rates all the way to 5.5% repo. But given the kind of disinflation that may come from Asia, you think India will have scope to cut more, even more than that?
So, I mean, again, all this is data dependent, and RBI will look at data very closely. Generally speaking, if you look at Asia, and that includes India too, inflation is coming down to target, or in some cases even below target. So that, in many ways, will imply that the space for monetary easing has gone up across many countries in Asia, including in India. And how the RBI reacts to that, it all depends upon how they see the data. But overall, I would say that is our policy advice to countries, is that you have monetary policy has more space to move. Of course, again, Lata, we have to be very careful here because, while there is monetary policy space, countries in Asia will also, central banks in Asia will also look to see what's happening to the interest rates outside, and what's happening to interest rates in major advanced economies, because that will have a bearing on exchange rates and, and then pass through inflation and so on. Our advice is that allow the exchanges to be flexible, and if there is significant volatility, then you could think in terms of intervention in very specific circumstances. Again, we have an integrated policy framework which provides a good playbook to look at, how should monetary policy respond, how should exchange rates respond. But overall, we would say allow the exchange rate to be a buffer against shocks, and allow monetary policy to be determined by domestic financial conditions. On fiscal policy, we believe that in Asia, there was a lot of fiscal spending, post-pandemic. Now it's a time to think in terms of consolidation. But here too, given the fact that some countries will face the shocks are facing significant shocks from these trade, tariff trade frictions, they could provide targeted and timely support for certain sectors which bear the brunt of the trade war. But overall, we believe that the policy mix should be allow the exchange rate to be more flexible, ease monetary policy because you have more space there, but consolidate fiscally because debt levels have risen. Countries have been spending a lot since the pandemic.
Okay, well, the two major regions are going to spend more from their fisc, Europe and China. Let's see how it goes. Thank you very much, Krishna Srinivasan, for joining us with your thoughts and the IMF's outlook. India gets away with a smaller brunt, but it's still at 6.2%, not a very happy number. That's it on this edition of It's the Economy. After a break, it'll be time for Chartbusters.
Axis Bank is the top Nifty loser, trading with losses of around 5% even as it reports its fourth quarter numbers above estimates. The bank sees weak business momentum from a year ago. Year-on-year deposit growth as well is the second lowest that we've seen in the last 16 quarters.
Tech Mahindra comes in for profit taking after reporting its quarter four numbers. The constant currency revenue declines by 1.5% versus an estimate of around a 0.5% drop from last quarter, while deal wins remain healthy.
SBI Life, on the other hand, is up around 4% in a weak market on results that came in above estimates. The value of new business margin actually rose by over 200 basis points year-on-year.
IEX climbs after posting a mixed quarter. Profit after tax comes in line with estimates, while revenue comes below analyst expectations. In fact, we have the management joining us to discuss the quarter gone by in further detail.
Science slips after the company reports a revenue and margin miss. The company also provided no guidance for the FY26, citing uncertainties in the near term.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. Well, Mangalam, we start off a new series. The last couple of series were good. But this series, well, you needed a reason for profit taking. Yeah. I think for the time being, the street is keeping an eye out on the border. And also global cues, well, more or less stable. But I think, you needed a reason to see some profit taking, and that's what's happening.
That's exactly what's happening. We've rallied around 2,500 points from the lows of April series. There were a fair amount of shorts which are out of the system. A lot of the HNIs also, booking out some of the profits. So maybe one of those reasons why the Nifty has fallen from the highs this morning. But what's interesting is that whether we go ahead and see some sort of recovery towards the end of trade or not, because day one of the series, lows made on day one or highs made on day one of the series, extremely crucial to track for the remainder of this series as well. What we're seeing, however, in the mid-cap end of things is a little more than just, the frontline indices. We have around 2,200 stocks which are in the red for about 200 stocks which are in the green. And a few of these names are seeing a brutal sell-off. SBI Card, for instance, is now lower by about 5.8%. Of course, reported a pain in their numbers as well. ACC is the other one, Adani Green, L&T Tech Services, Berger Paints. The paint sector had done well earlier as well, but now coming in for some profit taking. We have Loris Labs, Oberoi Realty, Z Entertainment, and Angel One as well, lower in today's trading session by anywhere between 3 to 5%. But the stock on our radar, the one that is actually doing a lot better, is IEX. The company reported a mixed quarter in the fourth quarter, mixed performance rather in the fourth quarter, with the revenue coming in below analyst estimates, but profits after tax came in line with estimates. To discuss the quarter gone by, more importantly, the outlook going ahead from a company standpoint, from an industry standpoint, and more importantly, from a regulatory standpoint as well, we have with us Rohit Bajaj, who's the joint managing editor at IEX. Thanks a lot, Rohit, for joining in. The fourth quarter, as it were, if you could give us a sense on the volume target for FY26. Last year, you did volumes of late teens, almost 20%. What's the target that you have for FY26? And if you could break that up across all your verticals?
So this year, before moving to FY26, let's see what we have done this year. In FY25, our electricity volume grew by 19% and certificate volume grew by over 100%. So we have been giving this sort of direction in the previous year also. Last year, this number was 14%. This year, it has improved to 19%. As demand is increasing in the country, as the supply side, we have seen liquidity coming in. There is a lot of coal availability in the country. The prices have stabilized. Gas prices have stabilized. So this is resulting into a little better supply availability, which is giving us some headroom to grow. So we expect that going forward also, what we have achieved this year, this trend can continue.
So 19% is gettable in FY26. Do you have a sense of whether you can better that or not? And if you could give us also an outlook onto power supply volumes and also the certificate volumes for FY26.
So electricity side, we are in the process of launching a couple of new products. So we are in the process of, currently we have contracts up to 3 months. We are extending this. We have filed with the regulator for approval. Once we have that approval in place, we would be extending it to 11 months. Which means there is additional 30-40 billion unit of market potential available for us. So that is over and above what we have, what the guidance we are giving till now. So business as usual basis, we can expect 18-19% growth, which we have been maintaining in the recent past. And on top of it, with the green RTM sort of segment, which is a new product, similarly the 11 months TAM contract, which is going to be a new product, we can definitely target for a little more. Now, the second aspect is certificates. Certificates, we have seen a lot of correction on the prices side. So this year, when we say we have doubled the volume, in fact, more than doubled the volume, it has because the prices have come down. More and more consumers as well as distribution companies, now they are finding it viable to buy at this particular price point. So this trend is expected to continue. There's a lot of inventory available, and we expect that prices will remain at a sweet spot at this level only, and then the growth momentum can be maintained.
Hi, Mr. Bajaj. Good morning. Good to see you. When the street seems to have liked what you've delivered so far. Another crucial matrix that we look at is the market share. Could you tell us in the last 1 year, how has the market share moved? And where do you see this market share headed?
Yeah. So electricity is our major segment, which contributes to little more than 90% of our total. So in this particular segment, last year our market share was 84%. This year also it is 84%. We are maintaining that level of 84%. And I'm sure with the newer segments that we are going to introduce in coming year, and we can have, since we are the one who have filed for approval, we might have first mover advantage there, then probably we would be able to increase this in the next year.
All right. You are likely to increase your market share in the next year. To what? Do you have any target in mind?
So 84% itself is a very good market share, but yes, couple of points above that is what we are targeting.
Okay. A large part of, your overall growth will also depend on what you do outside of electricity, even though electricity is about 90% of your business. I see a fair amount of profit contribution that has come in from IGX. And also you are speaking about ICX, which is a coal exchange. If you could give us a sense on, the potential that both these businesses hold for you, more in the near term, IGX, because it's a proof of concept already. If you could give us a sense of what kind of volumes you are doing here, what's the kind of business that you can do over the next few years, and the coal exchange, if you could give us a sense of the business size in the medium term for this one.
So we are very bullish on IGX now because the kind of volume increase we have seen in the last quarter, because prices in the gas side has stabilized and more people are interested in buying that now. In fact, if you have seen the recent headlines, in the crunch period, in fact, government is pushing for operationalization of all the gas-based plants which are there in the country. So this is one area where we expect that demand is going to grow. And with more CNG demand, more PNG demand, this is one thing which we see a lot of growth potential in coming years. So in quarter Q4 alone, we have seen 100% sort of jump in the YOY basis. So we expect that this is one target area for us. We expect very good volume going forward. And ICX is Indian Carbon Exchange, the subsidiary that we created about two years back. In this particular subsidiary, we have started registering, we have started issuance of international RECs, international RECs. So that thing we have started. This is not very high potential segment. Our top line this year is about 3.5 crore, which is going to increase in coming years. But we do not expect it to be anywhere similar to IGX or for that matter, IEX sort of a numbers. So there would be slow growth there. But coal exchange, you mentioned about coal exchange. This is one segment where, again, there is a lot of development which has happened. There very recently in the month of March only, the Ministry of Coal came out with a paper where they are seeking comments for amendment in the Act, Mine and Mineral Development Act, wherein they are paving way for creation of coal exchange. And we are again very bullish on this particular aspect and working very closely with the government and all other agencies. And as the framework will be created, we hope to launch this particular exchange also going forward.
Okay, all right, Mr. Bajaj, everything that you're saying operationally looks good. The biggest overhang on the stock is market coupling. Has there been any progress on that front? Have you heard anything, any direction that you'll have got?
So it's almost 2 years now.
Yes.
The first order came issued by CRC and no development as such. There has been no order on that regard, no report on that regard. We have not received any official communication. We are waiting to hear from a regulator on this particular aspect. But
any timeline you've heard, sir? As you said, it's been a long while.
No, sir, no timelines given till now. But again, we strongly believe because since the DAM and RTM, majority of the share, almost 99.5% of the share is with us. I'm sure regulator will look into all the aspects, and then they will also see this particular aspect. If everything is with one exchange, what sort of benefit can be accrued from the market coupling? I think those things will be seen while arriving at the final conclusion.
Could you give us a sense of the kind of discussions that you are having with them? Because ever since the first document came out, you said it's been 2 years. So I'm sure there has been a fair amount of conversation that you've had with the regulators. There has been a bit of a back and forth on, off, whatever, when it comes to the record. If you could give us a sense on what the pros and cons of this are, not necessarily from an IEX standpoint, but from an industry standpoint.
So there are so many things which are in public domain. In fact, when 2 years back it started, after that there was one order given by CRC wherein they mentioned that they did some simulation and the findings were not very, very positive. Still, they referred it to Grid India to do a pilot study, which I think we understand they are doing. So once this study will be done, and then probably we'll get to hear something from the regulator. So as of now, for let's say last 5-6 months, there has not been a single development on this front.
All right. And finally, for the end of this year, because you're speaking about good volume momentum continuing, adding a fair amount of new products as well, then the additional booster coming in from gas, would you have a sense on the kind of margins that you're targeting for the end of this year?
So margins are continuously improving because the cost, if you look at this year also, the top line grew, revenues grew by 19%, and then the cost increase was only 10%. So we expect, and exchange business is like that, the cost is not similar to the revenue growth. So we expect that this trend will continue and we would be in a position to deliver better margins going forward.
How much better?
Difficult to put number to that. But yes, since there are some new product also in the pipeline, so there would be some expenses associated, technology expenses associated with that. So at this point in time, it is difficult to put number to that.
And would the revenue growth be similar to the volume growth, or would it be more?
It should follow the trend that we have seen this year. It is expected to follow the similar trend.
Got that. Thank you so much for joining in and giving us an outlook onto your business for the entire year, and more importantly, the regulatory concerns as well, which you have highlighted and spoken about as well. That's IEX. The street likes the numbers. More importantly, the street likes the commentary. The stock up around 2.5% in an otherwise wobbly, weak market. Take a short break, come back. We focus on the markets itself. Manas Jaiswal joins in for a quick technical check on the way he's looking at the market right now. Stay tuned.
Welcome back. Well, the markets continue to see some kind of selling pressure. Delivery is one stock that's actually moved up in the last few minutes, so just keep an eye out on that particular counter. Manas Jaiswal, though, joins in for a quick technical check. Hi, Manas. Good morning. Good to see you win. The markets have pulled back. Some would say on expected lines after the kind of run that we had. Where do you see support for the Nifty?
Good morning. So I think Nifty can test its 10-day moving average, which is placed near 23,800. Or maybe below that, it can even test 23,600. So if one call I have to take right now, I think it would be a sell call. The stop loss should be around 24,150. That is cash levels. And I think you can see the bigger target of around 23,600 on Nifty.
23,600. So you're looking to sell into any kind of bounce.
Yeah,
Got that.
Yes.
Got that, Manas. What about the Nifty Bank? Because that one almost made it to 56,000. And even in my morning charts, I've been making this point that the next run for the Nifty will come once the Nifty Bank can take out that level. We went to 55,000, 900, 56,000 as well last week, but we couldn't, conquer it earlier this week, I meant. Where are the supports coming in for that? Because it's coming in at around 54,400 as we speak, down 700 points.
So I think here you may see some more weakness because looking at the pattern and especially Bank Nifty has broken the key support of 55,000. I think you may see some more correction. It can go down and test 53,500 of almost 1,000 points crack from current level. So here, I think here also you can create short position. The stop loss should be around 55,000 on the upside.
All right. And individual stocks, Manas, what's on your radar today? I mean, are you trading on the long side, looking for shorts, or looking for opportunities that have dropped and, providing an attractive entry opportunity, so to say?
No, since my view is bearish, so I would like to go short in two stocks. First is Container Corporation, where stock has broken its 20-day moving average. So in Container Corporation, one can create short position. Stop loss should be around 700. Target would be around 665. And second is a sell call on Voltas, where stock has given a confirmation of lower tops and lower bottoms. So take a short call here in Voltas also. This is a future price. Keep your stop loss above 1270 and target would be around 1210.
All right, Manas, thank you so much for joining in and giving us your views on the indices as well as individual stocks. With that, we'll get you a few ideas coming in from profit from our colleagues at Money Control Pro. Nitin Agarwal joins in with a stock.
Amid heightened market volatility driven by uncertainty surrounding US President Donald Trump's tariff policy, we are strategically focusing on opportunities within Indian market that have minimal or no exposure to America. This approach helps us mitigate the risk arising from the global trade tension. On the back of this, we have identified a company which is from the auto ancillary space. The name of that company is Bosch Limited. Bosch fortunes are directly linked to the commercial vehicle segment, which has shown a muted growth in FY25 primarily due to the election and less spending by the government. However, the medium to long-term outlook seems promising due to government's focus on thrust on infrastructure construction and mining activity. The management has indicated that the outlook for M&HCV segment is very, very promising. The management is also focusing on localization of the localization of products in order to improve its profit margin. In addition to that, the company has been consistently investing in new technologies and adopting and trying to capture the new segments that are coming up, such as electric vehicle segment. The company has been investing a lot of money out there, and they are expected to get the benefit from that segment as well. Going forward, the company is focusing aggressively on EV segment. In terms of valuation, the stock has corrected more than 30% from its 52-week high, making the valuation very reasonable. It is currently trading at around 30.7 times FY27 projected earnings, which we believe is reasonable for a company like Bosch.
Okay, all right, Nitin, thanks a lot for that. Well, time to slip into a short break, but as we do that, here's some good news for our viewers. India's business leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of this at your fingertips. Download the CNBC-TV18 app now from the Apple Store or from the Google Play Store, or just scan the code that's up for you on the screen.
Welcome back. There's a wave of profit booking and it's across sectors. If you look at the top 5 stocks on the Nifty which are hitting the lows of trade today, we have JSW Steel, which is at the low point. We have Tata Consumer, which is at the low point. Remember, the stock had rallied about 6% from lows in yesterday's trading session. Tata Consumer ended in the green, but now seeing some bit of profit booking after having rallied about 14% this month itself. Divi's Lab is the third one, down 3%, currently at the lows of trade. You have HDFC Life, which was actually doing well in, connection with the kind of results that SBI Life had posted, and as a result of which the up move that we saw opened in the green, fairly in the green, and has now corrected about 5% from the highs. And the fourth one we have are both Divi's Labs and Bajaj Auto, both of them at the low point of today's trading session. So it's across the board, no one particular sector. Even in the broader markets, you look at Nippon Life at the low point of trade. We have MCX, which is at the low point of trade, and Interglobe Aviation as well. The stock's seen a fairly good run, but currently at the low point of trade, seeing some profits being shaved off on Interglobe Aviation, currently down about 5%. But the big boy today will be Reliance Industries reporting its fourth quarter earnings. Rima joins in with the key expectations of what the street is working with this time around. Rima.
Steady and strong, that's the way perhaps to describe the expectations from big boy Reliance Industries earnings in the March quarter. Now on the top line, about a 1% revenue growth, 2.42 lakh crore. Year on year, the revenue growth would look more at 2 to 3%. EBITDA is seen on the flattish side. So 43,800 crore on the EBITDA, which means EBITDA margins of 18.1%, and profits are seen lower slightly, just about 2%. Now let's talk about the individual businesses. So Jio is going to be a growth driver. Jio is going to have another good quarter because the July tariff hike benefits will continue to flow through. Oil and gas is likely to be a bit subdued on account of lower volumes, and even retail is likely to see some sequential softness. So if you remember, Q3 is typically a very strong quarter for retail on account of festive season. So therefore, quarter on quarter, the Reliance retail EBITDA could be down, but year on year, it's still likely to report a growth of about 10 to 11%. And O2C is likely to have a mixed quarter. Cracks is slightly lower, but on account of better sourcing, perhaps the gross refining margins for O2C could be up. Now, the stock hasn't, year to date, it's up close to about 6%, but from its 52-week high, the stock has fallen close to about 20%. But bear in mind that a peer like Bharti Airtel, at least a peer in the telecom business, has outperformed Reliance Industries by 50% in the last 1 year. So investors are saying at some point, at least, there can't be so much disparity between Bharti Airtel and at least the Jio valuations of Reliance Industries. But what is dragging Reliance Industries down? One has been the slowdown in retail. So what investors are closely watching is when will the retail recovery come through? What does the company guide about that? Secondly, reduction in their capex intensity, which means more free cash flow. And thirdly, monetization. Is a Jio IPO coming? What do they talk? What do they say about that? What can they guide about potential monetization? These will be a few big things that are on top of mind for all investors. That's a standard disclaimer from Reliance Industries from our channel.
All right, Rima, also tell us about the key expectations from Reliance Jio's numbers.
So Reliance Jio is likely to be the growth driver this time around. So on the top line, we're looking at a growth of a little more than 2%, revenue seen at 29,925. And this will be driven by a combination of ARPU increase of 1.5%, and some subscriber ads. Now, ARPU is going to be critical. It's been going up for the last couple of quarters. And remember, in July, the entire industry had taken a price hike. And the benefit of that is still flowing through. So in the current quarter, according to our poll, the ARPU should increase to 206 versus 203. And for Jio, they have a higher percentage of annual recharge customers compared to its peers. So that explains why, even after 3 quarters, they will get that benefit of the tariff hike. Subscriber ads seen at about 5 to 6 million on a sequential basis. Now, margins are seen on the flattish side, 52.8%, and the profit number, according to the CNBC-TV18 poll, should be 6,515. 2 key things to watch. One, the fixed wireless access, where the ARPUs are much higher, basically a 5G, that is seeing pretty robust addition. And secondly, the IPO timelines, because that is the monetization all investors are awaiting. So good numbers expected from Reliance Jio, and that standard disclaimer will come up for you on the screen.
Take that point, Rima. Good numbers expected from Reliance Jio. All eyes on monetization of Jio, value unlocking out there as well. But for now, for the markets, there is profit unlocking or profit booking that is taking place right now. We'll leave you on this edition of Chartbusters, but stay tuned. Trading Hour comes up next.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. It's a Friday morning, 11 o'clock. Markets are in profit booking mode. Benchmark indices have lost over 1%. The Nifty is below the 24,000 mark. In fact, below even 23,950 as it sees a deep cut of 300 points. Sensex down in excess of 900 points. You know, for the week though, we're still up. The Nifty is up close to about 0.5%. The Midcap index has gained 1.8%. And not to bear in mind from the April low, which was about, I think I'm forgetting the number, but we're up close to about 11% from the April low. So in that context, because the rally has been so swift in one way over the last couple of 2 weeks, that this is just perhaps profit booking.
Absolutely, just perhaps profit booking, and I think rightly so, because yesterday we did see some bit of a subduedness. Today seems like, we opened up on the green side, but then we started seeing that fall coming in. Nifty Bank also is trading at the day's lowest point. We have the mid and small caps. The broader end of the market is seeing an underperformance coming in. Nifty Midcap is down almost 2.9%. Small cap also similarly is down 3.4%. Advance decline ratio today clearly is in the favor of declines versus advances. There's no doubt about that. Some bit of a bright spot that I would want to highlight that is there, and some of the stocks that are trading in the green today. We do have SBI Life that's managing to hold on to some bit of a green. They reported their numbers as well, so keep an eye out on SBI Life. We have IEX also. They reported their numbers. It was a mixed set of numbers that came in from the company, but volumes is the key that you keep an eye out on, where the management also joined us earlier on in the day as well, so keeping an eye out on IEX as well. Some stocks that are not doing well today obviously signed MOSL, SBI Cards, Garden Reach are some of the names that are not managing to hold on to that gain in today's trading session. As of now, all the sectors, Rima, are trading in the red, so there's no green spot in a actually, IT has just moved on to the green side. I would just like to pull up the Nifty IT and see where that's headed, because it was in the red a short while ago. Now it's come back to the green. So yes, that bright spot is only coming in from the IT side, Rima, but nothing exciting as a day coming in.
Okay, let's talk about the telecom sector then. Bharti Airtel, we understand from sources, has written to the government about its spectrum dues, which are worth 74,000 crore rupees. What CNBC Awaz understands is that Airtel is asking the government to convert these dues into equity like they did in the case of Vodafone Idea. So this provides Bharti Airtel some cash flow relief. Sanjay Kapoor, former CEO of Bharti Airtel, is now joining us on the show. Sanjay, first share your initial thoughts, because what we've learned so far is only from sources, but Bharti seems to have written to the government to convert spectrum dues into equity. What does this mean?
Yeah, so morning to everybody. And, I don't have much details than the ones that I have read in the media. And what I believe is that the government did convert the spectrum dues up to 2028 for VIL. So to bring in parity and to make sure that others have, a similar offering, probably, Airtel can also have the right of asking the government to convert their equity dues, their spectrum dues into equity. And I guess that's the bone of contention at the moment.
So Bharti Airtel may have asked, but is it incumbent on the government to convert and listen to the request, or can they refuse? And what could be the driving motivation for Bharti to do this?
So, whether the government can say yes or no, from a parity perspective, probably the government has always said they'll be fair to all players. So, probably they'll have to consider this option. But given the condition of Bharti Airtel in terms of financial strength versus VIL, government can always exercise its rights to say that, why can't you offload this in the open market and probably get a premium, right? Because Airtel doesn't have a funding issue. Airtel can go and sell this equity anytime in the market. They're a premium stock. So I guess government will always have the option of the refusal or the the last refusal.
Absolutely, they would have the right, because, and like you're mentioning, right, bringing parity, but Bharti Airtel does have the money to pay this dues, right? So if this actually takes place, then wouldn't they have a bit more advantage? And what would they be doing with the money that is already lying with them?
Well, telecom is definitely an industry where it's very capital hungry, and you keep investing money into networks and expansion. And Airtel will also be in the same boat to wanting to invest more monies into 5G. Reliance is investing more money in 5G. Does Airtel want to do that? Reliance has got a standalone 5G network. Do they also want to move towards a 5G standalone network? So I think they will have the strategies in place to say, why do they need this money? But they are well capitalized, and their ability to raise capital is not a question like VIL's. So I guess, probably they're finding, an opportunity here to bring in government. Though, I would be a little coy about government's move here to say, will government, if they accept this, not become over-invested in the telecom sector? though telecom sector is a very important sector for the country, and the government doesn't mince words on that. We need to keep alive at least 3 players in the market, if not 4, for such a large market to give the right choices to the consumer. So I think from a government's perspective, they only seem to be over-invested, but for the right reasons maybe. But from Airtel's perspective, I don't think this is the only choice that Airtel will have to raise capital. They can raise capital in the market as well.
But that's the option they seem to have gone, with, by writing to the government to convert, though they have other options. But then that brings the question that, Jio can also ask. They also have spectrum dues. So where does one draw the line? Because as you said, then there's a risk that the government is over-invested in the telecom sector.
Yeah, I mean, for now, what the government has converted for VIL is the spectrum dues. So I guess that Airtel is asking for spectrum dues and not AGR dues like some newspapers and print media has mentioned. Because if they do that, then that puts Jio at a disadvantage because Jio doesn't have AGR dues, and then they might come back and say, man, how can you give it to 2 guys and not the 3rd guy? So those controversies, I'm sure the government doesn't want. So right now, if it's spectrum dues, then Jio theoretically can come back tomorrow and say, me too.
Absolutely. But, Sanjay, do wait on with us. Actually, in a big development amid the tariff war, Apple aims to source all US iPhones from India in a pivot away from China. Parikshit is joining in with us to give us more details on this one.
Well, we know that currently the US has imposed tariffs as high as 245% on certain Chinese products. And the overall tariffs is almost as high as 145 to 150%. So considering the current tariff environment, the US is definitely considering importing more Apple phones from India. So this could mean that India may become a hub for manufacturing all Apple iPhones for the US market specifically. Now, while this is definitely the intent, the plan, a lot of this would also depend on the speed at which the capacity ramp up takes place at Apple's contract manufacturers here in India. And number 2, what is the geopolitical situation? If tomorrow US and China come to sort of a truce in the trade war, then things could well change. But currently, looking at the tariff environment, this is the intent to make sure that all phones for the US market are made in India. In fact, the target that is being set, and we've learned this from industry sources, that Apple has set itself a target of 40 million phones production in India in 2025. Apple contract manufacturers in the country are ramping up their capacity in Bengaluru, in Tamil Nadu. In fact, we're learning that in addition to Chennai, where Foxconn is maximizing capacity, Foxconn's Bengaluru plant will be up and running very soon, perhaps in the next few days. And when at peak capacity will take some time, of course. When it's at peak capacity, Foxconn's Bengaluru plant will have a capacity of 20 million phones per annum. Now, Apple did not respond to CNBC-TV18's query, but we learned from multiple industry sources that Apple is maximizing production at its plants in India and would like to increase capacity and utilize whatever capacity it has in India for the advantage of the US market.
Thanks, Parikshit, for that. That's a big story that he's picked up. Sanjay, I know your domain is telecom, but you do look at the TMT sector as, at large. Do you want to quickly weigh in with your thoughts on this?
Well, I think it's a no-brainer that India is a great alternate destination for production of electronic goods, especially devices. And, India has really moved over the last few years. Though I did read in one of the print medias that, they have defined the norms for what will construe to be or what will qualify to be made in a particular country, and they have certain guidelines around components and critical components and design and all that stuff. So I guess we are on the right path, and if we can integrate more on developing the key components and design in India, then India could turn out to be a behemoth as far as production of mobile phones, especially Apple, is concerned. And Apple over time, I think, has developed that confidence over here, and they are, along with Samsung, probably the biggest beneficiaries of the PLI scheme that the government announced. So I think they have benefited from the investment. They've benefited from our PLIs. They've benefited from the fact that India is producing quality products which can be acceptable to the rest of the world. So why not India become the key manufacturing hub for them globally?
Okay, Sanjay, thank you so much for joining in with us on the show, talking to us about the telecom sector as well as in terms of Apple iPhone and the updates coming in on that front as well. Thanks so much for that, Sanjay. But with that, we're going to actually sip into a very short break. And as we sip into the break, here's some good news coming in for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens. Welcome back to Trading Hour on CNBC TV18. Now let's shift focus and talk about the auto sector and the auto major Maruti, because that's set to report its Q4 FY25 earnings today. As of now, the stock is almost near the day's lowest point. But what are the key expectations? We have Sudarshan joining in with us for that. Good morning, Sudarshan.
Good morning, Vinny. So Maruti is expected to report earnings post-market hours today. First, talking about the stock performance, it's up 10% this year so far. Also, valuations after the recent correction that we have seen, like ahead of this year in the last few months, valuation has become supportive. It's currently trading at 23 times versus 5-year average of almost 28 times. So what are we expecting in earnings? First, it's going to be a steady set of earnings with volumes and rich mix will aid the revenue growth, while other increase in other operating expenses might weigh on the margin, which might see a minor contraction. Now coming to the headline numbers, profit is seen down 1%, revenue may increase by 7%, EBITDA too can increase by 4%, while margin can come in at 12% versus 12.3% in the same quarter last year. Now talk about the average selling price, or say realization. It's flat sequentially and it's up 4% year on year. Volumes were up 7% sequentially and up 4% year on year. And even raw material costs were flat year on year and sequentially as well. Gross margin too can slip 1% both year on year and sequentially. Now, what exactly in the commentary that we'll be looking from Maruti? First, if company gives any update on the order book and what's the inventory level, because talking about the inventory in the last few months, or say in the last 6 months, entire industry has seen an increase in the inventory because of the demand concerns. Also, what's the demand outlook for FY26? If you remember, just 2 months ago, in one of the conferences, most of the players for FY26 also were estimating growth in the range of 3 to 4%. So we'll see what exactly the company provides an update on that front, and if there is an improvement on urban demand, because rural has been largely doing better, and that can be that is being reflected even in the agri growth, or say tractor growth. But for PV, because Maruti is the leader in the entry vehicle segment as well, so now the comment on the rural demand will play the major role. And discounting trends. Remember, in the last few months, Maruti has taken price hike thrice, and still the discounting trends are being seen. So what is the current discounting trend? And lastly is the commodity price outlook, because that also has jumped in the last few months, and that is going to impact margin as well and overall earning. So these are some of the things that we'll be looking for in management's commentary.
Thank you very much for that. We will slip into a break on that note. We'll come back and discuss market technicals. Mitesh Thakkar joins in with his top trading bets. Welcome back. Let's talk about Tech Mahindra. Now that's under pressure post their Q4 numbers. So one reason is the revenues were lower than street expectations, though Tech Mahindra has now recovered from the day's low. So first, let's get to the negatives. One, revenues missed street expectations, down 1.5%, lower than consensus expectation. Two, the stock had seen a very strong run-up prior to the earnings. So in the last 7 days, till yesterday, stock was up 13%, so some profit booking. But as we highlighted in the morning, there were lots of positives in the numbers too. One, margins were ahead of expectations. Two, it was the 5th consecutive quarter of a deal flow improvement to nearly $800 million. Three, the communication vertical, which is one of their largest verticals, that's 33% of their overall revenues, is stabilizing, and that saw a growth of 1%. And four, the company holds on to its FY27 guidance. They've said that FY25 is a base building year. FY26 will be a year of stabilization, but FY27 onwards, they do expect to achieve their goal of 15% operating margin and above industry-leading averages. So, which is why there were many positives in the numbers, and I think now the street is acknowledging that, and we've seen that recovery in the stock price.
Absolutely, Reema. But, there were a lot of mid-cap IT names also that reported this number. This was a busy week for you. Some hits, some misses coming in on that front. Overall, what's the roundup and sense that we're getting from IT companies?
Well, mixed. So, just to quickly, tell you the hits and misses. So the companies which beat expectations, one of them is Persistent, the other one is Emphasis. LTIMindtree was in line, L&T Technology Services and Cyient were a miss. And you can see from the stock price reaction over the last 1 year that companies like Persistent, which were anyway outperformers, they were commanding premium valuations because it was able to deliver growth ahead of peers. They continue to do that. And the companies which were struggling, like Cyient, for instance, they have underperformed. So in a way, like the men are the men and the boys are the boys. And this, Coforge is the other one we're awaiting, and those numbers are only on 5th of May, and that stock has also been quite the outperformer, 40% up in the last 1 year. Now let's get to the growth numbers. Now, Persistent was the big outperformer, 4.5% revenue growth ahead of estimates. Emphasis too delivered on estimates, 2.9%. Now for LTTS, you can see it looks like a big 10% kind of a revenue growth, but that includes the IntelliSwift acquisition. Actually, LTTS was a miss on estimates, and the stock post earnings declined, and Cyient also disappointed the street. Now on to the guidance for the full year. Persistent is still talking about beating the industry growth rate in FY26. They also hold on to their FY27 annual revenue guidance of $2 billion, $5 billion by FY31, improving margins. So holding on to their long-term, medium and long-term guidance. Emphasis too, margins will be maintained in a narrow band. And again, they expect growth to be above industry leaders. Now, LTTS is just saying that, and normally LTTS gives you a numeric guidance. This time they're not. But they're saying FY26 to be better than FY25. And they're also saying it will be a double-digit revenue year. But even then, it's slightly lower than what analysts were hoping for. They were looking at a high double-digit, mid to high double-digit kind of a guidance for this year. So in that sense, it's a bit of a miss. Cyient is abstaining from giving a guidance for FY26. They expect the uncertainty to last through the first half of the year. And even their margin aspiration has been lowered and pushed forward.
Okay.
So that's the reason why Cyient is under pressure.
Absolutely. A lot happening for Rima during this week as well. Maybe sip on some water after the whole roundup of mid-cap ITs that's come in from Rima. Interesting. Mixed is what we're watching out for, is what I'm understanding from Rima as well. But let's move on and talk about banks, right? We have Axis Bank that reported their numbers. Now, the stock is under pressure today. What's leading to this? Abhishek is joining in with us to give us the review in terms of how Axis Bank performed in Q4. Abhishek.
Well, Axis Bank saw weak business momentum on a YOY basis. Take a look at deposit growth. It's just 9.8% YOY, perhaps the second lowest that you are seeing in last 16 quarters. Sequential business momentum saw a bit of uptick thanks to deposit growth of 7% quarter-on-quarter, which was one of the best in last 8 quarters. However, advances growth disappointed. So advances growth was at 7.85% YOY, which is perhaps the lowest growth that you are seeing in last 16 quarters. And sequential growth in advances was about 2.6% quarter-on-quarter. Now, what disappointed in the loan growth was the housing finance segment and the auto segment. So the housing sector and auto sector, both of them saw their loan book decline on a sequential basis. Cost to income ratio or operating efficiency was one of the worst in last 5 quarters. It was the highest at 47.8% versus 46.2%, the highest that you are seeing in last 5 quarters. Slippages were the heartening point, 4,800 crore. We saw a decline of 11.5% quarter-on-quarter, and thanks to highest write-off in 16 quarters, asset quality improved for them. So gross NP ratio came down to 1.28% versus 1.46%, perhaps the lowest that you are seeing gross NP ratio in last 39 quarters. Now, risk-weight asset to advances ratio, that increased to about 111.4% versus 109.8% in the previous quarter. It is at a 5-quarter high and does not augur well given the fact that risk has been built in the balance sheet a little on a sequential basis. The PNL NII was in line with our poll. However, the PAT on account of lower provision beat our poll. Back to you.
Okay, Abhishek, but do wait by because SBI Cards, that also reported its numbers down more than 6% as of now in the trading session. What are the numbers looking like for SBI Cards in Q4?
Well, credit cost was actually continues to impact SBI Card. It remains on the higher side despite the fact that it's improved slightly on a sequential basis. So take a look at quarterly spends. They are up nearly 11% YOY and about 2.5% sequentially. However, the receivable per card, that's declined both YOY and quarter-on-quarter. So card receivables, that is AUM, is up only 9.8% YOY and close to 2% sequentially. The net interest margin improved for them after many quarters. So it improved to 11.2% versus 10.9% in the same quarter last year and about 10.6% in the previous quarter. The annualized credit cost remained elevated at 9% when compared to 9.4% in the previous quarter. The revolver rate continues to remain low at 24% flat YOY and quarter-on-quarter. The NII growth was 7% YOY and about 2.3% sequentially. The PAT declined by 19.35% YOY and grew by 39.4% sequentially. In the con call, the management has mentioned that, a 6 to 7% credit cost range in the foreseeable future is actually very far for them. Back to you.
Okay, Abhishek, thank you so much for that. Surely we'll be keeping an eye out on SBI Cards as well as of now at the day's lowest point. But let's bring on board Mitesh Thakkar, who's joining in with us to give us a quick check on the technical front on the market. Mitesh, good morning. And right now, just a short while ago, we saw that the Nifty actually went to the 23,900 mark and then has seen a bit of a bounce back again coming in. What are the levels that we should keep an eye out on for today? And, from which point do you see a further fall coming in now?
So I think on the index, this is the level which I was hoping will hold. 23,870 to about 23,900. We made a low of around 23,879 and practically there. So there's a gap which happened on the Monday morning, and this gap should be acting as a good support level. In case it gets filled, then we might have a bit more dip to about 23,665. But for the timing, I'm hoping that this gap holds and we kind of end the correction over here. But The idea is that next few days could be spent consolidating. We've had a good rally. We've had a pullback today, a decline in profit booking led kind of a thing. And the indicators are coming out of overbought levels. So next few days might be choppy. I would hope that if 23,870 holds, then we might do a range of about 23,870, 890 to about 24,400. In case we have a dip, then I think we might see another 150 points on the upper side.
Thank you very much for that. On the other side, we'll talk about the global economy. Brian Coulton from Fitch Ratings, who recently, I think in the middle of April, had lowered the global GDP growth forecast, citing the tariff uncertainty and the Trump tantrums. We will discuss that when we return on the other side with Brian. Stay tuned.
Welcome back to Trading Hour on CNBC-TV18. Now shifting focus to the global macros. Now credit rating agency Fitch has sharply lowered its forecast for global growth as escalating trade tensions weigh down on the growth prospects. They have slashed the world growth in 2025 by 0.4 percentage points and China and US growth by 0.5 percentage points versus their March global economic outlook, which was much higher. So to discuss all of this, what is the indication that they're picking up further as well? We have Brian Coulton from Fitch Ratings joining in with us to talk to us about that now. Brian, good morning. Thank you so much for joining in with us on the show. You know, I just want to start by talking about the cuts that you all have given so far. What is the worst case scenario? Is this the worst case scenario? And if negotiations that, many countries are having with the US, if that goes through, then what is the upside also from this that we could see? If you could tell me both the parts of the story.
Yeah, I don't think we're so focused on the upside at the moment, really. I mean, what's transpired in the last 6 weeks has kind of been worse than most people's worst case scenarios as of like 3 months ago. So we just need to bear that in mind. I mean, we're at this 10% rate now on the reciprocal tariffs have been moved down to the 10% floor, but that's only temporary, remember. So there's got to be progress within the 90-day window for those not to revert to something higher. Now, hopefully there will be some progress, but that is ahead. Trump has also talked pretty explicitly about new sector tariffs that are coming down the pipe on pharma and semiconductors. So those weren't part of the Rose Garden announcements, but they are to come. I think where we're currently at extreme levels, where probably over the next 12 to 18 months we'll see some improvement, is the rates that we've now reached on China, which are just spectacular. This 145%. That's the sort of tariff bill that's going to completely disrupt trade, and I think the US has now come around to the view that maybe that all got a bit out of hand in terms of the escalation, and that's going to cause some real damage. So I think there is some prospects for coming back from these extreme levels on China, but nowhere near where we were before. We're assuming in our forecast that rate comes back, but only to about 60% on China.
So what are the global growth numbers now? If you could give that for the, on the whole, how has it changed after what we've heard so far on the tariff front, and even for the key economies like US, China, the Eurozone, and throw in India as well?
Yeah, so the backdrop is the world economies did pretty well in 2023, 2024, right? We had global growth of about 2.9% last year. That's above the long run trend. But with our latest revision, we're now seeing global growth fall to 1.9% this year. So below 2 is a pretty weak number. If you exclude the pandemic, the last time world growth was below 2 was in 2009. So we've got Chinese growth falling to just below 4% this year from 5% last year. US growth from about 2.8 to just 1.2 on average. And through the year in the US, Q4 on Q4, year on year, we've got that a point at 0.4. And then the Eurozone, has really been struggling since the Russia-Ukraine gas crisis. It's just been kind of like trundling along at rates below 1%, and we've got growth slowing to about 0.6, 0.7 this year from 0.9 last year. So India is still a global standout. With rates 6.5% range, we don't see it being as affected, but there is going to be some negative impact on India as well.
There will be some negative impact, but for India, but not as much as other EMs is what you're talking about. What about the flows into EMs overall as well? Do you think that could maybe see a bit of a shift or a pause on that front as well?
Well, this is definitely a risk-off environment that we're in now with this global trade war. So all else equal, that would be negative. We are looking at lower global growth. We're looking at lower Chinese growth. We're looking at lower commodity prices, and all those things historically have been associated with weaker capital flows to emerging markets. On the other hand, we have seen some recent weakening of the dollar, which tends to be a bit more supportive of emerging markets. So I think net, I wouldn't say this is positive for EM capital flows, but it could be worse.
You said US growth to slow down to 1.2% in 2025, which compares with 2.8% last year. Did I get the numbers right?
Yeah.
So that's a very sharp slowdown, and yet you don't expect the Fed to act very soon and with deep rate cuts.
Yeah, I mean, that's quite a striking feature of these revisions. We slashed our US growth forecast, but we stuck with our view that the Fed would have to wait until the fourth quarter of this year before they were going to cut rates. And that's really all about the adverse supply shock implications of this tariff hike, which will push up prices in the US and restrict supply. And that's on the figuring that we've done. We've got the US inflation rate heading up above 4% by the end of the year. We've got a 4.3% number for December for US CPI. So that's taking the Fed a lot further away from where they want to be on inflation. They hadn't got inflation all the way back down to 2%. It's going to be moving sharply in the wrong direction. And then separate to that, which is also very relevant for the Fed, has been this jump in household sector inflation expectations, which is a real threat to Fed credibility. And we think in the context of all that, even though the Fed will be lowering their growth forecasts in the next meeting as they digest the impact of the tariffs, we think that they're going to be cautious and cutting rates too soon, and so we'll kind of hang on, keep rates at the restrictive level until the fourth quarter. So yeah, it's not a great combination when growth is deteriorating, but you can't cut rates.
Absolutely, that is what everyone will be keeping an eye out on when not seeing much growth. Fed is not cutting rates as well. But Brian, when I'm just talking about Asian countries, specifically, they have a higher exposure, right, in terms of exports to the United States. And that is why these trade talks which are going on are key for them. But how do you see overall EMs in terms of performing, specifically with higher exposure, something like a Vietnam versus China and India? Do you think Vietnam would maybe have an upper hand, or if trade talks, what do you see that in moving in terms of that?
I think it's got to be complicated because, one of the things that happened in the first US-China trade war was this trade diversion, because it was just between the US and China, it became profitable for firms to sort of redirect their export and supply chains, through other countries. But the US administration is kind of all over that, and they don't want to see that happen again. So it's going to make that trade diversion, which did certainly benefit some countries, and Vietnam was definitely in the list there, and Mexico as well, but also other countries in Asia. It's got that trade diversion, which was a benefit. The China +1 strategy as well that we've heard a lot about. It's going to be a lot more complicated in this context because it's such a broad-based increase in US tariffs.
So, Brian, just to circle back, right? The numbers that you've shared with us in terms of the global growth forecasts, this is assuming what base case is tariff? On China, I think you said 60%. Is that correct?
No, we're assuming that the effective rate we think at the moment is about 100% once you account for the carve-outs, electronics and other stuff. We think it's going to remain around that level for some time, for quite a few months. And then it's going to come down to 60%. That's the assumption we're making. It's going to come down to 60% by the end of this year, start of 2026. For the rest of the world, we're just assuming something like 15% average tariff rate.
Okay, so China starts with 100%, comes down to 60%, and for the rest of the world, the base case tariffs should settle on an average of about 15%.
Yep.
And the global growth assumptions are based on that.
Yes, yeah.
Got that. Brian, pleasure speaking with you. Look forward to more conversations. Thank you once again for joining in and sharing your insight. Well, we'll slip into a break. On the other side, we'll discuss market fundamentals. Anirudh Garg from Inva Asset PMS joins in. Welcome back. All eyes will be on big boy Reliance Industries, and it's expected to be a fairly steady quarter for them. In terms of the pure numbers, top line growth seen up 1% quarter on quarter, 2.42 lakh crore. Year on year, the growth should be higher at about 2.5%. EBITDA is seen likely flat at 43,800 crore, which means margins mostly unchanged at 18.1, 18.2%. So what will be the drivers? On one hand, quarter on quarter, Jio will do well. That's the telecom business. That's because of the tariff hikes which the company took in July. There will be the residual impact. Also, Jio, compared to peers like a Bharti, Airtel or a Vodafone Idea, has a higher percentage of annual recharge customers, which means even in the current quarter, there will be customers who will recharge their overall package with the higher rates. And therefore, ARPUs are likely to improve, and this will drive Jio's performance. So Jio is going to have a good quarter in Q4. But on the flip side, retail will be subdued quarter on quarter because remember, December is a base festive quarter. So compared to the December quarter, numbers will always be weaker. Year-on-year growth is seen about 10 to 11% according to some estimates. Now, oil and gas is likely to be subdued. That's on account of lower volumes. O2C could be a bit mixed. Cracks are lower, but GRMs on account of better sourcing could inch up, on a quarter-on-quarter basis. So these are the key numbers. But the stock hasn't done too much. Right? It's been a bit of an underperformer. And also analysts are pointing out the stark difference between, say, a Bharti and Reliance. Right? Now, Bharti Airtel is pure telecom. Jio is a part of Reliance Industries. But Bharti Airtel in the last 1 year is up 40%, while Reliance Industries is down 10%, which means Bharti has re-rated vis-a-vis a Reliance Geo. So what is the street really watching, which can re-rate the stock, is the retail performance. So a lot of the analysts said that it was the weak performance of retail which has dragged Reliance down. So they want retail to come back to the growth trajectory, and that would be the key. And then you watch for other things like, the green energy commissioning, your capex, because if the capex intensity is coming down, your cash flows improve. So, but retail is going to be the key kicker in terms of re-rating. And secondly, if you do hear anything on monetization, that of course will be, much anticipated, and not anticipated is not the right word, but something everyone's watching and waiting for.
Absolutely key numbers to watch out for as well, and all the details over there. Thank you so much for that, Reema. Surely we'll be keeping an eye out on that. But on to a specific businesses now. So Darshan is joining in with us to tell us what to expect from oil and gas and O2C side of the business as well. So Darshan.
Two of the major divisions of Reliance Industries, O2C, that is oil to chemicals, and oil and gas, are estimated to report a mixed set of earnings for the fourth quarter of fiscal 2025. For O2C, while decline in diesel cracks and polyester margin may impact negatively, the weaker rupee against dollar that we saw in Q4 to an extent can offset the decline. And this may lead to a minor uptick in gross refining margin on a sequential basis. But year-on-year, there can be a fall. GRM for Q4 FY25 is seen coming at $10.80 per barrel. For oil and gas, lower volumes at KG-D6 Basin, which were down 4% sequentially and 9% year-on-year, likely to have a drag on the results. And as far as gas price is concerned, it was flat on a sequential basis and was up 2% year-on-year. Now, talking about the headline numbers, from Bloomberg estimates, for O2C business, revenue is seen rising both sequentially and year-on-year, while EBITDA and margin can see a decline on a sequential basis. EBITDA can fall nearly 2% and margin around 40 basis points. For oil and gas, both revenue and EBITDA are expected to slip nearly 3% each, and margin can be flat sequentially but hold on to levels above 87%. But in the recent past, we have seen that Brent crude has seen a sharp fall, but in the last few days, it has again moved higher. So we'll have to see overall what impact that it will have on the earnings of Reliance Industries.
Absolutely, Sudarshan. Thank you so much for that. That's going to be more in terms of, business specific that Sudarshan highlighted as well. As of now, Reliance is trading almost in the day's lowest point, down 0.7%. But let's bring on board Anirudh Garg, partner and head of research at Invest PMS, joining in with us to talk about the market on the fundamental front as well as sector-wise. What is he finding attractive? Anirudh, good morning. Thank you so much for joining in with us on the show as well. What have you made of the earnings so far? We had so many IT companies come out with their numbers as well. Reema did give us a roundup a short while ago. Today we have Reliance in terms of heavyweight reporting its numbers. Any thoughts on both these things?
Thank you and very good morning. I think the earnings are more or less in line with the expectations that everybody had. Our focus is primarily on both the sectors that you talked about. I consider Reliance as a sector only in India. So IT and private oil and gas, I think both these sectors are not the flavor as expected. We see traction in other sectors actually right now.
Okay, traction in other sectors that you find as well. Which are these other sectors that you're liking? And, given that global scenario that we're seeing as well, right? The possibility of tariffs, we don't know where that is headed. Domestic front issues are also going on. So how are you seeing overall in terms of a picking of sectors? What would you prefer right now?
Okay. So first of all, when we talk about the global macroeconomic scenario and the domestic scenario that we have on the LOC as well. So my experience of the last 16, 17 years has told me that whenever there is so much confusion, just focus on the growth. So we are focusing on growth and where expected growth is for the next 2 to 3 years. The first sector that we like, it is the CDMO and the CMO sectors. Look at the Laurus Lab results yesterday. They were in line with expectations and phenomenal. And we are expecting the same for other companies into this field as well. Apart from that, we like stock market intermediaries, all these into financial market infrastructure, be it an exchange or a depository or a good broker or a wealth manager, because somewhere the re-rating of this sector is being done. It has been done a lot, but I think there is still more steam to go as the market is, and the Indian market and the retail is developing over time. We've seen a significant shift from the FD culture to, the equity culture. Apart from that, the more these confusions of the global macroeconomic front arise, the more opportunities also arise. So if there is tariff war going on, we have to look for those companies which can benefit. So we are focusing on leaders of various sectors which have possible benefits out there. So something like a textile is one of those factors. And somewhere this market, all this confusion has led to a good, healthy correction in the market. And leaders of various sectors, be it consumption, be it defense, be it retail, all these companies are available at a massive discount right now. So I think we are in a comfortable zone. And if we have a 2-year vision from here, I think a good, healthy double-digit plus return will be, a CAGR will be seen.
Anirudh, is Reliance a part of your recommended stocks? It's such a large cap, and it's such a large weightage in, on the index. And what would drive an outperformance from here on for Reliance Industries? What exactly are you watching out for when it comes to the numbers this time?
Until and unless we feel that the markets are superbly expensive and we need to take a shelter, we do not go into these big shares. So our focus is generally to find those, I would say, mid-cap stocks that would, in a couple of years down the line, or maybe 4 years down the line, would convert into a large cap. So we never hold stocks like Reliance as per se, until and unless there is an extraordinary opportunity to be seen. We do not find any extraordinary opportunity in Reliance per se. I think it's a healthy company, but too many businesses, and sometimes it gets a little bit, you get away from the track. They're into good businesses, but these businesses take time. And apart from telecom, I do not find any business for Reliance, especially in the scenario that we are seeing crude, not bullish on the crude for the next couple of years. So we are not very bullish on Reliance from here. But I think, it'll be a market performer, not an underperformer or an overperformer from here. There are much better opportunities out there.
Okay, much better opportunities that are there as well. Earlier we had my colleague Parikshit, who actually spoke about, Apple having more of the production in India. So is that a story that you would be looking to play? Is there anything on that front that you find exciting as well?
When we look at we call it neighbors plus one, not just China plus one. So we are seeing a lot of traction in textiles when it comes from the problems in Bangladesh. And the trust factor, India has the trust factor, but along with it, the reality on ground is that you need companies and sectors which have developed over time. So if we see in India, the easiest way to look at it is what are the sectors that have led the previous bull runs in India. Those were the sectors which have, developed over time. So be it textiles, be it IT, be it pharmaceuticals, these are the sectors that India specializes in. And now when there is a global opportunity, these will be the people who will be first and early to capture those. For example, something like a semiconductor, there is an opportunity there, but India does not have the required infrastructure right now. Infrastructure will come with time. So let's focus on those companies which are already having a footprint and specialize in what they do. So since there is an opportunity, I think in reality, these will be able to capture them better.
Okay, and Anirudh, I was reading some views that came in for you as well. You were earlier saying that you re-entered the market and you booked your profit in the small cap and the euphoria that we saw last year. You booked your profits that time and then you re-entered the market somewhere around the 22,000 levels. Right in the last couple of days, maybe also we're seeing some bit of a profit booking. So your overall thoughts on the market, if you could just leave us with that.
So the reason for us exiting the markets was firstly the valuations were very, very high, and everybody knew that. Along with it, what we focus a lot is on behavioral finance, and we could see a lot of exuberance in terms of the greed that we saw in people, especially our clients, even us as fund managers. So we have our quant systems in place which are able to capture it in a better way. So we took an exit call in December and we entered at the 22K levels because both the sides flipped. The valuations were comfortable. We were getting the portfolios 30-35% cheaper. The small cap, mid cap index were 20-25%. The Nifty was around 20%. So this is what we look into. And the greed that was there has turned into extreme fear now. Trump tariffs. The situation at the LOC, there is a very simple rule, and it has helped us over the years, that markets in a bull run, they feed on bad news. And as I was talking to one of your colleagues as well, that to make solid bottoms, you need a good bad news, if I may say so. So a strong bad news, if that's the right word. So I think we are in a period of consolidation, and each dip that comes now, because the valuations are okay, there is no greed in the market right now. So somewhere we should be entering at lower levels. Every opportunity, every dip for us is a buy right now.
Every opportunity every dip is an opportunity that comes into buy. Anirudh, one more thing I just want to talk about, a sector that you've spoken about, you're highlighting is financials, right? So I want to understand in financials, what are you finding exciting now? We have HDFC, ICICI Bank, which reported a good number. Axis Bank on the other side, not that great, right? EU Small Finance Bank in its con call mentioned about how those MFI issues are easing now. So what are you liking in this space specifically on the financial side?
Okay, when it comes to the finances, we are liking the leaders right now. So we like the public sector banks, especially the bigger ones. I think even with the Axis Bank not having numbers that's required, I am still not bearish at the bank. I believe that's a very good management and things will get better from here. When it comes to the big heavyweights like HDFC or Kotak or an ICICI, wonderful numbers, wonderful technologies being in place. I think we have the best managed banks in the world. And apart from that, quality NBFC is also something like a Bajaj Finance. Disclaimer that we may have positions here and we may increase or trim them anytime, but not a recommendation to buy and sell. But yes, all these quality NBFCs are also looking good from here. So for us, finance is a major part of our portfolio, and we are bullish on finance for the next couple of years.
Thank you very much, Anirudh, for joining in. Need to get into a break on that note. On the other side, we get you the latest related to the Pelgam terror attack aftermath. Stay tuned. Welcome back. In the aftermath of the Pelgam attack, India sends a formal letter to Pakistan stating that the Indus Water Treaty will be held in abeyance. Pakistan terms it as an act of war and suspends all trade with India and even closes Pakistan airspace for Indian airlines. All bilateral treaties with India have been put on hold. Parikshit now joins in with the latest updates.
Well, yes, India has been retaliating. It has been inviting foreign envoys to the Ministry of External Affairs, briefing them about the linkages of Pakistan-based state actors to the terrorists who carried out that ghastly attack in Pelgam on civilians. Having said that, we're looking at complex military exercises that are being conducted by the Indian Air Force. Sukhoi fighters from all across the country are being deployed to carry out those exercises, those complex maneuvers as well. The INS Surat, the Navy carried out a missile test, an indigenous test also that happened yesterday. We're also looking at India and Indian forces retaliating at the LOC wherever the Pakistani forces are opening fire at India. There are anti-terror operations taking place in Jammu and Kashmir. We've sent a formal letter to Pakistan suspending cooperation on the Indus Water Treaty, and the letter by the Water Resources Secretary clearly states that the continued use of terror against India makes it absolutely impossible for India to meet its obligations under the treaty, and the circumstances have significantly changed since 1960 when the treaty was signed. So multiple efforts being done to corner Pakistan.
Okay, Parikshit, thank you so much for that and giving us the latest update over there. But a quick look at the market, 23,850-60 levels is what the market is trading at as of now. So 23,000, below the 23,900 mark, almost at a day's lowest point is what we're seeing the Nifty trading at, 370 points down in today's trading session. Banks also continue to be a bit under pressure as well. But that's where we'll end this edition of Trading Hour on CNBC TV18. Thank you so much for tuning in. Stay tuned in. Up next, you have Halftime Report.
Stocks slide as India-Pakistan tensions rise following the terrorist attack in Pelgam. Utilities, industrials and healthcare are the big losers, with midcaps bearing the brunt.
Axis Bank slips on weak loan growth and Tech Mahindra recovers from its morning lows, reacting to a mixed set of results, while SBI Life has climbed on a strong margin print.
Apple is likely to consider making India a hub to manufacture all Apple phones for the US market by next year, say sources tell CNBC-TV18. The decision to shift production will depend on adequate capacity ramp-up in India and the trajectory of US-China trade talks.
China's restriction on export of rare earth magnets is starting to hurt Indian electric vehicle makers, from whom this is a critical component. China is calling for end-user certificates from India's foreign ministry and the Chinese embassy for further supplies.
Investors look forward to Reliance Industries' fourth quarter earnings today, more so for the management's commentary on strategic issues than earnings. Analysts expect a steady quarter, with Geo's good show likely to be offset by softness in retail and a mixed show in oil to chemicals.
Good afternoon. You're with us here on Halftime Report, live from the CNBC-TV18 Motilal Oswal studios. I am Hormas Fatakia. With me, as always, is Mangalam Malu. Well, not a very good-looking screen, Mangalam, at the final trading day of the week. Of course, there are some tensions, so traders looking to keep their positions light as we head into the weekend.
Absolutely, and it's also the start of a new series, right? The market actually, after a near 2,500-point recovery from lows in April series, needed a reason for profit booking, and that exactly has come by. Nothing really to worry about as of now, but like Hormas pointed out, there is a reason for traders to perhaps look at lightening some of their positions. The reason I say there's nothing to worry about is because at lower levels, there is some recovery. Not particularly on the index, as you can see, as the low point of trade, the Nifty banked down 1,000 points as well. But look at the recovery of the day. Tech Mahindra, that is one of the biggest stories, right? Up nearly 6.5% from lows. Rima this morning had told us that these numbers aren't particularly bad. In fact, it's a decent show that has come in. And that's something that we've seen in IT stocks all through this week. The Nifty IT index comes up for you. For the last 3 trading sessions, Wall Street has been doing well. And IT index, after being battered out of shape, has continued to be fairly resilient, above important moving averages as well from a technical standpoint, and now holding on to gains. So supporting the index on the downside, and that's something we'll most definitely keep an eye out on. That's the IT index today. But if you look at the entire week, the Nifty IT index is actually among the top performing indices this entire week, with a gain of anywhere between 7 to 8% odd. So that's about the IT index, about 7% in the last 7 trading sessions. But the big development that we're tracking is coming in from Apple, and that's amidst the tariff wars right now. Apple aims to source all their iPhones, the US iPhones, from India in a pivot away from China, something that they've been trying to do for the last few years, but now maybe accelerating because of what's taking place between US and China in terms of trade wars. Parikshit joins in with the details. Parikshit.
Well, yes, Apple is considering manufacturing all phones for the US market in India, and India could possibly become a hub for Apple phones by next year. But this is the intent. It is a plan on the table right now, considering where the geopolitical situation is and the trade war with China is. The Chinese tariffs on certain products are as high as 245%, and the average reciprocal rate is almost 145 to 150%. Currently, in this environment, the US believes the right place to manufacture phones and export them to the US market is India. But a lot could change in case there is a US-China truce. Having said that, the company is considering increasing production to 40 million phones in 2025 itself. Now, if you look at the production last year, it was around 25 million to 26 million phones, and this year it could be as high as 40 million phones. Apple contract manufacturers in India are ramping up capacity. The Chennai plant has a capacity of around 20 million phones per annum, and that capacity is being maximized as much as possible. Foxconn's Bengaluru plant, which is a contract manufacturer for Apple, that will be operational within this month, and it will have a capacity of 20 million phones per annum at peak capacity. It will take some time to reach there. So yes, India in a geopolitically advantageous position right now, but a lot could change if US and China were to have a truce tomorrow. Apple did not respond to CNBC-TV18's queries.
Parikshit, hold on, because you're tracking another story, right? There's industry sources are also telling CNBC-TV18 that Indian electric vehicle makers are facing challenges because China has stopped the supply of rare earth magnets to India. What are you picking up here?
Well, rare earth magnets are extremely important for electric vehicle manufacturing. They're used in EV motors, in traction motors, and this could possibly challenge EV makers and component manufacturers in the country. Currently, there is inventory in the system. So next few months, there might not be a problem. But within a few months, if things don't change, the production could slow down and Indian EV makers could get impacted. So what's China doing? From the 4th of April onwards, they've put a condition that an end user certificate must be applied for and must be submitted by every company which is looking to buy and import rare earth magnets from China. Now, this means you have to get a notarized document saying that this is only for manufacturing vehicles and this is not going to be used for either weapon making or it could be given to third parties. So you'll have to give that declaration. Secondly, this end user certificate will not just have to be signed by the Ministry of External Affairs or the Indian Foreign Ministry, but also the Chinese embassy here in New Delhi. So this makes it complicated to get this dual authorization. The auto industry bodies and also the auto component makers have reached out to the Ministry of External Affairs for help. We believe that they will also be approaching the Ministry of Heavy Industries, the Ministry of Commerce for help as soon as possible. Let's see what happens. But yes, clearly there is some amount of alarm and panic in the auto industry as to what this restriction, this non-tariff barrier, so to say, could impact and the manner in which it could impact the auto industry.
Take that point entirely, Parisha. Thanks so much for that. Those are some industry-related updates coming in. Meanwhile, before we slip into a short break, just keep an eye out on a couple of these mid-cap names which are seeing a fair amount of sell-off. Cyient continues to do weekly in today's trading session. L&T Tech Services as well. SBI Card and Z Entertainment. That's the one that should come up for you. Currently at the low point of trade, and we are seeing some sell-off in names like ACC, Berger, and Nippon Life as well. Take a short break, and as we do that, we also get you a programming note. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact, and shaping the future. Nominations are now open. You can scan the QR code which is there on your screen and submit your entry for the SME Champion Awards Season 2. But even as the markets are lower in today's trading session, they've actually taken a bit of a sigh of relief after Donald Trump hit a pause in tariffs, and markets globally around the world are starting to come to terms with the reciprocal tariffs itself. This is about today, but if you look at the Nifty over the longer period of time, you've seen a bit of an up move that has come by. The world is, now coming to terms with the uncertainty that was earlier there. They're mapping it all out as well. So what's the roadmap for investment ahead? Our colleague Prashant Nair caught up with experts from Nomura to discuss what's next. He began by asking Rob Subaraman, who's the head of global macro research, when can we see finalizing of trade deals and what one should do in the stock markets itself. Listen in.
I don't think they'll be done quickly. I think trade deals take a very long time to do. Okay. I think the Trump administration will try to dress up some quick wins with some close allies and hopefully try to get some tariffs down. But, our view is that once tariffs go up a lot, and they have gone up a lot, we think the effective rate's 21%. They don't tend to come down that quickly. And so our baseline is tariffs are going to stay up pretty high. I think China has quite a bit of leverage over the US, and that trade tension will continue. And ultimately, Trump wants tariffs for revenue as well. So, tariffs are going to have a big macro effect on the US economy and economies everywhere this year is our bottom line.
So with China, what we've been hearing over the last 48 hours, should we read this as a bit sort of conciliatory, tempering things down a little bit, or is that reading into too much? I mean, things could change. We could hear something different over the coming days. What's your sense?
Well, look, right now, US tariff on China of 145%. I mean, essentially for a lot of trade between US and China, it's essentially stopped.
Correct.
So there will probably be some coming down. But the point I'd make is...
So between 10 and 145, there's
a big range, right? So
and Trump was, before elections, said 60%. So will we get down to 60?
We could get down to 60. And that has been our kind of a longer-term baseline around 60. But the point we'd make is that's still extremely high. And that is going to lead to a lot of, I think particularly for the US, a lot of inflationary effects. And it's going to hurt growth. Rest of the world, it's a different impact. It's more of a demand shock for the rest of the world, lower growth and less inflation. So there's going to be also a disconnect between central bank responses. We think the Fed is not going to be cutting rates quickly because of the inflation. We have the first cut in December. But for other central banks around the world, there's a lot of room for cutting rates.
You're saying that foreigners, and especially central banks, are selling US bonds. I mean, that has been happening, Japanese especially.
So we haven't seen it in terms of central banks. Okay. The data is actually
mixed.
It's actually quite mixed. But, you have on one hand the Treasury data, which shows you there's some direct selling from Europe. There's some direct selling that's coming from, let's say, China, Asia, ex-Japan as well. But then you have the safe haven, or the tax haven, should I say, places where you have seen actually buying. So it's a bit of offset. There's no consistency really about it on the central bank space. But certainly on the private side, it looks like something is happening there on the actual asset unwind.
I think that's the interesting thing. I think the central banks around the world have been diversifying away from US dollars, their reserves, for a long time. The new interesting thing is the private sector. Private institutional investors, big lifers, pension funds around the world, are they starting to diversify away from the US?
And the reaction, what we saw was interesting, right? Usually when stocks go down, I mean, bonds go up. But here you had a situation recently when everything was getting sold.
Yeah, long end US Treasuries, equities, it was basically almost get out of the US.
So that phrase US exceptionalism, are we at the end of it? What's your sense?
I mean, I wouldn't push it that far away at the end. I would certainly be saying that it's fading, right? That the evidence we're seeing is that it's fading. But at the end is still quite, I think of a push. It's a push to say that.
Sonal, let's come to India. It seems like we're first in line to get a deal. Would you agree?
Hopefully. I think we definitely have a head start. We started the negotiations ahead. The terms of reference have been finalized. India is a strategic ally. Now, deals take time. Agriculture is a politically sensitive subject for us, but there are other aspects of the agreement on the industrial tariff, parts of the non-tariff barrier, buying more of US products, which can easily be done. So I think if we can get the 26% reciprocal tariff down before the deadline, and our tariffs are lower than our competitors, then really in this world, what you're looking for is a relative advantage. And I think
will we have that relative advantage, Sonal? Because others also will negotiate, right? Others will also, for example, competitors in various industries like Vietnam, Cambodia, they'll also want to sort of lower tariffs, their respective tariffs, right? So it's all relative, as you said.
So I think most Asian countries are trying to negotiate with the US. The question is whether what they are offering will be acceptable to the US. One part of the deal is buying more of US products, but for countries like Vietnam, Cambodia, transshipment of China products has been an important reason for the reciprocal tariffs. Also, these other aspects of non-tariff barriers or whatever we want to call them. So, and right now we are seeing China trying to, also talk to Southeast Asian countries. It's putting Southeast Asia in a more difficult position in terms of choosing between US and China. I think for India, it's a lot more clear-cut. We don't have that transshipment problem. And therefore, I do think, relative to a number of our competitors, we do have an upper hand.
How long before we see a deal? Do you have a number in mind? How many days? How many months? With India, US?
No, I think the definition of deal is important. The trade negotiations run into years.
Yeah.
It's a deal on goods, it's a deal on services. This is going to take time.
But this is like the COVID emergency. We got the vaccine. COVID hit in Feb, we got the vaccine in November. So
the early tranche on some bits you could probably agree on by the 90-day, but the first tranche, of course, we are planning by September, October. The big deal, the real deal, is going to run into years.
Sign for equities. We're again back to, equities are snapback, right?
Yes.
And FIs are coming back, about a fraction of what they've sold over the last 8 months or so.
Right.
But they're coming back.
Absolutely.
But, very quickly here we tend to go back to high valuations and you're suddenly scratching your heads, now what, right? And you're waiting for earnings. I think your expectations in terms of earnings is lower than the street. That comes off the 5.8% number from Sonal.
Yes. So, yeah, Prashant, so basically, when we look at, through the pandemic, from fiscal 19 to 24, we had an, very strong earnings growth, north of 20%. Last year was a slowdown, fiscal 25. Now, fiscal 26 and 27, again, the expectations are around, mid-teens earnings growth. So if you look at, there's a lot of catch-up in earnings which has happened over the last 4 or 5 years. And if you remember the entire decade from 2010 to 20, we were struggling with corporate earnings, right? Consistent earnings cut. It was bound to happen, natural, sort of going back to a natural level of earnings and ROEs was bound to happen, and it happened over the last few years. So earnings to GDP ratio has bounced back. In fact, it's now very close to 2008, which is, just before the global financial crisis.
Sure.
With the kind of uncertainties, that we are currently dealing with, and if you look sector by sector, right, the profit margins are, on the higher side. And we are seeing downgrades there. So therefore, I think that, earnings to grow substantially above, let's say, a nominal GDP growth of around 10%, looks challenging, at least in the near term. And that's why we think that we will continue to see earnings downgrade. And on your question on valuations, right, I guess, currently we are just shade below 20 times 1 year forward earnings. We have breached 20 times in the past, especially the last few years. But I think, it's very difficult at this point to, foresee that level of valuation. So far, if you look at, there are, certain things which are in favor, like for bond yields are falling, which is positive for valuations. And the risk premium actually hasn't really flared up. It's still behaving.
But that's a risk. That's a risk.
That's a risk.
There's some recovery from the lows of the day for the Nifty now, almost 110 points higher from the lows of 23,847 that we have made. We are now above the 23,950 mark as we speak, but still 300 points down on the index. The broader markets too, at one point, the Midcap index was down almost 1,600 points or almost 1,700 points. That too has seen some bit of recovery, almost 400 points now off the lows of the day. We take a short break. Ajit Mishra of Religare Broking joins in on the other side with a chart check and some trading ideas as well. Stay tuned.
Welcome back. You're watching us here on Halftime Report, and perfect time to get you the F&O update at midday, day one of the May series. And it has actually started on the back foot if you are a bull. So Nifty down 300 points, the Nifty Bank down almost 800 points. So from record highs, we are seeing some profit booking on that index. The Nifty as well had seen a rally of almost 2,500 points from the lows. And we have the Midcap index, which is doing a lot worse as well. The India VIX has spiked as we've seen some profit booking in the market and from lower levels itself. And the market breadth tells you a story of the day where we are in the mood for profit booking, where we started with more stocks advancing. Thereafter, there was this intersection. And now as we speak, these lines have been parallel, but not before widening as far as 10 stocks in the red to one stock in the green itself. But there has been remarkable recovery in a couple of names as well. Even though the Nifty is broken below the 200-day moving average, closing above that would be something which everyone will be looking at as a next level on the way up whenever that happens over the next couple of days or couple of weeks, etc. But Tech Mahindra, look at the intraday chart, nearly 6.5% recovery. So were the Nifty to go ahead and reconquer the 200-day moving average, IT will have to play a strong part, which has been a strong index this week. And alongside that, some recovery from the lows on Nifty Bank as well. But as far as the options that expire next week are concerned, the option writers have made their call. On the way up, 24,000 call has seen a fair amount of writing for 222 rupees, telling you levels upwards of 24,200 might face some supply. In fact, we've also seen writing at the 24,200 call itself, 24,300 call. So 24,250 to 24,350 is the supply zone for the market. But at the lower level, we are at around 23,900, and that is where a lot of the put writers are fairly active as well. So 23,900 put, telling you that close to around 23,750 to 23,800 is where the support is likely to be seen for the frontline index. Looking at a couple of stocks now, we do have a bunch of them which are in focus. A lot of long positions added on SBI Life. We'll shortly be speaking to the management post their results as well. And then a lot of short positions added on names like Scient and Inox Wind in particular. So we'll most definitely watch out for that.
We'll watch out for that indeed. Some important triggers to watch out for the May series, but there is indeed some recovery from the lows of the day. Ajit Mishra of Religare Broking joins in on the show now. Ajit, good afternoon. Thank you for joining in. Is this much needed dip that the bulls were hoping for to re-enter into the market after that 7-day rally? Would you use this to re-enter and initiate longs, or would you wait on the sidelines for more clarity to emerge?
Yeah, good afternoon, Omar. So yes, I would have said yes to entering fresh, considering that if we have more days to the trading days to the week, because now we are seeing this unfolding new event unfolding related to India and Pakistan. So this thing has definitely dented the sentiment. That kind of rebound that we've already experienced from the recent lows. Market was anyways trying to find some reasons to correct after 2-3 days of consolidation. I would rather prefer to sit on the sidelines and see whether we manage to hold this area or not. Means 23,800, which was previously acting as a resistance, should act as a support now. The major support exists around 23,400 mark, where we have all the major averages are aligned. So maybe next week, at the beginning of the next week, we can consider going long if Nifty manages to hold this 23,800 mark.
What about specific stocks, Ajit?
So in a market like this, almost it's prudent that one should maintain position on both sides. So one stock which has been holding well amid all this choppiness is Marico. The stock is trading to its record highs, closer to this record highs, and we are seeing the consistent outperformance within the FMCG space. So 740 is what we are eyeing in Marico in the near future. So with stop at 695, one can go long. At the same time, IGL is offering a fresh shorting opportunity after this recent attempt of failure to reclaim its short-term averages. It has formed a fresh shorting pivot. So 172 is what we are eyeing in IGL on the lower side. So with stop at 184, one can go short in IGL at current levels.
All right, Ajit, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. Take a short break. On the other side, the management of SBI Life joins in to talk about their fourth quarter numbers. Stay tuned.
investing.
Welcome back. Still 100 points off the lows of the day now for the index. So there is some recovery that we are seeing from the lows, some buying interest emerging. Now it'll be interesting to see as we go into the second half of the trading session whether this bounce is being used to sell into or this actually sustains and we cross that 20-day moving average as Manglam was speaking about just a few minutes earlier. By the way, SBI Life is continuing to trade around 4.5% higher, is the top gainer on the Nifty 500. Of course, at one point was up almost 9%. Brokerages are expecting targets of in excess of 2,000 rupees on the stock. So we'll keep an eye out on that. But of course, the story of today has been Midcap IT, be it Emphasis, be it Persistent Systems, be it Coforge, and of course the recovery in Tech Mahindra, but that's of course a large cap IT name, but it is the mid cap IT that has dominated proceedings today. Emphasis is now up 4% and Persistent Systems also is up 2.5%. Coforge is up 1.5% as well. But of course on the other side, the other mid cap IT name that has not done very well is Cyient. That's down around 5.5% in today's session. Among the top losers in the broader markets though is Motilal Oswal. Numbers should be out anytime now in a few minutes. That stock is also down 7% as we speak as the top loser on the Nifty 500 ahead of its results. And Garden Reed Shipbuilders too seeing some bit of selling pressure in today's session. That too is down 6.5% in today's trade. But we were talking about SBI Life and the numbers were higher than expectations with VNB margins rising over 220 bips on a year-on-year basis. My colleague Yash Jain spoke to Amit Jhingran, the MD and CEO of the company, and began by asking about their anticipated growth outlook for the new financial year. Listen in.
These numbers have been a result of the continuous implementation of a strategy that the company had for the entire financial year, and particularly the Q4 we have been able to reap the results of whatever we did in the first 9 months. That resulted in growth on a very strong pace. You will notice that this 9% growth on individual APE basis, it is around 13%. So we are satisfied with the kind of growth that we have got. And going forward in the next financial year also, we are looking at a growth of around 14% on individual APE basis.
Okay, a 14% growth on the individual APE basis, and considering the share which individual APE has out of total APE, what is the kind of growth that you anticipate on the total APE basis? Because that will also help us to understand, the things on VNB as well as the margin side.
Company is very mindful of having a growth which is optimal for all the stakeholders. So you would have noticed that during the last financial year, our group mobilization was somewhat muted, and that was because of the market conditions. We didn't find it worthwhile to go very aggressive because that would have been margin negative. For the coming year, we will see how the interest rate scenario in the market works out, and depending on that, we will have appropriate strategy in the place.
Okay.
We will be continuing to be mindful of the optimum benefit for all the stakeholders.
Okay. But the number on the total APE basis, do you have a number in mind, just like you're targeting?
It should be somewhere around 12%, I believe.
Okay. One question that I want to understand before I speak to you about the margins is on the ULIP portfolio. Of course, for the industry, less for you, but still a higher ULIP portfolio, higher traction there does impact margins negatively. Now, in the fourth quarter, because of the market volatility, the ULIP interest did come down for players across the industry. For you, I want to understand fourth quarter FY25 on a year-on-year basis, how did the ULIP share change out of your total product mix? And now first quarter, is the demand for ULIP starting to come back again, or do you think it's more or less stable at the same level?
The contribution of ULIPs in the Q4 for the company was also muted, but it was on account of two factors. There was one, volatility in the market which might have affected. But secondly, also company's conscious strategy to have a healthy product mix. We launched 4 new products in traditional segment, in participating, non-participating segment, in the children segment and all. And during the quarter, we got some good traction. We also focused on making our agents and distributors active on these products. So that resulted in a healthier mix, lower ULIP portfolio in the Q4.
If I have to now speak to you about the margins came in much ahead of estimates, about 30%. Now, I just want to understand from you in the fourth quarter, what helped the margins going forward? As I said, your AP is expected to grow at about 12%. That will align in your favor. You'll have a better product mix, a more stable product mix, and favorable base effect also. For FY26, where do you see the margins to come in?
So during Q4, our VONB margin was at 30.5%, which showed a healthier growth on account of the change in product mix, which the company has been planning for last 3-4 quarters, and it started yielding results.
Okay.
Going forward, we provide a guidance of around 28% at the existing level for the next financial year also.
Okay. You said you are providing a range. Now, when you say 28%, would the range be 26 to 28%, or would the range be 28 to 30%?
I will say it will be around 27 to 28%.
27 to 28%.
Maybe some positive bias.
Okay. So, as you said, a total AP growth of around 12%, retail AP growth of about 14% is what you expect, and margins of about 28%.
Yeah.
Right? Accordingly, would the VNB be about 13 to 14%? Is that understanding correct?
That is what I am looking for, around 14% of VONB growth also.
VNB growth. One other thing that I want to understand, and this is on the distribution mix. You've been focusing very strongly on the agency network also. The agency is growing much faster than bancassurance. What is the growth that you expect in both agency network for FY26, bancassurance for FY26? And as far as the distribution mix itself is concerned, now if I look at the numbers, your distribution mix from bancassurance did come down in the financial year as compared to agency. Where do you see more changes coming in that distribution mix between agency and bancassurance in FY26?
Company has identified a lot of opportunities in the agency channel also. And that is why in last financial year, from the month of April itself, we launched an initiative called Agency 2.0. We have been opening more number of branches, employing more agents, and also trying to improve the agent productivity. All this has resulted in a good growth of 23% in the agency channel in last financial year. So this higher growth in agency channel has provided us in mitigating some of the concentration risk in the distribution channel, also improving the agency channel contribution by around 2%. Going forward also, we will continue to tap opportunities by creating more infrastructure in agency channel, opening more number of branches, and improving agent productivity. So we are looking for around 25% growth in agency channel in the current financial year also.
In the current financial year. The share right now of total APE between bancassurance and agency is 61% to 28%. How do these two numbers change with the growth that you're anticipating?
So we are looking for a 25% growth in agency channel, which may give a agency channel contribution of 30% plus in the coming
30% plus. And bancassurance will come down in a similar proportion then in that case?
Obviously, but not because of any reduction in bancassurance channel, but because of the higher agency contribution.
Okay. Just a little word on the higher surrender value. It kicked in from October, the regulations. Has there been any impact on the margins? Though the margins have been strong, but still, could the margins would have been a little stronger if, not for higher surrender value? Do you think there was some impact in the second half of FY25? And in FY26, do you stick to what you had said, that the impact on the margins won't be more than 50 basis points because of higher surrender value?
What was in favor of the company that our surrender values prior to the regulation were also higher. So with the introduction of new product range in line with the changed regulation, our pricing didn't get affected much. So the actual experience of surrenders will start coming after 1 year of the product introduction only. So we are very sanguine that our assumptions, whatever we have made for the new product range, will stand out, and we will see how the actual experience vis-a-vis our assumptions come out, and will decide accordingly.
Right, that was the management of SBI Live. The stock doing extremely well. The management sounding reasonably optimistic as well. With that, we'll take a short break. And as we do that, even as the market has shown some signs of recovery, and we started the show, it was closer to 23,900. Now it's closer to 23,975. So there has been a recovery from the lows. We'll get you some good news. That is India's business news leader, which is CNBC-TV18, is now just a click away, which is the CNBC-TV18 all-new app, which gives you instant access to breaking news, in-depth articles, financial world updates, all of them at your fingertips. What you got to do is download the app, and you can either get it from the Apple Store or the Google Play Store, or just scan the code, which is there for you on the screen. Welcome back. Sources say, tell to CNBC-TV18 that the spectrum dues to telcos equity conversion is not automatic. Telecom department is open to considering applications for telcos for equity conversion. What this means and what are the stocks on our radar? My sense is it will be Vodafone Idea that will be impacted by this. We'll get Ashmit for bringing more details. Ashmit.
Well, important clarification coming in. We spoke to various government officials. What they're telling us in very clear terms is that as far as the application process is concerned for this equity conversion, this conversion will not happen under an automatic route. So just because a company has made an application does not mean that automatically that spectrum due or that AGR dues gets converted to government equity. What the government officials are telling us is that there is a process, that there is a certain amount of discretion that the government will exercise in terms of converting these spectrum dues to equity. In fact, there will be application of mine and a decision will be made on a case-to-case basis is what various government officials are telling us. So essentially clarifying, it's not an automatic transition that takes place. What government officials also tell us is that companies, of course, are free to apply under this scheme, under the 2021 cabinet scheme, and that the government will take, the government is not bound to make that transition, but that the government will take an informed decision and will exercise discretion on this conversion. Another key clarification that has come in from government officials is that both AGR dues as well as spectrum dues will be eligible for conversion under this equity conversion scheme. And that, of course, is where we need to bring in the context. So far, the only equity conversion that we've seen so far is in the case of Vodafone Idea. What government officials have previously told us is that now the fresh applicant is Bharti Airtel. Bharti Airtel is also seeking parity with Vodafone Idea, is seeking similar treatment with Vodafone Idea, and therefore is seeking this conversion. And just to set the context, in 2021 is when this cabinet relief had been allowed, had been granted the nod. And under this 2021 scheme, at least as per the language that was used back in 2021, it was eligible. Only spectrum dues that were for spectrum that was bought before 2021 is something that was eligible for this equity conversion. So clarifications coming in from highly placed officials within the DOT. Back to you.
All right, Ashmit, thank you so much for that important update there. Meanwhile, IEX is the other one that's doing well for itself today after a mixed fourth quarter. Revenues were below analyst expectations while profits were in line with what the street was anticipating. Vinny is joining in with more on the numbers and what the management had to tell us earlier in the day. Vinny.
Hi, afternoon. So in terms of IEX numbers, it is a mixed number like you mentioned as well. Revenue was below what the street was expecting. Motilal Oswal even highlighted that this could be mainly due to the reason of low per unit transaction fee that is there, and that could have been something that impacted the earnings of IEX, especially in terms of revenue. Profits in line with estimates. Profits saw a growth of around 21% on a year-on-year basis, but EBITDA margins, that's seen a contraction of 93 basis points YOY. Now, what the management actually spoke to us about, because volumes is a key for IEX, right? So they said that they have seen electricity volumes that grew by around 19% for FY25, as well as the certificate volumes growing by around 100% in FY25. They expect this 18 to 19% growth in FY26 to continue as well. They saw a jump of 100% in IGX volumes in Q4, and they see a good growth potential going forward from here on as well. So we could see this building on in terms of momentum from here on. Other than that, there is a lot of inventory is what the company highlighted, and they expect prices to remain stable. And now, given the stabilization in prices, they are saying that there is some bit of a room in terms of growth that they could have here on. So IEX, that's why it's in focus. We're seeing a gain of almost more than 1% in today's trading session as of now.
All right, Vinny, thanks a lot for that. It's the mid-cap IT stocks which are on our radar as well. In focus was their fourth quarter earnings. Companies like Persistent Systems and Mphasis beat street estimates. Mphasis actually is currently at the high point of trade. We have L&T Tech and Cyient, which were a miss as well. So which is why we have, L&T Mindtree, which is L&T Tech Services and Cyient, which are lower in today's trading session by about 5 to 6%. Rima joins in to tell us more about the report card of the mid-cap IT numbers that have come by so far. Rima.
Yeah, there's been a flurry of, mid-cap IT earnings. But if you had to summarize, you could say that the strong are getting stronger and the weak are disappointing. So when you mean by strong, we're talking about companies like Persistent, Mphasis, and Coforge is still awaited. But these are the companies which have positively surprised the street despite the tough macro, while companies like Cyient, LTTS, which have had a few rough quarters and the stocks have underperformed, have disappointed the street. Now, onto the numbers. This time, Persistent, Coforge and LTTS reported a positive revenue growth. But the beat came in from Persistent, 4.5% versus estimates of 3.8%, and Mphasis was also slightly ahead of street expectation. LTIM, LTTS, Cyient missed the mark on the top line. For LTTS, the numbers look good, like you see a 10.5% revenue growth, but that includes the IntelliSwift acquisition. The estimates were actually for a 13% growth, which is why L&T Technology Services, despite the double-digit top-line growth, is actually a miss. Now let's quickly get to the guidance. Now Persistent maintains its FY27 annual guidance of $2 billion, $5 billion by FY31. They're also on track to improve margins by 200 basis points, and they're also hopeful of outperformance. Mphasis is guiding for above industry growth rate. LTTS is saying that FY26 should be better than FY25. They're looking at a double-digit growth rate, but some people on the street were hoping for a stronger guidance. So their own internal estimates were that LTTS would do a high double-digit kind of a growth given the acquisition. So in that context, just a double-digit has disappointed the street. And Cyient is the one where the guidance is actually the most dismal. Firstly, there is no revenue guidance. They expect the uncertainties to last for the first half of the year, and even the margin aspiration has been lowered and pushed further down. Now they're looking at a 15% margin over the next 2 years.
Midcap IT indeed stronger, getting stronger, the weaker not doing very well for itself. But from IT we move to auto as the sector begins its results today with the onset of Maruti, and with our offering quarter se quarter tak, Sudarshan is here to highlight what the street is expecting from the auto sector this time around. Sudarshan.
So the Indian auto sector has faced a turbulent FY25 with overall sentiment subdued, particularly during the second half of the year. Macroeconomic headwinds, uneven rural recovery, regulatory changes and shifting consumer preferences have all contributed to the sector's volatile performance. For the last quarter of FY25, the divergence in growth projections is becoming increasingly evident, with estimates ranging widely from a modest 2% to a robust 23%. Reflecting varied expectations, let's begin with the reported volume numbers across key categories. On a year-on-year basis, tractor sales have emerged as the biggest outperformers, aided by relatively stronger rural demand earlier in the year. However, on a sequential basis, the same tractor segment has witnessed the sharpest decline, indicating weakening momentum and seasonal moderation. Excluding tractor segment, most other segments have posted modest year-on-year growth. Two-wheelers and three-wheelers have seen low to mid-single-digit growth year-on-year, with sequential declines driven by soft rural demand, higher base effect, and limited festive tailwinds. Passenger vehicles and commercial vehicles, in contrast, have reported sequential growth, with PVs benefiting from stronger demand and SUVs and new model launches, and CVs gaining from infra and construction-related activity. On the revenue front, the overall sector is expected to post around 10% year-on-year growth. In Q4, however, as with volumes, the revenue performance will be far from uniform. The two-wheeler segment is expected to show the widest range in performance, with estimates varying from 2% at the lower end to 23% at the upper end, depending on product mix and pricing power. Four-wheelers are projected to deliver double-digit growth, supported by a strong mix of premium and mid-segment offerings. Notably, tractor segment is expected to outperform on a revenue basis, with an estimated 20% growth on year-on-year. And that would be largely driven by pricing actions and earlier demand strength. Amid this uneven landscape, certain players are expected to emerge as outliers in terms of performance. In the two-wheeler space, TVS Motor and Eicher Motors are likely to surprise positively. TVS is benefiting from urban recovery and premiumization trends, while Eicher continues to gain traction through Royal Enfield's steady domestic and export performance. Among four-wheelers, Mahindra & Mahindra stands out with a strong SUV portfolio, robust order book, and agricultural equipment division contributing positively. Within auto ancillaries, Samvardhana Motherson is positioned to be sectoral outperformer, aided by global diversification and increased content per vehicle. From a valuation standpoint of view, the sector appears relatively attractive. With a few exceptions, most auto companies are currently trading at or below their 5-year average price to earnings multiples. And as far as stock performance is concerned, except TVS, Eicher, Maruti, and Ashok Leyland, all the companies that you can see on your screen here have given negative returns in 2025 so far, with biggest declines seen in auto ancillary names on the back of global uncertainty. Let's wrap with the outlook. In the near term, outlook for the sector looks optimistic. The anticipated implementation of the 8th Pay Commission and income tax reliefs are likely to aid the growth for two-wheelers and lower-end car segment. And for tractor segment, Met Department has predicted above normal monsoon for current year, and that is likely to boost rural income, leading to an increased demand.
Right, Sudarshan, thanks a lot for that comprehensive outlook into what one can expect from the auto sector in the fourth quarter. We're awaiting numbers from Maruti, but seems like from everything that has been expected so far, tractors would be the clear winners in the fourth quarter. Take a short break, come back, get you more on the markets and a lot of stock-specific action.
Welcome back. The bulls fighting tooth and nail to get the Nifty back to that 24,000 mark. Is still at 23,970 as we speak. And of course, all eyes are on the big boy Reliance Industries. They'll be reporting results after market hours later this evening. And Rima is here to tell us what to expect from Reliance Geo, the telecom vertical. Rima.
So Reliance Geo is likely to be the growth driver this time around. So on the top line, we're looking at a growth of a little more than 2%, revenue seen at 29,925. And this will be driven by a combination of ARPU increase of 1.5%. And some subscriber ads. Now, ARPU is going to be critical. It's been going up for the last couple of quarters. And remember, in July, the entire industry had taken a price hike. And the benefit of that is still flowing through. So in the current quarter, according to our poll, the ARPU should increase to 206 versus 203. And for Geo, they have a higher percentage of annual recharge customers compared to its peers. So that explains why, even after 3 quarters, they will get that benefit of the tariff hike. Subscriber ads seen at about 5 to 6 million on a sequential basis. Now, margins are seen on the flattish side, 52.8%, and the profit number, according to the CNBC-TV18 poll, should be 6,515. 2 key things to watch. One, the fixed wireless access, where the ARPUs are much higher, basically a 5G, that is seeing pretty robust addition. And secondly, the IPO timelines, because that is the monetization all investors are awaiting. So good numbers expected from Reliance Geo, and that standard disclaimer will come up for you on the screen.
The IPO timeline indeed, Rima, thanks a lot for that. But we look at retail as well. And, talking about the retail sector this time around, let's set this scale up. First things first, for Reliance Retail in the third quarter, it was a stellar quarter that had come by. It was a record-setting quarter because it also had festive seasons, etc. It was above all expectations. So would that continue in the fourth quarter? Perhaps not. The street is expecting a bit of moderation in the retail growth year on year. And at the same time, quarter on quarter, there might actually be a decline. So if you look at the trend of the retail sales over the last 5 quarters, you would see that 4 out of 5, Reliance Retail has done sales of anywhere between 75 to 76,000 crores every quarter. It was just the last quarter that saw a spike, which was on account of festive season. So we might be somewhere in the middle of 76 to 90,000 crores in terms of quarterly sales for the fourth quarter as well. What will be more crucial to watch out for would be the EBITDA. Out there, the analysts expect between 11 to 12% jump in the retail business EBITDA year on year. And some say that upwards of 15% would actually be a positive surprise as well. So put all those numbers together, you're working with an EBITDA range for Reliance Retail this time around between 6,400 to 6,550 crores. Again, a number above 6,600 crores would be considered positive. What I'll be watching out for, apart from these numbers, are some strong internals. The most important one of them being what happens to Campa. Remember, Campa has been fairly aggressive when it comes to launches and expansions in terms of production and distribution as well as marketing. At the same time, there are new formats, the likes of Tira, we have Swadesh and Ustar, which is the value fashion doing extremely well. New commerce, which accounts for 18% of their sales, is something where we'll track the developments in as well. And to close the loop on Campa, remember at the end of the third quarter, they said that it's over 10% market share in select states. And at the same time, they are looking to clock over 1,000 crores in terms of sales for this financial year. What do they do in the next financial year is something I'll be tracking fairly closely for Reliance Retail as well.
Interesting. And we keep an eye out on all of these. Reliance Retail and Geo are touted to be the growth drivers, right, for Reliance going forward. Be interesting to see how the numbers pan out. By the way, still at 23,980 now, so taking 10 points ahead towards that 24,000 mark is the Nifty, but still 270 points lower on the index. The Sensex is down 800 as well. Navin Fluorine has emerged as one of the outliers in what has been an otherwise weak broader market. That is up 3.5% in today's session, bucking the trend as we speak there. So 3% higher on Navin Fluorine. Nava is another one. That stock is up around 2%. But while Motilal Oswal is down around 6.5% ahead of its results, there is Nuvama Wealth that's up almost 3% on the flip side. But with that, we call time on this edition of Halftime Report. Mangalam and I will be back in another 30 minutes. But for now, Business Lunch takes all the action forward.
Indices see a mild recovery from day's low even as India-Pakistan tensions rise following the terrorist strike in Pelgam. Utilities, industrials and healthcare are big losers, with midcaps bearing the brunt. IT sector bucks the trend. Axis Bank slips on a weak loan growth and Tech Mahindra recovers from morning lows, reacting to a mixed set of earnings, and SBI Life climbs on a strong margin print. Apple is likely to consider making India a hub to manufacture all Apple phones for the United States market by next year, says sources. They tell CNBC-TV18 the decision to shift production will depend on adequate capacity ramp up in India and the trajectory of US-China trade talks. China's restriction on exports of rare earth magnets is starting to hurt Indian EV makers for whom this is a critical component. China is calling for end-user certificate from India's foreign ministry and the Chinese embassy for supplies. Investors look forward to Reliance Industries Q4 FY25 earnings today, so more so for the management's commentary on strategic issues than on earnings. Analysts expect a steady quarter, with Jio's good show likely to be offset by softness in retail and mixed show in OTC. Hello, good afternoon. You've tuned into CNBC-TV18. You're watching Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwal, and thank you so much, as always, for tuning in. A look at the markets, right? At one point of time, we did see the Nifty go below the 23,900 level. Now has made that recovery. Look at it, 24,000, again back to the 24,000 level. So that's exciting coming in the last half an hour or so. We've seen this recovery come in for the market. 0.8% of decline still is what we're seeing for the Nifty 50. 219 points down still in today's trading session. That's what the Nifty is looking like. Let's look at the contributors and what is actually contributing in terms of supporting the market and what is dragging the market. So what's dragging the market is the banking side. We have the private banks. So look at it. Axis Bank, HDFC Bank, ICICI Bank. These private banks are not managing to support the market. Even Bharti, Airtel is actually dragging the market. Well, what's supporting the Nifty 50 actually is Infosys, SBI Life, good numbers coming in. TCS, IndusInd Bank is something that is supporting the market. Look at the Nifty Bank also, given that, so many banking names are dragging. Nifty Bank also is down almost 1.2%, recovered from the day's lowest point nonetheless. Advance decline ratio, yes, it's in the favor of declines versus advances today. So that is something to watch out for. Advances at 268 versus declines of around 2,314. And, because of that, what we're seeing also is the mid and small cap clear underperformance that's coming in from the broader end of the market today. Both these indices, whether you look at the Nifty mid cap or the small cap, are down almost 2% in today's trading session. So, yes, look at it. The recovery is coming overall in the market. When we started the Nifty also see a recovery, we're seeing the Nifty mid and small cap is also seeing some bit of a recovery from the day's lowest point. So, that is something interesting to watch out for. Let's also look at Nifty IT, right? That's that green coming in the screen today, because other than that, we're seeing all the sectors in the red. So Nifty IT today is doing well. 0.7% of gain, went in the red also at one point of time. And as of now, Nifty IT holding on to gains of 0.7%. Like I mentioned in today's trading session. Some of these individual names I want to highlight that is coming in from the broader end of the market. They've seen a recovery coming in from the day's lowest point. HPL Power is one of them. In the last few hours or last hour or so, we could say it gained 3%. So almost from the day's lowest point, that has seen a good recovery coming in. HPL Power. K-Fintech, that's another one as well, which is holding on to gains right now of 0.5 to 0.6%. But from the day's lowest point, almost a 3% recovery that's coming for K-Fintech as well. So yes, that's something to watch out for in today's trading session. We are seeing some bit of a recovery there. But let's move on and bring on some of these domestic issues that are going on. And especially in the aftermath of Pelgam attack, India sends a formal letter to Pakistan stating that the Indus Waters Treaty will be held in abeyance. The Army Chief Upendra is also in Kashmir to take stock of the situation on ground. Parikshit is joining in with us to give us more details on this front. Parikshit.
Well, yes, the army chief is in Jammu and Kashmir right now. He is meeting the 15 Corps commander and other military leaders in the region, and all of them are briefing him on the security preparedness in the region. Also on the ceasefire violations by Pakistan overnight and how India has responded. There has been no fatality, but we're told that the Indian forces are reacting in an effective manner to ceasefire violations by Pakistan along the line of control. Having said that, there is a military exercise that is underway in the country. This is called Akraman. The Indian Air Force is carrying out complex military exercises whereby Sukhoi jets from different parts of the country are being involved. There are maneuvers taking place, and all of this is to send out a very strong message of strength to Pakistan and the world that India will not be deterred. At the same time, the Indian Navy has test-fired a medium-range surface-to-air missile in the Arabian Sea that happened yesterday via INS Surat. So that's a story we're following very closely. On the diplomatic front, India has now sent a formal letter. That is, the Secretary, Ministry of Jal Shakti, has written to the Secretary, Ministry of Water Resources in Pakistan, suspending the Indus Water Treaty. India has communicated in as many words in black and white that the sustained use of cross-border terrorism against India makes it absolutely impossible for India to meet its obligations under the Indus Waters Treaty, and therefore we will not be able to follow it and respect it anymore. So India can now work on restricting the flow of water to Pakistan. We can stop sharing flood data with Pakistan, stop visits of officials to our dams in the region as well. So a lot that India can do on that front. The visas for Pakistani nationals have been cancelled, including all existing ones. So everyone who is in India right now must return immediately. We also are seeing meetings take place at the Foreign Ministry in India, where envoys of different nations are being called. They are being briefed on the linkages between Pakistan, the state actors, the army, and the terrorists who killed civilians in Pelgam. A lot of show of support for India, not just from President Trump, but by Prime Minister of Japan, Prime Minister of Italy, Prime Minister Netanyahu of Israel, also President Macron of France, and King of Jordan as well, who called the Prime Minister. So lots of solidarity, lot of show of support, but India now working on different options and saying that we will retaliate at a time and place of our choosing.
Absolutely, Parakshit. Thank you so much for giving us the latest update on this front. And, viewers, we'll keep you all updated more on this front as well going forward. But on that note, we're going to slip into a very short break. When we return, we'll put the spotlight on the markets, focus on some of the stocks that are in focus today, specific action on that front. So stay tuned in for that. Welcome back to Business Lunch on CNBC-TV18. Let's get more stock specific from reports that are reported, earnings that are reported to earnings that are expected to be reported. Firstly, let's start with Axis Bank because that's under pressure today. Q4 numbers don't seem to be exciting the street. But what is the main detail coming in from Axis Bank this time? Why is the street not happy with the numbers? Abhishek is here to give us more details.
Well, Axis Bank saw weak business momentum on a YOY basis. Take a look at deposit growth. It's just 9.8% YOY, perhaps the second lowest that you are seeing in last 16 quarters. Sequential business momentum saw a bit of uptick thanks to deposit growth of 7% quarter-on-quarter, which was one of the best in last 8 quarters. However, advances growth disappointed. So advances growth was at 7.85% YOY, which is perhaps the lowest growth that you are seeing in last 16 quarters. And sequential growth in advances was about 2.6% quarter-on-quarter. Now, what disappointed in the loan growth was the housing finance segment and the auto segment. So the housing sector and auto sector, both of them saw their loan book decline on a sequential basis. Cost to income ratio or operating efficiency was one of the worst in last 5 quarters. It was the highest at 47.8% versus 46.2%, the highest that you are seeing in last 5 quarters. Slippages were the heartening point, 4,800 crore. We saw a decline of 11.5% quarter-on-quarter, and thanks to highest write-off in 16 quarters, asset quality improved for them. So gross NP ratio came down to 1.28% versus 1.46%, perhaps the lowest that you are seeing gross NP ratio in last 39 quarters. Now, risk-weight asset to advances ratio, that increased to about 111.4% versus 109.8% in the previous quarter. It is at a 5-quarter high and does not augur well given the fact that risk has been built in the balance sheet a little on a sequential basis. The PNL NII was in line with our poll. However, the PAT on account of low provision beat our poll. Back to you.
Okay, Abhishek, thank you so much for that. But wait on, because SBI Cards, that's the one that reported its earnings as well. Doesn't seem like a great number coming in from this one as well. So as of now, stock is down almost 5-6% in the trading session. What are the details for SBI Cards?
Well, credit cost was actually continues to impact SBI Card. It remains on the higher side despite the fact that it's improved slightly on a sequential basis. So take a look at quarterly spends. They are up nearly 11% YOY and about 2.5% sequentially. However, the receivable per card, that's declined both YOY and quarter-on-quarter. So card receivables, that is AUM, is up only 9.8% YOY and close to 2% sequentially. The net interest margin improved for them after many quarters. So it improved to 11.2% versus 10.9% in the same quarter last year and about 10.6% in the previous quarter. The annualized credit cost remained elevated at 9% when compared to 9.4% in the previous quarter. The revolver rate continues to remain low at 24% flat YOY and quarter-on-quarter. The NII growth was 7% YOY and about 2.3% sequentially. The PAT declined by 19.35% YOY and grew by 39.4% sequentially. In the con call, the management has mentioned that, a 6 to 7% credit cost range in the foreseeable future is actually very far for them. Back to you.
Thanks so much for that, Abhishek. But let's move on to earnings that are expected to be reported today. We have big boy Reliance Industries that will report at Q4 FY25 earnings. Rima is joining with us to give us the key expectations.
Steady and strong, that's the way perhaps to describe the expectations from big boy Reliance Industries earnings in the March quarter. Now, on the top line, about a 1% revenue growth, 2.42 lakh crore. Year on year, the revenue growth would look more at 2 to 3%. EBITDA is seen on the flattish side. So 43,800 crore on the EBITDA, which means EBITDA margins of 18.1%, and profits are seen lower slightly, just about 2%. Now let's talk about the individual businesses. So Jio is going to be a growth driver. Jio is going to have another good quarter because the July tariff hike benefits will continue to flow through. Oil and gas is likely to be a bit subdued on account of lower volumes, and even retail is likely to see some sequential softness. So if you remember, Q3 is typically a very strong quarter for retail on account of festive season. So therefore, quarter on quarter, the Reliance retail EBITDA could be down, but year on year, it's still likely to report a growth of about 10 to 11%. And O2C is likely to have a mixed quarter. Cracks is slightly lower, but on account of better sourcing, perhaps the gross refining margins for O2C could be up. Now, the stock hasn't, year to date, it's up close to about 6%, but from its 52-week high, the stock has fallen close to about 20%. But bear in mind that a peer like Bharti Airtel, at least a peer in the telecom business, has outperformed Reliance Industries by 50% in the last 1 year. So investors are saying at some point, at least, there can't be so much disparity between Bharti Airtel and at least the Jio valuations of Reliance Industries. But what is dragging Reliance Industries down? One has been the slowdown in retail. So what investors are closely watching is when will the retail recovery come through? What does the company guide about that? Secondly, reduction in their capex intensity, which means more free cash flow. And thirdly, monetization. Is a Geo IPO coming? What do they talk, what do they say about that? What can they guide about potential monetization? These would be a few big things that are on top of mind for all investors. That's a standard disclaimer from Reliance Industries from our channel.
Okay, Nima, thank you so much for that. As of now, Reliance Industries is quite muted in today's trading session, down 0.2%. But let's move on. And in a big development amid the tariff war, Apple aims to source all US iPhones from India in a pivot away from China. Parikshit is joining you with us to give us more details on this front. Parikshit.
Apple is considering making India a hub to manufacture all Apple phones for the US market by next year. This is because of US-China trade tensions and the high tariffs on China imposed by the Trump administration. But Apple's decision will also depend on adequate capacity ramp-up in India and the trajectory of the US-China trade talks. The company is considering increasing production to 40 million phones in India in 2025. Production last year was around 26 million phones. Apple contract manufacturers in India are ramping up capacity in existing facilities. Foxconn's Bengaluru plant is likely to be operational within this month and will have a capacity to manufacture 20 million phones at peak capacity. So while there is an intent to make all Apple phones in India, a lot will depend on whether US and China can reach a deal. Apple did not reply to CNBC-TV18 queries.
Okay, Parikshit, but you have more updates coming in on where industry sources are telling CNBC-TV18 that Indian EV makers will face challenges as China stops supply of rare earth magnets to India. What are the details you're picking up here?
Indian EV and component makers are facing production challenges as China restricts supply of rare earth magnets, say sources. Automobile and component makers have approached the Indian government for help. CNBC-TV18 has learned that China has restricted supply of rare earth magnets to India from the 4th of April onwards. The magnets will be supplied only to those companies which submit end-user certificates in a prescribed format. The Chinese government is demanding end-user certificates releasing any exports of rare earth magnets and also are demanding that they be duly authorized. China says importers must get end-user certificates signed by both the Indian Foreign Ministry and Chinese Embassy. And importers must confirm that the rare earth magnets will not be used for making weapons or given to any third party. Clearly, the Indian auto industry will be impacted. Rare earth magnets are a critical part of traction motors and other components of electric vehicles and automobiles. For the moment, there is inventory, but if these restrictions continue, then there could be production challenges in the coming few months.
Okay, Parikshit, thank you so much for that. But on that note, we're going to slip into a very short break. And as we slip into the break, here's the good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screen.
more.
Welcome back to Business Lunch on CNBC-TV18. Now, Russia pounded Kyiv with missiles and drones, killing at least 12 people in the biggest attack on the Ukrainian capital this year and drawing a rare rebuke from US President Donald Trump. Take a look at this report.
Rescue workers found a man alive in the rubble in Kyiv after Russia hit the Ukrainian capital overnight. At least 12 people were killed in the missile and drone strikes, and at least 90 were wounded in the biggest attack there this year. Anxious friends and relatives of those missing stood near destroyed buildings hoping for good news. The violence led to a rare rebuke from U.S. President Donald Trump, who told Russian President Vladimir Putin on Truth Social, quote, "Vladimir, stop." Trump was asked about his message to Putin during a meeting with Norway's Prime Minister in the Oval Office.
What is your level of frustration with President Putin?
I didn't like last night. I wasn't happy with it. And we're in the midst of talking peace, and missiles were fired. And I was not happy with it. That's what I meant.
Why are you not putting more pressure on Russia? I know a lot of Europeans.
Putting a lot of pressure. You don't know what pressure I'm putting on Russia. They're dealing. You have no idea what pressure I'm putting on Russia. We're putting a lot of pressure.
Can you maybe tell us that?
We're putting a lot of pressure on Russia, and Russia knows that, and some people that are close to it know, or he wouldn't be talking right now.
What concessions has Russia offered up thus far to get to the point where you're closer to peace?
Stopping the war, stopping taking the whole country. Pretty big concession.
Trump said he still believed both sides wanted to make a deal to end the war begun by Russia in 2022. But the White House has also threatened to abandon its efforts at peace talks if no progress is made soon. On Wednesday, Trump slammed Ukrainian President Volodymyr Zelensky over a comment in which Zelensky repeated that Kyiv would not recognize Russia's occupation of Crimea. Zelensky, who cut short his trip to South Africa after the Russian attack, said he did not see signs Washington was putting strong pressure on Russia. Ukraine's foreign minister said on X that the brutal strike showed that Russia, not Ukraine, was the obstacle to peace, a viewpoint shared by EU Foreign Policy Chief Kaja Kallas during her visit to Moldova.
It is clear that we want peace. Moldovans want peace, Ukrainians want peace, Europeans want peace. But the reality is that Putin is escalating the attacks, and it's making it clear that he doesn't want peace. It takes two to want peace. It only takes one to want war. We have to keep supporting Ukraine, that they are able to defend themselves.
Talks did take place between the U.S., Ukrainian, and European officials in London this week, and Zelensky said on Thursday that the meeting with a U.S. representative had not been easy, but that it had been constructive. A U.S. official said Trump's special envoy is expected to meet Putin on Friday for more talks.
And let's move on to some Bollywood update. Crime master Gogo is back on the silver screen. The iconic Amir Khan and Salman Khan starrer Andaz Apna Apna is re-releasing. And forget the fans, even Bollywood is buzzing with excitement. CNBC-TV18 Shilpa Ranipet as well as Santya Gora dive into the re-release mania and report that it's a strategy that has many hits as flops.
ब्रेड का बादशाह और आमलेट का राजा बजाज हमारा बजाज.
Back in 1994, just like its iconic characters, Andaz Apna Apna had big dreams from the box office, but it failed to deliver. However, just like Salman Khan and Amir Khan's bromance grew over the course of the film, so did the film's popularity. Its dialogues like Teja Main Hoon, Mark Idhar Hai and Do Dost Ek Cup Mein Chai Piyenge have become classics and are meme gold. Now, 21 years later, this cult classic is back in theatres.
The advance bookings we've just opened, they're quite strong, and we're hoping that once it hits theatres on the 25th, there will be some organic, buzz online. There will be some organic word of mouth, because 100% this is one of those films on every level that, stands the test of time.
Nostalgia is a big pull for these re-releases. Most of the people lining up are keen to watch it again on the big screen. But a lot of the audience is also from Gen Z who want to know what the hype is all about.
ये तेजा तेजा क्या है? ये तेजा तेजा.
Believe it or not, it is your WhatsApp forwards, memes, reels that decide which movies get a second innings. Whether it's those iconic one-liners, the rib-tickling punchlines, the brutal put-downs, the sarcastic repartees, or that one scenario on reel which seems to sum up your life. Cinema makers and multiplexes are choosing what people seem to want to resonate with. And the choice is not just limited to Bollywood. Even South Indian films like Rajnikant's Basha are being re-released in Hindi. Experts say a creative lull in Bollywood is also making re-releases a good business option, especially if it's about a dead asset becoming a money spinner.
Production houses have nothing to lose, right? I mean, this content was ready with them since the last 10 years, 15 years, 20 years. They have already monetized, more than 90-95% of the value in terms of, whatever revenue that they would have made from this content, to be it digital satellite rights and through box office. So what this is doing is, just adding maybe a few crores or increasing their monetization, perspective.
Now, not every re-release is a pot of gold. Experts estimate that only 12 to 13% of the movies re-released so far have hit the mark. Interestingly, while super hits like Veer Zara and Kaho Na Pyar Hai barely created a buzz on re-release, some of the films that bombed the first time around have drawn crowds. Tumbad, for instance, grossed only 13.4 crore rupees originally, but earned over 31 crores on re-release. Similarly, Sanam Teri Kasam, which made just 4 crore rupees the first time, earned around 15 crore rupees on its second innings. But experts say this does not matter because a re-release is much cheaper for studios and cineplexes than a premiere. Or as Amar tells Prem,
Chit mein jeeta aur pattu hara.
The trend is being seen as a win-win for everyone. Theatres and studios split the profits, filmmakers and artists stay relevant, and the public gets to relive their favorite films or in some cases share it with the next generation. Exports add with fresh ideas in short supply, re-releases are here to stay. For all parties concerned, the trend works because
आया हूँ कुछ तो लूट कर जाऊँगा.
In Mumbai, with Shilpa Rani Peta, Santya for CNBC TV18.
Okay, now let's move on. And thousands of people continue to flock to this St. Peter's Basilica to have the final glimpse of the Pope, whose funeral will take place on Saturday. President Draupadi Murmu left for the Vatican City today, while a host of other world leaders, including US President Donald Trump, will attend the funeral. Okay, and with that, we are absolutely out of time on this edition of Business Lunch on CNBC TV18. We've seen that recovery coming in the markets. About 24,000 is what the Nifty is managing to hold on to as of now. But don't go anywhere, because up next, you have Midcap Radar to take you through all the market action.
Final 120 minutes of what has been an action-packed week, the first full 5-day week after 2 truncated ones, and we head into another truncated one. You're watching Midcap Radar from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia. With me is Manglam Malu, and well, some recovery from the lows, Manglam, and the bulls are finding some support at lower levels at 23,850, so it's almost a 200-point recovery from the lows.
It's an important recovery. You know, what we'll talk about is the day one of any series start. The low or a high of that day is very crucial. We started lower, and from the lows we've recovered. That's telling you that there is some support, and as we speak, the level at which the Nifty is right now is the 200-day moving average. While we were at halftime report, we were talking about the potential of a recovery, and that being led by IT, and that's exactly what has taken place. If you look at Infosys, if you look at TCS, the IT index itself, but all of that for in just a bit. We'll talk about all of that on Midcap Radar. First up, all the top stories. The indices, they see a mild recovery from day's low, even as India-Pakistan tensions rise following the terrorist attack in Pelgam. Pharma, realty and healthcare are the big losers, with mid-caps bearing the brunt. IT sectors buck the trend.
Fourth quarter numbers have dragged shares of SBI cards lower. Credit costs remain elevated. Quarterly spends have surged both sequentially and on a year-on-year basis. The receivables per card also have declined.
L&T Tech Services under pressure after fourth quarter numbers missed street estimates. Company tells CNBC-TV18 that anticipated better revenue growth in the quarter, but macros created unexpected headwinds. They expect FY26 to be a better year than FY25.
Emphasis is one of the few IT names that are bucking the trend after the numbers were a beat on expectations. They've reported the highest sequential growth in the past 3 years. Total contract value is also the highest in the last 7 quarters.
Cyient slips after fourth quarter revenue and margins miss estimates. The company also provides no guidance estimate for FY26, citing uncertainties in the near term. Welcome back. As we were talking about the recovery in the market, just look at the intraday chart of Infosys and TCS. Infosys and TCS, both of them actually this week have rallied about 5%. The Nifty is around the 200-day moving average. Closing above that would be extremely important for the bulls, and we've seen a near 200-point recovery from the lows itself. From the broader markets as well, there are a bunch of stocks which are recovering. Most notable of them is Coforge, which has recovered about 4% from the lows, currently at the high point of trade. We're also seeing some traction in names like Chola Invest, which is up around 2% from the lows itself, now in the green. But a bunch of stocks are moving around. Hormaz, my co-anchor, has moved across to the wall to take us through all those mid-caps that are moving around. Hormaz.
The recovery from the lows is what is going to be prominent in all the charts that we just see. But we will start off with the losers from the broader markets, as that is currently still the color despite the recovery from the lows. Garden Reach is now down around 6%. ACC, an earnings reaction. Earnings came during market hours yesterday, but it's down 6%. Sirma, SJS2 and Blue Star is now down 13% so far this week. Profit booking continuing in this stock. There are earnings reactions plenty. We are counting down to earnings from a lot of the larger names, but SBI cards, as we just mentioned a few minutes earlier, look at the recovery in Cyient, look at the recovery in LTTS, and look at the recovery in Emphasis. Emphasis now, in fact, is now up at the highest point of the day, 3% higher on that stock as well. Real estate as a pocket has not done well today, but that too is seeing a fair bit of recovery from the lows. Look at Anantras. There was a price target cut from Nomura yesterday on the stock, is down 5%. Obra Realty and DLF2 among the losers on the index, where every stock is still in the red. Stocks that are doing well on the back of strong volumes in today's session. These are a few that are bucking the trend. IEX, of course, an earnings reaction, but GIC is off the lows. Nava is off the lows, and both of them are recovering on strong volumes. And lastly, some other names that are still in the green despite a wobbly broader market. Naveen Fluorine is one of them, 3% higher, while Motilal Oswal is down almost 6.5–7% ahead of results. Nuvama Wealth is doing well for itself at 3.5% higher, and Persistent Systems, of course, another mid-cap IT name that has been fairly resilient in what has been a weak broader market so far. Manglam.
Take that point entirely, and since you're talking about gainers, I'll just put the spotlight on Restaurant Brands Asia. This is, remember, the company that operates Burger King in India and also in Indonesia. Big up move is what we're seeing on the stock. In this hour itself, it's seen a big spike. So put up the intraday chart of Restaurant Brands Asia, and you would see that it's at the high point of trade with a fair amount of volumes as well. And it's not just today. In fact, this week itself, the stock has now turned positive after today's gain. In the month of April, so far, the stock is up 36%. So there's definitely something brewing out here in Burger King or Restaurant Brands Asia. Maybe some refund purchase or, perhaps an HNI investment that is taking place here. You just watch out for that. The price tells you that. I remember, talking about the quick service restaurant space on Editors Roundtable, saying that maybe it's out of the woods. And Restaurant Brands Asia is actually among the top-rated stocks when it came to upsides as far as the brokers are concerned. Obviously, we had Sapphire Foods, which was showing the maximum amount of upside given the valuation discount that it trades with as compared to Devyani. But now we have, Restaurant Brands Asia, which has moved to the high point of trade. But good time to bring in Vinay Rajani of HDFC Securities for a quick technical check in the market. Vinay, after a near 2,500-point recovery from the lows in April series, we started on the back foot, and that dip has been bought into. Do you think this purchase or recovery from the lows is a lot more durable, and that's the texture of the market going forward? See a dip, go ahead, buy it?
Yeah, good afternoon. I think that it is durable, and whatever fall we have seen in the intraday, it is more like a correction in the overall bullish trend. So we have seen a 2600 points rally from the lower level, and today it has come down. It has retraced a bit around 23.6% retracement, and the previous swing high was placed around 23,800, 23,870. So previous resistance, we were expecting it to act as a support. So from that level only, it has started recovering. So it is more like a correction in the overall bullish trend. We are continuing our bullish stance on the market, and we feel that dip should be bought into. And overall, we feel that Nifty should reach a target of 24,800 in the coming weeks. So positionally, we are bullish. This is just a correction in overall bullish trend, and dip should be bought into. The stop loss in the long position that we are suggesting is around 23,700. So with that stop loss, one can continue to remain long, and overall positional trend is looking quite strong.
All right, and individual stocks, what do you like here?
Yeah, so IT stocks have been performing very well. So Coforge is the stock which is looking very strong to me, and it has remained resilient in the falling times of IT stocks. So Coforge is one of the strongest IT stock. So 7430 should be the entry level, 7290 is the stop loss, and 7650 should be the target. The second pick, I would take it from the FMCG, that is Patanjali Foods. For last two trading session, it has been recovering from the intraday lows, and primary trend has been positive. So 1960 is the level around which one can go long as a trading. 1900 should be the stop loss. On the upside, 2050 should be the target.
All right, Vinay, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. By the way, now we are heading towards 24,100 now on the Nifty, almost 225 points higher from the lows of the day. So bulls getting some buying interest at lower levels. SBI Cards, though, still remains at the lows of the day, 6% down. ACC is down 6%. Scient 2 down almost 6%. But what's recovering among the leading Nifty names is, of course, Infosys and TCS, as Mangalam just highlighted. IndusInd Bank too is currently in the green, and what has now moved into the green is Reliance Industries. That too has recovered from the lows of the day ahead of the results announcement, and that too is showing up on the recovery on the Nifty. But take a short break. Just before we do that, some good news for our viewers. Here is India's business news leader, which is now just a click away, which is the CNBC-TV18 all-new app, where you get in-depth news, financial world updates, breaking news, all of it just at your fingertips. You can download the app from the Apple Store, the Google Play Store, or even scan the QR code that just comes up on your screen. Take a short break. Back on the other side.
We're speaking about, the truncated week next week and also going into the weekend. Pull up Global Spirits reports its numbers shortly. Among the first earlier, companies to report their numbers, Global Spirits has actually spiked about 5% from the lows, currently at the high point, moving higher. Let's talk about the mid-cap IT stocks. Since we're talking about recovery in the large-cap IT stocks, the mid-cap IT stocks post their fourth quarter earnings. We had companies like Persistent and Mphasis that beat street estimates, and those stocks are doing well. On the other hand, L&T Tech Services and Cyient, which were a miss, have actually seen a decline, though they're recovering from the lows currently, but results weren't very good. Rima joins in to tell us how mid-cap IT fared in Q4 FY25 so far.
Yeah, there's been a flurry of, mid-cap IT earnings. But if you had to summarize, you could say that the strong are getting stronger and the weak are disappointing. So when you mean by strong, we're talking about companies like Persistent, Mphasis, and Coforge is still awaited. But these are the companies which have positively surprised the street despite the tough macro, while companies like Cyient, LTTS, which have had a few rough quarters and the stocks have underperformed, have disappointed the street. Now, onto the numbers. This time, Persistent, Coforge and LTTS reported a positive revenue growth. But the beat came in from Persistent, 4.5% versus estimates of 3.8%, and Mphasis was also slightly ahead of street expectation. LTIM, LTTS, Cyient missed the mark on the top line. For LTTS, the numbers look good, like you see a 10.5% revenue growth, but that includes the IntelliSwift acquisition. The estimates were actually for a 13% growth, which is why L&T Technology Services, despite the double-digit top-line growth, is actually a miss. Now let's quickly get to the guidance. Now Persistent maintains its FY27 annual guidance of $2 billion, $5 billion by FY31. They're also on track to improve margins by 200 basis points, and they're also hopeful of outperformance. Mphasis is guiding for above industry growth rate. LTTS is saying that FY26 should be better than FY25. They're looking at a double-digit growth rate, but some people on the street were hoping for a stronger guidance. So, their own internal estimates were that LTTS would do a high double-digit kind of a growth given the acquisition. So, in that context, just a double-digit has disappointed the street. And Cyient is the one, where the guidance is actually the most dismal. Firstly, there is no revenue guidance. They expect the uncertainties to last for the first half of the year, and even the margin aspiration has been lowered and pushed further down. Now they're looking at a 15% margin over the next 2 years.
Divergent trends in the mid-cap IT earnings, the good ones doing well, being rewarded, while the bad ones getting smashed in today's session. But IEX is holding steady off the highs of the day after a mixed quarter, but still holding on to some bit of gains. The revenues were below expectations. The profits too were in line with what the street was expecting. Vinny is here to tell us more on the numbers and also what the management told us. Vinny.
Absolutely. So it was a mixed set of numbers that came in from the company. Like you mentioned, revenue below estimates. Motilal Oswal said that this is mainly due to the lower per unit transaction fee. Now, profits that came in line with the estimates. So profits saw a growth of around 21%. On the other side, we saw margins, EBITDA margins see a contraction of around 93 basis points. Now, what the management has highlighted and what is important is in terms of volumes for IEX, because that's the key, as well as in terms of market coupling and regulations that come in. So in terms of volumes, the company's highlighted that, the electricity volumes have grown by 19% in FY25, and certificate volumes have grown by 100% in FY25. Other than that, they expect this 18-19% growth to continue in FY26 as well. They saw a 100% jump in terms of their IGX volumes in Q4, and they expect this to continue in terms of momentum. So good volumes on that front is what they're expecting as well. The company highlighted that there's a lot of inventory and they expect the prices to remain stable. And because of the stable pricing, they are saying that this could give them some bit of a headroom to grow further. So that is something interesting to watch out for. IEX managing to hold on to gains of 1.4% as of now.
Absolutely. Take that point. Decent results. Management commentary was fairly good, and as a result of which we've seen the stock move or hold on to the gains despite the wobbly moves that we're seeing in the broader markets. In fact, the number of stocks which are advancing have now moved higher from 270 to about 305, though the number of stocks which are declining are still close to around 2293 itself. Take a short break, come back, get you more on the markets, a lot of stock-specific action. Stay tuned to Midcap Radar.
Welcome back. The markets are taking a bit of a sigh of relief after Donald Trump hit a pause in tariffs and on markets globally. And they are starting to come to terms with the reciprocal tariffs. So what is the roadmap from here? Our colleague Prashant Nair caught up with experts from Nomura to discuss what is next for the markets and began by asking Rob Subaraman, who is the head of global macro research, as to when can we see the finalization of these trade deals. Listen to excerpts of that conversation.
I don't think they'll be done quickly. I think trade deals take a very long time to do. Okay. I think the Trump administration will try to dress up some quick wins with some close allies and hopefully try to get some tariffs down. But you know, our view is that once tariffs go up a lot, and they have gone up a lot, we think the effective rate's 21%. They don't tend to come down that quickly. And so our baseline is tariffs are going to stay up pretty high. I think China has quite a bit of leverage over the US, and that trade tension will continue. And ultimately, Trump wants tariffs for revenue as well. So, you know, tariffs are going to have a big macro effect on the US economy and economies everywhere this year is our bottom line.
So with China, we've been hearing what we've been hearing over the last 48 hours. Should we read this as a bit sort of conciliatory, tempering things down a little bit? Or is that reading into too much? I mean, things could change. We could hear something different over the coming days. What's your sense?
Well, look, right now, US tariff on China of 145%. I mean, essentially for a lot of trade between US and China, it's essentially stopped.
Correct.
So there will probably be some coming down. But the point I'd make is...
So between 10 and 145, there's
a big range, right? So
and Trump was before election said 60%. So will we get down to 60? What I mean,
we could get down to 60, and that has been our kind of a longer-term baseline around 60. But the point we'd make is that's still extremely high, and that is going to lead to a lot of, I think, particularly for the US, a lot of inflationary effects. And is going to hurt growth. Rest of the world, it's a different impact. It's more of a demand shock for the rest of the world, lower growth and less inflation. So there's going to be also a disconnect between central bank responses. We think the Fed is not going to be cutting rates quickly because of the inflation. We have the first cut in December. But for other central banks around the world, there's a lot of room for cutting rates.
You're saying that foreigners, and especially central banks, are selling US bonds. I mean, that has been happening, Japanese especially.
So we haven't seen it in terms of central banks. Okay. The data is actually
so maybe investors,
mixed. It's actually quite mixed. But, you know, you have on one hand the Treasury data, which shows you there's some direct selling from Europe. There's some direct selling that's coming from, let's say, China, Asia, ex-Japan as well. But then you have the safe haven, or the tax haven, should I say, places where you have seen actually buying. So it's a bit of offset. There's no consistency really about it on the central bank space. But certainly on the private side, it looks like something is happening there on the actual asset unwind.
I think that's the interesting thing. I think the central banks around the world have been diversifying away from US dollars, their reserves, for a long time. The new interesting thing is the private sector. Private institutional investors, big lifers, pension funds around the world, are they starting to diversify away from the US?
And the reaction, what we saw was interesting, right? Usually when stocks go down, I mean, bonds go up. But here you had a situation recently when everything was getting sold.
Yeah, long end US Treasuries, equities, it was basically almost get out of the US.
That's so that phrase US exceptionalism, yeah, are we at the end of it? What's your sense?
I mean, I wouldn't push it that far away at the end. I would certainly be saying that it's fading, right? That the evidence we're seeing is that it's fading. But at the end is still quite, you know, I think of a push. It's a push to say that.
Sonal, let's come to India. It seems like we're first in line to get a deal. Would you agree?
Hopefully. I think we definitely have a head start. We started the negotiations ahead. The terms of reference have been finalized. India is a strategic ally. Now, you know, deals take time. Agriculture is a politically sensitive subject for us, but there are other aspects of the agreement on the industrial tariff, parts of the non-tariff barrier, buying more of US products, which can easily be done. So I think if we can get the 26% reciprocal tariff down before the deadline, and our tariffs are lower than our competitors, then really in this world, what you're looking for is a relative advantage. And I think
will we have that relative advantage, Sonal? Because others also will negotiate, right? Others will also, for example, competitors in various industries like Vietnam, Cambodia, they'll also want to sort of lower tariffs, their respective tariffs, right? So it's all relative, as you said.
So I think most Asian countries are trying to negotiate with the US. The question is whether what they are offering will be acceptable to the US. One part of the deal is buying more of US products, but for countries like Vietnam, Cambodia, transshipment of China products has been an important reason for the reciprocal tariffs. Also, these other aspects of non-tariff barriers or whatever we want to call them. So, and right now we are seeing China trying to, also talk to Southeast Asian countries. It's putting Southeast Asia in a more difficult position in terms of choosing between US and China. I think for India, it's a lot more clear-cut. We don't have that transshipment problem. And therefore, I do think, relative to a number of our competitors, we do have an upper hand.
How long before we see a deal? Do you have a number in mind? How many days? How many months? With India, US?
No, I think the definition of deal is important. The trade negotiations run into years.
Yeah.
It's a deal on goods, it's a deal on services. This is going to take time.
But this is like the COVID emergency. We got the vaccine. COVID hit in Feb. We got the vaccine in November. So
the early tranche on some bits you could probably agree on by the 90-day. But the first tranche, of course, we are planning by September, October. The big deal, the real deal, is going to run into years.
It could be a MOU in the coming months.
The actual order will take time.
All right, so that was an interesting conversation. Meanwhile, we had numbers coming in from Chennai Petro at the bottom of your screen. Quarter on quarter, big jump is what we've seen in the revenue. But if you look at the bottom line, it's an even bigger jump from 10 crores. The numbers have jumped all the way up to 400 plus crores on the profitability front. And that's reflected in the EBITDA as well. From 241 crores, it's up to over 500, 600 crores. Actually, if I read it correctly, over 700 crores. And that's exactly what the stock is, doing as well, or denoting after those numbers. It's up at the high point of trade. What's also at the high point of trade is the market at large. From today's low, there has been a recovery of over 200 points, 250 points, 270 points, as our team tells us right now, over 24,114. So firmly above the 200-day moving average as we speak. The Bank Nifty is also recovered from the lows, as is the Midcap index, where we now have gains or cuts of sub 1,000 points on the Midcap index. It's the IT pack which has led from the front, but don't lose sight of Reliance as well. Ahead of numbers today, Reliance is the big boy, which is slowly but steadily waking up. The intraday chart of Reliance comes up for you, currently fairly in the green. Take a short break. Come back on the other side. All your stock and investment-related queries on your stocks.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in, as always. A quick look at what the market is doing, because recovery, that's the name of the game right now. Because since around 11:30-12, we've seen that recovery come in for the market, slowly, steady, picking up pace. And we've seen that up move. 24,140 levels is what the Nifty is trading at. Sensex also has seen the recovery coming in, now just down 0.3%. So yes, keeping an eye out on the markets. Where are we going to be headed in the next 1.5 hours? That's going to be important to watch out for. Other than that, we have a whole host of numbers that just came in. VST Industries has reported their numbers. You're seeing it on the bottom of your screens as well, flashes, that EBITDA is down by 28.6%. We're seeing a decline in terms of the revenue as well. So that is something to watch out for in terms of numbers. Doesn't seem to be that exciting. Escorts Kubota has come out with an announcement that they will be taking price increases from the 1st of May. So keep an eye out on Escorts Kubota as well. And just a short while ago, we'd seen Mangalam and who must also mark Chennai Petro. That stock has seen a very sharp spike up after its Q4 numbers. Seems like a great set of numbers coming in from the company. So watch out for that, as well as Quest Corp. That is also something that has seen a good spike up in the last hour of trade. So that'll be interesting to watch out for in terms of the mid-cap also and the small cap. Where that is going to be headed in terms of a recovery will be key to watch out for. Nifty mid-cap is also seeing some bit of a recovery, and small cap also is seen some bit of a recovery from the day's lowest point. But yes, that's how the market setup is looking like. But this is a show where we solve all your stock-related queries. And to solve all those queries today, we have our experts joining in with us, independent market expert Shaina Mukaddam, as well as Vaishali Parekh, Vice President Technical Research at Prabhudas Leeradhar. Good afternoon, Shaina, as well as Vaishali, and thank you so much for joining in with us as always. Vaishali, I just want to take a quick check in terms of the market's important levels on the Nifty as well as the Bank Nifty that one should be watching out for, especially at the closing. What is the level and indication that we could pick up?
Very good afternoon. Yes, so market has turned sideways. Nifty I would say 23,800 on near term acts as a crucial support to carry on with a bullish uptrend view. And 24,500 acts as a resistance. So today's level to watch is 23,800. We did see 23,900 low today. So market is attempting to bounce. So I think for now it should be a sideways move. And Bank Nifty is showing some sign of corrective move right from the time it witnessed 56,000 as the target resistance. So for near term, I would say 54,000 would be the support. So the range would be 54,000 to 56,000. Either ways would decide the further trend of the stock.
Okay, Vaishali, thank you so much for that. Keeping an eye out on those levels over there. But let's move on and get started with the stock-related queries then. The first query for today is coming in from Karan, who's writing to us from Bhopal. He's holding 25 shares of Titan. This is at a price of 3,000 rupees per share. Wants to know whether he should continue to hold this or look to sell this one. Shaina, let me take this to you first. In terms of Titan, we had the Q4 update that has already come in for the company. Not a bad update, right, in terms of growth that we are seeing for the company. So what is the outlook that you have for Titan, and should the viewer continue to hold this for the long term?
I would say, valuations are very expensive. So if you're looking at a 1 year or maybe 2 year holding, it would be better to switch from Titan to something like even a HAL, some defense stock, or a large banking stock like ICICI or HDFC. Basic reason being that, of course, we all know the quality of management is good, and they are in good segments in terms of growth segments. But at the same time, the short term, they could see some issues like in the quarter going forward or the 6 months in their export business. Gold prices also have, as you know, reached quite high levels, which could impact growth going forward, at least for the shorter term. And jewelry does account for 85% of their revenues. So to that extent, I believe combination of high valuations and a little bit of slowdown in growth over the next 1 odd year, I believe it would be better to switch. You could relook at it after some couple of quarters.
Okay, can relook at it after some couple of quarters is what you're saying. But Vaishali, on the technicals, how is it looking like, right? Shaina's highlighting the valuations are high, but on the technical front, anything different?
I would say, well, the stock has already got into a trend. So I would say it would have some resistance at around 3,300 levels. So it is already above that. And if it sustains, then I think we can look for a trading target of 35 to 3,700, and 3,200 would act as a near-term support. So I think if the market continues to show some strength, this can go towards 35 to 3,600.
Okay, surely keeping an eye out on those levels over there for Titan. Let's move on to the next query for today. We have Umesh Paul, who's writing to us from Pune. He wants to hold ONGC for the long term and is asking whether it's a good idea to do so. They've not mentioned any buy price or anything, but Shaina, your view coming in for ONGC, is it a good time to maybe enter? I don't know whether the viewer is already holding it or what price is he holding it at. So ONGC, your view.
I believe for a long-term investor, there are better stocks available both in the PSU space as well as also if you see the oil and gas. I would say even something like a Reliance, which offers you multiple sectors to be invested in. I think there it offers you better long-term return in my view. Basically, the valuations are not expensive. It's at about 8 times price to book. At the same time, if you see last quarter, they are average, I would say $72 was the average refining margins. And we have seen that crude oil prices have been lower March end. So to that extent, they may see some inventory loss. I would say that, holding it for the next couple of quarters would be, you may not get good return given the fact that US is also tightening its norms as to who ONGC can buy crude from, who it can export to. So to that extent, I would believe that it's better to switch.
Okay, better to switch from ONGC. That's the view coming in there. Vaishali, what's your view on ONGC? And if not ONGC, which one in that sector would you suggest?
I would say ONGC, for now, the upside looks to be capped at 280. Unless and until it goes above 280, can I see further run up coming towards 350 and so on. So, I'm not too sure, but I think Reliance would be a better bet in this sector. And I think going ahead, this can go towards higher targets of 1,500, 1,550. So Reliance would be a better.
Okay, surely keeping an eye out on Reliance instead of ONGC. So yes, not ONGC, both our experts are saying something that we could skip and looking at. But let's move on to the next query for today. We have Vijaya Kirthi, who's writing to us from Chennai. She's holding 110 shares of Spandana Spurti. This is bought at a price of 1,040. So wants to know the strategy now for this one and whether she should average, hold, book her losses in the investment because she's making a significant loss on this one. So Shaina, what's your view coming in on Spandana Spurti? Obviously, we had those recent announcements that came in as well. Any suggestion that you have for the viewer?
Well, it will be very difficult for her to recover her losses by remaining invested at least for the next 1 odd year in Spandana Spurti. As you know, the FY25 numbers were pretty bad. On a 600 crore total revenue they have made for the 9 months. They made losses close to about, I would say, on 2,000 crores of revenue, 600 crores of losses. And while they are trying to clean up their books by selling some of their bad loans, I would believe that, this will continue on for some more time in terms of their problems on their balance sheet. I think there are better stocks available in this type of a market, so it's better to switch. There are a lot of NBFCs which have much better quality and where valuations are also attractive. And not to say that Spandana Spurti is expensive at current levels, but I just don't think it's the best stock to be invested in as of now. She should, in fact, in my view, book some of her losses.
Okay, book some of the losses. That's a view coming in for Spandana Spurti. But Vaishali, your view coming in for Spandana Spurti on the technicals. Anything that seems like maybe some sort of a respite or some bounce back and she can reduce the losses that she's making and get out at such a level?
So I was just going to suggest that because technically, if you see the stock has really taken a badgering right from 1,300 levels to 200 odd levels. So I would say now that it's held on for so long, keep a stop loss of 280. And if the trend continues, if it shows further on strength, this can go towards 400, 430. That would be the level to exit.
Okay. Keep an eye out on those levels over there for Spandana Spurti in case you're looking to exit as well. And exiting is the better bet, coming in as a opinion and a view from both our experts. Let's move on to the next query. Vipul Sheth is writing to us from Ahmedabad. He's holding 50 shares of KFintech, and this is at a price of 1,014. Long-term investor, and wants to know whether he should book out his profits or continue to hold this one. KFintech as a stock, Shaina, how is that looking like? Are there any better companies that they can switch to booking profits or continue to hold KFintech?
Well, the whole segment is doing well, and you could be invested in one of even the exchanges. At the same time, I would believe that KFin you can continue to hold. Valuations are expensive, but at the same time, they have made acquisitions to increase their global footprint. Recently, they acquired Accent in Singapore, I believe. So to that extent, they are expanding. They are growing even currently more than 35% on top line margins, and profit margins also very good. So to some extent, if you're holding it for a 1 to 3 year period, you're likely to see a decent return. It's in a good segment, growing segment related to the capital markets. So I would say continue to hold.
Okay. Continue to hold is the view coming in from China on KFin. On the technicals, Vaishali, what is KFintech looking like? Because YTD performance, specifically when I'm looking, since Jan we saw that fall coming in, then we started seeing some bit of a recovery. So this recovery that we're seeing coming in since March, is that something that will sustain, and could they have some higher bit of a profit?
So, well, I don't have much of a data in this, but from what I can see from the near-term chartical move, I think it's getting in a trend. There are signs of improvement. And in all likelihood, if 1,000 level is held on as a support, and near-term basis, if it's for a trading perspective, 1,100 should be the level to watch as support. And once we see the stock moving about 1,300 odd, this can go towards 1,700 also. So I would take this as a trading bet for now.
Okay. Trading bet for now. Okay, Vaishali, thank you so much for that view coming in there. But on that note, we're going to step into a very short break, viewers. And as we step into the break, here's some good news coming in for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screen. Welcome back to your stocks in CNBC TV18, and a quick look at the numbers that are coming in as well. We have Ather that reported its numbers just a short while ago, so that has seen a bit of a spike up in trade. But we have Maruti also that has reported their numbers as well. Net profits 3,711 crore. Poll was 3,840 crore, a slight bit below the expectation. Revenue almost seems like in line with expectation. 40,674 crore is what the revenues have come in at as of now. Maruti is holding on to a decline of 1% in today's trading session. We'll wait out for more details that come in terms of the EBITDA margin as well. So keep an eye out on the margins as well, where that is going to be headed. I'll wait out for those numbers as they are flashing on the screen. But profits as well as right now the revenue seems like profit slightly below, revenue seems largely in line with expectation. But we do have Prakash Diwan also, who's here to break down the numbers for us and help us understand what are the numbers looking like. Prakash, first cut in terms of the numbers, profits seems slightly below expectation, but revenue seems in line. What are you making of it? Anything that you've seen?
No, so, Vinny, revenue in any case is a function of the product mix. So is, of course, margins. But what could have happened is that this particular quarter is usually not the best. And most of the people would buy towards the end of March for the depreciation benefit and all of that. But so those sales were never very spectacular. What possibly they've done is they've utilized this quarter to ramp up their inventory on some of the newer launches that they are gearing up for. And they have the new Brezza that's kind of already on the road. And I think it's a quarter of consolidation. So really, we can't read too much into this. There was expectation that margins will be about 10-12% lower on a YOY basis. So if that's kind of built into the price, there won't be any major disappointment that the market will see from this softness. But revenue is something which they can also scale up once exports pick up. But this tariff regime is also something which has been a bit of an overhang in terms of a lot of shipments getting into stages of uncertainty. So I think, given all of that, I think it's a fairly decent set, is what I would say.
Fairly decent set. Prakash, there's one point that I want to highlight as well. My colleague Sudarshan was also mentioning earlier that, when you're looking at valuations for Maruti, right, 1 year forward PE is 23 times currently and 5-year average is 28 times. So valuations are also supportive. Will that come into play as well? And also, if you could highlight in terms of demand trends, specifically for Maruti, is that anything that we should watch out for as well?
So, yes, I think that's a very valid area to look for the demand build-up, the demand creation that could come on the EV side for them. Because remember, Maruti has been late to the party in terms of EV launches, as compared to Tata Motors and M&M. So in terms of the response that they are able to get for that and some of the newer mid-size SUVs that they are relaunching or resetting, those are things that I would look at. Because, see, the year ahead is going to be fairly tepid for auto growth. I mean, generally autos start doing well after the economy shows very clear signs of having turned around or started growing, which is just beginning with interest rates coming down, some sort of GDP estimates coming through, which are fairly okay. But, even if you look at PMI data, it's been fairly encouraging for April. But it's not something which you really can see for the whole year as yet being very robust. So my sense is auto growth will probably be about 4 to 6% depending on models and segments. Within that, Maruti could probably look at regaining market share, which they had lost to some of the new incumbents like Kia and even the older ones like M&M and all. So I think this thing from the management, commentary from the management in terms of new launches and how they plan to scale up the EV segment is going to be more critical going forward. The stock will probably start responding to that particular commentary rather than the past numbers.
Absolutely. Surely keeping an eye out. And then just an update in terms of the margins. We had them flashing at the bottom of the screen right now. EBITDA margins have come in at 10.5%. Expectation was 12% of CNBC-TV18 poll. And obviously versus last year also, the EBITDA margins were 12.3%. So we've seen a sharp contraction, Prakash, in this terms of the margins that we're looking out for. Is there any sort of a worry that, when you're looking at such margins? Because it's a very, very sharp contraction there, even versus expectations.
So at least our expectation was about 10-12% kind of this thing softness in margins, and it's kind of in line with that. But yes, on an absolute terms, if you take expectations aside, it's definitely something which could cause a lot of concern. But that's the whole thing. This particular quarter, they've used to keep revenue at a decent level, while not probably pushing for high value products or high margin products, and it's more of restocking that's probably happened given the March this thing end. But I think it's going to be more of their gearing up for new launches is what I can make out. This year will probably be a year of many launches, and a lot of them will get designed and relaunched, some of the blockbuster models. So it's going to be more of that. Consolidation is what I would explain that this quarter has gone through, and that's why revenue probably is not seen so much, but operating leverage is probably diminished a bit, and that's why the margins are impacted.
Okay, Prakash, thank you so much for joining in with us and, explaining us what the numbers of Maruti actually indicate. Thanks so much for that. As of now, Maruti is not seeing a very sharp cut as well. Seems like we are seeing in terms of a % of a cut, which was there when the earnings were reported as well. So keep an eye out on Maruti. Suzuki is a bit of a decline there. But yes, that's something to watch out for. Margins is where we've seen the big miss coming in on that front. That's something to watch out for. Seems like expenses could be an issue as well. And consolidation is what Prakash highlighted, is how we could term Q4 coming in for the company. Obviously, you'll wait out for more details coming in from Sudarshan soon as well. But yes, that's Maruti Suzuki as of now at 11,812, down 0.6% in today's trading session. Some bit of a spike up again is what we're seeing there. But okay. Let's keep it going then with other stocks that are buzzing in trade. You all have sent us your queries related to, and we still have Shaina as well as Vaishali with us for that. For the next query for today, we have this coming in on Birlasoft. We have Krishna, who is writing to us from Hyderabad. He's holding 32 shares of Birlasoft. Price is 600 rupees per share. He's a long-term investor. What should he do with this? Shaina, continue to hold, look to sell this one.
I would say continue to hold. The stock has already seen such a sharp decline based on the very disappointing third quarter numbers, where we saw a huge dip in profits on a slightly lower turnover. Having said that, and they had mentioned that they are seeing a lot of furloughs in the third quarter. They saw a lot of that in the BFSI segment, healthcare segment, and that is likely to continue also to some extent in the fourth quarter. So I don't expect any great numbers in the fourth quarter also. Having said that, I think given the fact that they are getting good new, their deal pipeline is quite good. It was quite good in third quarter, expected to be good now also in this current quarter and going forward. So I would say continue to hold, and valuations are also have started becoming more attractive. It's about 15 times 1 year forward on a PE basis.
Okay, and Vaishali, on the technicals, Birlasoft, how is that looking like?
So I would say on the whole IT pack, we are seeing good correction coming in, and particularly if we talk about Birlasoft, I think the worst is nearly over. So I would say one can add more at these levels so that the cost also comes down, and when the going gets good, I think there will be very good returns. I think I'm looking at a bounce back coming towards 500, 550 to start with. So I guess one should average out at these levels.
Okay. That is the view coming in on Birlasoft from both our experts. But Vaishali as well as Shaina, that was the last query for today. So thank you so much for tuning in with us and helping our viewers always solve their stock-related queries. And viewers, thank you so much for always sending us your queries. Remember, you can always email us your queries and on the email address that is on the screens as well. And we will get them solved with our experts. But with that, we'll wind up this edition. So thank you so much for tuning in. And up next, we have Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Taiwan index managing to hold on to gains of almost 2.5%. Hang Seng is holding on to gains of 0.8%.
And, support for the Nifty Bank, 54,664.
Have a head start. We started the negotiations ahead. The terms of reference have been finalized.
24,282 is where the Nifty is at, 0.15% higher.
Tariffs were just an excuse, so to reset valuations on the way down.
The Nifty is below the 24,000 mark. In fact, below even 23,950 as it sees a deep cut of 300 points. Sensex down in excess of 900 points.
It also depends on the speed at which the capacity ramp up takes place at Apple's contract manufacturers here in India.
We have been opening more number of branches, employing more agents.
The Secretary, Ministry of Jal Shakti, has written to the Secretary, Ministry of Water Resources in Pakistan, suspending the Indus Water Treaty.
From the broader markets as well, there are a bunch of stocks which are recovering. Most notable of them is Coforge, which has recovered about 4% from the lows, currently at the high point of trade.
Well, it is a slow day, a down day, whatever you want to call it. Broader markets recovered from the day's lowest point. The Nifty and the Nifty is down about 145 points. It was down over 300, actually almost 400 points early in the first few hours of trade. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Surbi and Reema here in the studios with me. And Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, good afternoon. Maybe we can call it down, but not out, Prashant, because of that recovery that's coming in. I think that this is a market where, because it went up in such a hurry, from the low of 21,750 odd to the high, I mean, 12% in about 9 to 10 trading sessions. So maybe dips like these are getting bought into.
No, absolutely. Looks like it. And, it's... I mean, is there panic or is there any real reason at the margin for the market to sell off? Or, I mean, nothing. And we've had enough and more news flow, which you could have very confidently identified as the driver for big moves. But, I mean, today's move, I think just a mix of things, a bit of profit taking. And as we were discussing in the morning, there is that element of, some uncertainty, apprehension of how things on the border may sort of develop after the attacks. So it's just a combination of those things which are playing out. Otherwise, I mean, there's no real big driver in that sense. Market breadth is negative. 5 declines for one stock which is up. So that is noticeable. The Midcap index is down 2%. And I think it's the broader markets which are hurting a little bit more, even as the frontline indices have come off the lows by quite a bit. Some numbers are coming through, and I think we just saw Maruti flashes. Sud will be with us in just a bit to run us through the numbers, and I think now you got Hindustan Zinc coming through as well.
Well, thanks. Courtesy the gains in the early part of the week. For the week still, the Nifty is up 1.1% and the Midcap index is up 2.2%. IT top honors. One, there was an intraday recovery. The Nifty IT index started in the red but now is up 1.5%. And now for the week, the Nifty IT index has soared more than 7.5%. On to the gainers then. On the way up, SBI Life on the back of its numbers, 5% higher. TCS, Tech Mahindra, Infosys. These are commanding a gain of about 1.5%. Tech Mahindra has managed to recover. In this, the early tick on Tech Mahindra was actually down. The street was disappointed with the revenue performance, but the stock has managed to claw back into the green. On the way down, it's Axis Bank with a 3% fall. Again, numbers here. Adani Enterprises, Adani Ports. Trent is losing ground. That's 3% lower. Shriram Finance, Apollo Hospitals, Bajaj Finserv, BEL, cutting across sectors, but there are more stocks in the red than green.
Oh, absolutely. I mean, no doubting that. And the Midcap index also, but there was a point in time when the Midcap index was down 3%. And from there, the recovery has come through. But having said that, I mean, a lot of stocks where money is coming off the table for one reason or the other. SBI Card, for instance, after earnings down about 6%. Motilal Oswal ahead of earnings, profit-taking, nervousness, call it what you want, 6% there as well. Blue Star, we discussed this in the morning as well. Blue Star has lost about 14% this week. And it's falling about 5% now as well. So yeah, these are some of the spaces where there's plenty of profit taking going on. And in general, of course, the financial space, if you look at the volume charts, then lots and lots of tier 2 financial stocks, RBL Bank, for instance, under pressure. J&K Bank obviously has had a rough week. So plenty of names, a lot of PSUs as well, NMDC, Ericon, Hindustan Corp, a lot of PSUs also seeing profit taking. Nigel?
That's right. And in fact, if you just look at the breadth of the market, at one point of time, there were less than 200 stocks actually that were advancing. So that intraday graph actually should come up for you. The crisscross lines have tried to get a little bit closer to each other. Quick word on Hindustan Zinc's numbers were there. You had the silver LME prices that had spiked up in the last year or so. So that's one factor that's played out. The other factor is, the zinc prices have improved. The other factor is the silver segment has done quite well. They give the segmental breakup over there. And that could explain why, the stock is recovered from the low point of the day. There's only 3-4% of free float in the market. But these numbers look pretty okay. It's not what happened, in the past quarter, but the street would like to understand from the management what's the path ahead, how do they see the demand-supply dynamics play out. So we'll try to get the management later today and, in fact, get you an update by Monday itself. But these numbers look a little bit better than what we are working with. Mitesh Thakkar, though, joins us to tell us about his take on the markets. Hi, Mitesh. Good afternoon. Good to see you, Ben. Mitesh, the buy on dip worked out again today. For the time being, I think till we defend the 23,800 odd mark, it should be pretty good times for the bulls. How are you reading today's trading action?
Good afternoon. I was talking about this gap which happened on Monday, around 23,870 and 23,900. And I said buy all the way down till about 23,900, 920 zones and keep a 23,840 kind of a stop loss. Just hit those levels. But yeah, that is this important support level. 23,850, 870 is the area where you can give and take 10, 20 points from where the market should have bounced back. It has done that. So for the timing, it's holding out. Now, what has happened in the meanwhile is that, the intraday charts have still, slightly started coming off from overbought levels, which means that while we may not immediately get into an uptrend, I think we could go into some kind of a consolidation at higher levels post this rally. So broadly, 23,850, 820 to about 24,300 is my understanding for the next few days. And we might see the markets, be ranged. On the stock side, I have a buy on Reliance. It's a buy with a stop just below levels of 1279. Look for 1350 as the target area. And I think you were discussing Coforge is something, which is looking interesting on the short to medium term chart. So Coforge is a buy. I would look at targets closer to about 76.60 and a stop at about 73.50.
Coforge is yet to report its numbers, expected to be a strong quarter, but numbers will be out only on 5th of May.
What's the CC expectation, Rima? I mean, is it...
I don't have to open my Excel, but I think it
because
should
this
be
is
3%.
something we discussed earlier in the past as well. I think that, when you're looking for stocks where there is maybe some room, some dislocation, given fears that everything got sold, right? But Coforge has come off the lows as well. 6,000 was the low. It's back to about 74, 74.50. But of course, the highs were about 10,000 or so. So yeah, I mean, it's come off, but off the lows at this point as well. Rima?
Okay, let's invite Prakash Diwan on the show. Prakash, thank you so much for joining in. You want to quickly first come in on some of these big IT drags today? One of them is Cyient, down 6%. The other one is LTTS. Tata Elxsi too has gotten hit hard. Stock has plummeted nearly 5%. Any interest in buying these stocks after the fall?
Good afternoon, Rima. So, I think what you need to put this into context by trying to rationalize what led that up move, which a couple of days back that we saw, and Midcap IT was looking so strong, just on the back of anticipation that what Persistent did or probably, could be anticipated or expected from Coforge and the likes. In fact, when Tata Elxsi reported numbers, KPIT was expected to actually be even weak and actually did better. So I think it was classic sector rotation after banks. The underweight area was IT, and since FI money was coming back of sorts, people anticipated it would get allocations into some of these beaten down names. But, the fundamentals haven't changed favorably for sure. Even with the up move, there was nothing to kind of back that up. Even at the current juncture, the uncertainty that prevails in terms of any potential for new client, any TCV improvement for some of the largest names, even the mid-sized names, they're going to keep struggling even to maintain, the thresholds that they have. So my sense is this was just likely to be a corrective move. The up move was without much of fundamentals backing it, and hence, you see that kind of reversing itself. I would still wait for IT to be sending clear signals that it's out of the woods, and that could probably be end of this quarter or maybe September, but not before that. So we'll have to wait for that. Market also, I'm sure, not getting very charitable and paying for something which is just more like a hope trade.
Okay, all right, get that. Prakash, hi, good afternoon. Let's talk about the stock that has reacted very well to numbers for obvious reasons, because, that VNB margin that SBI Life put out, it was way ahead of expectations, and they're sounding quite optimistic for the current year as well. Your thoughts on the stock?
No, absolutely. Good afternoon, Subi. So, you need to put, again, this in context with the fact that even HDFC Life numbers were pretty good, right? I mean, there was no reason to complain. And if SBI Life, with its fair degree of superior distribution reach, can kind of show some improvement in margin. And usually, absolute terms, VNB goes up, VNB margins go up. All of that is a reflection of the fact that they're getting their product mix right, to suit the distribution network that they have. Now, if that continues to even gallop ahead for 2 or 3 quarters, you have an amazing footprint that kind of, gives you an advantage over the others in terms of even market share. So I know of a fact that their distribution has become much more refined, and it's not just a call center trying to reach out to people and bothering them with phone calls, but it's actually people meeting on the ground, even in tier 2, tier 3 cities now. So that's the kind of change they have brought about in the last year and a half, and that will start showing in numbers, is what my sense is. So the earnings scorecard is definitely very impressive, and my sense is this will continue. March usually is a good quarter, but if that continues for another quarter or two, as I said, you'll probably see a full advantage in the year and a re-rating that's possibly due for SBI Life.
Okay, by the way, look at Motilal Oswal's numbers. The stock has tanked 7.5%. The company's reported a net loss of 65 crore, and even on the bottom line there is a loss, and the top line has fallen 45%, 1,190 crore on the top line versus 2,154 crore. We know that Q4 was tough. Equity markets had started declining. The regulations had resulted in a drop in volumes significantly. But these appear to be slightly worse than what perhaps the street would have expected. 7.5%, 8% down now on Motilal Oswal share price. Top line down 45%, net loss of 65 crore. Prakash, quick word?
So very, very reminiscent of even the last quarter, Rima. Last quarter also we had a similar, the loss that came through wasn't on anticipated lines, but then the stock recovered and did its bit for various reasons. But I think the overall segment, the wealth management, asset management, of course, broking, investment banking, all of those have been on a slightly lower, in this quarter. We all know that. But things could change dramatically for some of these plays. And at lower levels, there will be a lot of money that will come into this segment because you have very few established players which offer that kind of a visibility and scale. So, what's happened to the India Infoline deal, foreign participation coming in on a strategic level is very different than just financial investments. And all of these players will start kind of sensing that there is opportunity to do that, to scale up. So from that perspective, at lower levels, you'll see some buying and some interest come through. But yeah, the numbers will definitely be disappointing for people who are used to very good performance from this name all these quarters in the last 3 years at least. So, but this is a quarter of reckoning. Nothing much has been done, and that's exactly what's happening. Hopefully, it doesn't spill over. We'll wait for the commentary to assuage those doubts, and then you can probably relook at it.
Okay, all right, Prakash. The numbers of Hindustan Zinc, which are obviously backdated. The world is in a different place today in comparison to the past quarter because President Trump has put those tariffs in. But the numbers look pretty okay, and they have plans in terms of reducing their cost of production, and LME prices have now stabilized. What's your view on the stock? The problem is you don't know what Mr. Agarwal is going to do next, but the stock is, as it has been languishing, in this 400, 450 odd mark.
So, Nigel, you're right. The magic on this stock is a low float. So if you see the company do even half a good thing, it kind of starts getting celebrated very easily. And the same way, something doesn't happen, which is in line with what people expect, or there's some disappointment and it kind of moves it. But I think where it is in terms of the business and vis-a-vis the stock price, it's at an amazing spot to be able to scale up from here in a lot of ways. Forget the byproduct benefit of silver and all of that, but I'm saying even zinc as a commodity is something which is not so easily available. And given their ability to scale the mining techniques, that the technology that they've started deploying now is far more amenable to a scale up which is rapid. And if they see LME prices move up, they can capitalize on it very, very effectively. So and Mr. Agarwal is smart enough at that opportunity seizing. So I would believe it does offer a good risk reward. The numbers are probably not as bad as they could have been, given how this last one quarter has been. It's almost been a washout for most commodity plays. But going forward, I think it could offer that. When it happens, when does a trigger kind of happen? That's difficult to pinpoint. But I would believe it's sitting at a very good risk reward at this point, 450 or wherever it is.
I just want to make a quick, the clarification is important. That loss largely is on account of the MTM change on their investment portfolio, Motilal's investment portfolio. That is important to note. So this is March 31 values as compared to December 31 value. That's the change, and that is the reason why you have this this big loss which has come through. So net loss on fair value change is 430 crores compared to a gain of 424 crores. So December 31st, as compared to September 30th. The gain was 400, and 31st of March compared to 31st of December, I mean, it's turned the other way, and there's a loss of 400 plus crores. That explains largely the numbers.
I was looking at that breakup, Prashant. So that explains why, if you look at the treasury investments, if you look at the revenue streams, and treasuries obviously has got this big loss because of this mark to market. The treasury business has seen a loss of about 537 crores, which is the market aspect of it. But if you look at the other businesses, the capital markets business, and that's where this whole change in regulation, I mean, finally it shows up in numbers, right? Look at the capital markets business for Motilal. The number there is about 143 crores in terms of revenue, which is lower than the December quarter. Of course, compared to last year, it's still up because year on year, I mean, that's the great financialization story that Mr. Ramdev Agarwal talks about. Year on year, it's still high. But quarter on quarter, obviously, there's been that sobering effect. Even wealth management, which is, of course, the largest business, wealth management has dipped a little bit, both year on year and quarter on quarter. So, yes, treasury is the big bummer. But even otherwise, the businesses have been a little sluggish. We'll discuss that. We'll discuss these trends.
Yeah, if you remember Angel's numbers, the revenues were down 22%.
Yeah.
This is the slowdown here is much sharper.
Yeah.
So but the point is that directionally, all brokers, because of the changes which have been made on the broking side, I mean, revenues have taken a hit to varying degrees in the fourth quarter for these companies. I mean, the Angel management told us that 26 will be a year of consolidation, and then I mean that's what they said. And even if you look at estimates for most, I mean, they're all penciling in a slight decline, a single-digit small decline, 26 over 25. Prakash, thank you very much for joining us and appreciate your time here on CNBC-TV18 as always. We'll take a quick commercial break here. We're going to come back. Jitendra Gohil of Kotak Alternate Asset Managers will be with us on the other side. Welcome back. Jitendra Gohil is Chief Investment Strategist at Kotak Alternate Asset Managers. Jitendra, good to have you with us here. Good afternoon. Markets taking a bit of a pull, combination, just profit booking, I guess, right? 12-13% quickly. But where does that leave you and what you're doing at Kotak Alternate? Give us a sense of what you're liking, what you're not liking. Where do you think there are still opportunities in?
Hey, hi. Just few things before we jump into what we like. What we are seeing in the market is there's a big reset going on. So if I look at the US market, which is the largest consumer in the world, and China, which is the largest producer in the world, now they both are having this trade tussle, and we don't know where the equilibrium will be. But it seems that both countries are facing several challenges domestically as well. One on the debt side, other will be on the consumption slowdown side. So I think there is a big reset going on. And this is actually good for the global because too much concentration in this couple of countries might not bode well for other countries. So I think in that perspective, I think this near-term shift in this global trade, probably it will have a long-term impact on a country like India. And we think that that would be on a positive side. Now, on the, what we like and how we are looking at this whole thing is that, look, there was too much focus on US markets, US exceptionalism. Almost 71% of global MSCI market cap was concentrated in US. And since now the dollar has started to weaken at that time when there was a risk-off environment, gold price there shot up. So it seems that the risk premium is getting adjusted. So we are applying little less or lower risk premium for emerging market, and that is possible, and that is very clearly visible that we have seen FPIs have started to come back to India to some extent. Our yields have remained well anchored despite US yields have shot up sharply. So from a macro perspective, I think we are in a very decent space, which gives us a lot of comfort. Now, in this kind of a setup, what we are, suggesting our investor is first that because of India's macro stability, the way rupee has behaved, pretty much stable year to date. We saw some kind of volatility, but overall it's pretty stable. Yields are stable. In this kind of environment, banks tends to do better. Our inflation is well under control. RBI has also started to ease a bit, and there's a possibility of a 50 basis rate cut as per our house view. And if we are a little dovish, if the growth slows down globally as well as a little bit locally, then that 50 basis point could be 75 or even 100 basis point rate cut this year, which is fantastic for some of the NBFCs and banks. So we think that while these trade tensions lead to a lot of uncertainty, from the medium to long-term perspective, I think India's macro stability gives us a lot of confidence. And that leads to focus on some of the domestic names, especially banks. On the other hand, if I look at the global setup, so even Europe, for example, has now started to spend. So Germany has lifted its debt ceiling, and I think we will see a lot of spending happening outside US. So while US might be controlling its spending, the other economies might want to again support their economy. For example, even China has started to cut rates, and they started to stimulate. Europe probably might have to do it. India has a little bit headroom, more headroom on the monetary and less headroom on the fiscal side, but still we have good headroom to stimulate in case that we see growth slows down. So net, while we remain little skeptical about what is happening in the near term, but let's say if we fall another 5-7%, again you will see the buying interest might come in. However, on the other hand, if I look at the concerns that we have, while we are a little positive
so,
on the...
Jitendra, allow me to come in. We have limited time. So you like banks, right? That's the
yes.
Right. So to the exclusion of pretty much everything else, I'm understanding. Very few things you like at these prices.
So yeah, I'm coming to that. So banks and NBFCs probably are in a better position, and also we are bearish on oil. So if oil starts to fall, probably you will see that our macro improvement starts to factor in, and that leads to some kind of bounce back in even PSUs as well. So we think that banks are better positioned. And from a tactical perspective, if we see that oil starts to fall again back to, let's say, 60, we might see some more rally in the PSUs as well. Other sectors that we like probably would be healthcare, where we are positive on hospital stocks, while the global pharma companies, we have turned neutral recently, but we think that there are CDMO space where we have started to become more constructive as of now.
Okay, Jitendra, thank you very much for that. Sorry, shorter conversation because we have earnings lined up as well. We'll pick up on some of these points in greater detail next time around. Ramdev Agarwal is with us, Chairman and Co-founder of Motilal Oswal Financial Services. Ramdevji, good afternoon. Good to have you here. Prashant this side. There is a loss. And we're not used to seeing losses from Motilal Oswal. Has not been the case for a while. But I think that it's a MTM revaluation, right, on your investment assets, March 31st to December compared to 31st December. Let's just clarify that, and then we'll move on to segments.
Yeah. So let me just explain to you the Q4, where there is some amount of 224 crore losses visible. Actually, our top line is up by 8% for the quarter, from 1,300 crores to 1,200 crores. That's the most important thing in the company. Operating revenues are up by 8%, despite all the regulatory changes in this quarter. Bottom line is up by 3% from 502 to 519. This is the most significant number among all the capital market players, 519 against 502. The treasury loss is 743 crores for the quarter. That makes it look like the total net loss for the quarter is 224 crores. But so that's how it adds up to losses. But if you look at the full year, I mean, this is a time to look at the full year. Revenue is up by 31%. PAT is up by, operating PAT is up by 31% from 1,542 to 2,000 crores. And then treasury gain is about 478 crores against 1,084. So the total profit remains at about 2,500 crores for the year compared to 2,600 crores for the last year. So it's more or less flat kind of situation, maybe 2-3% lower than last year. But it's a very, but for the fourth quarter mark to market, which happened, in last 3 months, the operating performance has been quite fantastic, I would say. 31% top line growth, 31% bottom line growth. Actually, when you have 31% top line growth, we should have more like 38-40% kind of bottom line growth in the operating side. But that didn't happen because we actually over-invested in the entire operating side so that we can be ready to harness the bull run which is there in the capital market in the years ahead. So that's a summary of what has happened in the company in the quarter and for the year.
Thank you, Mr. Ramdev ji, for putting that into context. But we were also looking at your numbers on a sequential basis, and there is a decline in the company's top line. And Q4 was the first full quarter where SEBI's stricter F&O norms came into effect. Is it possible to quantify the impact of that in the March quarter? And also, we know that this is a cyclical business. Things recover once the market recovers. How has April been for you, and what should we expect in the current quarter?
Yeah, so between December quarter and March quarter, the most impacted segment of the 6 businesses we have is the retail broking. So our retail broking revenues went down by 20% in quarter on quarter. But that 20% brokerage revenue shortfall is more than made up by distribution revenue of insurance, mutual funds, equities. So all kinds of deals do happen, and the distribution revenues more than made up that entire loss in the revenue of the brokerage. But yes, there was a brokerage loss of 20%, maybe 22% from December to March. And what we are seeing now is that April revenues are very much matching with actually March revenue. In fact, it is ahead by 5, 7, 10%. So my sense is Jan, Feb, March has shown the worst of the decline in the brokerage revenues. And now under the new, whatever the restricted regulatory framework in which there is a two weekly expiries and all, I think revenues are stabilized. And in fact, now the traction is that we are seeing little more progress in the revenue build-up on the base of March quarter.
Ramdev, just to go back to the treasury loss bit, since we're talking mark-to-market, markets have bounced sharply, up 12-13% on the Nifty.
Yeah.
So if you were to mark-to-market as of 24th of April compared to 31st of March, what would that, would you have made up for, how's that number looking?
Yeah. I don't know, at least half of it we must have made up in April, but I don't have exact number as of what we have done. How much is the recovery in April? That number I don't have, but I have the March loss exactly 743.
Okay, Ramdevji, good afternoon, Surabhi here. So, okay, that's mark to market, and I think that's a function of the market. Can't help it, up or down. Yeah. But back to understanding the businesses. So what you're saying is that maybe the worst of the hit for the broking business because of the regulatory changes, that should be behind. Then what should be, now that there's this new normal that's been established with F&O norms, etc., right? So what should be the new rate of growth that we can expect, given market volatility, which is part and parcel of this business?
Yeah, if you look at the March quarter as the base and multiply it by 4 as the year gone by, rather than taking the first 9 months, in that case, on the base of March quarter, I would think 25-26 will be at least 30 to 35% growth in the revenue.
Okay.
On the basis of March
broking.
Quarterly number.
On the basis of the March quarter, got it.
For the broking. Yeah, okay. So there will be full recovery. I would be surprised in the year 25-26. We should be having at least as good a number as 24-25 for the full year, despite all the changes. I mean, it will take 1 year's growth for the changes, okay? But other businesses like, say, iBanking, I think our real strength, which turned out to be in 24-25, real highlight is the capital market business, where we raised 51,000 crores for out of 39 deals. In 39 deals, we have raised 51,000 crores, and we have been termed as the top of the charts in QIP handling. I mean, our distribution is good, so we have done the largest number of QIPs in last 12 months. So that has been the highlight of Motilal Oswal institutional broking side and iBanking side. So that is one thing, and second is the HFC, Housing Finance Company, which was kind of going through the reform process for last 2-3 years. That has fully stabilized, and there is a 20% AUM growth and 80% disbursal growth. And the best thing is that quality of asset is best quality in the entire industry. My 30 days plus is less than 2%, which is the best in the industry. So I think one, the capital market resurgence from what boom we are going through, and second is the only asset which was kind of a languishing in our balance sheet was my HFC, which is now absolutely kind of in a growth path and doing very well.
So your private wealth management business, which is also another big piece of the business, here year on year there's growth, but sequentially there's a small degrowth coming through. Again, what would your expectations be for FY26 from private wealth management?
Yeah, so private wealth management, the highest amount of build-up is happening in private wealth management, and hence growth will be quite robust. I mean, actually the March quarter is a very different kind of quarter compared to, say, other quarters. So a lot of adjustments are there in terms of bonuses and variable bonuses and all for the March quarter. So if you look at the whole year, I think wealth management reported up. Wealth management will grow at about 30 to 35% because wealth management has, the private wealth management and wealth management from the broking side. So I think gets mixed up, but I think wealth management, private wealth management per se, will grow very rapidly. I would think that it will be the fastest growing segment in the capital markets from MO side.
Got that. Ramdevji, investment banking, absolutely. I know a banker or two, they're working on Sundays also. They're in office or something. Business is booming.
The kind of booming. Yeah, I mean, we don't have any conference rooms left, despite we have 25 of them.
Okay. Now, since we have you, let me ask you a quick couple of questions on the market as well. Where are we at now, Ramdeji? Have things, have we seen the worst? You think we are, once again, prices have snapped back very, very sharply. What's your sense?
Yeah, so it's a risk market, new risk keeps coming. So now I think we are just about getting over this Trump tariff risk, which was kind of hogging the limelights in last 1 month or so. So that portion is, my sense is that we have seen the worst of that, globally also and locally also. So I don't think market is going to be scared second time out of the tariffs. You can't take the global markets or local markets lower than whatever we have seen in last 1 month because of tariff. Now this new issue of Indo-Pak has come up, this Pelgam, which is very serious, and one will remain cautious because this brings a very different kind of India localized kind of a risk factor, and how things will move, we have to be at the guard and be cautious on that. But I think India, so leaving aside that particular thing, which is going to happen very quickly in next whatever time frame, I have no idea. So that's a new risk we have to tackle. But otherwise, I think India is standing out as a shining star in the global framework, in the sense that I was meeting few FIs, they are saying that they're underweight America, they're underweight China. So I said, where is overweight? So they said Europe and India. So I think India is standing out very clearly. And if you see the last 10-15 days flow, that clearly shows that which way the wind is blowing as far as FI's attitude is concerned. But let's see, I think in this year, 25-26 will be Indian markets for FIIs. They'll come big time. Now, with that, DI in any case is positive. So with both sides positive, I think we'll have good time in 25-26, leaving aside the kind of risk we are seeing locally.
Like they say, na baap bada na bhaiya, sabse bada rupaiya, right? Rupaiya or dollar in this case. If the dollars start coming in, then all bets are off. Then all conversations on earnings, valuations, everything kind of has to take a back seat. Take that point, sir. Just a last question before we wind up, because for Motilal Oswal, and you've been very optimistic on your private wealth business for several quarters, right? And even now you're saying it should be the fastest growing business for Motilal. Can you give us some ballpark numbers? When you say fastest growing, is it 20%, 30% growth? And also there's intense competition in this business. The foreign banks want to come in. If they cannot set up shop on their own, they're coming and buying pieces. I mean, look at the IFL deal. There are lots of boutique Indian houses as well. We actually had Ashish Shankar along with Feroz Aziz on our show earlier this week to discuss this. And, one of them highlighted that, yes, retaining talent is an issue. I mean, there's a lot of competition. So just define a little more in terms of your expectations and growth from this business.
See, I look at the big picture. See, today we have our market cap is about, equity market is about 400 lakh crores. Of that, promoters are about 200 lakh crores and rest of the market is 200 lakh crores. In next 4 to 5 years, in 4 years it will double. So another 400 lakh crores will be there in the marketplace. And of that 800 lakh crores, 80-20 principle is there. So 80% of the market cap will be the 20% of the people. And they all need wealth management kind of a support. So 600 lakh crores of money has to be managed by somebody or other. It should be managed. Whether they give the mandate or not, that is a different thing. So opportunity for all the wealth management companies, because this is not winner takes it all. I mean, a wealth manager can survive with just one client also. He can have 10 clients, he can have hundreds of clients and thousands of clients. So I think it is the USP of every wealth management platform, what they bring on the table. And we have a very strong proposition for any client who wants to come and harness the power of equity in their wealth. If they want predominant equity oriented portfolio in their wealth, I think one of the best places to come is Motilal Oswal. So that's how we have positioned our wealth management practice, and the opportunity is big. So my sense is that if market is trended well for next 4-5 years, the clients coming to get expertise of wealth managers, not only us but everybody else, is going to be quite big. And that's why if you see the listed space, the highest valuation is for the wealth management firms.
Absolutely.
That clearly tells that growth potential is good for them.
Is FFI, just to go, a point taken, 26,000 plus this year, Ramdev, on the Nifty? Back to highs?
All bets off. I mean, I think it will surprise us if things are peaceful, because now credit flow is coming, the tax benefits are going to flow in, the regulators are talking about growth. So I think everything is positive for this thing. And in this kind of environment, and particularly it's a corrected market. I mean, 25, 26 at index level, it's just about 6-7% up. So we have a fully corrected market. 25, 26 should be more like 18-20% kind of thing.
Okay, all right. So there is upside here if things remain. I mean, as you said, the Pelgam thing, of course, is serious, and we need to be on guard, be watchful. But otherwise, things seem to be sort of working in our favor. Ramdev, thank you very much. Appreciate your time here, and we'll invite you on back for a full-fledged discussion on markets per se as the weeks roll on. Thank you very much once again. We'll take a quick commercial break here. We get you what's happening in dealing rooms, D-Street chatter with Nimesh on the other side. We'll get you some trading ideas as well coming up.
Welcome back. You're tuned in to Closing Bell here on CNBC-TV18. Well, we're half an hour away from the weekend, but before we get to that, let's get in Nimesh to tell us how is he reading D-Street chatter. Nimesh, what's the feedback you've got today?
Well, Nigel, a decent recovery from the intraday lows, but still under pressure. I guess largely it's to do with the geopolitical risk that people are talking about. From a flow perspective, it's not a bad day. I mean, it's not. I've not heard very large FI selling, so to speak. So, what the sense I'm getting is, especially in the broader markets, the first couple of hours saw a bit of unwinding of retail long position. So that added pressure to the mid and small cap indices. That seems to have been played out in the first half. So even that, to a larger extent is done with. I guess, we need to see the technical levels of 23,800. I've been saying for a while now that will now act as a very strong support on the downside. Today, if you see exactly from those levels, market recovered. So again, it's an indication that maybe on the downside, 23,800 is a level to watch out for. As I said, there is not big selling, so to speak, but the broader markets have a little underperformed. And as I explained, that underperformance largely because of unwinding of retail positions in the F&O market.
Well, that's right. Nimesh, the Nifty Bank as well, after leading for the last 1 month or so, this week actually it's underperformed in comparison to the other indices, and the RSI as well had perked up above 75. So we'll have to keep an eye out on that. But what about individual stocks? Sorry, Pelgam?
Okay, so in terms of individual names, the first stock on my list is Tata Power. It's under pressure today, but for the last couple of days, I'm getting a sense that a couple of domestic mutual funds and a leading HNI investor has been aggressively buying into Tata Power. So that's the first stock. Second stock is CDSL. Again, stock is under pressure today on the lines of overall pressure. But I understand a very large long-only fund has been accumulating CDSL at these levels. So that's the second name. The third stock is Varun Beverages. Under pressure for the last few days. And even in today's market, I understand there are very strong sell flows. So expect high delivery volumes on the sell side in Varun Beverages. And the last one is HPCL. Among the OMCs, this is one stock which has actually recovered from the intraday lows. There is a bit of buying as well, is what I understand. And also for HPCL and for all OMCs, apart from the earnings, I guess watch out for any sorts of clarity on the LPG subsidy. That could be a big trigger for the OMCs in the very near future.
Thank you, Nimesh, always for that list. We will go to Mitesh now for a few BTST calls as we enter into the weekend. Mitesh, what do you have for us?
So, in fact, I have one STVT call as well. It's just that the way the intraday charts are shaping up, ACC seems to be having a good breakdown. So, take a STVT here. Keep a stop at about levels of 1952 and a target of around 1915, 1920 can be looked at. And that apart, my sense is that we could also look to buy into a short period which has come back to its 200-day average. So keep a stop just below levels of 223 half here and a target of 228 can be looked at.
Okay, all right, got it. Numbers coming in from Shriram Finance. That net profit number is in line. We'll have to wait by and get more details on the other segments, overall growth, etc. Stock is down along with the rest of the market, at least for the time being. Net interest income has come in 5565, and that's below expectations. And that explains why there's a dip on the stock now. So net interest income missing the mark for Shriram Finance. Profit is okay, it's in line. We have Anand Tandon joining in on this leg of the show. Anand, great to have you on. Good afternoon. Thanks for joining in. So let's actually talk about some of these large financials, because the market rally in this leg has been entirely led by them, right? What would you make of things? The banks that have reported, the large banks, numbers seemed okay. Axis, the market reaction is very different today. And what about a big NBFC like Shriram Finance?
Well, I think overall the banks have, as you said, done quite well. I mean, you can't comment on an individual bank on a particular day. But by and large, I think the trend remains positive. I see no reason to, especially in a situation where the likelihood is that interest rates and therefore consequently deposit rates will move down a little bit over the next 1 year or so. There should not be any major negative in terms of the NIM. Of course, you can argue that the asset book perhaps will be priced faster downwards rather than the liability side. But I think banks have learned how to manage those kind of risks. More importantly, the treasury profits will go on. So overall, I think banks are in a fairly healthy space. There is no doubt that there is a bit of a slowdown in the credit growth. Overall, the industry growth has come down from 15-16% a few months back to now about 11%, and that's a bit of a cause of concern. So overall, I think banking also remains relatively cheap. When it comes to NBFCs, I think the situation is not that great, because I think the kind of portfolio that they are going to be financing is something which is a lot more riskier, and also where the consumer demand becomes a bit of an issue. My own thesis is that we should see a slowdown in consumer discretionary demand that will impact most of the NBFCs, because that's what they lend against. And in their competitiveness, they may actually end up building a poorer book. So autos specifically, for example, have already witnessed a slowdown for quite a considerable number of months now. Overall, I don't think that you should be worrying too much. If you have to stay with the financials, banking, the large banks, and maybe the insurance companies are the two places to be.
Okay, banks and insurance. So BFSI is your best bet right now. But let's talk about Maruti. Declared their Q4 numbers. Margins were a miss. The stock is down 1.5%. Sudarshan joins in with the fine print.
So it's a mixed set of earnings from Maruti as far as profit and revenue are concerned. Those numbers have come slightly below estimates, but margin has come in at 10.5% against our expectation of 12%. And company has given reasons, and because of expenses have increased, and three parts of expenses, if I can talk. First one is material cost. It has risen both sequentially and year-on-year. It was up 6% sequentially, 1% year-on-year. Employee expenses were up 15% year-on-year and 2% sequentially, and other expenses have increased 14% year-on-year and 13% sequentially. So if you accumulate all these have impacted margin by 230 basis points. Now, material cost impact on margin was by 90 basis points, employee cost impacted by 30 basis points, and other expenses impact were of 110 basis points. So what all a company has included in other expenses? It has mentioned first, new plant-related expenses, second, higher sales promotion or ad expenses, and third, higher manufacturing overhead expenses. So these have come in other expenses, and that has impacted margin by 110 basis points. But what was the positive in the earnings was the realization. It has improved both sequentially and year-on-year because of the price hike that company has taken, not only in Q4, but even in Q1 FY26 also it had announced price hike. But just if you talk about Q4, they had taken price hike twice, and that had impacted positively to realization, which has improved 7% year-on-year and 3% sequentially. Now in the commentary, what exactly we'll be looking for? First, what company says on outlook, demand outlook, because recently they had attended press conference, they had attended one conference in which all the companies, including Hyundai, M&M and Maruti, were saying that in FY26 also PV demand growth is likely to be in low single digit. So we'll have to see if there is any update on that and what exactly company says on commodity outlook going forward.
Okay, all right, got it. Thank you very much for that, Sudarshan. So that's Maruti at the end of the quarter. That gross NPA ratio level, I think, was at 4.5% for Shriram Finance, which is down because they've taken big write-offs. And that's how that GNPA level seems to have come down, because if I remember correctly, the gross NPA levels were northwards of 5%, 5.3 thereabouts in the previous quarter in Q3. Anyway, it's an NII miss and the market doesn't quite like that. Anand, since we are talking numbers and earnings, I mean, it's all eyes on Reliance. And Reliance has really tested its investors' patience for a while. I mean, even before the market correction started, the stock simply wasn't moving. What is your expectation? Not from the results today per se, but in general. I mean, what do you see ahead?
Well, there are too many moving parts in that. See, clearly oil and gas is not doing anything great, and given where the prices are, it's not likely to do too much. So the real question is what happens on telecom and retail. Those are the two places where they have been growing and they will continue to grow. Of course, Airtel is a pure play there and therefore an easier bet to take. One of the key things to watch out for would be another split happening in the Reliance group and one more company coming out of it. But other than that, retail is going to go through some trouble again now, because as I said, my own thesis is that you will see a bit of a consumer discretionary slowdown. So some parts of Reliance's retail portfolio, which is exposed to that, will probably take a bit of a breather. The rest of the portfolio continues to grow and quite reasonably, but it is also more or less in the prices. So I think to a large extent, it's not likely to be something that will set the market on fire. But I don't also expect it to be an underperformer, because the profile of the group is now changed. It is a lot less industrial, a lot more consumer, and therefore can sustain higher Ps.
Got that. We'll take a quick commercial break here, Anand. There's 11 minutes to go for the market closing. We're going to come back and continue the discussion. Stay with us.
That's the map of the day. And by the way, as we're getting ready to wind down, there's still that sense of unease. Look at the Midcap index. Again, it's down about 2.7%, heading back towards the lows of the session, as is the Nifty, but it's more pronounced on the Midcap index at this point in time. We, of course, have Anand Tandon with us. Anand, in terms of any buy ideas from here on, because the market has finally given that correction despite the last week, 10 days rally. Which are the pockets that you would look at given the environment?
I mean, there are no sectors which are cheap as such. So it's only a question of relative outperformance. And as I mentioned, I think banking, insurance, etc., are a couple of places which look fairly good. There may be selective chemicals which will likely benefit, and we should wait a little bit to see how the new tariff, how the new trade regime with the US comes through. But there may be some opportunities that you would probably get because of an export shift, some of it going from India. For example, textiles could be a clear beneficiary given what the tariffs that have been put on both Bangladesh and Vietnam, which are proxies for China. So overall, I think there will be some opportunities that will arise along the way. But I think you should also keep in mind that the overall trend for the economy will be slightly lower this year compared to last year. And the earnings, which has been factored in today, will also probably slow down quite considerably. So one has to be very selective of the valuation at which one enters to make any money.
I get that. By the way, look at the market go a little bit more, right? I mean, as we are going into the close, we are taking a bit of a dive. Any thoughts on, tough to say, but Anand, on this possible military response to these terror attacks in Kashmir, and how does one, there is apprehension, that much we know, but no way to tell, right?
So even if you were to say that, one could put a probability to it, and I think the probability is high that there will be some kind of option, some kind of operation. The question is, how do you play it? And the answer is you can't. So you just ignore it for the time being. When it happens, you react and react quickly. But other than that, you can only assume that the government will have to do something to establish that we are not going to let this kind of event go past without some reaction. And the reaction will come. Now, we don't know the times, we don't know the intensity, and we don't know the outcome. So it's best not to worry too much about it and to focus on the earnings and where the market can head irrespective of that. And as I said, one of the things you have to keep in mind is that we started the year with, again, 14% odd kind of earnings growth. That's not likely to happen. I think it will come back into the single digit. And therefore, you have to keep an eye on the valuations, and that should keep you light in terms of the equity relative to some of the other asset classes.
And earnings, I mean, I'll have to look at how earnings expectations have moved so far in this earnings season. It's a long earnings season, of course. But it doesn't look like at the margin there have been any, I can't remember, have there been any big beats? Maybe there have been a few, but far and few, Anand.
So there may be beats which will be in the smaller companies, but if you look at the frontline companies, so far I don't see any beats. Financials, as expected, have done well. So there may be marginally some analyst expectations maybe here or there. But for the bigger sectors, if you were to look at it, IT has pretty much done what it was expected to do, which is showing a slowdown. FMCG has done almost nothing. The volume growth is almost flat, if that at all. There will be margin pressures in terms of autos, which is one of the largest manufacturing sectors. So, you will see a problem there as well. That doesn't, the part that will continue to do well is probably the engineering and the construction areas. That too will probably slow down in the last quarter compared to where we were, but it will still show a robust enough growth. But most of these companies here are fairly expensive and overly priced. So there isn't an obvious sector that one could argue is somewhat cheap. And that is why I said that, you will get opportunities. For example, things like textiles, etc., may offer opportunities once we know how the lay of the land is, given the new trade agreements that we may end up signing. But I don't see a reason to hurry into any of these things. Keep some powder dry so that one can invest at the opportune time.
All right, take that advice and really appreciate you being with us on the show this afternoon, Anand. Thank you very much for joining in. You have a good rest of the day and a good weekend. Well, let's recap what's been a down day for the market. No denying that. And the market is going home with a level of just about 24,000 on the index. In fact, entirely around that mark right now. So an attempt at a recovery, not entirely successful, ending again closer to the lows than the highs of the session. Let's talk about the Nifty. Though, of course, the bigger problem was the mid-cap. So the Nifty, for what it's worth, look at the damage on Shriram Finance. I mean, 8% down. That NII miss, the market is just in no mood of digesting. So 8.5% gone there. Other weak names included Adani Enterprises, Trent, Adani Ports, lower. Axis Bank also, it was a result casualty right from the morning. It's just a whole list of red stocks. Apollo, BEL, Power Grid, doesn't matter. Just pick up anything and everything. It's down and out. Reliance ahead of earnings is absolutely flat. So relatively, Reliance has outperformed in this session. The other gainers include, of course, the life insurance stocks because of the good performance from SBI Life, 5% up on that stock. And interestingly, Tech Mahindra recovered. Started lower in the morning on weak performance in Q4, but finally the stock recovered. In fact, Tech is the only little place of green on the Nifty. TCS, Infosys also notching 0.5% to about 1% gain, but otherwise weak, 250 points down finally. And that's the large cap screen, but the bigger, much bigger damage is in the mid cap space with a cut of nearly 3% again, Prashant.
No, absolutely. And, it's looking pretty poor out there, at least as far as Friday is concerned. For the week, I mean, between, 0.8 to about 1.5% gains coming through in the Nifty, the Bank Nifty, the mid-cap index and the small-cap index as well.
Okay, just very quickly, some names. Watch out for these capital market stocks. SBI, stocks like Motilal Oswal, 8.5% down. Angel has fallen another 7% as well. Heavy duty selling in SBI Card. That was, again, a result reaction today. And Garden Reach Shipbuilders. So, big selling here as well, down about 6.5%. So just some examples. Sami Hotels, yesterday's big deal, big mover. Today down 7%. So total profit taking on the street is what we have seen. The bell is gone. The day and the week is over. Let's watch out for all the news flow, global and local, over the weekend. But for now, it's a wrap on the Closing Bell show from this team. But don't go anywhere because Editors Roundtable takes the action forward.
The Lal Street ends the week in the green with the benchmark soaring nearly 1% while the mid-caps outperform. Hello and welcome to another edition of Editors Roundtable. Over the next 30 minutes, we'll decode the week's market action. We'll put the spotlight on the IT earnings. I am Rima, and with me are Nigel, Nimesh, Prashant. And joining us here in the newsroom is Hiren Ved, Director and CIO of Alchemy Capital Management. Hiren, great to have you here with us.
Thank you.
Hi guys, another week of gains.
Yeah, towards the end we actually gave up a bit. So
We gave up a bit, but we still clocked in about,
it's been a good week. Yeah, it's been a good week because because of the expiry as well. I think it helped the momentum. Now we need to see how May series pans out. Big earnings will come. Earnings have started disappointing too at some level at the margin. So yeah, need to see how it pans out. But yeah, April was a very good series. I mean, and honestly, but you know, I was talking to a lot of fund managers and investors. A lot of people have missed out as well in this rally. Not many could participate, and you know, could have anticipated such a big move of 2,000 points, 2,200 points in last 10 days. So there is a bit of miss out feeling as well.
Well, that's right. From October to February, you had 5 series when the bears were on top. Yeah. And suddenly the bulls have pulled back in the last 2 series or so. Sell-in May and go away. Will that play out? Or will the bulls build onto those gains? That's something that we'll be focusing on.
Let's ask Hiren as to what is he doing. Hiren, you've been investing in this fall?
We were consistently investing in the fall, right? So, to that extent, we benefited from this.
Sure.
Very smart rise that we saw from the lows that we've seen. Again, I mean, we don't try to take so much a call on the market as much as the underlying stocks that we own. So when markets fall and correct, it gives us an ability to buy more. But I think Jan-Feb were definitely, the swiftness of the fall was fairly dramatic.
Yeah.
And the breadth of the fall was also fairly dramatic. But I think we bought all through that fall.
Okay. This is the only fall, Hiren, you think, this year, or you'll get one more round?
Difficult to say.
You know, what happens is when you're not, as Nimesh said, when you're not able to buy first time, not you, but then you're thinking, ek aur aayega to lunga.
This time you got the second one, but you got 21,900, then you got 21,700. Now,
But you know, Hiren, the local risk factor which has emerged this week was the Pelgam terror attack, right? So how do you expect, how worried are you about that? And, should investors be cautious?
I think it's natural to be cautious because, quite ghastly from a humanitarian perspective, and I think India will and should respond at every level, whether it's diplomatic, economic, and also potentially military, right? The problem with something like that is you don't know how long it lasts, what the escalation is going to be. But if you go back and look at all historical such events, by and large, you've had a knee-jerk reaction and then markets have usually clawed back, right? Unless obviously you have a very long-drawn geopolitical issue, which I don't think, it's very difficult to predict something like this. But it's quite natural that people might sit on the sidelines for a while to see ki kya ho raha hai, let's see, what's happening, and then normalcy will return. I mean, I personally feel that the level of global support that India will get this time around will be of a very different order than all the previous events where we had to go it alone, so to speak. And that could be a big difference, in my opinion.
The problem, though, is, even with all the military support, it's a country with, very unlikely we'll, hopefully, we need to respond. But at the end of the day, it's like it's a pretty much a failed state, right? I mean, what do you do? But a failed state with nukes. So
correct.
That's the problem.
And there I feel, Prashant, that while our response will be adequate, but India has never been irresponsible in that sense, right? Because I'm sure that the leadership, the political leadership, has a much broader viewpoint of the economy and the country, rather than, we can't act like ruffians on the street, so to speak, right? So I think we've always conducted ourselves with a level of maturity, and I think that will continue. But we also need to communicate that we can't put up
to
with
show
this
strength as
bullshit,
well.
right?
Absolutely. Hiren, so let's just get back to the market. What have you bought? Give us a few things that you've done. Maybe that'll give us a segue into specific sectoral discussions. Give us some ideas.
So I think, Prashant, we don't change our portfolios too much, frankly. But if you really look at what has happened, I think that we did get an opportunity because of the tariff issues where sectors like pharma, sectors like IT, corrected quite sharply. And we selectively actually added to our exposure there, right? Because too often have we seen that the markets are too consumed with a near-term narrative of saying, okay, now, there could be a potential tariff on pharma, so, all stocks get hammered. But as more mature long-term investors, we have to understand that no sector loses a competitiveness because of something like this. And now it's a different factor that we are seeing a lot of dialing down of that, fear as well, right? And the same is the case with tech as well. Though tech is a little bit more serious in the sense that there genuinely is uncertainty and, it will impact growth. But then there are always outlier companies which tend to do better when the general industry is not doing well. So you get to have an opportunity. The other area which we found interesting was the whole CapEx investment story, which had slowed down in the last 6 months, right? And stocks corrected thereafter. Our belief is that there are certain sub-segments which will continue to grow irrespective. And again, the market is giving you an opportunity because the last 6 months were not great or the last 2 quarters were not great, but you are really looking beyond 2 and 3 quarters. So there is always something to do in the market. So I think to put it very simply, we went counter-cyclical to every temporary narrative which was seeming to be challenging and bought and doubled down on those sectors actually.
And IT actually, I was just looking at returns for the week. I mean, lots of stocks are up 10, 12, 13%. But for the year, of course, they're still in pain. So pharma, IT and pockets and capital goods.
Yeah.
Essentially. One phenomenon I've noticed, I don't know if you guys have noticed, and I spoke with the Nomura team. It's a very stark difference. All the economist folks are all very bearish. But as they say, economists were, that's their job. But the market folk are also not, actually, the difference is not so much markets and economists. The global guys actually are all very, very circumspect about what's going to happen about growth and hits to growth. Whereas locally, when we speak to and interact with fund managers, it's slightly more bullishness. Do you sense that at all? At least that's what I feel when I read and speak with, and we do on to global.
I guess we both are doing our jobs. The global guys are worried about global macro. I can understand that, but I think there is, there is also a feeling that perhaps India will come out tops in this whole geopolitical trade tariff environment, because our problem is not as big as what the US has with China. And usually we end up with a collateral damage. This time we might end up with a collateral advantage, right? So I guess that is also a little bit of that underlying stuff, that the principal trade adversary is not India actually, it's actually China. And does that open up some opportunities for Indian sectors and Indian companies to even more deeply get aligned in global supply chains? It could be quite interesting, right?
Like the word, collateral advantage for India. But let's talk about IT, because that was a sector which looked challenged till last week, but has rebounded very smartly. Up more than 7% for the Nifty IT index this week. But bear in mind, till last week, the index was down 25%, sharply underperforming. And plus, there were lots of shots in the system which got corrected. And then the FIs came back in the market, and FIs historically have favored IT stocks along with banks. So that could have also added to the buying. But you know, the point that Hiren was making, that there are outlier stocks, and the outlier stocks, so far at least, were always the persistent Coforge's emphasis. And once again, the numbers so far that we've seen seem to be that back the winners, back the stocks which are showing growth, because there is momentum there. So from the Midcap earnings pack, you had Persistent and Emphasis both came out with their numbers. Persistent was a big beat, 4.5% top line growth. Emphasis met street expectations, but 2.9% growth. The others, whether it's an LTIMindtree, LTTS, Cyan, Tata Elxsi, all disappointed market expectations. Coforge, though, is yet to report numbers, 5th of May, and that stock is up nearly 40% in the last 1 year. Large cap IT also came in for a lot of buying. So whether it's Infi, TCS up nearly 5%, HCL Tech soared 10% this week. And the key reason appears to be the free cash flow yield has now turned attractive after the decline in share prices. And for FY27, the free cash flow yield for these large cap companies will come up. It's close to about 5%, and nearly 6% for a company like Wipro. So that could have aided the buy. That said, the outlook still remains uncertain. And I'm just going to quickly wrap up with the guidance shared by the companies, which gives you an indication that FY26 is going to be a tough year. Growth is still, missing. Infi is guiding for 0 to 3%, HCL Tech 2 to 5%. Wipro's Q1 guidance, not full year, Q1 guidance was -3.5% to -1.5%. LTTS is guiding for double-digit growth, but that includes the acquisition. If you strip that out, again, we're talking about a low single-digit kind of a top-line growth. And Cyient has abstained from giving a revenue guidance, citing uncertainty. And they've also pushed forward their margin aspiration. They've lowered it and pushed forward the date by which they will achieve it. So Hiren, you spoke about the outlier stocks, right? Will you continue to back them? Because so far the outlier stocks were what? Your Emphasis, Persistent and Coforge more than the others.
Actually, it's quite interesting because it's precisely during times like this that you really get to know who's executing in a tough environment. And therefore, when times get better is when those stocks actually deliver far better returns, right? So the men and the boys, when the sector is growing, everybody is growing. Somebody is growing more, somebody is growing less. But when the sector is on the back foot, and then you have a few outlier companies that can grow, that tells you that, there are some outstanding management teams who are continuing to execute, because the environment is the same for everybody, right? Yeah. And I think that, this is a sector, as you rightly mentioned, even if there is no growth, at least in the large caps, people have the safety of quality and cash flows and buybacks and, payouts and stuff like that. But if you're a growth investor, then I think you have to look for those outliers.
And you want to talk about anything you like there?
I wouldn't take names, but we do have a couple of outliers who...
One outlier management we often discuss internally is Coforge.
Coforge, yeah.
And we've always, whenever we have him on Bazaar and...
you try to poke him a little bit more, he says, no, I'm as confident. I'm even more confident than that. So
outstanding confidence in terms of just, the ability to execute.
Exactly.
So, as Rima said, the numbers are on fifth of May.
Persistent is the other one, which has been delivering quarter after quarter of very, very strong growth. And it's been rewarding to all the shareholders.
Towards the end of the week, Hiren, we had numbers come in from Maruti, and there were a couple of one-offs out there. But you all have chose the auto sector as a theme that you all would play by a very niche play. So you all are focusing on the premiumization theme out there. How much of it do you think is already in the price, or do you think it has a longer runway from here on?
I think in autos, on the two-wheeler side, we have exposure to Eicher.
Yeah.
On the four-wheeler side, in some of our small cap funds, we have an exposure to a company called Force Motors.
Force Motors, yeah, that's what I was referring to, yeah.
Yeah. It's an early bet. We believe that it's a company which has got great products. It's also a great way to indirectly play the premiumization theme. because they manufacture engines for BMW and Mercedes. And if you look at the history of any automotive OEM which has delivered returns or value over a long period of time, it's all about products, products, products. You need a killer product, right? I mean, Hero Honda was made on the CD100.
Yeah.
Bajaj was made on the basis of Pulsar. You know, all great companies have great products. We think Urbania is a great product that Force has. And it's relatively, you know, out of the radar, not too many people talk about it. And again, you know, I want to give full disclosure that we and our clients own it in our portfolios. So, you know, this is not a recommendation. But we think that there could be an opportunity there.
With the full disclosure, you want to at least tell us the IT stocks that you own, since we spoke about it? With the disclosure, no recommendation.
We do own KPIT.
KPIT. Well, that's been a big outperformer, but it's just, I think the auto ER&D slowdown has slowed down the growth rates, but it's still, you know, growing pretty.
Rima, you know, IT stocks hit out of the park. You know who else hit out of the park this week?
Me? Why?
Yeah. Street Chatter.
Street Chatter.
So
Sami, 361.
361, and I think there are a couple of more coming. So we'll take a quick commercial break here, and you know, we'll discuss some of those deals which have been announced and what else is on the anvil. Stay with us. Okay, welcome back. You're still with us here on Editors Roundtable, and we're in conversation with Hiren Ved, just sort of wrapping up the week and, of course, what lies ahead. And, you know, as I said, Nimish, you had a couple of wins this week.
Smashing it out of the park. Let's
Sami
see.
and 361.
Yeah, so some deals went right. Sami went off very well. And it's a good deal, actually. You know, GIC putting in money. At least there will be an institutional holder now. So that worked very well. Which was the other one? I forgot.
361, UBS.
Correct. So again, 361. Let's ask Hiren. What's your view on the whole, you know, wealth management space? We saw the first big delivery in MNC came in and bought into 361. Nuvama is another good play.
I think it's a great space. It's a growing space. And incidentally, I think what's interesting about this space is that you know, the real strong guys are actually Indian companies, right? Because there was a time when you had the Stanseys and the Cities and the, you know, the Barclays of the world, you know, who've been kind of post the global financial crisis in India have been on and off.
It's like the broking sector, right? I mean, the foreign guys are all sometimes here, sometimes not here.
Correct.
It's the Indian guys who've kind
and it's now really the Indian brands, the, you know, the Nuvamas, the Kotaks, the IIFLs, the Motilals of the world, who have built these franchises, and rightly so. And as our Bhaiya used to say, ladki sundar hai to aayenge, to ab gore aa rahe hain sab stake lene Indian wealth management companies mein. So I think it's a great sector. You know, I think there is a lot of wealth created. I mean, you know, post-COVID, we've seen an explosion in market cap. Entrepreneurs are selling their businesses, they are monetizing, they have wads of cash which they don't know what to do with, and that's where the wealth managers come into
And
play.
that's exactly what the UBS team told me, that now if they are not in India, even though they are the #1 in Asia, the India pie, if they miss out, the ranking changes very fast because of the size and the sheer amount of deals that India is doing right now.
But also, Nimish, if you see the data, right, in the last 5 or 10 years, and I don't remember, but the fastest growing billionaires have been in India.
Correct.
So this is the growth market for wealth. Right.
Absolutely.
So they have to come.
So what about the other capital market plays? Anything that you have an exposure to?
We have exposure to both the exchanges, which are listed.
Okay.
We have exposure to wealth managers.
Okay.
And in fact, within financials, we have a larger exposure to capital market plays than the typical lenders or the banks.
Okay. But do you think now it's time to shift from this to the lender? Just purely from a tailwind point of view. We put out a piece, Hiren, suggesting that, normally we've learned this in the companies as well. A change of guard leads to re-rating. Just with the new RBI governor at the helm, the Nifty bank is up 15% from the Jan lows.
Correct.
And it's done a lot of corrective measures, right?
Yeah, so I mean, it's for us, it's not either or. Okay. It could be both, right? So we do have lenders exposure. And I agree with you that the macro for the banks and the NBFCs have substantially changed.
Okay.
And I think RBI has, the new RBI governor has made a big difference in terms of easing regulation.
Easing liquidity.
Easing liquidity massively, right? Which should aid in growth. And the balance sheet tightness that we were seeing, I think that's something of the past. So you will see the sector perform much better this year.
Hiren, in pharma and capital goods, again, with full disclosure, what do you own? I mean, just to give a sense.
Pharma, it's largely CDMO. So, we have, our largest exposure is to Divi's, which is the boss of the sector.
It's done well?
It's done phenomenally well.
What about this GLP-1 kind of? I mean, Divi's is a play in a way.
Yeah, I mean, it's a large growth opportunity. I don't think we are playing it just because of GLP-1. GLP-1 is one big opportunity that is in front of these companies, and I think in general CDMO as a sector has a long runway for growth in India. I think India's competitive advantage is very, very solid.
Yeah. And what about capital goods? I mean, what's the...
So there largely our exposure is to power transmission area, right, where we think there is a lot of runway for growth because, with renewables, with data centers, with power required, you have to build the grids. And incidentally, India is also globally competitive. So a lot of the Indian electrical power goods companies are also exporters. And, we've already seen 2 wars being played out globally. At some point in time, those wars will stop and rebuilding of, their infrastructure and electric power lines and all of that has to happen. And that will only feed into bigger export demand going forward from here. So these are some areas that, we continue to like.
Okay, out of time. Hiren, thank you very much for joining in. Enjoy your weekend, folks. We're going to call time on this edition of Editors Roundtable. Thank you very much for watching.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Indian and Pakistani forces exchange fire briefly at the line of control as tensions rise after the Pelgam terror attack. Indian Army sources say Pakistan initiated the firing. Army Chief General Upendra Dwivedi is in Srinagar as the United Nations calls for maximum restraint. Sensex and Nifty gained 1% this week despite a sell-off on Thursday and Friday. Nifty manages to hold above 24,000. Midcap index up 2% this week. Maruti Suzuki misses estimates in Q4, profits down over 4%. Revenue growth is below expectations. Margins contract by 180 basis points annually. China denies any trade negotiation with the US once again. This after President Trump claims officials from both nations have been meeting each other. China tells US to abolish the tariffs if it wants a resolution to the tussle. Apple is seeking to import most of the iPhones it sells in the United States from India by the end of 2026. Sources say the company is aiming to accelerate the shift beyond China to mitigate the tariffs. Google's parent company Alphabet reports quarterly revenue of $90 billion and profit of $30 billion, beating street estimates. Chip maker Intel reports a quarterly loss and cuts growth outlook along with a warning on potential layoffs. Indian electric vehicle makers face a challenge as China restricts the supply of rare earth magnets which are critical for production. Beijing is now demanding end-user certificates signed by officials from India and China before authorizing imports. A day after Bharti, Airtel sought conversion of spectrum dues to equity, government sources say such a conversion is not automatic. The telecom department is open to considering the request, but it's subject to evaluations. President Draupadi Murmu will be attending the state funeral of Pope Francis tomorrow. World leaders, including US President Trump and heads of state from Europe, will be in attendance. The top story today, India and Pakistan's relationship has hit a new rock bottom. Days after the terrorist attack tourists at Jammu and Kashmir's Pelgam, killing 26 people and leaving 17 injured. The police claims that 2 of the 3 suspects are Pakistani citizens. Islamabad, on its part, has denied any link. Indian and Pakistani forces exchanged fire briefly at the line of control last night. Indian Army sources said that Pakistan violated ceasefire near Nogam village of Jammu and Kashmir. Army Chief General Upendra Dwivedi is in J&K to review the security situation. He held meetings with LG Manoj Sinha and top army officials. The Army Chief has directed all officials in Jammu and Kashmir to remain on high alert. The United Nations has urged India and Pakistan to practice maximum restraint. A spokesperson for the agency said that issues between the nations should be resolved through meaningful mutual engagement. India has already unleashed a set of measures against Islamabad. All visas to Pakistani nationals have been cancelled. The Atari border, the only permitted trade route with Pakistan, has been sealed. The Indus Waters Treaty has been suspended as well. India has formally notified Islamabad about its action. A letter from the Union Water Resource Ministry said that sustained cross-border terrorism by Pakistan targeting Jammu and Kashmir impedes India's rights under the treaty. Pakistan too has retaliated with a set of measures, including closing its airspace to Indian airline companies. The Pakistan government also summoned the Indian envoy in Islamabad. Arunima reports from Pelgam on the security situation in J&K.
The constant whirring of the chopper is the only reminder of the kind of bloodbath that this place, the meadow of Baisaran, has seen just 4 days ago. And suddenly all that is remaining of this picturesque trek is raw beauty, air surveillance, penetrating radars looking at these pine forests to see if the terrorists are still hiding somewhere, a combing operation. People from CRPF are soldiers from Rashtriya Rifles, Jammu and Kashmir Police, CRPF, constantly scouting these pine forests, not just in these high altitude areas of Pelgam, but also on the other side, in the Jammu division, in Doda, in Kishtawar, in Kathua. They're keeping an eye at the foothills of Anantnag. Next door, Shopian, at least 2 local terrorists have been identified. Their antecedents have been checked. Their residences in Tral and Bijbehara have been blown off in an explosion. So in terms of security, this entire area is now a very, very high security zone. Like I said, just a few days ago, this was a picturesque picnic location. But little did these tourists know that what they were thinking to be a memorable holiday will soon turn into a nightmare.
Ministers Amit Shah and Rajnath Singh briefed lawmakers on Pelgam at an all-party meeting yesterday. Opposition parties condemned the attack and gave the government full support to take any action that is likely to take. Apart from Shah and Rajnath Singh, top NDA ministers and senior opposition lawmakers, including Rahul Gandhi, Mallikarjun Kharge, Sudeep Bandyopadhyay and Supriya Sule, were present at the meeting.
कश्मीर में शांति रखने के लिए वो अच्छा प्रयास करें और वहाँ पर शांति रखना जरूरी है, ये बात उनके सामने हमने रखा और उन्होंने ये कहा कि सभी एक्शन ले लें.
The spirit was good. Security lapses were discussed, but assured the government that all political parties will stand by the government, whatever decisions they can take for the interest of the country.
हम सब की एक ही मांग है, पूरे देश की एक ही मांग है, आतंकवादियों को बर्बाद किया जाए, उनको उसी भाषा में जवाब दिया जाए जैसी दरिंदगी और हैवानियत उन्होंने दिखाई है. मासूम और निहत्थे लोगों की जान उन्होंने ली है.
Congress MP Rahul Gandhi visited the victims of the Pelgam attack at the Army Hospital in Srinagar today. He had cut short his US visit to return to India after the terror attack. The leader of opposition in Lok Sabha promised healing and solidarity. He's also scheduled to meet various delegations in Kashmir, including the trade and tourism sectors.
We had a meeting yesterday with the government, and the united opposition condemned this action and said that we are there to support whatever action the government wants to take. The idea behind what has happened is to divide society, is to make brother fight brother. And it is very important that every single Indian stands united, stands together, so that we can defeat what the terrorists were trying to do.
The houses of two suspected terrorists involved in the Pelgam attack was demolished in Jammu and Kashmir. The homes of Asif Sheikh in Pulwama district and Adil Thokar in Anantnag were razed to the ground, apparently using explosives, according to several media outlets in Srinagar. The police have not issued any statement yet on the demolitions. Muslims in Hyderabad and other parts of India wore black armbands to Friday press to protest the attacks on tourists in Pelgam. Lok Sabha MP Asaduddin Owaisi had issued a call yesterday to all Muslims to wear black armbands as a mark of protest. All right, moving on to the stock market action now. Sensex and Nifty gained 1% this week despite a sell-off on Thursday and Friday. Nifty managed to hold on to the 24,000 mark after a 200-point decline. Sensex lost nearly 600 points. The Midcap saw sharper cuts today, but the index ended with gains of 2% for the week. Prashant Nair is here with the market wrap.
Well, Friday was nothing to write home about. We finally saw some profit booking. And actually, there were hints of that Thursday as well. I mean, on Thursday, if you remember, the Nifty was up 150 points, and then we ended with 15-point gains. And today, of course, I mean, we started lower, and then we kind of sort of, in the first hour, we were down. And we kind of sold off more, recovered a little bit, but it was down by 330. But for the week, it was the third week of gains, if you look at the full week. So the Nifty this week was up 0.8%, the Bank Nifty was up 0.7%, Midcap Index 1.7%, and the Smallcap Index was up about 0.8%. Remember, Friday took a bite out of these gains. As of Thursday's close, I mean, these numbers would have been much better. And by the way, in these 3 weeks that we've seen, the low was about 21,740 or something on the Nifty. We are up as of this Friday 10.5%. So it's not small, and many stocks, well-owned stocks, as part of this, for example, the BSE 200 universe are up easy 20-25%, some more. As I said, Friday, of course, weekly gains aside, Friday was a down day. Nifty, Bank Nifty, Midcap, Smallcap indices, everything. I'll go back to the broader sort of gains that we had, and I looked at the BSE 500, NSE 500 universe for this, Friday to Friday, actually, what gains did we see? So the big gains actually surprisingly came from the IT sector. Now remember, the IT space has been completely bashed up. And it was not as if numbers which we got this week were anything great to write home about, but it was just sort of, a lot of selling had already happened. And there were some bounces which we saw. Tata Elxsi 14% this week, Coforge up 12, Tech Mahindra 12, Emphasis was up about 12% as well. There were some other names, AU Small Finance Bank 15% pop, Vari was up 15, Newgen was up 13, Apar Industries and Atul were up 13% respectively. Some losses coming through in names like Blue Star, 14% cut this week. There was Syngene, which was down 14, RK Forging and PCBL. Actually, just 4 names with losses in excess of 10% this week. All told, a pretty good week. I mean, I think as we go into the weekend, trade headlines, Trump comments, etc. remain top of mind. But there is, of course, an added element which we will need to keep an eye out on, which, of course, is, the repercussions and how India will react to in response to the absolutely, terrible attacks which took place in Kashmir. If and when we will see that, I think markets are waiting and watching that very closely as well. Back to you.
Right, thank you, Prashant, for that. Moving on, shares of Maruti declined in trade after reporting a weak set of numbers in the fourth quarter, missing street estimates across most parameters. Net profits slipped over 4% and margins contracted by 180 basis points on an annual basis. Sudarshan Kumar joins us with the earnings snapshot. Sudarshan.
So it's a mixed set of earnings from Maruti as far as profit and revenue are concerned. Those numbers have come slightly below estimates, but margin has come at 10.5% against our expectation of 12%. And company has given reasons, and because of expenses have increased, and 3 parts of expenses, if I can talk. First one is material cost. It has risen both sequentially and year-on-year. It was up 6% sequentially, 1% year-on-year. Employee expenses were up 15% year-on-year and 2% sequentially, and other expenses have increased 14% year-on-year and 13% sequentially. So if you accumulate all these have impacted margin by 230 basis points. Now, material cost impact on margin was by 90 basis points, employee cost impacted by 30 basis points, and other expenses impact were of 110 basis points. So what all company has included in other expenses? It has mentioned first, new plant-related expenses, second, higher sales promotion or ad expenses, and third, higher manufacturing overhead expenses. So these have come in other expenses, and that has impacted margin by 110 basis points. But what was the positive in the earnings was the realization. It has improved both sequentially and year-on-year because of the price hike that company has taken, not only in Q4 but even in Q1 FY26 also it had announced price hike. But just if we talk about Q4, they had taken price hike twice, and that had impacted positively to realization, which has improved 7% year-on-year and 3% sequentially. Now in the commentary, what exactly we'll be looking for? First, what company says on outlook, demand outlook, because recently they had attended one conference in which all the companies, including Hyundai, M&M and Maruti, were saying that in FY26 also PV demand growth is likely to be in low single digit. So we'll have to see if there is any update on that and what exactly company says on commodity outlook going forward.
All right, thank you, Sudarshan, for that. China has once again denied having trade negotiations with the United States. This statement comes after President Donald Trump indicated that officials from both nations have been meeting each other. The Chinese government has told the US that if the Trump administration wants to have trade negotiations, they will have to remove the tariffs. Remember, Trump had softened his stance on imposing massive duties on Chinese imports last week. He said, and I quote, "Tariffs will come down substantially, but it won't be zero." End quotes.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later, but they had meetings this morning, and we've been meeting with China.
Tech giant Apple is considering India as one of its manufacturing hubs for all iPhones for the US market. Sources have told CNBC-TV18 that the production shift could be done as early as 2026. However, this decision could be subject to India's ability to scale up production rapidly and the US and China trade relations. Parikshit Luthra is standing by with the details. Parikshit, what will this mean for India?
Apple is considering making India a hub to manufacture all Apple phones for the US market by next year. This is because of US-China trade tensions and the high tariffs on China imposed by the Trump administration. But Apple's decision will also depend on adequate capacity ramp-up in India and the trajectory of the US-China trade talks. The company is considering increasing production to 40 million phones in India in 2025. Production last year was around 26 million phones. Apple contract manufacturers in India are ramping up capacity in existing facilities. Foxconn's Bengaluru plant is likely to be operational within this month and will have a capacity to manufacture 20 million phones at peak capacity. So while there is an intent to make all Apple phones in India, a lot will depend on whether US and China can reach a deal. Apple did not reply to CNBC-TV18 queries.
Parikshit, please stay on with us. Let's also talk about China's restrictions on supply of rare earth magnets that have worried Indian EV makers. The magnets are a critical component used in the production of electric cars and two-wheelers. What can you tell us on that front?
Indian EV and component makers are facing production challenges as China restricts supply of rare earth magnets, say sources. Automobile and component makers have approached the Indian government for help. CNBC-TV18 has learned that China has restricted supply of rare earth magnets to India from the 4th of April onwards. The magnets will be supplied only to those companies which submit end-user certificates in a prescribed format. The Chinese government is demanding end-user certificates releasing any exports of rare earth magnets and also are demanding that they be duly authorized. China says importers must get end-user certificates signed by both the Indian Foreign Ministry and Chinese Embassy, and importers must confirm that the rare earth magnets will not be used for making weapons or given to any third party. Clearly, the Indian auto industry will be impacted. Rare earth magnets are a critical part of traction motors and other components of electric vehicles and automobiles. For the moment, there is inventory, but if these restrictions continue, then there could be production challenges in the coming few months.
Right, thank you, Parikshit, for that. The United States may relax curbs restricting the number of graphics processing units that India can import from the country. Sources tell CNBC-TV18 that talks are underway between the two nations to ease the cap of 50,000 GPUs imposed during President Joe Biden's tenure. This could help India's AI mission, under which the government is looking to raise GPU availability to over 33,000. 31% of Indians have used generative AI tools. This, according to a study by Google in collaboration with Kantar India, which reveals that 60% of Indians are unaware of the technology. The study also found that 84% of respondents who have used generative AI use it for assistance with homeworks and daily chores. Speaking with CNBC-TV18, Google DeepMind Senior Director Manish Gupta said that the tech major is focused on streamlining its AI offerings into a more user-friendly experience.
Amazing country with so much of potential. And I think when it comes to really developing deep tech capability, we are already beginning to see glimpses of, again, tremendous advances, the Indian developers playing a very key role in developing all of these solutions based on AI for the entire world. In terms of innovation, I think there's potential, right, for us to take it to a far higher level. And it's, again, very heartening to see the government in terms of making real investments in encouraging the startup ecosystem, supporting deep tech startups in India. I think likewise we need to see industry investing more in research.
All right, it's time for a short break. Coming up next, a day after Bharti Airtel sought conversion of spectrum dues to equity, government sources say such a conversion is not automatic. That and more when we return. Welcome back. You're watching Business 360. A day after Bharti Airtel sought conversion of spectrum dues to equity, government sources said such a conversion is not automatic. Ashmit Kumar joins us now. Ashmit, tell us more about the government's stance on the matter.
Well, important clarification coming in. We spoke to various government officials. What they're telling us in very clear terms is that as far as the application process is concerned for this equity conversion, this conversion will not happen under an automatic route. So just because a company has made an application does not mean that automatically that spectrum due or that AGR dues gets converted to government equity. What the government officials are telling us is that there is a process, that there is a certain amount of discretion that the government will exercise in terms of converting these spectrum dues to equity. In fact, there will be application of mine and a decision will be made on a case-to-case basis is what various government officials are telling us. So essentially clarifying, it's not an automatic transition that takes place. What government officials also tell us is that companies, of course, are free to apply under this scheme, under the 2021 cabinet scheme, and that the government will take, the government is not bound to make that transition, but that the government will take an informed decision and will exercise discretion on this conversion. Another key clarification that has come in from government officials is that both AGR dues as well as spectrum dues will be eligible for conversion under this equity conversion scheme. And that, of course, is where we need to bring in the context. So far, the only equity conversion that we've seen so far is in the case of Vodafone Idea. What government officials have previously told us is that now the fresh applicant is Bharti Airtel. Bharti Airtel is also seeking parity with Vodafone Idea, is seeking similar treatment with Vodafone Idea, and therefore is seeking this conversion. And just to set the context, in 2021 is when this cabinet relief had been allowed, had been granted the nod, and under this 2021 scheme, at least as per the language that was used back in 2021, it was eligible. Only spectrum dues that were for spectrum that was bought before 2021 is something that was eligible for this equity conversion. So clarifications coming in from highly placed officials within the DOT. Back to you.
Thank you, Ashmit, for that. In international earnings now, Google parent Alphabet reported a strong set of numbers in the first quarter, surpassing street estimates on most parameters. Revenue surpassed the 90 billion mark, jumping 12% on an annual basis. The company's search and advertising units also showed growth despite competition in the AI space. Overall, advertising brought in over $67 billion, growing 8.5% from the year before. Net income increased by 46%. Intel's first quarter performance surpassed analysts' expectations as well. However, the chip maker's guidance for the current quarter disappointed the markets. Intel said it will break even with revenue of $11.8 billion. It added that its second quarter guidance reflected elevated uncertainty driven by the macro environment. The company said that it plans to slash operational and capital expenses in 2025. These include an unspecified number of layoffs announced by the CEO today. US President Donald Trump has said that Russia has made a big concession to end war in Ukraine by not taking the whole country. Speaking to reporters at the White House, he said he believes both Russia and Ukraine want peace. He added that he has his own deadline for ending the war, but maintained that Washington's attitude could change if an agreement fails to materialize by then.
We're putting a lot of pressure on Russia. And Russia knows that, and some people that are close to it know, or he wouldn't be talking right now. The Prime Minister understands that better than anybody. He wouldn't be talking right now. He's talking, and we're putting a lot of pressure. I think he wants to make a deal. We're going to find out very soon, but it takes two to tango. And you have to have Ukraine want to make a deal too, and they're being hit very hard. And I do believe they want to make a deal. Stopping the war, taking the whole country. Pretty big concession.
A senior Russian military officer was reportedly killed when a car bomb exploded as he walked past in a city near Moscow. Authorities have said that the improvised explosive device was packed with shrapnel and a gas cylinder inside the vehicle fueled the blast. The car was outside a residential unit. Israeli forces have killed more than 60 people in Gaza in the last 24 hours. The Palestinian Civil Defense Branch has said that 12 people from the same family in North Gaza were among those killed in the early morning airstrikes. The Hamas-run Gaza Health Ministry has reported that nearly 2,000 people have been killed since Israel pulled out of its ceasefire agreement with Hamas on the 18th of March. President Draupadi Murmu has left for Vatican City to attend Pope Francis's state funeral. She is accompanied by Minority Affairs Minister Kiren Rijiju, his deputy George Kurian, and Goa's Deputy Speaker Joshua Peter. D'Souza are also part of the delegation. US President Donald Trump and Ukraine's Zelensky are among the prominent dignitaries who will attend the pontiff's funeral tomorrow. The government has notified rules and procedures for filing appeals at the GST appellate tribunals. Timsi Jaipuria joins us now with the details. Timsi, take us through the government's guidelines.
In a major move to streamline tax litigation, the government has notified the operational framework for the long-awaited GST appellate tribunals. Effective from 24th of April, the new rules mandate digital-only filing of appeals and applications, paving way for a new era of electronic governance in tax adjudication. Under the framework, all appeals, applications and supporting documents must be through the official GST-80 portal. The system will also handle electronic service of notices, case tracking and order issuance. The digital transition is expected to significantly reduce manual errors, delays and the burden of physical paperwork. What is also seen with this notification is a major relief in GST dispute resolution mechanism. The notified rules are structured in 15 chapters, detailing the procedures from admission of appeals to conduct of hearings, electronic filing and disposal of cases in a time-bound manner. Rules provide for e-filing and hybrid hearings, which is likely to bring in uniformity, reduce litigation timelines and ensure faster resolution. With this, industry can now start filing appeals from today itself. Urgent matters will be given priority and tribunals, if needed, can impose costs for defaults or litigation expenses, including penalties for misuse of the process. To be seen now is how actually the functioning of tribunals across the country is able to be a key change maker to reduce GST litigation.
Right, thank you, Timsi, for that. With that, it's a wrap of this edition of Business 360 News and Updates. Continue right here on CNBC-TV18. Hello and welcome to this very special episode of IPO KYC. Ather Energy is India's second pure-play EV maker and it's getting all set to list on Dalal Street. Founded in 2013, Ather Energy was a college project of two IIT Madras graduates, Tarun Mehta and Swapnil Jain. And today, it's valued at nearly $1.5 billion. It's also been a while since we've done an IPO KYC, and this IPO will test the investor appetite. One, after the market turbulence on account of Trump tariffs, and two, even the EV ecosystem
given the mess at Blue Smart or the troubles at Ola Electric. So let me waste no time and welcome our very special guests on this episode of IPO KYC. I have Tarun Mehta, co-founder and CEO, and Swapnil Jain, CTO and co-founder. Thank you very, very much for joining in.
Our pleasure.
So let me start with the question everyone wants to know, right? Path to profitability. You've been loss-making for the last, I think, since inception now. When do you think you will turn profitable?
See, so any new business, especially R&D and a deep tech business like ours, where there's a lot of investment in product development, in IP, in platforms, obviously it's going to be investment heavy in the early years, and then the losses are recouped and profits come. We are no different. After 10, 11 years of investment, our recent trajectory has been very solid. Any profitability is a function of two things, which is your unit economics and then the volumes you put behind it. So how are you doing on both? Unit economics, you will notice in our recent quarters, there's been an enormous improvement. We have almost doubled our gross margins over the last 3 quarters, over 3 quarters of FY25, hitting almost 18-19% kind of gross margins, adjusted gross margins. So significant progress there. And if you see our volumes, again, YTD till Q3, there has been an almost 35-40, I think almost 40% plus kind of growth. So volumes have also grown quite healthily. So put these things, two things together, I feel pretty bullish about where we're headed as a business on profitability. Also, if you see our overall losses, they've started to trend in the right direction. If you see again 3 quarters performance, losses have been reducing, not just at percentage, but even at an absolute level. So I think the basics of a business, the more you sell, the more margin it brings home, it covers your fixed costs, and you become profitable. I think the engine starts to make sense in where we are, and I'm very optimistic about where it's headed.
So peak EBITDA losses behind the company, and from here on, losses should continue to moderate, as we've seen?
I think if volumes are continue to grow as we hope for them to be, for the industry and certainly ourselves, and we continue to defend our margins. Remember also Ather's positioned its products in a more premium position. That's allowed us to command generally a more premium pricing. I think that our ability to sell software separately as Ather stack, these are things that give me a lot of confidence on continued margin growth. And volumes, nobody's challenging where EV industry is headed overall. It is a growing industry. So I think, yes, I definitely feel that we continue to move towards profitability.
So you spoke about unit economics, which is basically gross margins. And gross margins in the first 9 months of FY25 are 19% versus 9 months in the comparable period of last year.
Okay.
These margins are sustainable and should improve. Gross margins, right?
Yeah.
That's the trajectory.
These are not one-time spikes. They've come about as, honestly, and I'll give a lot of credit to our product development teams. They've come about because of fundamental and hence sustainable reductions to our cost structures of the core vehicle platforms across chassis, electronics, battery, across the board. There's been a lot of work on the supply chain front, which has fundamentally reduced cost structures. With introduction of multiple vendors, with a lot of work on value engineering, a lot of work on straight pass ratios. So this is not a one-time, and the proof of that is this is not a 1 quarter or 1 month performance. This is now been consistent over 9 months. So hopefully that gives us a lot of confidence.
So for you to turn profitable, at least at the EBITDA level, what should the gross margins be? Should they hit 25%? Do they need to hit 30%? Is there an aspiration that you want in terms of a business model?
See, I think difficult for me to comment on ourselves per se, but I can point to a few references in the industry. I think Indian two-wheeler businesses have been incredibly strong, and we have a lot of respect for them. And I think those become our guiding compasses on margins. Mass premium players have in the past been able to get to late 20s, even early 30s kind of gross margin structures. And I think those kind of gross margins in the two-wheeler business seem to generally ensure strong profitability. So I think for any business that's trying to build a mass premium kind of play, an ultra premium strategy like some of our peers, like in the bike side, they can obviously yield much higher gross margins. But a more mass premium play with scooters, I think seems like that kind of number seems to have worked out very well in the past for our peers.
Okay, and there's no reason why EV gross margin should not get to the ICE gross margins, right? There is
different structures of the industry and different structures of the product.
But you can aspire for late 20s gross margins, realistically.
I think there are certain advantages with EV sales. I think electric opens up this entire window of opportunity, an entire opportunity around software, which was not very strong, I think, with ICE architecture. Selling software allows you substantially higher margins, as you will see even in our numbers, and something we are also trying to perfect more and more. And I think this is something very new and novel with electric. Not just in India, actually even globally. Tesla sells its FSD pack at a substantial markup to the vehicle price. We sell our software on top of the vehicle price with a healthy markup. So I think electric, if anything, opens up some new opportunities for additional margin and revenue, which probably was not very strong with ICE. And that's why I'm even more bullish with EV.
Fair enough. That's a point well made. So for you, what percentage of your revenue comes by selling software, and what are the gross margins on software?
So roughly about 6% of our revenue comes by sale of software. And it's a very high gross margin business, given that software architecturally is generally a higher margin business. So that's just the nature of that part of the world.
Very high. We'll go with that. What about FY24? I mean, your revenues dropped by 1.5%. You bounced back very smartly in 9 months with a 28% top line growth. What's the sustainable revenue growth we're looking at?
I think there is a secular growth that's happening, which is the growth of scooters overall. Scooters continue to grow much faster than motorcycles. And given that we are scooters first right now as a business, that part of the growth affects us also. The other part is, however, the expansion that we are doing. So we are expanding our stores. And the recently introduced model, Ather, our convenience scooter, that's landed very well in in convenience first markets. So there are a lot of new stores that we're adding in those parts of the country. So distribution will continue to expand healthily for us, and that's something we're excited about. In addition to that, remember, our industry is at a very early stage in terms of products. A good two-wheeler maker would have 6, 7, 8, possibly even 10 products in their portfolio. Our industry is still at a stage where we have 1 to 2 products each. So we are overall at a very early stage. There's nothing wrong with us. It's just that we are at an early stage. As our portfolio expands, and I'm not just speaking for Ather, I'm speaking for our entire industry. As we go from a single product or a 2-product company like Ather to potentially 6, 8, 10 products, there's natural expansion of the addressable market that is bound to happen. And as that product portfolio expands, it'll make it more and more viable to expand distribution to the hinterlands of the country.
Got it.
Today, EV is still largely an urban phenomenon. As we go from tier 1, tier 2 to now increasingly more tier 3, a very large chunk, perhaps one of the largest chunks of scooters are sold in that part of the urban country. We haven't even entered there yet in a big way. So I think there's a lot of opportunity on both product and distribution expansion. And that what gives me a lot of confidence for our industry's growth in the near term.
So Swapnil, come in, right, in terms of the product expansion. You're early in the EV game, but you've had only 2 products. You've gone slow and steady in terms of launching. When do you get to 6, 8 products from the current 2? And what about a motorcycle? Is that something you're working on?
Right. So, firstly, the aspect of building it over time. The first 4-5 years of the company, we spent a lot of time building the platform itself. Automotive is something where you have to invest in building a robust platform, and then you build products on top of it. And that's what you would see in our product portfolio itself. Then probably until 2020, 2021, we had 2-3 variants of the product in the market. And then over a period of time, we have added more variants. We have added of the 450 itself. Then we got the 450S. Then we got the 450 Apex. And then we have the Arista. So if you see the last 3 years, we have been able to rapidly build up on the same platform and build multiple products. And that's the strategy we are going to continue to adopt. Our next platform, which we are now working on a completely new platform with the same idea, build a robust platform and then build out a lot of
when
products
will that come
on
up?
The
top of it.
yield platform is under development. Obviously, we can't give you specific timelines, but it's something we are quite excited about.
And on the motorcycle, again, motorcycle is at a similar stage that we are building the platform. So when will we bring it out? I think we'll have to find out the right time to bring it out. The large part of the work is to build the platform. And that's what we are, first we are prioritizing that, building a robust platform and keeping it ready, and then find the right time to bring it into the market.
Let's talk about your market share, right? Because that's been a little bit of a concern. It's been around 10-11%. And players like a Bajaj Auto, TVS Motors, they came after you, and now they're much stronger than you in terms of market share. Why weren't you aggressive enough? You ceded market share to them.
Our first product was a performance scooter, Ather 450, and I think that's done incredibly well for where it is positioned. It's a limited addressable market, 19-20% of the scooter market. But I think within that space, 450 has done incredibly well, especially in the southern markets. Our new scooter, Rizta, that's the one that's actually changed our trajectory quite meaningfully. So you would have access to the Vahan data. So you would know how we have done on market shares post-Rizta launch.
It's about 16%, I think.
Yeah, so and there is the answer, right? The 10-11 that you were citing and the almost 15-16 that you're referring to now. A lot of that growth has come because we now have a new product in the offering. And that product allows us to expand into new geographies. It allows us to go after newer customers and also the larger markets. Particularly if you see, so go market by market. We're not trying to win all India in one shot. And I think good companies will also always focus. We've been always very focused in South, where if anything in recent months, we've been also the largest player, even by volume. Recently, we've also started doing well in some of the Western markets. And I think with Rizta, we'll continue expanding. We are very clear, we will only expand our distribution as it shows viability. We don't want to expand distribution if it is not viable. And more products just make more stores profitable. So with Rizta, that's giving us a lot of confidence. We'll expand there. Our peers in the industry can sometimes expand faster because they've got existing ICE businesses. Which makes this a question of who gets what first, right? Do you get distribution first or do you get product and innovation first? Well, we're learning distribution and we're expanding that.
So what's your market share aspiration?
We strongly believe that India is a premiumization story. You would typically imagine somebody going after a mass premium strategy is going after a small market share. We think otherwise. We think the entire two-wheeler story is premiumizing. Scooters are particularly premiumizing super fast. We've even mentioned that data in our RHP. In fact, the sale of 125cc scooters, which used to be considered premium once upon a time. If I tell you there's a premium category, you typically expect what? It's 5-10% of the industry, right? The sale of 125cc scooters has grown from 20% to 47% in FY24. And I'm sure it would have continued its growth trajectory even now. So we actually believe that the two-wheeler story and the scooter story particularly is the one that of premium products and consumers upgrading up. We want to be a great option for those customers. That's what we're positioning our brand towards. So we obviously have good market share ambitions. Can't put an exact number.
You know, I'm coming back to the market share point, right? I know it's improved from the 9 months that you've quoted in RHP and as per the Vahan data.
Yeah.
But even your peers, the ones I referred to, Bajaj, TVS, even their market share has climbed as per the Vahan data. It's now at 20% plus. Do you have the resources to fight the big boys?
It's very incorrect to see this in terms of a fight. I know there's an easy temptation to see that this is a fight. We're all creating the EV market at such an early stage. Honestly, very few products are even truly competing against each other. At this point, remember, we all have a fairly small portfolio that we are selling out of still a limited distribution compared to our ICE peers. So the real challenge for us, all of us, is to convert more and more of the ICE vehicle buyers to electric vehicle buyers. And which is why you will need a lot of resources to fight if it is the same pie being cut different ways, right? So in that case, you have to go discounting, you have to throw money at it to win market share. I think right now market share is really down to what products you're building and how many more customers' problems can you solve. And that's what happened for us with Rizta. With 450, we could only go after one kind of customer, the performance scooter buyer. The minute we could build a convenience scooter, our market share and our volumes have shown a healthy trajectory. So, and I think that's what will happen. Build more scooters, build motorcycles. As we build all of them, we are fundamentally taking market share away from petrol vehicles. And that's the right way to see this. We've been fairly healthily capitalized by our existing investors. And obviously, I think the IPO is that one big jump.
Which gives you the resources also.
It also gives us good, solid resources to continue investing in growth.
You know, the problem, you spoke about EV penetration, right? The pie is large enough for everyone, but the pie needs to keep growing. Now, EV penetration, despite all the hoopla surrounding it has been increasing at a very slow pace. It was 4.5% in FY23. FY24, it was 5.1%. And now in 9 months, till December of 2024, it was about 5.5%, 5.6%. So it's been expanding despite all the subsidies at a very slow pace. And that's really the elephant in the room for all of you.
Right. I think there is zero doubt in my head that the industry continues to expand. Volumes will continue to grow. I think after our initial product launches, all of us are now starting to also solve for industry barriers. Like, how do we get more consumers? So you're looking again at the overall two-wheeler number, but if you see the scooter data particularly, because most of us are selling electric scooters for the most part, penetration is already up at almost 3x that level, 3.5x that level, because scooters are a different market. I think as we start solving for better range, easier charging, better battery life, and I think a lot of that is starting to happen. If you see Ather itself, we now are, in the recent months, we've been able to introduce an 8-year battery warranty. The truth is, Ather has been only in like, 100, 200 cities until now. India has a 1,000-city market. So we've got to expand our distribution, we've got to expand our products, and most importantly, we've got to start solving for category barriers, which is, I think, starting to happen in a meaningful way last year. The results of it, you will see as consumers discover it. The ultimate answer here also is that marketing in our industry has been a little slim. So that's something we've been very bullish about. In fact, we wrote a large section in our RHP that it's very imperative for EV brands to invest in marketing, not as a way to fight each other, but as a way to drive category awareness higher. Because the fundamental truth of electric is that it is great for consumers. Total cost of ownership is amazing for most scooter buyers. And with things like 8-year battery warranty, a large fast charging network, they are good answers to some fundamental category barriers. But you need to get the word out, which is what we are starting to invest in a bigger and bigger way.
So one problem, as you also articulated, is the way geographically your sales are happening, right? 60% of your sales happen in South. How will this change? Because you have a production facility, you're planning capex in Maharashtra. So how are you looking to change? Are you looking to be more aggressive in other areas? Like West, you've already started.
West and North are big focus areas for us. They are good electric scooter markets, and one we are quite excited about with Rista. Part of the reason we are also setting up Auric is in Aurangabad. A complete facility there is so that as our sales expand in these territories, which is what you're hoping for, we also have a production facility in that geography to service them.
But you are aggressively expanding your distribution and marketing spends.
Yes, we are.
Okay, got it. And capex, currently what is the production capacity and how much will it increase in phases, if you could give a timeline?
So the current wholesale capacity is about 4.5 lakhs, and with the Sambhajinagar Auric facility, we'll be investing about 900 crores. The entire investment will be done by March 27. Like to do it if it happens earlier, and that will bring in about 500,000 capacity more in phase 1. Post that, when we work on the phase 2, that will bring in 500,000 capacity more.
Tarun, how would you gauge the investor sentiment? Because you lowered the amount that you were looking to raise. What we learn is that even the valuation has come down over the last couple of months. One, that there's a lot of market turmoil, but even this whole, Blue Smart scandal, for instance. Ola Electric share price has fallen 65% from its highs. So clearly, investors have sort of burnt their finger, private and public.
I would put it differently. I think investors now are wiser and understand the industry a little better with some more experience. What we have had an opportunity to meet are incredibly smart investors who have a very good thesis of how the category expands. I think there is no doubt in anybody's mind that the EV sector is growing and scooters are going to obviously lead the way here. That's what we believe in. That's what we've seen in investors. You notice that even in the overall size of the IPO, we've only touched the debt repayment schedule, nothing else. None of the growth investment pieces have been retouched at all. And even debt we have largely touched only because recent quarter's performance gives us a lot of confidence on our accruals and our ability to repay the debt instead of paying it right away. So our growth story remains intact. We have zero doubts about it, and I believe investors see that also. Finally, price is, it's a book building process. It's such a long process. Banks work with investors, and the feedback that comes eventually is the one you go. Nobody can time, and I don't think we're definitely here to time the market. I think we're building a great business that, and I'm sure recent data kind of gives you that sense, is on a great trajectory. So you want to make sure that the future growth is a fully
so investors haven't turned a tad bit cautious, right? There's no taking, I mean, credit where it's due. What you've built is remarkable. But, while you can be relatively unscathed, you can't be immune if the investors turn cautious towards the entire EV ecosystem.
I think that plays out in a bit of timing also. So, and I think bankers have advised us well there when to bring the issue out, making sure that the entire investor community is kind of kept abreast and is kind of kept aware about how the business is shaping up.
Just, one final, set of questions, and that's on Hero MotoCorp. Hero MotoCorp is one of your early backers. They invested in 2018? 17. And they hold now how much?
37% before the IPO.
Before the IPO.
Yeah.
Now, they're also, isn't there any conflict of interest in that way? Because they are also one of the largest two-wheeler makers. They have their own EV aspirations.
You kind of answered it. Hero has been one of our oldest backers. Even before Ather actually began production and was, for the most part, an idea. Hero has been a solid investor. It's invested over several private equity rounds that we have raised, along with investors several times. But I think what's been true and what's been clear to both parties is that it has a very different platform, and it needs to be built in a very different way. Our focus on scooters, our focus on premium customers, our focus on the upgrading Indian, I think these are very, very interesting and very different stories, and which is why we're building them out differently.
So no conflict of interest? Because they would know what you're doing as the promoters.
I think that is, I think we're not at a point in our industry where it's individual EV players really competing with each other that's really determining this. I think Hero's presence on the cap table, their continued and solid support over the years has meant a lot for the business, and we're very, very, very happy to have them as
So what's their
partners
involvement then in the company?
So their involvement is largely at a board level, where they've been involved for many years now, almost all the 8 years that they've been. There are a few topics on which we have even collaborated. So like we realized a few years ago that infrastructure, especially charging infrastructure, needs an industry-wide push. But how do you get started? Because every player is so neck deep in operations and just thinking about their own strategy, because they're still early days of the industry. Now that was a topic where us and Hero could get together and take the then Ather standard and actually push this as a more neutral and industry standard together. Actually commonize charging infrastructure, push for things together, push for a common standard in India. So there have been topics like that where we did collaborate, but a lot of the operational topics, companies have stayed independent.
Thank you. Thank you very much, Tarun and Swapnil. Wish you all the very best. Thank you.
Thank you.
Hello and welcome to Global Eye. I'm Parikshit Luthra. Tensions are simmering at the line of control between India and Pakistan after the terror attack in Pelgam left 26 people dead. There was a brief exchange of fire at the border. Sources in the Indian Army say Pakistan violated the ceasefire near Naugam village and opened fire using small arms, and the Indian forces retaliated effectively. The Indian Army Chief, General Upendra Dwivedi, is in Srinagar to take stock of the security situation. Sources say the Army Chief has directed all officials in J&K to remain on high alert. The United Nations called on both India and Pakistan to show maximum restraint. A spokesperson for the agency said that issues between the nations should be resolved through meaningful mutual engagement. Joining us right now is Lieutenant General Satish Dua, who has served extensively across Jammu and Kashmir. He was the Chief of Integrated Defence Staff and the former General Officer commanding of the 15 Corps in Kashmir. For our viewers, General Dua was the Corps Commander in Kashmir who planned and executed the surgical strikes in response to the terror attack at Uri. General Dua, thank you very much for joining us. Let me begin by asking you about the options for India at this stage when it comes to retaliating.
Thank you, Parikshit. Thank you for having me on your show. You know, if you allow me a minute before I come to the options per se, I think what India, our response has to be three-pronged. The options or the response to terrorism is one of them, the first one, the most important, no doubt, but there are also a couple of other things that we need to do. Let me expand on them first before coming here. I think the fact that the terrorists are killing innocent tourists, something they have never done before, something we also, when I've been in Kashmir for so long, we imagined that it won't happen. Whenever anyone asked us, Kashmir mein aana safe hai, we said, yes, of course, they don't attack touristy places. And so they are taking a leaf out of Hamas's book. When they attacked the Nova Music Fest, killing innocent people, they wanted to internationalize the thing. So this is what they wanted to do here. Pakistan's diminishing relevance over the last 5 years because Kashmir is moving towards development, peace, tourism, political process, and progressing in every which way. So they are now, they've changed their tactics. All right. Having done that, they picked out people from one community, picked out the males. Now, what needs to be done, we have to ensure that when the bodies go back home, passions are not aroused. We don't have to get into that communal divide, religious divide. Because if we do, if it happens in other parts of the country, then the terrorists would have achieved their aim. We must deny them that. And the next thing is, the third part is, over the last 5 years, tourism has improved or been enhanced, increased by leaps and bounds in Kashmir. And many people have invested into tourism. People have built houses, extra rooms and homestay. People have taken a loan and bought a car to drive as a taxi. People have started buying ponies for so that sort of a thing is happening. Because 2 crores was a number last season. Overnight, that has been wiped out. So I think the state, when I say state, I mean the center as well as the union territory of J&K must take have an outreach towards these people whose livelihood has suddenly been snatched away. Because I don't see very many tourists going there this season at least. So right. I think these things are also required. But last thing on the, may I continue on the response now?
Yeah, one more question. As you were talking about the intention of the terrorists who attacked, clearly they wanted to create communal disharmony, create tensions and panic in the country, create a communal divide. How long back do you believe they would have actually infiltrated, entered the country? Do you feel that they would have probably set themselves up locally a few months back? Or was this something they started 15 to 20 days back, entered India, they were hiding themselves somewhere in the forest and then carried out the attack?
It is very clear that bulk of them are foreign terrorists. With a couple of local terrorists, with the help of a couple of local terrorists, they've carried out this attack. I may not be able to put a figure to it, I mean, number of days, etc. But they could there wouldn't be bulk of them. We wouldn't be here for much long, at least in this area, because when the terrorists move and operate in an area, even when they don't operate, they don't cause violence. There are rumblings. There are indicators that can be picked up by intelligence agencies. There are sources who will give you up. So they wouldn't want to risk a high-profile mission like this. So to my mind, in this area, they have not sort of set them up, as you put it, for long. They have carried out some recce. Today, anybody else could have carried out a recce for them with cameras, etc. And they have launched themselves at an opportune moment. Such operations are always, as a military man, I tell you, such operations, covert operations, are always cleared at the highest level. And they had the clearance of the highest level there of ISI, and the army is the Pakistan Army Chief, whose rant of a speech we've already heard. Okay. Now, talking of your first, sorry.
Talking about the options now, sir.
Yeah, options. You know, when Uri, the terror strike took place at the Uri army camp, I was the co-commander. We lost 18 soldiers. Losing 18 soldiers is very tough. But the leadership acted bold. Mr. Parikar came there that very day and gave okay for this, what is now known as surgical strikes. In 10 days we launched it. It was a shallow strike. It was a few kilometers inside, across the border on terrorist training camps, because we wanted to hit the terrorists. 2.5 years later, when Pulwama happened, 40 CRPF Jawans were lost. And when that happened, we carried out a precision airstrike deep into the Pakistan territory, again at terrorist camps. This time round, their intention is evil. It is much bigger than Kashmir or J&K. I mean, the intention is to spread this throughout the country, because tourists, they did not belong to army or a particular group or a state or some place. They are pan-India. And the grief is national. So, and the Prime Minister's speech, before that, the Raksha Mantri's speech also said very similar things. But the Prime Minister, when he announced yesterday in Bihar, and the fact that he suddenly switched to English, he was not speaking to the people of Bihar. He was speaking to global audience. And he said, operative two sentences are that we will identify, we will track them, and we will pursue them wherever they go. And who? Not only the terrorists, but also their backers. And who are the backers? The backers are very clearly the ISI, which is a part of the Pakistan Army. So I think it is the Pakistan Army overall, which is the biggest terrorist organization. And I'm sure our response will be very bold, very imaginative. It has already begun. Indus Water Treaty, a diplomatic surgical strike has taken place. Pakistan was always complacent that over 4 wars, or 3.5 if you count Kargil conflict not as a full-blown war, over 3.5 wars we have, and so many terrorist strikes, we have never ever used water as a leverage, as a matter of humanity, because it serves the poor people of Pakistan. It serves the farmers in Punjab and elsewhere. Punjab, that is in Pakistan. We have never done that. But this time, we have put them on notice that no more, enough is enough. We will actually hurt them. You know, this is going to hurt them the most. So that has begun. So, despite, in addition to the slew of diplomatic measures, I'll not go into that. Everyone knows that by now. Economic.
Right.
Already economic has taken place. Already economic has taken place. Because of the water scarcity, their economy will crumble. And so, as far as the military response is concerned, the last sentence I want to say is, you see, diplomatic and economic measures are always decided upon in a CCS meeting, announced, and then applied. Whereas military response will, of necessity, always be executed first and then announced. There is obviously, it cannot be announced in advance.
Right.
Thank you.
And perhaps right now is not the best time, considering Pakistan also has started military drills. They are completely prepared So perhaps this is not the best time. It has to be at a time and place of our choosing, General Dua.
Absolutely. Such things are always a time and place of our choosing. We will decide when to do it, whether it is first to lull them in complacency, whether it is to do with the bet and the other conditions, whether it is to build some opinion, whether it is to sort of do the acquisition of targets, that means decide. So all that is, let me not discuss more. So it has to be, the operative phrase is what you said rightly, it has to be at the time and place of our choosing. And since it is going to be a much bigger than a surgical strike or a Balakot strike, we need to exercise more caution and sort of make sure that it is just not known in public domain. It won't happen, and I'm sure we'll have a better. We've used so many enablers there over the last few years. There are drones, there is artificial intelligence, there is space, or they have so many things have developed, and I'm sure there will be an appropriate response at the right time.
And my final question, sir, before I let you go, I'm running out of time, but briefly, if you can explain to us a question that a lot of people are asking as to how come there were so many tourists there and there was no security. We know that the closest army position is 7 kilometers away from Pelgam. The army will be deployed in any region in a place like this only when they have orders to do so. This area possibly would have been under the control of the police. Where do you think the lapse was, and what is the immediate learning for us from what has happened in this tragedy?
Let me clarify, and let me say, I hope the viewers understand this in the correct perspective, that whole of Kashmir Valley, it is 124 kilometers long and about 38 to 40 kilometers wide. The whole of Kashmir Valley abounds with such tourist attractions. There are valleys, there are rivers, there are meadows, and at some places where it is developed into a gondola ride, a cable car way, and all that. Those are, of course, the sort of concentration points. But people go on treks, people go for angling, for fishing, for for the mountain trout. So there are so many things there. I don't think it is possible to post police. Of course, it can't be army, because army is doing counter-terrorist grades, and so is Rashtriya Rifles. It is not possible to post policemen at every place. And in fact, the bigger part is that there was never any requirement, because like I said earlier in the beginning, we never imagined they're going to attack tourists, because it is going to erode away their popular support, and which is a fact, which has happened. Now everyone in Kashmir has sort of stood up against them, cutting across party lines. All the opposition parties, including the Hurriyat, have condemned this. People have come out in vigil because it has struck their livelihood also. So it was not expected that they'll do it on one hand. On the other hand, it is not really possible to place protection parties everywhere. And but I do concede it's not that nothing can be done or nothing could be done. For instance, we have to work up more intelligence. We should not, the security forces, the police has to keep an ear to the ground. We must not let go of our human intelligence, because a lot of electronic intelligence, ELINT as it is called, is being generated. So sometimes there is a tendency to rely more on that and less on human, but I think there is nothing better than cultivating sources and keeping a keen ear to the ground, so that you keep picking up such things, especially after Pakistan Army Chief Surand. We could have also read the picture better, and things like that would have been done. I'm sure we all are learning our lessons.
All right, General Dua, thank you very much for joining us with that comprehensive perspective on what has happened and the road ahead and the lessons as well. We're taking a short break, but coming up on the other side, India and Pakistan have closed their main borders linking both nations to one another. What are the other diplomatic measures that the two countries have taken? A special discussion on the other side with Manjeet Kriplani and Burzeen Wagmar. Don't go anywhere, that discussion coming up.
He has not had any direct contact, but I can tell he's obviously following the situation very closely and with very great concern. We were very clear in our condemnation of the terror attack that occurred in Jammu and Kashmir on the 22nd, 2 days ago, which killed a large number of civilians. But we very much appeal to both the governments of Pakistan and the government of India to exercise maximum restraint and to ensure that this situation and the developments we've seen do not deteriorate any further. Any issues between Pakistan and India, we believe can be and should be resolved.
Welcome back. The Cabinet Committee on Security, India's highest decision-making body on national security, unleashed its response against Islamabad on several fronts. The Indus Waters Treaty has been suspended. All visas to Pakistani nationals have been cancelled. India has also downgraded its diplomatic ties with Islamabad while reducing its mission strength. Pakistan has been asked to do the same. The Atari border in Punjab, the only permitted route for India-Pakistan trade, has been sealed. Pakistan has said that any attempt to stop or divert flow water belonging to Pakistan as per Indus Waters Treaty will be considered as an act of war. Pakistan also responded with a slew of retaliatory measures. It has revoked all trade-related activities. The country will also close down the Wagah border with immediate effect. All bilateral agreements have been put in abeyance, including the Shimla Peace Agreement signed more than 5 decades ago. Islamabad has also closed its airspace to Indian airline companies. Joining us right now is Berzeen Wagmar from University of London. Also joining us is Manjeet Kriplani, Executive Director at the Gateway House. Berzeen, if I could begin with you, do you feel Pakistan, with the manner in which it has supported these terror groups, has isolated itself around the world? Just look at the optics, the manner in which this attack was carried out. Just as General Dua pointed out a short while back, you have taken a cue from the manner in which the Hamas had attacked Israeli civilians long back, and you attacked civilians, you have killed them at point blank range, so clearly the public opinion is against them.
The historian in me, Parikshat, would like to commence by harking back to Operation Parakram in 2002, when tensions were this high as they are now. Then in 2002, Pakistan was deemed a non-NATO ally and frontline state in the war on terror. Its importance has considerably diminished, not to mention it disgraced itself with Osama being discovered in 2011 in Pakistan. So things have changed and much water has flowed under the bridge. What has not changed is that Pakistan continues to be a rogue state in that it does not care for the consequences and fallout insofar as reputational costs go in the international arena. It has always factored that in and felt it can ride it out. It did so back in 2002 with the Kalujak massacre and prior to that the Parliament attack and the Red Fort attack in 2000, if you remember too, plus the Akshardham Temple attack in September 2002. And every time it does so because of the nuclear umbrella. And pursuant to Operation Parakram, as you know, Indian planners had taken a major departure step. It was a watershed moment in that they had to come to realize that one will have to fight with Pakistan despite the nuclear umbrella. Conventional warfare must be conducted under the shadow of it, which led to the origins of the cold start doctrine propounded by the Indian forces, as you know. So even if Pakistan importance is not there currently and it's reeling under one-to-many crises, it does feel the urge to keep itself in business by running such proxies to keep India on the trot. What has happened is India has called it game, set and match, as you know, and the Indus Waters Treaty is a new step. It's a novel step, but it also builds on the 2016 terrorist attack, pursuant to which data sharing as per the IWT, Indus Waters Treaty, had been considerably curtailed. And the Pakistanis had been complaining since 2016 that only 40% of data sharing has been happening. But I'll stop here for now and then we can come back to it later.
All right. Manjeet Kriplani, thank you so much for joining us as well. Let me ask you about the impact that Pakistan wanted. It wanted to bring back the Kashmir dispute. It calls it a Kashmir dispute, and they wanted to bring it back from their perspective on the international arena. They wanted to instill fear in the minds of Kashmiris that the Pakistani army, Pakistani terrorists still are a force to reckon with in Kashmir. Do you feel that the Indian government, while retaliating militarily, diplomatically, will have to address this at the ground level going forward?
I think definitely they have to address it. But one or two things that we need to do, which we have not done so far, is two things. The Indus Water Treaty, putting it in abeyance, is long overdue. So we need to start doing what we plan to do, which is building all the 10,000 megawatts of hydroelectric projects. Because although people think that Pakistan is the sufferer here, actually India gets only 30% of the water of the Indus from this treaty. Pakistan gets 70%. Secondly, we have not imposed sanctions on Pakistan at all. I mean, this is something, our regulations are woefully out of date. We have a 1967 regulation, which is the Unlawful Public Activities Act, which we're using for dealing with terrorism. We don't have any updated sanctions acts, which is what the US and USS CATSA and the UK and Germany, they all have updated sanctions laws. We need to start using this very aggressively. So once we use the economic tools that we need to develop, then we can start thinking about the military tools. The last thing is, financially, we have to get Pakistan back on this particular incident, means that Pakistan has to get back onto the FATF. Clearly, the resistance force, which has taken responsibility for this attack, is loosely linked to the Lashkar, which means that they've got funding from somewhere. And maybe even if it's local funding, we have to get to the bottom of it. You always have to follow the money. Then you can do whatever you need to do militarily, but you have to strangle them economically.
Right. Manjeet Kripalani, do you also believe, and this is what one of our panelists said yesterday, is that do you have a consistent Pakistan policy? Do you feel it's time that our doctrine on Pakistan gets very, very clear? There are no changes in it, whether it's water sharing, whether it's economic relations, or whether it's use of airspace, nothing changes and it remains as it is?
That's very hard for us to do, Parikshit. It is our neighbor. We're in this strange situation that really very few countries are in, where we have an actual hostile neighbor to our north. One is Pakistan on our west, and the other one is China to our north. Now we've got Bangladesh, a problem with Bangladesh to our right, which I hope will get resolved. But it's very hard for us to have, draw hard lines. This is not the Soviet Union where you can divide an iron curtain. It's just not that era. So we have to use, I feel we have to use all the economic tools first to really strangle Pakistan. And also we need to step up our diplomatic and our public relations on Pakistan. Pakistanis have superb public relations and we have none. So we can think we're a big country, we can manage, but we can't. We have to use these tools to the best of our ability. And, then we'll have a proper doctrine. It shouldn't only be military.
Barzeen, just to get you in at this stage, as Manjeet Kripalani was pointing out, you need a very strong diplomatic and PR machinery to continue exposing Pakistan at every stage. But currently, on the issue of economic sanctions that Manjeet pointed out, do you feel it's important for India to work with countries like US, other P5 nations, to see if sanctions can be imposed on Pakistan? We have very close linkages with the United States. Can we convince, according to you, the United States to impose sanctions on Pakistan? After all, their vice president was in the country when this terror attack was unfolding.
India should capitalize on that. Your interlocutor in Bombay has quite rightly laid out the facts, and that India has a Trump administration in place, the current dispensation, which is particularly favor to India, which has never been seen hitherto in so many decades. Consider just the Tower Rana's arrival in India, which would have been unthinkable otherwise in yesteryears. India should capitalize and build on it. And as the lady mentioned, that also India has never had a robust PR policy. The entire thinking in South Bloc, insofar as Pakistan is concerned, is not to give it the oxygen of attention and PR, and somehow the matter would die a natural death, and that you can just ignore it by the wayside. But you see, goes back to also what I've mentioned, that Pakistan is active enough to conduct these atrocities over and over again, because reputational costs don't matter to it. Just like Iran and what Iran does in the Middle East, reputational costs don't matter to it. It feels it can ride it out and get away with it because of the nuclear umbrella and because of the fact that it's considered a keystone state in a geostrategic region, and that the Western powers may be averse to coming down hard on it because of the terrorism factor. It has played that. You can only play that card for so long. But now, of course, India can act on this. And even on flights, I mean, Air India is pretty inured to it. All it does is just exit out of the west coast of Gujarat, and flights can continue to the west. So there's no problem in it. The Indians have enough experience on these matters for flights going to the...
We've completely run out of time, but thank you. Okay, we've completely run out of time, Barzeen. I'll have to leave it there for the moment, but thank you very much to you and Manjeet Kriplani for joining us in the program. This is a story that we'll continue tracking very closely here on CNBC TV18. With that, it's a wrap on this edition of Global Eye. Thank you for watching. News continues on the other side.
Through meaningful mutual engagement.
Wasn't happy with it, and we're in the midst of talking peace, and missiles were fired, and I was not happy with it. That's what I'm putting a lot of pressure. You don't know what pressure I'm putting on Russia. They're dealing. You have no idea what pressure I'm putting on Russia. We're putting a lot of pressure.
Can you maybe tell us?
We're putting a lot of pressure on Russia, and Russia knows that, and some people that are close to it know, or he wouldn't be talking right now.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, one of the key elements of a sound financial plan is having proper life cover. On the show today, we will discuss exactly how much term insurance, which is the purest form of life insurance, how much of it do you really need? the key factors to consider while buying that term policy, and ways to ensure smooth claim settlement. To talk about all of this, we have with us on the show today Mr. Satishwar B, MD and CEO at Bandhan Life, and Sarbvir Singh, Joint Group CEO at PB Fintech. Gentlemen, thank you so much for joining in. It's good to have both of you in. Like I said, it's typically still April, and we usually start with brass tacks, financial planning 101. And obviously, before we talk about investments and growing wealth, we need to ensure that we are adequately protected. So I want to start there. And Mr. Satishwar, if you could open for us. A lot of people feel that, and especially young people, right, that if I'm not married, if I don't have children, why do I need to bother with life insurance? Your opening thoughts.
As for me, insurance is actually a necessity. Okay? And to be very broad, frankly, or broadly put in, life insurance basically takes care of two specific needs, right? And in a very, very broad segment, it's basically called as either dying too young or living too long. Okay? These are the two broad spectrum which actually covers. Now, what do I mean by dying too young, right? So when you're pretty young and you just started your work, you have not yet created a corpus, right? Ideally, you should also parallelly start creating a corpus. And the initial years, you have not yet created a corpus. And in that scenario, if death occurs, right, and there are dependents on you, then there is a financial burden on the rest of the family members. Now, this is where exactly the life insurance component, the purely life insurance component comes in. But having said that, right, there are also a lot of living benefits which comes with life insurance, right? With the life term plan, you can actually add some riders in terms of, say, critical illness cover, those kind of things. That's one. Also, as I said, the other big component is towards your living too long. So you start building a corpus, especially the long-term products, right? That's where you start building the corpus. So life insurance, yes, a necessity for all. And there are these two specific aspects which gets covered in that.
Oh, absolutely. Let me bring in Sarbvir as well. Sarbvir, good to have you on the show. And Policy Bazaar recently did a survey called How India Buys Insurance. And I noticed there were some nuggets there on term insurance as well. So tell us, Sarbvir, is India buying more life insurance, more term insurance, yes or no? And what would your opening thoughts be? Does everyone need life insurance or only married people with children?
So thanks, Ravi, for having us on your show. I think we just spoke to almost 4,000 Indians across, across cities and across states. And one of the things which is a bit frightening is that as much as half of the respondents were not even aware about term insurance. They were not clear as to what is the difference between term insurance and other forms of life insurance. And as you said in your opening remarks, that term insurance is the purest form of life insurance. And I think in a country like India, where, right now social security, etc., doesn't really extend to the middle class, I think having term insurance is a very essential thing. So I think this is something that we've been now, every year, we've been doing this research, and we find that while there is some improvement, so obviously more people buy term insurance than bought in the previous year, but unfortunately that rate is moving very slowly. And perhaps that is because of some of the misconceptions. So like you said, that yes, people with children or with dependents, I would argue, must buy term insurance. Actually, it's not just about dependents, it's about liabilities. So let's say that even if you are a married couple without children yet, or maybe you don't plan to have children, you still have liabilities. You may have some home loan, you may have other liabilities, and anybody who has those liabilities needs to cover for them. And the second point that we also must remember is that it's a moment in time. Maybe today you don't have dependents, but you are likely as you go forward. Now, in that case also, it is important to buy term insurance as early as possible, because this is a fixed rate plan. The price is going to remain the same, and the earlier you buy, the lower rate you lock in, and you are able to then cover yourself, when you need it. So I would say that it's broader than just having children, and one should look at the term insurance category in a more holistic manner.
Yeah, absolutely. I think that's a point well made, that whether it's investments or insurance, the earlier you start, the better. That's where you have the, you run the chances of getting the best returns or basically the best coverage. But, before we go on and talk about the quantum of insurance, etc., sir, I want to ask you, Sarbvir raised a very interesting point that even now, awareness about term insurance is pretty low across the country. Why is that? Because when it comes to health insurance, I think the message has gone home loud and clear that it's an expense. You pay that expense every year, hoping you don't have to make that claim, because if you want to be healthy, it's a necessary expense. वो खर्चा करना है to secure yourself. Why is that message not going through for term insurance?
So the term piece is basically, it's a very emotional subject, right? You're actually talking about death.
Yeah.
And nobody actually wants to kind of speak on those lines or actually even deliberate on those lines. So as for me, awareness, if you ask anybody what a life insurance is, I think they know that, right? But do you need life insurance or do I have a life insurance? There you will find that 8 out of 10 people don't have it, right? And so awareness in terms of what it is, yes, but the urgency and necessity to have it, I think that's what is lacking.
Yeah.
And the reason why it is, it's a taboo kind of a subject because I don't want to hear about my death. The very fact that I can die any moment is something which becomes a little difficult to register. And that's one of the single most stumbling block or the challenge that we are also still trying to drive. And that's where I would like to actually, in a way, compliment Policy Bazaar on their messaging on those lines, right? They've actually brought on a very hard-hitting message in terms of why life insurance is specifically talking directly on the point. It's a very difficult message. So the messaging and people actually also starting thinking on those lines that it can happen to me, right? So that whole aspect of and the urgency associated with, that's what is lacking. So.
Okay, so let's get down to the basics. The whole idea of this conversation is to help you, the viewer or the potential policy buyer, make the right decisions. First, a very clear definition. What is this business of term insurance that we're talking about? Term insurance, why do we call it the purest form of insurance? Because here you're not buying a policy expecting something to come back. This is not an investment product. It is, you're paying the insurance company purely to protect your loved ones, your dependents, in the case of your demise. So now the first question, how much term insurance do I need? How do we answer that?
You can have a very wonderful, complicated formula to it, but broadly, and very broadly, when I say this, you will not be, you will be right more than 99% of the time. Is basically one is take care of your immediate liabilities, if any. Suppose if you have borrowings on you, that needs to be covered, right? That's one. Over and above that, term plan is an income replacement product, right? So if when a breadwinner is not there, right? Naturally, you can't take care of the emotional aspect, but at least those whole financial thing, you naturally have working years, say, in a very broad sense, it's 60, right? So you will work till age 60, so you're going to basically generate income over those number of years, right? And that is what is covering. So suppose if something happens at age 40, for the balance 20 years, there is the income stream is stopped, right? That needs a replacement. Now, that's where term plan comes in. So the most simplest way, broadly we say 10 times, 20 times, but the way I define it is your working age, say 60. 60 minus your current age, right? That's the multiple. So suppose if you're 30, 30 times of your current income, very broadly put in.
30 times your current income.
It's basically
it just 60. Covers you till 60 years of retirement.
So whatever your balance working years, that's your multiple.
Okay.
Right? And you will actually see that even in life insurance companies, the younger you are, the multiples are higher.
Sure.
Right? So if you are a 40 plus person, then naturally the multiple will be a little lower. But if you start early, say 25, your multiple will be much higher. Very broadly, your current income into balance working years is a simplest form as per me.
Okay, fair enough. Sarabhi, let me ask you, is that a rough formula that you would go by as well? And then maybe some examples. I mean, someone who is 30 to 35, typically, what's the quantum we're talking about? How many crores of this sum assured are we talking about, and how much will it cost?
Yeah, so I think, Surabhi, I completely agree with Satishwar that, one can complicate this subject very much. There's jargon like human life value calculator, etc. But I think more than that, I would say two things. One is, like he said, go with a multiple. I have an even simpler rule of thumb that if you are below 40 years, then you should have at least 15 to 20 times your income. And if you are above 40, then maybe it should be 10 to 15 times. And the second thing that I would also say is that we should start. See, one of the problems is that insurance is a category where, one can deliberate a lot. One can keep discussing, thinking about it. My suggestion to your viewers would be that term insurance is essential. Please start. Let's say that you are today earning 15 lakh rupees a year or 20 lakh rupees a year. You can even start with 1 crore, 1.5 crores, 2 crores of term insurance. Very relatively easy to get. There's not much problem. If you're 30 years old, if you want to get 1 crore, the cost will be in the range of 1,200 to 1,500 rupees a month. So very, very affordable premium as well. So I think the main thing is start. There are many plans which offer features like as your life stage changes, as you get married, as you have children, you can actually increase the life cover, and obviously you'll have to pay a little bit extra for that. So I think there are many ways of improving the life cover. But first thing, hesitation that I feel is that we just don't start. So I think it's very affordable. Term insurance, interestingly, is at this moment is cheaper in India than in many developed countries. So it is surprising, actually, if you think about it, because sometimes one would expect that it would be cheaper in countries where the longevity is higher. But still, given the competition, given the I would say relative value that term insurance offers in India, I would actually say that it's a really good deal from a customer perspective, and it's something, again, every customer should have.
So in ballpark, I know this will vary greatly across companies and specific ailments, etc. But roughly, if you're talking about a healthy individual in their early to mid 30s, what would the annual payout be, premium payout, for a cover like you're saying, maybe a 2 CR or a 5 CR cover?
So it would roughly, for 1 crore for a 35-year-old, it would be in the range of 25,000 rupees a year, so 2,000 rupees a month. So for 2 crores, you can increase that. It won't double. It will be probably 3,000 to 3,500 rupees a year, a month. It's very, there's a wide variety of covers that are possible. So if you come to Policy Bazaar, you can see the range of options that are available to you. Different brands, different, companies have different prices. But generally speaking, as a rule of thumb, I would say that 1,000 to 1,500 rupees per month for 1 crore and maybe 2,500 to 3,000 rupees a month for 2 crores for a healthy 30 to 35-year-old person.
Oh, fair point. To add to that, what Sarabhi just mentioned, that maybe you realize that your insurance coverage needs are increasing with life. I mean, it was just you, and now you're married, and then maybe you're planning a family, and you realize that your current policy isn't enough. So what should one do? Should you look at adding on more policies, and then hopefully, if at all you need a claim, then you claim through multiple policies, or do you kind of add on in the existing one? What's the way?
So the ideal one is basically you buy a new policy. Add on to the existing one can also happen, but it basically goes through the same process.
Okay.
Even within the same life insurance company, it will be a new policy.
Oh,
right? Because if it's a standard premium, right? So you just can't add on to that, but the process becomes easier.
Okay.
Because naturally your KYC and all those things are done. It's more to do with the immediate evaluation and those things. But my take on this is a little different. So as I said, right, it's basically an income replacement, and it basically is supposed to take care of dying too young, right? So as an individual, one is, of course, it's a risk mitigation product, as you said, right? It's an expense.
Yeah.
So when you're young, you have not yet created a corpus.
True.
Right? And that's a reason, in case of sudden demise, there's a huge burden in terms of those whole financial income being lost.
Yeah.
In parallel, you're actually supposed to create the corpus.
Yeah.
Right? So if you are at, say, age 45, 50, or even closer to that number, you have already created a corpus. So your life insurance need at that point in time should also take care of the corpus what you have, in the sense, rather than take care, while you evaluate, you should also consider the corpus that you have. And the difference is what
investments and your existing corpus.
So buying early ideally takes care of it. If you have been parallelly creating a corpus.
Sure.
So the very fact that now you see everybody we have a specific thing called a special exit plan. Now that's what is in mind. If you have created a corpus for yourself, you don't need a life insurance.
Sure.
Right? In that case, you can actually take the money back. Right? The special exit value,
these exit plans, exit value plans, that's
the
what
special exit value is what we call it as, right? So that the intent is that you ideally should create a corpus in parallel, and that should take care of it, rather than continuously talking about my income is now growing
your policy
and those things.
And then therefore increasing your policy as well.
True. So that's a much more planned activity, rather than just ensuring that whatever is my earning, I should get.
I really compliment you, sir, for saying that. From a boss of a life insurance company, that's such honest, genuine advice. That as we grow older, our income streams grow, our wealth creation journey also grows. Typically, the wealth creation corpus should take care of a bulk of the life insurance needs as well, and instead of adding on more and more policies. That's a very, very logical point. We need to take a quick break on that note. Come back on the other side, and then the nuts and bolts. How do you ensure that your claim gets settled? What do you need to disclose? We'll talk about all those issues on the other side.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing the importance of buying a sound, comprehensive, solid life insurance policy which takes care of the needs of protecting your dependents in the event of your untimely death. So the question is, now we know why we need term insurance. We have an idea of how much term insurance we need. The question is how to get the right policy. And Sarabveer, help us out over here. I mean, typically, what is the kind of documentation? And if you're very healthy, great, then it's a green thumbs up all the way. But what if you have some ailments, some pre-existing illnesses? Where might you be rejected by an insurer? And what should you do? What should I do as a prospective policy buyer?
So I think, Surabhi, just like any other insurance policy, it always starts with full disclosure. I think the most important thing that we need to do, especially because we are buying a policy for a point of time when you may not be there, right? That's when the policy would pay off. So you need to ensure that everything that you have disclosed is absolutely correct. And the disclosures are in two broad categories. One is your health. So you need to explain, typically there may be a medical test. So you should explain very clearly if there are any ailments that you have, any medication that you are taking. Sometimes there may be a question around family history. So I think you should answer that truthfully. See, because answering it truthfully doesn't mean that you will get rejected. In fact, then the insurance company will do its work, will do their, tests, and they will work it out. And largely today, insurance companies have different types of options. So even if there is a challenge, they will, find a way to give you a policy. The second thing is that you must disclose what other policies that you have, again, very truthfully. Now, the insurance industry has ways of checking. There is a bureau and they can check from that. But it doesn't hurt to be very, very open and transparent about what policies you have, because again, that helps in calculating your total sum assured that you bought and making it easy for the insurance company to make a decision. Largely, there are just two things. One is your financial profile. Second is your health. And based on this, the insurance company will, obviously, you will get a standard quote and, you will be able to issue the policy. The more cooperative you are, the easier it is to get the policy. And it does take a little bit of time, especially if there's a medical test involved. But I think it's better for the customer to go through that medical test. It also acts as a check. Most of us don't go through regular medical checkups. So I think in that sense also it's helpful. But I think if you do these two things well, then there's absolutely no problem. The process is very smooth.
No, absolutely. It sounds, sounds absolutely logical. It might not be a one-click, buy-at-a-click kind of product. Though maybe I'm sure there's a lot of innovation, so maybe that's also there. But just comment on this, sir. In terms of buying a policy, obviously full health disclosure, family medical history. On this financial profile disclosure, does it really matter where I'm working, what I'm doing? I mean, to what extent does that weigh on my prospects of getting a life cover?
If you notice, term plan is an income replacement plan. As you initially said, it's an expense. The health insurance, similar is term, right? It's not an investment product. It's a risk mitigation product. And it is supposed to take care of replacing your income in your absence, right? Now, from that perspective is where this whole income assessment happens.
Okay.
Right? So that it's not a money-making tool. It's basically replacing your income. And it's also one of the biggest pieces is income and your education and your work profile. These are also an indicator of longevity.
Under what circumstances can a claim be rejected? And, once again, just to recap, what all can I do to ensure highest chances of a claim being honored?
So as Sarabveer also said this, right? So the only single reason why a claim can get rejected is non-disclosure.
Okay.
And again, I would like to kind of put it over here that whatever has been asked for, we are not expecting some to be declared which is not being asked for by the life insurance company, right? So there is an application form that you fill in and the process that you will follow in terms of identification or authenticating yourself, and then also medical terms, right? So the application form in itself takes care of it. So let it be your occupation, let it be your income, let it be your health profile in terms of are you currently suffering or anything, kind of any illness in current. So all those things is where you need to be very honest about it.
Sure.
Right?
Sure.
If this is there is no way a claim can be rejected or repudiated.
Okay.
Right? So the whole piece is the process itself.
Yeah.
If you thoroughly kind of follow the process,
disclose,
and be very honest at that stage, and only those pieces which has been asked for.
Yeah.
There is no need for doing something over and above that.
Yeah.
It's a simple set of questions, and it's simple. It's pretty simple English over there.
Got it.
So,
got it. Okay, Sarabir, coming down to some final thoughts on product innovation, because the industry keeps coming out with, though it's a very plain vanilla product, this term insurance, but now there are a lot of riders as well, right? So what all should someone consider before deciding on a term plan, and what are the additional toppings or riders that you might want to add to your policy?
So I think, Surabhi, the plan, as you said, is a very straightforward, I think, plan which, as we know, pays off demise. The riders that you have available, I think one that Satishwar also spoke about, which I would definitely want to talk about, which is the special exit value, or zero cost as it's popularly called, where you have now almost across plans, you have this feature where you can, at the age of 60, 65, depending on the plan, you have the right to stop paying for the policy and take back the premium that you have already paid. So this is, I think, a very useful feature, because once your corpus is built up, once you have financial assets and you don't want to continue with the plan, you are able to then get your money back. So effectively, it almost becomes like a free term insurance plan where all the money that you paid, except for the time value of money, is returned to you. So I think that's one feature that one customers or consumers should definitely look for. The second, there are features around accidental death benefits. So there's, sometimes you can add a rider which will give you double the payment if something happens to you in an accident. There are plans which have, critical illness plans, which I think is an interesting and important addition that one can consider or should consider. Because when one is critically ill, what happens is that while you will not obviously have a payoff from the term plan, you will have certain expenses. You may not be able to work. You may, need expenses both for your medical treatment as well as, loss of income. So I think critical illness plans make a lot of coverage, makes a lot of sense. I would say that these are the 2 or 3 basic riders that you can add. The other is a form of payment, which is essentially that you can either pay every year for the term of your policy, or you can pay what is called in a limited format. So you can pay over 5 years or 10 years. Now, this could also be something you can consider, because this allows you to pay for term insurance in that limited period, and then ensures that even if, let's say, you don't have a job or there is any kind of income change for you over your lifetime, you don't have to worry about the term insurance premium. So I think I would say, like I said, there are 2 or 3 riders that you should think about, and then there is a form of payment where you could choose to pay in a faster way versus paying over a longer period of time.
And typically, Sarabir, these riders would cost, a fraction of the premium of the policy itself? I mean, some ballpark numbers here?
Yeah, the accidental death benefit riders are relatively inexpensive. The zero cost or special exit value is now built into plans, so actually it doesn't cost anything extra. And the critical illness can cost, that can be 15 to 20% or more depending on the amount that you choose. So that can cost a little bit, but as I said, it's worth it because it covers cost of illness as well as the income that you may lose at that time.
Absolutely. All right. Very, very helpful advice. Thanks to both of you for joining us and helping us give some more clarity when it comes to our life insurance needs and why term insurance could be, of course, a very, very beneficial product to consider for people across age groups, across sort of life stages as well. Thank you very much, Mr. Satishwar and Sarabir, for joining in. And with that, we're completely out of time on this edition of Let's Talk Money. So it's a wrap from the team that puts this show together. We will see you same time, same place next week.
Let's Talk Money.
मुस्लिम सिख ईसाई आपस में है भाई भाई कश्मीर को बदनाम करना बंद करो बंद करो
कश्मीर को अमन अंजाम देने में यहाँ के हॉस्पिटैलिटी इंडस्ट्री का भी उतना ही हाथ है। ये सब जगह मैंने एम्फेटिकली बोली है।
We want justice. We want justice. We want justice. कॉलेज
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Indian and Pakistani forces exchange fire briefly at the line of control as tensions rise after the Pelgam terror attack. Indian Army sources say Pakistan initiated the firing. Army Chief General Upendra Dwivedi is in Srinagar as the United Nations calls for maximum restraint. Sensex and Nifty gained 1% this week despite a sell-off on Thursday and Friday. Nifty manages to hold above 24,000. Midcap index up 2% this week. Maruti Suzuki misses estimates in Q4, profits down over 4%. Revenue growth is below expectations. Margins contract by 180 basis points annually. China denies any trade negotiation with the US once again. This after President Trump claims officials from both nations have been meeting each other. China tells US to abolish the tariffs if it wants a resolution to the tussle. Apple is seeking to import most of the iPhones it sells in the United States from India by the end of 2026. Sources say the company is aiming to accelerate the shift beyond China to mitigate the tariffs. Google's parent company Alphabet reports quarterly revenue of $90 billion and profit of $30 billion, beating street estimates. Chip maker Intel reports a quarterly loss and cuts growth outlook along with a warning on potential layoffs. Indian electric vehicle makers face a challenge as China restricts the supply of rare earth magnets which are critical for production. Beijing is now demanding end-user certificates signed by officials from India and China before authorizing imports. A day after Bharti, Airtel sought conversion of spectrum dues to equity, government sources say such a conversion is not automatic. The telecom department is open to considering the request, but it's subject to evaluations. President Draupadi Murmu will be attending the state funeral of Pope Francis tomorrow. World leaders, including US President Trump and heads of state from Europe, will be in attendance. The top story today, India and Pakistan's relationship has hit a new rock bottom. Days after the terrorists attacked tourists at Jammu and Kashmir's Pelgam, killing 26 people and leaving 17 injured. The police claims that 2 of the 3 suspects are Pakistani citizens. Islamabad, on its part, has denied any link. Indian and Pakistani forces exchanged fire briefly at the line of control last night. Indian Army sources said that Pakistan violated ceasefire near Nogam village of Jammu and Kashmir. Army Chief General Upendra Dwivedi is in J&K to review the security situation. He held meetings with LG Manoj Sinha and top army officials. The Army Chief has directed all officials in Jammu and Kashmir to remain on high alert. The United Nations has urged India and Pakistan to practice maximum restraint. A spokesperson for the agency said that issues between the nations should be resolved through meaningful mutual engagement. India has already unleashed a set of measures against Islamabad. All visas to Pakistani nationals have been cancelled. The Atari border, the only permitted trade route with Pakistan, has been sealed. The Indus Waters Treaty has been suspended as well. India has formally notified Islamabad about its action. A letter from the Union Water Resource Ministry said that sustained cross-border terrorism by Pakistan targeting Jammu and Kashmir impedes India's rights under the treaty. Pakistan too has retaliated with a set of measures, including closing its airspace to Indian airline companies. The Pakistan government also summoned the Indian envoy in Islamabad. Arunima reports from Pelgam on the security situation in J&K.
The constant whirring of the chopper is the only reminder of the kind of bloodbath that this place, the meadow of Baisaran, has seen just 4 days ago. And suddenly, all that is remaining of this picturesque trek is raw beauty, air surveillance, penetrating radars looking at these pine forests to see if the terrorists are still hiding somewhere, a combing operation. People from CRPF are soldiers from Rashtriya Rifles, Jammu and Kashmir Police, CRPF, constantly scouting these pine forests, not just in these high altitude areas of Pelgam, but also on the other side, in the Jammu division, in Doda, in Kishtawar, in Kathua. They're keeping an eye at the foothills of Anantnag. Next door, Shopian, at least 2 local terrorists have been identified. Their antecedents have been checked. Their residences in Tral and Bijbehara have been blown off in an explosion. So in terms of security, this entire area is now a very, very high security zone. Like I said, just a few days ago, this was a picturesque picnic location. But little did these tourists know that what they were thinking to be a memorable holiday will soon turn into a nightmare.
Ministers Amit Shah and Rajnath Singh briefed lawmakers on Pelgam at an all-party meeting yesterday. Opposition parties condemned the attack and gave the government full support to take any action that is likely to take. Apart from Shah and Rajnath Singh, top NDA ministers and senior opposition lawmakers, including Rahul Gandhi, Mallikarjun Kharge, Sudeep Bandyopadhyay and Supriya Sule, were present at the meeting.
कश्मीर में शांति रखने के लिए वो अच्छा प्रयास करें और वहाँ पर शांति रखना जरूरी है, ये बात उनके सामने हमने रखा और उन्होंने ये कहा कि सभी एक्शन ले लें.
The spirit was good. Security lapses were discussed, but assured the government that all political parties will stand by the government, whatever decisions they can take for the interest of the country.
हम सब की एक ही मांग है, पूरे देश की एक ही मांग है, आतंकवादियों को बर्बाद किया जाए, उनको उसी भाषा में जवाब दिया जाए जैसी दरिंदगी और हैवानियत उन्होंने दिखाई है. मासूम और निहत्थे लोगों की जान उन्होंने ली है.
Congress MP Rahul Gandhi visited the victims of the Pelgam attack at the Army Hospital in Srinagar today. He had cut short his US visit to return to India after the terror attack. The leader of opposition in Lok Sabha promised healing and solidarity. He's also scheduled to meet various delegations in Kashmir, including the trade and tourism sectors.
We had a meeting yesterday with the government, and the united opposition condemned this action and said that we are there to support whatever action the government wants to take. The idea behind what has happened is to divide society, is to make brother fight brother. And it is very important that every single Indian stands united, stands together, so that we can defeat what the terrorists were trying to do.
The houses of 2 suspected terrorists involved in the Pelgam attack was demolished in Jammu and Kashmir. The homes of Asif Sheikh in Pulwama district and Adil Thokar in Anantnag were razed to the ground, apparently using explosives, according to several media outlets in Srinagar. The police have not issued any statement yet on the demolitions. Muslims in Hyderabad and other parts of India wore black armbands to Friday press to protest the attacks on tourists in Pelgam. Lok Sabha MP Asaduddin Owaisi had issued a call yesterday to all Muslims to wear black armbands as a mark of protest. All right, moving on to the stock market action now. Sensex and Nifty gained 1% this week despite a sell-off on Thursday and Friday. Nifty managed to hold on to the 24,000 mark after a 200-point decline. Sensex lost nearly 600 points. The Midcap saw sharper cuts today, but the index ended with gains of 2% for the week. Prashant Nair is here with the market wrap.
Well, Friday was nothing to write home about. We finally saw some profit booking. And actually, there were hints of that Thursday as well. I mean, on Thursday, if you remember, the Nifty was up 150 points, and then we ended with 15-point gains. And today, of course, I mean, we started lower, and then we kind of sort of, in the first hour, we were down, and we kind of sold off more, recovered a little bit, but it was down by 330. But for the week, it was the third week of gains. If you look at the full week. So the Nifty this week was up 0.8%. The Bank Nifty was up 0.7%. Mid-cap index 1.7%. And the small-cap index was up about 0.8%. Remember, Friday took a bite out of these gains. As of Thursday's close, I mean, these numbers would have been much better. And by the way, in these 3 weeks that we've seen, the low was about 21,740 or something on the Nifty. We are up as of this Friday 10.5%. So it's not small. And many stocks, well-owned stocks, as part of this, for example, the BSE 200 universe are up easy 20-25%, some more. As I said, Friday, of course, weekly gains aside, Friday was a down day. Nifty, Bank Nifty, mid-cap, small-cap indices, everything. I'll go back to the broader sort of gains that we had, and I looked at the BSE 500, NSE 500 universe for this Friday to Friday. Actually, what gains did we see? So the big gains actually surprisingly came from the IT sector. Now remember, the IT space has been completely bashed up. And it was not as if numbers which we got this week were anything great to write home about, but it was just sort of, a lot of selling had already happened. And there were some bounces which we saw. Tata Elxsi 14% this week, Coforge up 12%, Tata Tech Mahindra 12%, Emphasis was up about 12% as well. There were some other names, AU Small Finance Bank 15% pop, Vari was up 15%, Newgen was up 13%, Apar Industries and Atul were up 13% respectively. Some losses coming through in names like Blue Star, 14% cut this week. There was Syngene, which was down 14%, RK Forging and PCBL. Actually, just 4 names with losses in excess of 10% this week. All told, a pretty good week. I mean, I think as we go into the weekend, trade headlines, Trump comments, etc. remain top of mind. But there is, of course, an added element which we will need to keep an eye out on, which, of course, is, I mean, the repercussions and how India will react to in response to the absolutely, terrible attacks which took place in Kashmir. If and when we will see that, I think markets are waiting and watching that very closely as well. Back to you.
Right, thank you, Prashant, for that. Moving on, shares of Maruti declined in trade after reporting a weak set of numbers in the fourth quarter, missing street estimates across most parameters. Net profits slipped over 4% and margins contracted by 180 basis points on an annual basis. Sudarshan Kumar joins us with the earnings snapshot. Sudarshan.
So it's a mixed set of earnings from Maruti as far as profit and revenue are concerned. Those numbers have come slightly below estimates, but margin has come in at 10.5% against our expectation of 12%. And company has given reasons, and because of expenses have increased, and 3 parts of expenses, if I can talk. First one is material cost. It has risen both sequentially and year-on-year. It was up 6% sequentially, 1% year-on-year. Employee expenses were up 15% year-on-year and 2% sequentially, and other expenses have increased 14% year-on-year and 13% sequentially. So if you accumulate all these have impacted margin by 230 basis points. Now, material cost impact on margin was by 90 basis points, employee cost impacted by 30 basis points, and other expenses impact were of 110 basis points. So what all a company has included in other expenses? It has mentioned first, new plant-related expenses, second, higher sales promotion or ad expenses, and third, higher manufacturing overhead expenses. So these have come in other expenses, and that has impacted margin by 110 basis points. But what was the positive in the earnings was the realization. It has improved both sequentially and year-on-year because of the price hike that company has taken, not only in Q4 but even in Q1 FY26 also it had announced price hike. But just if we talk about Q4, they had taken price hike twice, and that had impacted positively to realization, which has improved 7% year-on-year and 3% sequentially. Now in the commentary, what exactly we'll be looking for? First, what company says on outlook, demand outlook, because recently they had attended press conference, they had attended one conference in which all the companies, including Hyundai, M&M and Maruti, were saying that in FY26 also, PV demand growth is likely to be in low single digit. So we'll have to see if there is any update on that and what exactly company says on commodity outlook going forward.
All right, thank you, Sudarshan, for that. China has once again denied having trade negotiations with the United States. This statement comes after President Donald Trump indicated that officials from both nations have been meeting each other. The Chinese government has told the US that if the Trump administration wants to have trade negotiations, they will have to remove the tariffs. Remember, Trump had softened his stance on imposing massive duties on Chinese imports last week. He said, and I quote, "Tariffs will come down substantially, but it won't be zero." End quotes.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later, but they had meetings this morning, and we've been meeting with China.
Tech giant Apple is considering India as one of its manufacturing hubs for all iPhones for the US market. Sources have told CNBC-TV18 that the production shift could be done as early as 2026. However, this decision could be subject to India's ability to scale up production rapidly and the US and China trade relations. Parikshit Luthra is standing by with the details. Parikshit, what will this mean for India?
Apple is considering making India a hub to manufacture all Apple phones for the US market by next year. This is because of US-China trade tensions and the high tariffs on China imposed by the Trump administration. But Apple's decision will also depend on adequate capacity ramp-up in India and the trajectory of the US-China trade talks. The company is considering increasing production to 40 million phones in India in 2025. Production last year was around 26 million phones. Apple contract manufacturers in India are ramping up capacity in existing facilities. Foxconn's Bengaluru plant is likely to be operational within this month and will have a capacity to manufacture 20 million phones at peak capacity. So while there is an intent to make all Apple phones in India, a lot will depend on whether US and China can reach a deal. Apple did not reply to CNBC-TV18 queries.
Parikshit, please stay on with us. Let's also talk about China's restrictions on supply of rare earth magnets that have worried Indian EV makers. The magnets are a critical component used in the production of electric cars and two-wheelers. What can you tell us on that front?
Indian EV and component makers are facing production challenges as China restricts supply of rare earth magnets, say sources. Automobile and component makers have approached the Indian government for help. CNBC-TV18 has learned that China has restricted supply of rare earth magnets to India from the 4th of April onwards. The magnets will be supplied only to those companies which submit end-user certificates in a prescribed format. The Chinese government is demanding end-user certificates releasing any exports of rare earth magnets and also are demanding that they be duly authorized. China says importers must get end-user certificates signed by both the Indian Foreign Ministry and Chinese Embassy, and importers must confirm that the rare earth magnets will not be used for making weapons or given to any third party. Clearly, the Indian auto industry will be impacted. Rare earth magnets are a critical part of traction motors and other components of electric vehicles and automobiles. For the moment, there is inventory, but if these restrictions continue, then there could be production challenges in the coming few months.
Right, thank you, Parikshit, for that. The United States may relax curbs restricting the number of graphics processing units that India can import from the country. Sources tell CNBC-TV18 that talks are underway between the two nations to ease the cap of 50,000 GPUs imposed during President Joe Biden's tenure. This could help India's AI mission, under which the government is looking to raise GPU availability to over 33,000. 31% of Indians have used generative AI tools. This, according to a study by Google in collaboration with Kantar India, which reveals that 60% of Indians are unaware of the technology. The study also found that 84% of respondents who have used generative AI use it for assistance with homeworks and daily chores. Speaking with CNBC-TV18, Google DeepMind Senior Director Manish Gupta said that the tech major is focused on streamlining its AI offerings into a more user-friendly experience.
Amazing country with so much of potential, and I think when it comes to really developing DTEP capability, we are already beginning to see glimpses of, again, tremendous advances, the Indian developers playing a very key role in developing all of these solutions based on AI for the entire world. In terms of innovation, I think there's potential, right, for us to take it to a far higher level. And it's, again, very heartening to see the government in terms of making real investments in encouraging the startup ecosystem, supporting deep tech startups in India. I think likewise we need to see industry investing more in research.
All right, it's time for a short break. Coming up next, a day after Bharti Airtel sought conversion of spectrum dues to equity, government sources say such a conversion is not automatic. That and more when we return.
Create effective strategies with insightful expert opinions. On the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential.
Welcome back. You're watching Business 360. A day after Bharti Airtel sought conversion of spectrum dues to equity, government sources said such a conversion is not automatic. Ashmit Kumar joins us now. Ashmit, tell us more about the government's stance on the matter.
Well, important clarification coming in. We spoke to various government officials. What they're telling us in very clear terms is that as far as the application process is concerned for this equity conversion, this conversion will not happen under an automatic route. So just because a company has made an application does not mean that automatically that spectrum due or that AGR dues gets converted to government equity. What the government officials are telling us is that there is a process, that there is a certain amount of discretion that the government will exercise in terms of converting these spectrum dues to equity. In fact, there will be application of mine and a decision will be made on a case-to-case basis is what various government officials are telling us. So essentially clarifying, it's not an automatic transition that takes place. What government officials also tell us is that companies, of course, are free to apply under this scheme, under the 2021 cabinet scheme, and that the government will take, the government is not bound to make that transition, but that the government will take an informed decision and will exercise discretion on this conversion. Another key clarification that has come in from government officials is that both AGR dues as well as spectrum dues will be eligible for conversion under this equity conversion scheme. And that, of course, is where we need to bring in the context. So far, the only equity conversion that we've seen so far is in the case of Vodafone Idea. What government officials have previously told us is that now the fresh applicant is Bharti Airtel. Bharti Airtel is also seeking parity with Vodafone Idea, is seeking similar treatment with Vodafone Idea, and therefore is seeking this conversion. And just to set the context, in 2021 is when this cabinet relief had been allowed, had been granted the nod, and under this 2021 scheme, at least as per the language that was used back in 2021, it was eligible. Only spectrum dues that were for spectrum that was bought before 2021 is something that was eligible for this equity conversion. So clarifications coming in from highly placed officials within the DOT. Back to you.
Thank you, Ashmit, for that. In international earnings now, Google parent Alphabet reported a strong set of numbers in the first quarter, surpassing street estimates on most parameters. Revenue surpassed the $90 billion mark, jumping 12% on an annual basis. The company's search and advertising units also showed growth despite competition in the AI space. Overall, advertising brought in over $67 billion, growing 8.5% from the year before. Net income increased by 46%. Intel's first quarter performance surpassed analysts' expectations as well. However, the chip maker's guidance for the current quarter disappointed the markets. Intel said it will break even with revenue of $11.8 billion. It added that its second quarter guidance reflected elevated uncertainty driven by the macro environment. The company said that it plans to slash operational and capital expenses in 2025. These include an unspecified number of layoffs announced by the CEO today. US President Donald Trump has said that Russia has made a big concession to end war in Ukraine by not taking the whole country. Speaking to reporters at the White House, he said he believes both Russia and Ukraine want peace. He added that he has his own deadline for ending the war, but maintained that Washington's attitude could change if an agreement fails to materialize by then.
We're putting a lot of pressure on Russia. And Russia knows that, and some people that are close to it know, or he wouldn't be talking right now. The Prime Minister understands that better than anybody. He wouldn't be talking right now. He's talking, and we're putting a lot of pressure. I think he wants to make a deal. We're going to find out very soon, but it takes two to tango. And you have to have Ukraine want to make a deal too, and they're being hit very hard. And I do believe they want to make a deal. Stopping the war, taking the whole country. Pretty big concession.
A senior Russian military officer was reportedly killed when a car bomb exploded as he walked past in a city near Moscow. Authorities have said that the improvised explosive device was packed with shrapnel and a gas cylinder inside the vehicle fueled the blast. The car was outside a residential unit. Israeli forces have killed more than 60 people in Gaza in the last 24 hours. The Palestinian Civil Defense Branch has said that 12 people from the same family in North Gaza were among those killed in the early morning airstrikes. The Hamas-run Gaza Health Ministry has reported that nearly 2,000 people have been killed since Israel pulled out of its ceasefire agreement with Hamas on the 18th of March. President Draupadi Murmu has left for Vatican City to attend Pope Francis's state funeral. She is accompanied by Minority Affairs Minister Kiren Rijiju, his deputy George Kurian, and Goa's Deputy Speaker Joshua Peter. D'Souza are also part of the delegation. US President Donald Trump and Ukraine's Zelensky are among the prominent dignitaries who will attend the pontiff's funeral tomorrow. The government has notified rules and procedures for filing appeals at the GST appellate tribunals. Timsi Jaipuria joins us now with the details. Timsi, take us through the government's guidelines.
In a major move to streamline tax litigation, the government has notified the operational framework for the long-awaited GST appellate tribunals. Effective from 24th of April, the new rules mandate digital-only filing of appeals and applications, paving way for a new era of electronic governance in tax adjudication. Under the framework, all appeals, applications and supporting documents must be through the official GST-80 portal. The system will also handle electronic service of notices, case tracking and order issuance. The digital transition is expected to significantly reduce manual errors, delays and the burden of physical paperwork. What is also seen with this notification is a major relief in GST dispute resolution mechanism. The notified rules are structured in 15 chapters detailing the procedures from admission of appeals to conduct of hearings, electronic filing and disposal of cases in a time-bound manner. Rules provide for e-filing and hybrid hearings, which is likely to bring in uniformity, reduce litigation timelines and ensure faster resolution. With this, industry can now start filing appeals from today itself. Urgent matters will be given priority and tribunals, if needed, can impose costs for defaults or litigation expenses, including penalties for misuse of the process. To be seen now is how actually the functioning of tribunals across the country is able to be a key change maker to reduce GST litigation.
Right, thank you, Tim C, for that. With that, it's a wrap of this edition of Business 360 News and Updates. Continue right here on CNBC-TV18.
Influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bharti.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. Fabric and its subsidiary Intellica raises $13.5 million in Series A funding round. Led by Nuveen, the fresh funds will be used to scale its cutting-edge data and energy solutions. Intellica currently serves over 3 lakh EVs.
Finvolve, an India accelerator, invests 2.5 crore rupees in AI-powered claims management platform Paramount. The firm plans to leverage this funding to strengthen its proprietary software, enhance digital claims management capabilities, and expand its presence across insurance companies in India.
Peers App announces a 8 crore rupees ESOP. The hearing care solutions provider plans to expand to 250 stores by FY26 and 500 stores thereafter, targeting twofold growth in the next 3 years.
Apple is seeking to import most of the iPhones it sells in the United States from India by the end of 2026. Sources say the company is aiming to accelerate the shift beyond China to mitigate the tariffs.
Google's parent company Alphabet reports quarterly revenue of $90 billion and profit of $30 billion, beating street estimates. Chip maker Intel reports a quarterly loss and cuts growth outlook along with a warning on potential layoffs.
Over 28,000 startups in India have shut shop in the last 2 years as per data intelligence platform Traction. While some filed for bankruptcy, others remained inactive for more than a year.
Well, those were the headlines we've been tracking for you this evening. Tech-enabled Intercity bus network platform Intercity Smart Bus has hit the accelerator on growth, clocking a 70% year-on-year revenue surge and cruising steadily in the profitability lane for the second year in a row. With a 10x jump in adjusted EBITDA, Intercity Smart Bus now has its eyes set on a 1,000 crore rupee revenue milestone by 2027. To talk to us about this turbocharged journey and the ambitious goal of serving nearly 1 million travelers every month, joining me today is the co-founder and CEO of Intercity Smart Bus, Manish Rathi. Manish, welcome to the show. A strong FY25, 70% year-on-year revenue growth and 10x profit increase. What were the key growth drivers behind this performance? And in an industry where scaling profitability has been a challenge, how have you managed to crack the code?
First, thanks, Shruti, for having me around. So I think, what we did across, I think if I were to summarize it in 3 factors. One, we made, we have changed the perception of the travelers towards the bus industry. It is more, people have started considering that as one of the mode of the travel they would take. So people are taking buses more and more. Second, I think, over the last 4-5 years, ever since we started, we made a conscious effort on looking at certain metrics which traditionally was not been looked across by the bus industry, be it across more towards, we focus more towards how we can realize more revenues from a bus as compared to the number of buses we are running or the number of seats we are selling. It was more about, operational efficiencies towards doing that. And the third is that, predominantly we've focused more on tech and data to help us understand where the industry is going, where our business is growing, and kind of use that data and technology to put it to the execution part. So those are the 2 or 3 things which really has helped up. Last 2 years, we are seeing all the results of all the investments we are seeing through that.
All right. Manish, like I mentioned earlier, Intercity is aiming for 1,000 crore rupee turnover by 2027. What's your roadmap to achieving this milestone? What makes you bullish, and what role will technology play in reaching it? If you could take us through your tech edge as well.
Sure. So first of all, last 3-4 years, we have set the foundation for the future growth. So in a sense, now today we have built up our infrastructure, we have built up our tech and product and deployed it about 7 hubs across the country, where we believe we are going to scale in the next 2-3 years, connecting these hubs, these major cities to the Tier 2 and the Tier 3 towns, from where we are going to see the next 2 years growth coming from these hubs, connecting to the Tier 2, Tier 3 towns. So our technology is what has enabled us to grow. And that makes us more and more confident and bullish towards how we can scale. We put our eyes and ears in all our buses. We are now looking at, we can now kind of scale across in the business without deploying more capex into that and more expenses into that. Technology simply enables us to scale.
Sure. Manish, you've set an ambitious goal of serving 1 million travelers every month by 2027, with plans to add 500 new smart buses over the next 2 years. How are you gearing up in terms of capacity, infrastructure, and fleet to make that scale up a reality?
Yeah, so as I said, I think our growth foundation we have already done. Now it is about scaling every city. So, for example, wherever we've seen a good product market fit, and we are still at a very early stage, probably only at about 4-5% of the market. We expect ourselves to grow to about 15-20% of this market over the next 2-3 years on all the routes where we are operating today. And this is where the growth would come here. This is where our primary growth over the next 2 years would come from. With regards to our technology, see, all our buses, we call it as a cloud connected buses, in a sense that when it is running, it is connected to the cloud, and it has the capability to kind of transfer data from the buses to the cloud and probably also receive the data from the cloud. This enables us, enables us with the data and this one around, and that really becomes the base for whatever we do.
All right. Manish, let's now talk about your revenue model. How does Intercity deliver tangible value to operator partners? What kind of growth or returns are they seeing? And how does your tech-led approach improve occupancy, efficiency, and overall utilization compared to traditional models?
See, our traditional partnership with our operator partners is really a more across the win-win. They have the what I cross is the knowledge and the capability to run and operate the buses. We have the capability of what across the technology and consumer interactions and those things around. So that's where the win-win probably for both of us come through. Over the last 4 or 5 years, 4 or 5 years, if I were to give you some examples, people who gave us about 2 buses or 4 buses about 3 or 4 years back have recently given us their 40th or 42nd buses. That's a scale and that's a growth they have seen across in their asset lineup over the last 5 years. Our hypothesis to them, and we give data around, is that assuming that if they are able to run their buses on the road, we can demonstrate a 15-20% increase on the revenues across from their assets.
Okay.
That's been the primary value proposition for us to the buses side.
All right, Manish, one final question, if you could quickly answer that. Intercity's companion app, Rail Yatri, continues to serve over 14 million monthly users. How well has it complemented your smart bus ecosystem, and what kind of an impact do you see it making on revenues going forward? If you could answer that quickly.
It is a companion in a sense that travelers are the same. Sometimes they take trains and sometimes they take buses. So for our value proposition are there for help them out in any of the long distance journey. Trains is a great platform for us to connect to our customers or potential customers. It also gives us a lot of intelligence of how people are traveling across the country. And that is an intelligence we use to run across our buses also.
All right, Manish, on that note, it's time for me to wrap up our conversation. But many thanks for your time and appreciate you joining us on Startup Street today.
Thank you.
Well, Gen Z-focused women's fashion brand Outsider has raised 30 crores in a seed funding round led by Solaris Venture Partners. These funds are going to be used to strengthen the brand, enhance its capabilities, and deliver the latest on-trend fashion products for young women. The brand has launched its D2C platform and now is also present on e-commerce platforms, aiming to reach 100 crores in annualized run rate in the next 6 to 8 months. For more on this, joining me now is Nirmal Jain, who's the co-founder of Outsider, along with Mayank Jain, who's principal at Solaris Venture Partners, their investor. Mayank and Nirmal, both of you, thank you very much for your time here on CNBC-TV18. Nirmal, before we get to that funding, very briefly, give us a sense of how large the brand has grown to be in the last 1 year since you launched.
Thank you. And we launched in February, and it's been like less than 3 months since we went live, and we're almost at a annualized run rate of almost 20 odd crores as we speak. So we have seen some strong traction in a very short span of time, both across primarily in our D2C channel, our website, as well as on the marketplaces that we've recently went live.
All right. And Mayank, is that what got you excited? What got you to sign the check? When the company made their pitch, what were you most impressed with?
Several things. Predominantly, there were 3 pillars of our investment thesis. Overall, we find the overarching market of affordable fast fashion to be very, very attractive. It's a very, very large market, very, very unorganized, very impulse-led and design-led, leading to high gross margins. In addition to that, company has a very unique test and quick react model, which allows them to bring trendy fashion fastest from, a trend to shelf. And third, we felt that the team of Nirmal, Mani, and Justin had a very, very strong, what we call as founder market fit. They come from the fashion domain, carry a proven track record of achievement, and are very, very complementary in their skill set. So these constituted the 3 pillars of our investment.
I see. Well, Nirmal, now that you've got that 30 crores, give us a sense of how you're going to deploy this money in the medium to short term. What will be the growth priorities?
We're focusing on 3 areas largely. One is on the brand building side. Secondly, the core of our business is anchored around this entire test and react model. So a lot of investment will be actually in building out this entire capability set on building an agile supply chain that can quickly react, on right demand sensing capabilities, and as well as getting the right team in place to ensure that we can execute this at scale. And the third part of investments will go towards the technology bit, because technology is a significant enabler for our business. So these will be the 3 primary areas of investment in, let's say, in the next 6 months or so.
All right, Mayank, then at Solaris, what do you estimate the size of the market opportunity for affordable fashion, especially focused on Gen Z, really is? And how much of it can new players like Outsider really capture? Because the space is heavily dominated with a whole host of large and small and young players.
So needless to say, the company at least is addressing the young females fashion market, typically females in senior school, college, first or second jobbers. This is, of course, a very, very large market in volumes. And affordable fast fashion, is roughly, by different estimates, 70 to 75% of the overall market, which can also be intuitively seen by the, several mom and pop unorganized fashion stores that we keep seeing. So it's a very, very large market. And in fact, on the contrary, I'd argue that there aren't too many organized brands that exist in this market, with a few exceptions. So we see a very, very large opportunity to build a brand and take some of those market share from unorganized players.
All right. So you hope that some of the unorganized share will come onto the organized players and outsider will be a beneficiary. But Nirmal, you talk about global fashion trends, bringing them to Gen Z women at very affordable prices. And this fast fashion is the term that you're using. But how are you ensuring this is more environmentally sustainable as well, especially when you're catering to a more conscious younger generation now?
I think being on trend and being sustainable, these need not be polar opposites. You can use good fabrics and yet be on trend, right? I think while there is a very common perception that fast fashion. So if you look at it, there are two sides to it. Like how you create fashion and how much you consume as fashion. I think the company can take a conscious call whether you want to build a supply chain that's anchored around good fabrics and environmentally friendly fabrics, right? That doesn't mean that, and yet you can offer trendy products. So I think from a supply side of the entire business, we are focused primarily on ensuring that we provide products which are based on good fabrics with a healthy mix of, let's say, with the naturally or natural fibers. Now, when it comes to the demand side, I think the choice of how much to consume should be left best to the consumer is what we think. I think if you really look at how the markets have evolved in India as well as globally, the core insight for our business is that today young women go out much more. There are many more micro occasions in their life, and they prefer occasion appropriate dressing for each of these micro occasions, and naturally that increases the demand or increases the frequency at which they purchase. And I think we believe that we as a brand would like to provide what this consumer is seeking in the best possible way at the most affordable price point and in a manner which is environmentally friendly. At least that's how we think of the brand and how we want to service this consumer.
All right, and you aim to get to 100 crores of revenue in the next 6 to 8 months as well. Nirmal and Mayank, thank you very much. That's all the time we had today, but it's been a pleasure speaking with both of you. Thanks very much.
Thank you.
Thank you so much.
On that note, it is time for us to head into a short break. But coming up on the other side, the Young Entrepreneurs Fund, a $10 million initiative, was launched by marketing strategist Harshvardhan Chauhan. We speak to Chauhan of Bharat YEF about this fund. Stay tuned.
He has not had any direct contact, but I can tell he's obviously following the situation very closely and with very great concern. We were very clear in our condemnation of the terror attack that occurred in Jammu and Kashmir on the 22nd, 2 days ago, which killed a large number of civilians. But we very much appeal to both the governments of Pakistan and the government of India to exercise maximum restraint and to ensure that this situation and the developments we've seen do not deteriorate any further. Any issues between Pakistan and India, we believe can be and should be resolved peacefully through meaningful mutual engagement.
Welcome back. You're still with us on Startup Street. The Young Entrepreneurs Fund, a $10 million initiative, was launched by marketing strategist Harshvardhan Chauhan. YEF allocates grants ranging from $10,000 to $250,000 to early-stage pre-revenue ideas, prioritizing societal impact and scalable solutions over traditional business metrics. Joining us now to discuss the fund and its agenda is Harshvardhan Chauhan himself, the founding visionary and chief belief officer of Bharat YEF. Harshvardhan, thank you so much for joining us on Startup Street, and that's quite a designation that you have given yourself there. But, before we get to everything, your career has been defined by scaling hyper-growth startups and redefining brand psychology, right? How has your journey shaped your vision for the Young Entrepreneurs Fund?
Absolutely. I think at the onset, namaskar, Arundhati, and to all our viewers. I'm humbled and it's a pleasure to be at your network and channel. I think, as you rightly said, my entire career had been built around, on both sides, 0 to 1 journey, building startups from scratch, whether it has been contributed in my own writing capacity to very early stage startups, which became a unicorn. At the same time, dabbling into large legacy change management and large corporates with the likes of Godrej, DLF, RP Sanjeev Goenka Group, and Trident Group. I think at a right time, I got the realization of balancing between my karma and dharma, while the corporate endeavors had been my dharma of sustaining my own livelihood. The karma became to endeavor to pick up a bigger aspiration and a challenge, which would become the voice of Bharat. And that's what emanates Bharat YF, where a strong belief has been, where I believe that the VC ecosystem in the country has been largely broken, specifically for the innovators in tier 2, tier 3 sectors, people who are innovating in agri-tech, deep tech, climate tech, and who do not get the opportunity of getting possibly through the doors of a traditional VC. And hence, it's a diagonally opposite approach at Bharat YF.
Right, absolutely. And if we can get to the fund, the Young Entrepreneurs Fund offers grants ranging from $10,000 to $250,000, right? Which is a significant departure from traditional equity-based funding. If you could sort of, tell us which ideas or founders are how do you determine this, are most deserving of these grants? And what are the kind of impact that you're hoping to see in return?
Brilliant question, Arundhati. I think it's a complete departure from the traditional VC ecosystem, where I believe that it's not a few individuals who can decide which idea is the best. It's not few conferences, few pitches, and we wanted to make it truly democratic. So on 14th of April, we made world's first intuitive platform, bharatyf.com Live. It's a platform which is a flywheel in itself. It's India's own Y Combinator. So at idea stage, there are at one level Bharat Karmyogis, who are ideators and who, in a very UGC fashion, submit their ideas with a small pitch which is posted on Instagram for the world to see. Their ideas are visible to the citizens of India, who in a gamified fashion, they're not putting in their real money, but it's like gamified crowdfunding, where they say, hey, I like the idea and I would have ideally put in my own 50,000. So the meter goes on and you can see an impact where the entire Bharat has pledged, let's say 2 crores on a particular business, which is a strong barometer. But the strongest hook of Bharat YF is Bharat Fellowships. Bharat Fellowships are internships ranging from 3 months to 12 months, typically IITs, IIMs, SRCCs, Hindus of the world. And it's one of the world's, we say, most coveted internships, where there's a real VC experience, where the talent of the country from IITs, IIMs directly mentor a grassroots level innovator and completely over the platform, very automated, leveraging AI and ML, which basically means that the flywheel is covering 3 big pillars. Somebody who's an agriculturist and an innovator in the Bhagalpur of Bharat gets a great mentorship from IIT student, and they both come together and they move from an idea to MBA.
Absolutely. We're running out of time, but if you could quickly tell us, with your focus on deep tech, clean energy and rural platforms, what emerging trends or technologies do you believe have the potential to reshape India's economic landscape in the next decade?
Arundhati, on this question, I think I would have a strong synergy with the government of India. What the vision of Narendra Modi ji and Piyush Goyal ji also have been, and he has been very articulate during the startup Mahakumbh. So we strongly believe national IPs, deep tech and agri-tech is the one where we're investing. We're not investing for an exit cycle for next 5 years or 10 years. We're looking for Viksit Bharat 2047. And we have very early backers who are corporate stalwarts, the likes of Devendra Chawla, the CEO of Green Cell Mobility, TC as he's known, and more such corporate stalwarts who have been backing up our fund in terms of not just capital, but a whole lot of intellectual capital, mentorship, etc. that they come up with. And hence the focus would remain to reach out to the tier 2, tier 3 innovators, get the next Viksit Bharat 2047 ideas for agri-tech, for clean tech, for deep tech, and most importantly, support truly the national IPs, which would make India at the map of the world and truly to realize the dream of Viksit Bharat.
All right, Harshvardhan, thank you so much for joining us on the show today, and we wish you all the best on this journey going forward.
Absolutely. Grateful to be here. Thank you, Arundhati. Thanks a lot.
Bustling cities, a new kind of hunger is taking over the appetite for clean, conscious and convenient eating. One brand is not just riding the wave, they've also planted seeds nearly a decade ago. From tech-enabled kitchens to their own organic farms, they built a salad empire, and they've also raised 30 crores in a Series A round, their first institutional funding after operating as a bootstrap venture for over 10 years. Aishwarya Anand puts a spotlight on the Salad Days story.
In India, salads have historically played the role of a supporting character. A few slices of cucumber on your plate or some cucumber on the side of your dal. But can a salad ever become a main event? 11 years ago, this thought was almost impossible. But today, it is a thriving category, and leading the charge is Salad Days. This journey started in a tiny cloud kitchen tucked away in a hidden corner of Cyber City, Gurugram. But the name Salad Days wasn't just about food. It was inspired by Shakespeare's words, symbolizing youthful passion, fresh beginnings, and idealism. And that's exactly what this business embodies. Challenging norms, redefining eating habits, and proving that healthy food can be just as exciting as a plate of biryani. We are here at their organic farm in Delhi, the backbone of their farm-to-fork model, to peel the layers of Salad Days from the roots. So, how did they become a successful health food brand in India? How are they balancing freshness, scale, and profitability? And can they turn salads from a niche trend into a mainstream staple? Well, let's dig in and literally and figuratively into the Salad Days story.
When we were doing trials, this is way back in 2013 end, you won't believe it was so difficult to get 10 kilos of iceberg lettuce of good quality every day. So I realized that solving the supply chain was a very big priority for me at that time. So the farm started to know our raw materials better. I think we grew everything that we could, everything that you can think of, which was seasonal in nature. This season we were harvesting about 10 tons of combined produce from here every month.
What does the SKU currently look like?
The SKUs or the menu categorizations, we just don't do salads, but we do a lot of awesome gourmet sandwiches. We do grain bowls. We do wonderful pita pockets, oatmeal bowls. We do a lot of beverages. We do desserts. So we do a lot of things. And salads in our menu contribute to about 50% of our revenue.
As a consumer, if I am buying from Salad Days, what would my average cart value look like?
We are very, very competitively priced.
Okay.
Our salads start from about 279 rupees, go up till 329, 349, with the median being around 299. So that's our salad cost, plus of course GST and some packaging charges. Our average order value is around 500 to 510 rupees.
So talking about kitchen, you are operating nearly 26 cloud kitchens, 25?
Last night we are at 28.
You're at 20.
Yeah, we opened one yesterday.
28 cloud kitchens. So, how do the economics of scale impact the profitability here?
I would like to open as many kitchens as possible in a city, which would hit a target number in, let's say, 1 year. I feel that as of now in our portfolio, on an average, we should have about 20 kitchens per city of these.
You've been profitable for 10 plus years, even before you got your funding. Where does your revenue stand right now? And what are some of the targets for the end of this year?
We have been growing about 80 to 100% year on year in the past 2-3 years when it comes to top line. And last year we closed at about 31 CR net, and we should be closing again 80%, 100% plus from that, 80 to 90% plus from last year. And probably by the end of this year, I'm going to make my thesis around omni-channel strategy, wherein I would try to go for probably a brick and mortar or some other model.
India's healthy food industry is on a remarkable ascent, projected to touch $30 billion by 2026. Now, startups are at the forefront of this revolution, changing the way we eat one bowl at a time. The space has cumulatively raised nearly $200 million in the last few years.
As innovation meets tradition, technology fuels the taste. One thing is clear. Healthy eating in India is no longer just a fad, it is the future. With camera person Saurabh Chauhan, Aishwarya Anand for CNBC-TV18.
And with that, it is a wrap on this edition of Startup Street. We leave you with a snapshot of the big deals in the startup world that took place this week. More news and updates on the other side. Stay tuned.
Hello and welcome to Market Masters. Today we are in conversation with the top markets team at Nomura. It has been an incredible last few weeks. Massive, not exactly reciprocal tariffs, stock market selling off hard, bond markets throwing a big tantrum, a 90-day tariff pause, markets snapping back globally, with the exception of US assets, dollar US assets which kept getting sold, and over the last few days, some repair and recovery in US assets as well. A complete roller coaster. What is the roadmap from here? Is there a roadmap to begin with? It's my pleasure to speak with the top team at Nomura. We have with us here Rob Subramanian, Head of Global Markets Macro Research at Nomura. Craig Chan is Head of Global Forex Strategy. Sonal Verma is Chief Economist, India and Asia, ex-Japan. Sayan Mukherjee is India Head of Equity Research. Sonal and gentlemen, thank you very much, all of you, for being here. It's been an absolute roller coaster ride. And, I was joking, saying that I'm getting up earlier and earlier every day and getting to office later and later. so much overnight news to digest, right?
Yeah, it feels like what's happened in the last 3 months usually takes 3 years or longer to happen.
Yeah, I mean, and you think of it, it's what, only 10%, not even 10%, 5% of Trump's term, 4-year term?
Yeah.
I mean, if you calculate the number of days. So we're just in the beginning. These trade deals now, I think, is what markets are focused on, Rob. What's your sense? Are they going to get done quickly? Because markets are swinging between optimism to despondency. What is your sense?
I don't think they'll be done quickly. I think trade deals take a very long time to do. Okay. I think the Trump administration will try to dress up some quick wins with some close allies and hopefully try to get some tariffs down. But our view is that once tariffs go up a lot, and they have gone up a lot, we think the effective rate's 21%. They don't tend to come down that quickly. And so our baseline is tariffs are going to stay up pretty high. I think China has quite a bit of leverage over the US, and that trade tension will continue. And ultimately, Trump wants tariffs for revenue as well. So, tariffs are going to have a big macro effect on the US economy, and economies everywhere this year is our bottom line.
So with China, what we've been hearing over the last 48 hours, should we read this as a bit sort of conciliatory, tempering things down a little bit? Or is that reading into too much? I mean, things could change. We could hear something different over the coming days. What's your sense?
Well, look, right now, US tariff on China of 145%. I mean, essentially for a lot of trade between US and China, it's essentially stopped.
Correct.
So there will probably be some coming down. But the point I'd make is...
So between 10 and 145, there's
a big range, right? So
and Trump was, before election, said 60%. So will we get down to 60?
We could get down to 60. And that has been our kind of a longer-term baseline, around 60. But the point we'd make is that's still extremely high. And that is going to lead to a lot of, I think particularly for the US, a lot of inflationary effects. and is going to hurt growth. Rest of the world, it's a different impact. It's more of a demand shock for the rest of the world, lower growth and less inflation. So there's going to be also a disconnect between central bank responses. We think the Fed is not going to be cutting rates quickly because of the inflation. We have the first cut in December. But for other central banks around the world, there's a lot of room for cutting rates. We've just added another 2 cuts for the ECB this week to our forecast. Many central banks we have essentially cutting while the Fed's on hold.
Got that. Do you expect a recession in the US? Or you think we won't get it? I think your house view is that you escape it, but you get pretty close to it, but don't actually see it.
That's where we are right now. So it's very close. So if you look at our growth forecast for Q2, Q3, Q4, it's 0.1% quarter on quarter. So not much margin of error for negative growth numbers there. So very close to recession. We put it around a 40% chance.
What happens on the 4th of July? You said no deals. 4th of July is when the 90-day sort of tariff pause expires. So we get another extension and then these negotiations.
I mean, I think between now and then there could be some deals. But what I'm saying is I don't think all the reciprocal tariffs are gone. I think that some will be coming back.
Okay. I mean, what is, Craig, welcome to the program and great speaking with you. What is your sense in terms of how, I mean, bond markets threw a tantrum and it looks like there is a bond put but no put for equities. Is that the way to look at it? Because as Rob is saying, this is a long drawn-out process, and the big deals are with EU and China, and what really matters for global growth, etc. And if they take a long time, I mean, growth may suffer and markets may swing as well. But have you seen the worst in that sense, dollar assets?
No, I don't think we have. I mean, I just say that what we have seen so far is actually just evidence of some outflow. Right, it's definitely not been broad-based. It looks like it's mainly on the bond side, where there has been some selling from the Japanese investors, from Taiwanese, to some extent Korea as well. But it hasn't been really excessive. There hasn't been much kind of equity-related selling. Overall, in terms of looking at kind of the value of assets in the US, still exceptionally high. You know, we're talking about the last numbers we have. They're quite old, but I mean, it's like 33 trillion US dollars of foreign investment value in bonds and equities. I mean, it's just surged in the past few years. I think we're starting to see some signs of that unfold.
You're saying that foreigners, and especially central banks, are selling US bonds. I mean, that has been happening, Japanese especially.
So we haven't seen it in terms of central banks. The data is actually
so maybe investors,
mixed. It's actually quite mixed. But you know, you have on one hand the Treasury data, which shows you there's some direct selling from Europe. There's some direct selling that's coming from, let's say, China, Asia, ex-Japan as well. But then you have the safe haven, or the tax haven, should I say, places where you have seen actually buying. So it's a bit of offset. There's no consistency really about it on the central bank space. But certainly on the private side, it looks like something is happening there on the actual asset unwind. But I just say quickly, beyond the asset unwind, there's also another element around it, and that is there's a lot of investors that put money into the US that actually haven't hedged out the FX risk. Japanese life insurance companies have low FX hedge ratios. Taiwanese life insurance companies have low FX hedge ratios. So that's another risk. They could start selling more dollars to hedge out the FX risk.
I think that's the interesting thing. I think the central banks around the world have been diversifying away from US dollars, their reserves, for a long time. The new interesting thing is the private sector. Private institutional investors, big lifers, pension funds around the world, are they starting to diversify away from the US?
And the reaction, what we saw was interesting, right? Usually when stocks go down, I mean, bonds go up. But here you had a situation recently when everything was getting sold.
Yeah, long end US Treasuries, equities. It was basically almost get out of the US.
So that phrase US exceptionalism, are we at the end of it? What's your sense?
I mean, I wouldn't push it that far away at the end. I would certainly be saying that it's fading, right? That the evidence we're seeing is that it's fading. But at the end is still quite, you know, I think of a push. It's a push to say that.
Because even if, Rob, everything goes back and they say, well, we've made deals, etc. I mean, it's an issue of trust, right? Suddenly you've thrown everything up and, you know, it's kind of Isn't that is the heart of the issue here? When we say US exceptionalism, I mean, the exceptionalism was about the trust in the systems and the institutions, etc.
I think US exceptionalism means different things to different people. Yeah. I was going to ask you what you mean by that, because
to some people it just means tech exceptionalism.
Yeah, it's true, right? Exactly. And then for others it means the economy. And US is facing stagflationary effects, which is bad. But then the worst case of US exceptionalism is what I think you touched on, Prashant, is foreigners losing trust in the US dollar as the global reserve currency. And as Craig said, I don't think that's clear yet. But in terms of the US economy starting to wobble and less scope for policy support for it, I think that's quite a valued concern right now.
There's been so many different angles, right? It's been from the DeepSeek fears and the impact on AI. Then it moved to tariff policies, non-tariff policies. Then there's concerns about, am I going to get taxed on, if I'm holding US treasuries? It's just a lot of policy, as you mentioned, policy uncertainty for investors. And that is going to reduce the effective overweight that we've seen in US assets for many years. And that's what's happening now.
Fair enough. Sonal, let's come to India. It seems like we're first in line to get a deal. Would you agree?
Hopefully. I think we definitely have a head start. We started the negotiations ahead. The terms of reference have been finalized. India is a strategic ally. Now, deals take time. Agriculture is a politically sensitive subject for us, but there are other aspects of the agreement on the industrial tariff, parts of the non-tariff barrier, buying more of US products, which can easily be done. So I think if we can get the 26% reciprocal tariff down before the deadline, and our tariffs are lower than our competitors, then really in this world, what you're looking for is a relative advantage. And I think
will we have that relative advantage, Sonal? Because others also will negotiate, right? Others will also, for example, competitors in various industries like Vietnam, Cambodia, they'll also want to sort of lower tariffs, their respective tariffs, right? So it's all relative, as you said.
So I think most Asian countries are trying to negotiate with the US. The question is whether what they are offering will be acceptable to the US. One part of the deal is buying more of US products, but for countries like Vietnam, Cambodia, transshipment of China products has been an important reason for the reciprocal tariffs. Also, these other aspects of non-tariff barriers or whatever we want to call them. So, and right now we are seeing China trying to, also talk to Southeast Asian countries. It's putting Southeast Asia in a more difficult position in terms of choosing between US and China. I think for India, it's a lot more clear-cut. We don't have that transshipment problem. And therefore, I do think, relative to a number of our competitors, we do have an upper hand.
I just add that, from what we've heard from the White House as well, it's quite clear that India and Japan are way ahead of the rest. There's 185 countries which have had these reciprocal tariffs. 32 are under discussion. So India's by far ahead.
And the hit to the GDP, etc., is also, about 0.4, 0. But of course, it's a moving number. It's a moving target, right? Does the tariff stay?
Yeah, the direct impact is 20 to 30 basis points, but usually in these scenarios, it is the indirect impact that is more important. So whether it's world growth slowing down, hit on IT services, hit on investments, confidence, uncertainty, etc. So for FY26, our view is GDP growth is likely to slow below 6%. So we're expecting a 5.8%. It is below what consensus and the Reserve Bank are looking at right now. But of course, we've made much bigger growth downgrades in rest of Asia, which are more open economies. So of course, on a relative basis, we should be better off.
Yeah, to put that in context, India, a bit below 6% growth. We're thinking China in the coming quarters is more like 3.5%. As I said, US is close to zero. So, yeah.
Europe, Germany is zero. I think many other parts of the world.
That's right, yeah.
Doing much better. Sign for equities. We're again back to, equities are snapback, right?
Yes.
And FIs are coming back, about a fraction of what they've sold over the last 8 months or so.
Right.
But they're coming back.
Absolutely.
But, very quickly here we tend to go back to high valuations and you're suddenly scratching your heads, now what, right? And they're waiting for earnings. I think your expectations in terms of earnings is lower than the street. That comes off the 5.8% number from Sonal.
Yes. So yeah, Prashant. So basically, when we look at, through the pandemic, like from fiscal 19 to 24, we had an very strong earnings growth, north of 20%. Last year was a slowdown, fiscal 25. Now, fiscal 26 and 27, again, the expectations are around, mid-teens earnings growth. So if you look at, there's a lot of catch-up in earnings which has happened over the last 4-5 years. And if you remember the entire decade from 2010 to 20, we were struggling with corporate earnings, right? Consistent earnings cut. It was bound to happen, natural, sort of going back to a natural level of earnings and ROEs was bound to happen, and it happened over the last few years. So earnings to GDP ratio has bounced back. In fact, it's now very close to 2008, which is, just before the global financial crisis. With the kind of uncertainties, that we are currently dealing with, and if you look sector by sector, right, the profit margins are, on the higher side. And we are seeing downgrades there. So therefore, I think that earnings to grow substantially above, let's say, a nominal GDP growth of around 10% looks challenging, at least in the near term. And that's why we think that we will continue to see earnings downgrade. And on your question on valuations, right? I guess currently we are just shade below 20 times 1 year forward earnings. We have breached 20 times in the past, especially the last few years. But I think, it's very difficult at this point to, foresee that level of valuation. So far, if you look at, there are, certain things which are in favor, like for bond yields are falling, which is positive for valuations. And the risk premium actually hasn't really flared up. It's still behaving.
But that's a risk. That's a risk.
That's a risk.
And your view, Sayan, is local, focus on local sectors, right?
Absolutely.
And consumption, etc. And we'll talk more about that. I have to take a very quick commercial break, here. So allow me to do that. So take that break back with the Nomura top team in just a bit. Welcome back. We're in conversation with the top brain trust at Nomura. So we're talking top-down, macro, economics, and of course, markets as well. Thanks very much, Sonal and gentlemen, for being here on this program. I want to just talk about, Craig, if I can ask you, trade wars are also, in a way, capital and currency wars in that sense. I mean, if this were to continue, what is your sense? Can this, and the Trump administration and so many others, have said it's not about tariffs per se, it's about non-tariff barriers, which countries like Japan, etc., is also perhaps about the currency. We don't know. Will this devolve into something sort of bigger as we go forward? Because this will take time to work itself out.
Yeah, I mean, there's been quite a bit of discussion about this kind of Mar-a-Lago Accord, but then it's not really intensified because it's really been from, if you want to say, the economic advisor rather than from the top level, treasurer and others actually pushing it, as even Trump himself. But I would think that, if we have further discussions around this, the market could really take this seriously and start thinking about, who exactly would be the ones that would be kind of going along to effectively strengthen their currencies against the dollar. But for Japan, there is a lot of focus on it at this point in time, particularly with...
You think at some point in the next 2 years, we will see a revaluation with countries like Japan, even China? I don't know. Is it possible?
I mean, the US Treasury Secretary's already talked about this yesterday, saying that he doesn't have any particular levels that he's looking at for the Japanese yen. But having said that, if it's about, we don't want you manipulating, we want the market to drive the exchange rate, there's still a lot of risks around that because there is, this potential downside pressure on dollar yen, where if there's a sense that there cannot be a buying of dollar yen from the Ministry of Finance, BOJ, then actually it can be a bit of an overshoot. And then the adjustment comes naturally. So I think for dollar yen, that's definitely one that sticks out to us. The rest, not so convincing.
Okay. Rob, cost of borrowing, right? I mean, there's a lot of debt coming to be rolled over later this year. And that was one theory, that they want that cost to be lower. What is your sense? Is this success what we've seen so far, or will we see?
I think the jury is still out on long-term cost of borrowing in the US. I think, on the one hand, there's a lot of talk about recession. We're saying it's close. If the US economy does go into a recession and expectations build of the Fed having to cut rates a lot, you could see Treasury yields come down a lot further. But on the other hand, the perverse situation we've seen in recent weeks where you've had equity markets going down, but 10-year bond yields going up, is raising concerns that maybe risk premium is building in the US. And whether that's because of the fiscal situation or because, as we talked about before, maybe loss of trust or loss of confidence in policy making in the US, that can play a role as well. So I think right now, my biggest suggestion to you is it's going to be very volatile, I think, at the long end of the US curve.
Is it really possible, Rob, that President Trump does not care about the stock market? In his first term, I think we used to see him waking up in the morning and mentioning the Dow, right? And he was proud about how high US markets were doing. Not this time, nothing. There are midterms as well. Sure. I mean, the one theory is take all the pain up front, and then, the good stuff comes later, around the time the market. I mean, you'd want the markets to do well, right? By the time we get to the midterms. You don't
want the markets and the economy to do well by then. But I think, of course, I think everyone would like, all leaders would like their stock markets to be at all-time highs. I think the challenge right now is Trump has shown his hands a little bit with this so-called Trump put. He's come in to try to soothe markets a few times now. And I think the risk is if he really wants to achieve a lot of his longer-term goals, which are going to be disruptive for the economy, markets may test the credibility of that Trump put again and may be disappointed. If he really wants to achieve his longer-term goals, there may need to be economic pain up front.
There's been some talk, Rob, about Main Street versus Wall Street, that maybe is that credible, you think? I mean, that maybe Main Street is the focus and, Wall Street perhaps takes a backseat.
I think that's one way to spin the narrative, right? To say Wall Street has to take some pain. We're trying to bring manufacturing jobs back, boost the manufacturing sector, help Main Street. Another narrative is to blame the Fed, say the Fed should be cutting rates in this environment. So there's a few things here where you can deflect the blame a little bit, I think. But I think ultimately it's going to be very interesting in the coming months. One of the concerns I have with all the tariffs is Main Street, not Wall Street so much, but the small companies that are not listed on the equity market could face a lot of cash flow problems as their costs because of the tariffs go up.
Absolutely. Sonal, what is your sense? Will this China plus one is not new, right? But it's again, I think, got one more lease of life. Is that going to happen? Manufacturing and companies, supply chains moving to India?
I think it's already happening, and the smartphone is a clear example. Even if China tariffs come down, but they stay, let's say, at 60% for the next 4 years, that automatically means that manufacturers will need to look for an alternative, because for the low and the mid-tech manufacturing segments, and I would include the entire bunch of electronics, toys, textiles, footwear in it, these are low-margin businesses. You cannot work with 50, 60%.
In 2018,
tariff.
the shift happened to Vietnam and Cambodia, especially footwear, textiles, etc., right?
That's right.
China.
That's right. But it was also a lot of the Chinese firms themselves that were investing and trading via Vietnam and Cambodia and Thailand, which is one reason why I think actually the reciprocal tariffs on these countries is fairly high. So this is different from Trump 1.0, i.e.
The main difference is substantially higher tariffs in China. I mean, even if it is not 145, but it's not 10, it's not 20, it's higher.
Exactly, which is actually the US goal of strategic decoupling from China, which is tariff on China and higher tariffs on countries that are allowing transshipment to happen, on behalf of
So basic
China.
manufacturing, essentially, right?
I think, yeah, so what we call essentially the low-tech, mid-tech manufacturing. So smartphones, but, the broader electronics, you could think about personal computers, printed circuit boards, more high-end legacy kind of semiconductor chips. Toys, China has a market share of 60% in the world. We are at 0.3%. I think there's substantial scope for India to gain on this front.
Sayan, for an equity investor, what does this mean? I mean, this is all obviously, it'll take time, right, to play out. But in some sectors, maybe we will start to see.
See, I guess, equity investors do look at long term, right? So I think that narrative of China plus one, and as you mentioned, that, probably we haven't seen much of success. But the thing is, we are probably better prepared now. And with the differential tariffs, if it comes in, maybe we get a boost, on that. So I think that narrative can sort of, continue. So I think from a equity portfolio perspective, I think this China plus one themes, should be there. I think, though I know some of that are expensive, but they're still delivering on earnings, unlike many other spaces where we are seeing earnings cut. And if this narrative sort of sticks on or gets a little bit of more boost and people get more confident, I think that's one space, we think one should be positive on. But otherwise, I think wherever you have international demand-related concerns, right? I think whether it is IT services or anything where, you are exporting and you could see a sudden fall in demand, I think that's the space to avoid. So that means, one has to look more domestically and focus on more domestic, sectors.
Sonal, to the point of, and so Sayan said he likes consumption as a play as well. Do you think the RBI, of course, has done a lot to ease liquidity, but credit demand is still slow? Do you think more needs to be done? What is your feedback? Are things going to pick up a little bit in terms of domestic demand itself, or it needs help, more help?
Transmission takes time. So this turn in, policy and liquidity is just 2 months old. Usually transmission takes like up to 9 months. And now you're fighting these global headwinds. So, the effort will need to be double what we thought previously.
So double RBI plus government?
I think mainly RBI, but I think the combination of the rate cuts plus liquidity in terms of, faster transmission. And within consumption, the urban discretionary is more sensitive to global fluctuations, job market. But the rural side, can be a defensive, of course, in this environment. Low inflation is a fairly, big positive for real incomes on the consumer side. So relative to exports and investment consumption, as Shan was saying, should be, better off in the next 12 months.
Last word, Sonal, to you. How long before we see a deal? I mean, do you have a number in mind? How many days? How many months? With India, US?
No, I think the definition of deal is important. The trade negotiations run into years.
Yeah.
It's a deal on goods, it's a deal on services. This is going to take time.
But this is like the COVID emergency. We got the vaccine. I mean, COVID hit in Feb. We got the vaccine in November. So
the early tranche on some bits you could probably agree on by the 90-day. But the first tranche, of course, we are planning by September or October. The big deal, the real deal, is going to run into years.
It could be a MOU in the coming months.
The actual order will take time.
Yes.
All right, fair enough. Sayan, Sonal, Craig, Rob, thank you very much. I have a lot more questions, but completely out of time. So we need to do one more of these over the coming weeks, months, and I think it would be lovely to do that. Thank you very much.
Thank you.
Bye.
Loved it.
Well, that is Market Masters, the Nomura Brain Trust. Thank you very much for staying with us. More coming up in just a bit.
Welcome to Indonomics. The bank Nifty has moved from being a laggard of the markets last year to the leader in 2025. Watch these numbers. The Nifty rose by 8.8% in calendar 2024, whereas the bank Nifty rose only 5.5%. But in 2025 so far, in the first 100 days, the Nifty has risen only 2.7%, but the bank Nifty has rallied 8.6%. Now, the complaints last year were India's old banking model is gone. People are no longer saving via bank fixed deposits, but they're saving via mutual funds. Banks have only short tenure money now and can no longer finance India's capex. Secondly, we were told banks will have to compete very hard for deposits, and hence they won't be as profitable as they used to be. And then there were, of course, short-term problems last year in terms of very tight liquidity, euphoria in unsecured loans and in MFIs, and all that hurt their profits. But then now, has Indian banking turned the corner? Come 2025, the narrative has changed. The Reserve Bank has cut the CRR, the new governor has ensured bucket loads of liquidity that has taken the interbank market to a surplus. Risk weights on NBFC loans to NBFCs have been cut, and liquidity coverage, or the amount of money that has to be kept in low-yielding government bonds, has also been cut this week. All of which has led bank stocks to stage a smart comeback. The question we are asking today is, are banks back to the glorious days of pre-2013 or even pre-2020, when we had 20% credit growth and 4% margins? Or is the current positivity only a relief from last year's very tight position? In other words, are the best days of Indian banking well and truly over? Or is the current rally of the last 2 months signaling the start of another glorious period? For these questions, I have with me an elite panel. I have with me Dinesh Khara, the former chairman of State Bank of India, Suresh Ganpati, Managing Director and Head of Financial Services Research at Macquarie Capital. We also have with us Ashish Gupta, the Chief Investment Officer, CIO at Axis AMC, all banking experts, of course. Gentlemen, thank you very much indeed for your time. Mr. Khara, thank you in particular. Want to ask you first, as the person who has been there, done that, what is the sense you are getting? Can these loads and loads of liquidity still solve the structural problem that banks are no longer going to get easy float?
Well, I think, Lata, when it comes to the RBI steps which have been taken in terms of providing liquidity, is certainly going to help in terms of ensuring that the loan rates come down, because otherwise the policy rates reduction would not have got transmitted into the loan rate reduction. Because typically speaking, the last year the banking system has seen that there was a huge challenge in terms of the liquidity. And I think as far as the structural readjustment is concerned, that has actually happened. And going forward, whether at what pace the banks can grow, to my mind, it's a function of the real economic growth. And plus, maybe, we have seen that in the real terms, the GDP growth has been around 10%, loan growth has been around 12%. And now whatever is being talked about by IMF also, they are actually talking about a little lower growth in terms of the GDP. And I think in terms of nominal terms, it would be somewhere around the same 10% or so. And if at all that being so, I think the banking system can very well grow somewhere in the range of about 12 to 15%, depending upon the capability of each of the bank to garner the deposit. The second question is that, the second aspect which I would like to highlight is that effective from 1st of April 26, this LCR reduction which has happened, it will actually release some further liquidity also. And overall, it is expected that it will further give a jump to the growth as far as the banking credit is concerned, to the extent of about 1.5 to about 2%. The third piece is relating to the co-lending. So this will also eventually help in terms of ensuring that the whole ecosystem is very well greased, and they can underwrite and pass on to those who have got the ability to absorb in the balance sheet. Okay. So I think these are the kind of things which will probably help in terms of pushing the growth.
Ashish, what is your sense? The question I'm asking is, the days of float seem to be over. Even government is not keeping the float. Even that is just in time spent. And so are savers like you and me. My father kept in FDs. I am not, and I will not, maybe even when I retire. So is that slack over for the banking system, and therefore the best days over?
So, Lata, if you recall, I think sometime last year on your show, we had discussed the fact that households are investing in mutual funds actually does not reduce the deposits in the system, right? It changes the nature of the deposit. So you're right, from potentially money coming as float income or savings account, money will come as a fixed deposit account, money will come rather than a retail deposit, it will come as a wholesale deposit. And the nature of deposit changes, but the aggregate deposit growth in the system does not change.
No,
right?
yeah,
And
if I may just interrupt, you got it right.
Yes.
What I'm trying to say is amount of money in the banking system obviously remains the same.
Sure.
But
yeah.
I think Rajeshwar Rao, the Deputy Governor, gave some data in one of his recent speeches that total amount of term deposits have fallen from about 66% of total deposits to about 60%. So the tenure of money is clearly going down. Won't that hurt margins?
Yes, yes. And I think it was a bigger problem when the runoff rate on LCR on wholesale deposits was very high, right? So I think what has been announced last week is very, very important. When the runoff rate on the wholesale deposit has come down, and wholesale deposits therefore also become part of lendable resources of banks. So it's not just retail deposit that they have to rely on for lending. The fact that wholesale deposits can also be used for lending, given the reduction in the runoff rate in LCR, I think is a very important change. Of course, this does not do anything in terms of the cost of funds. So to the fact that the float deposits will be lower, the cost of deposits is going to be higher than maybe what banks have enjoyed historically. But that is something that potentially they can build into the pricing or will have potentially some impact on the margins. Right? But there are multiple levers on margins. What is the kind of loan mix you have? Secondly, what is happening on the deposit rate front, etc. So you have seen already several banks reducing their interest rate that they offer on savings deposit.
Suresh, to wind up this, is there a structural story in terms of banks being hit or no?
Yep. You know, the advantage of speaking after two stalwarts like Mr. Khara and Ashish is that my job becomes much more easier to answer some of your questions. But, you know, let me try to put this in two contexts, right? One, to explain why the banking stocks have done well recently and try to put it in the near-term context, and of course also try to address the structural story. So specifically taking points from Mr. Khara as well as Ashish is the fact that the monetary policy transmission has become easier because banks now have more liquidity with them, right? The fear in the market was that when we were going to go through a downward rate cycle, the repo rate linked loans will adjust downwards.
Yes.
But because there is a heavy competition for deposits and liquidity was continuously being tight, what could have happened here is that you will land up losing margins because of the fact that your loan yields are immediately reset downwards because they're linked to repo rate, but you were not in a position to cut the deposit rates. Now, what has actually changed in the last 2-3 months here is because of this tremendous change in the liquidity stance, what's happened with the LCR rules, effectively the banks have become even more confident and they've gone ahead and cut the deposit rates, right? You've already seen special deposit schemes by HDFC Bank being cut by 35-40 basis points, which is quite a substantial amount. And even savings deposit rates have been cut by 25 basis points. So what this exactly means is what you're going to lose on margins this financial year, you're going to actually gain on margins the next financial year because of lag repricing of deposits. The second part, as far as structural growth drivers and stuff is concerned, look, Lata, let's be honest, I don't think, at least for the foreseeable future, banks in India are going to grow at 20%. Now, there is a demand issue, there is a supply side issue. Demand in the sense that when we were growing at 20% in 2006-07, it was retail which is driving the growth. Then post that, it was infrastructure and corporate capex cycle which is driving the growth. Gone are those days where you're going to see a 30% growth in personal loans and unsecured loans, or for that matter, mortgage loans. And gone are those days where you're going to see 20-25% growth in infrastructure loans or capex related loans, right? So from a demand angle, there is an issue with respect to growth. So we should be happy even if the outcomes are 14 to 15%. The supply side, look, I think all said and done, for every 100 rupees of deposits that you mobilize, unfortunately, 30 gets taken away, right? I mean, though the statutory appropriations will be 22%, I mean, you have to keep a little bit excess SLR to meet the LCR requirements and stuff, right? So roughly it comes out to be 20 to 30 bucks. Structurally, for India to gain greater degree of ability to mobilize and deploy, you need the fiscal deficit to be brought down. You need the government borrowing requirements to be brought down. You need the statutory requirements to be brought down.
But I'm still striking at a smaller point, and after that, I'll go off to the other question. Mr. Khara, you have seen the days when you were having float. Now it is, I think the average tenure of deposits in banks is way lower than 1 year now. Would your sense be that, we have to reconcile ourselves to a slightly lower margin than before? Banks will never be attractive as long as the tax laws don't favor you. Long-term capital gains for equities is 10%. For, fixed income, FD, it is your income slab, probably 33% for most of the savers. As long as you have the disadvantage, the margins are not going to be what they were previously. Is that a fair assumption?
Well, Lata, I think when it comes to the cost of deposit, that is something which you have seen that it has gone up last year also. And even prior to that also, it has been on the upward trajectory. But, when it comes to the kind of action which we have seen in the recent past, is essentially, I would say that it is an effort on the part of the banks to ensure that their names are protected. That is this is a very clear message, because, when the deposit continues to be, still there's the banks are clamoring for more and more deposit, but still we have seen that there's a cut in the interest rate as far as the deposits are concerned. So that is something which we have seen. So now what you are saying is that, whether, the cost is something which is a reality, which perhaps they will try to reduce something, but how much they will have to probably wait and watch, because all said and done, deposit is a franchisee. And actually, when it comes to the savers' interest, that cannot be ignored, because unless and until there's a basic fuel, unless and until savers are taken care of, there will be a challenge in terms of mobilizing deposit.
Let me take a break on that point. Do banks now, to protect their margins, have to go aggressively after cutting their costs, for cutting their operational costs? Because interest costs, more or less, their back is to the wall in terms of the float money going away. That question after the break to my guests. Welcome back to the Special Economics, where we are discussing the fortunes of the banking sector. Are the recent improvements in liquidity and lower liquidity coverage ratio rules only a palliative, or are banks likely to return to their glorious period of nearly high teens growth, 20% growth and 4% margins? I've been speaking with Dinesh Khara, former chairman of State Bank of India, Suresh Ganapathy, the head of financial services research at Macquarie Capital, and Ashish Gupta, the CIO, Axis Mutual Fund. Gentlemen, thank you very much for waiting on. Ashish, let me restart this question about banking stocks when you analyze it as an analyst and an investor now. Do you think banks have to aggressively cut costs, the point that Mr. Khara was making now, because the interest rate maneuverability is less?
No, definitely. I think longer-term profitability, value enhancement really comes in a competitive market on basis of your cost and operating efficiencies. So I think banks will do well if they can really build on the scale and bring down costs. I think the big challenge in terms of cutting costs is going to be that a larger and larger proportion of costs is going towards technology. And the ask on technology that banks have coming on account of A, their large networks, B, the real-time payment system that are being offered free to all depositors, and of course, the increasing compliance PMLA burdens means that they have to continue to invest more in technology. And of course, all of us know the advancements in technology that is happening. All banks, I'm sure, are working on various AI projects. So in this context, for them to be able to scale back on technology costs is going to be very, very challenging, right? I think the other large component, of course, that has historically been there has been the employee costs. That probably, I think the growth rates there have already plateaued. But I think technology spend is something banks will have to keep the pedal pressed hard on. And I think what this will lead to is that there will be increasing differentiation between large bank and small banks. And clearly, scale will benefit the larger banks because what you need to spend on technology systems is agnostic to the size of your balance sheet, right? In many ways. So I think the opportunity that will be there, in my view, for the larger banks to get some benefit of scale and moderate their cost ratios are probably going to be more meaningful compared to the smaller banks. But your question is completely valid that the driver of profitability and the differentiation in profitability will come as much as what banks are able to deliver on their OPEX ratios.
Okay. Well, until now, Suresh will bear me out as well as Ashish. When we were looking at banks, we used to look at NIMs, we used to look at NPAs, we used to look at credit cost. But Suresh, now you have a new parameter. Your last two reports are reporting on how much is the technology spend and how much are employees being, what is the employee strength, plus or minus. So do you think these will be the new parameters for you banking experts to judge banks altogether? We won't just be looking at NIMs and credit cost. We will start looking at tech spends and employee expenses.
Interestingly, if you look at the profitability of the banking system today, and we analysts, of course, give an overwhelming importance to ROA because leverage is a function of the amount of capital that you hold. And accordingly, the ROA will be different. But if you look at it on an ROA basis, the banking system today actually lands up having the best ROA at an aggregate level seen in the last 20 years or so, rather the best ever ROA.
Okay.
Of course, I understand that is more coming below the PPOP line item, right? The provisioning levels have been at rock bottom levels, and that is what has been driving the ROA, and provisioning levels can be a bit more cyclical in nature. Having said that, let me try to deliberate a little bit more on the cost ratios. Look, I think the banks so far have, of course, done a reasonably decent job. If you look at the last couple of years, the balance sheet growth of HDFC and ICICI, they have had a decent balance sheet growth, but they managed to keep the cost income ratios flat, right? Of course, we would ideally want a reduction in the cost income ratios, and HDFC Bank has had a tall target of 40% going down to 30% over the course of next 10 years. But initially, the way this would work here is that while you are having efficiency gains flowing through because of usage of technology, the technology spend itself is keeping the cost ratios, or rather not resulting in the cost ratios coming down. And that's what I wrote in today's report itself, that if you look at HDFC and ICICI on an absolute level, the cost, the technological expenses that they've incurred has gone up 4 times in the last 5 years. Right, that's the scale of technological expenses that's been done. And if you look at some of the global banks with the best technology and stuff, their total OPEX, technology expenses to OPEX is closer to about 18 to 20%, whereas in India, we are at 10%. So indeed, if we have to catch up to them, understand the business models are different. They're more into investment banking and equities, and where the cost ratios could be higher. But nevertheless, even if I were to see 10% going down or going up to 15%, at least in the near term, you are investing for the future. It would not flow into your profitability numbers. You're just preparing for the future that eventually you do this, reach a plateau, and then you will start seeing the benefits of some of those technological investments, resulting in eventually lower OPEX ratios and eventually higher ROA.
Yeah, we are all hoping that AI is going to bring that manna, but first it will be investing in it. You know, I last spoke to KV Kamath. He said credit costs need to come down to 2/1/4. Now, that may be an extreme statement, but do you see credit costs for banks going down even to 30% that HDFC is talking about?
You're talking about OPEX, not credit cost, Lata.
Okay.
OPEX has to come down to 1/4, not credit cost. Credit cost is
Sorry.
Yeah.
I meant OPEX, yeah. Sorry, I meant cost to income, actually.
Yeah, cost to income. Yeah. I mean, that's a very tall aspiration. I mean, it's good to have that, but I don't think in the near term that is something which is achievable. Remember also that banks are growing, they are setting up. You will have, of course, infrastructure costs, which will still rise and stuff, right? So, I mean, not 1/4, that's too much of an expectation, I would say. But yes, marginal reduction, maybe an annual reduction of 100 basis points over a period of 5-6 years itself would be a great outcome, I would say, Lata.
Okay, yeah, I agree, because there are so many tech spends that are looming. Just a final rapid fire from all of you. Mr. Kharat, do you think we go back to the golden days of pre-2013 or even pre-2020 in terms of credit growth and margins?
I would say that we will go forward.
Sir, rapid fire. Yes or no?
Yes, we will.
Okay.
With the economy growing, it is certainly possible.
Okay, Ashish?
So I think both in terms of credit costs and margins, we are already at a very high level. So I think the challenge in stock performance has not been that. I think challenge had been that loan growth for the banking system had been falling. And with prospects of loan growth looking better, I think that is what drives the positivity towards the banks. I think we are very happy with the margins and credit costs they are operating at.
Okay. Rapid fire is not working for me, but Suresh, last word.
No, I mean, I just cannot go against Ashish on this aspect. He's spot on. I mean, look, I think the real challenge today, Lata, here compared to what you have been comparing with respect to 2013 is not ROA, right? ROA today, as I said, is the best seen in the system at an aggregate level over the course of last 10, 15, 20 years. The real challenge is how do you go back to 20% growth? And there are several bottlenecks against that. Of course, Mr. Khara is a banker and always an optimist, but they're in taking a very practical view and the uncertain trumped world that we are living in, I think it's very difficult to argue for a growth greater than 13-14% next year.
No, I take your point, Suresh. We should not have credit growth of 20 and 25% when nominal GDP is only growing at 9 or 10%. That will lead to other problems. But my reference was not to credit growth. My reference was to profitability. Will banks have the same profit rate that they had in the past? I have my doubts on that, but thank you very much for igniting our thinking on those lines. Thank you very much for joining me in this very special edition of Internomics. Welcome to this Monetary Policy Special. The Monetary Policy Committee of the Reserve Bank voted unanimously for a rate cut on April 9th and an accommodative stance, and the minutes of the policy, which are just out, indicate a strong dovish tone in the writings of practically all the members. Governor Sanjay Malhotra has summed up the arguments beautifully in his minutes by saying that with CPI inflation aligned to the MPC's target of 4% and growth moderating, it was logical for the MPC to cut rates and change the stance to accommodative. Strongly agreeing with him were the other members, including Mr. Nagesh Kumar, who has actually very strongly pointed to the hurdles to growth emanating from the global sphere thanks to the US tariffs. Joining me now to comment on the minutes and the state of the global economy and the Indian economy is Mr. Nagesh Kumar himself, external member of the MPC. In a bit, I will also be joined by Abhishek Upadhyay of ICICI Securities PD and Suwadi Prakshit of Kotak Institutional Equities to give us the market impact and market reading of the minutes of the MPC. But first, let me welcome Mr. Nagesh Kumar to the conversation. Thank you very much, Mr. Kumar, for joining me. First, if you can parse the global environment, sir, the way you have written it looks like a recessionary conditions are imminent. Can you tell us how bad this impact can be on Indian growth? Should we be prepared for something less than 6.5?
I mentioned in my statement that there are 2 or 3 things one should worry about, because the meeting happened during 7th to 9th, and that was just exactly 1 week after the 2nd April Liberation Day announcement of President Trump, where he slapped very high tariffs on every country. Now, some of our Indian economists and analysts are reading something positive in it, because India was, sort of slapped with 26% tariffs vis-a-vis other countries, our peers, a much higher, percentage. So we were taking a bit of relief that we may be spared lightly, and we may actually be able to make more inroads in the United States market because our peers are facing higher tariffs. Now, but that is only part of the story. The second part of the story is that China, which is facing 145% or 245% kind of tariffs, and that means they will be really eased out of United States market, and the kind of excess capacity they are sitting with and the deep pockets, they will begin to dump that capacity in Indian market and in our other destinations of exports, EU, UK, and rest of the world. So we may be getting a hit in our exports and in our domestic market, domestic production as well. And the third thing I pointed out was that there is a serious risk of a world economy getting into a kind of a prolonged recession, which may impact India and the economy also like any other. So there is a compounded kind of thing, but that is all evolving situation. One has to see how the negotiations that different countries are having with the United States are able to bring them down, these tariffs. And then what else is done to support the growth and not allow it to go into recession globally. So all of these are open questions which we will find answers to in the next half a year, 5-6 months, are going to be very critical. As of now, I mean, there is some decline in the projections, like RBI projection for India for 2025 and 26 was 6.5% growth rate, but IMF has come down and has brought it down to 6.2 for 2025 and 6.3 for 2026 for India. So there is already some kind of a downward, pressure on the growth rates projected for India, but one has to see how the situation evolves.
Okay. No, Mr. Kumar, you're very strongly pointing out to instances of Chinese dumping in other countries. So do you foresee a very good possibility that inflation in our country may be actually even less than the 4% that Reserve Bank has now forecast for this year?
I think inflation-wise, we are now seeing not so much of an issue. First of all, the crude prices have come down below $75 to a barrel. And all other commodities are also heading downwards because Chinese economy will be slowing down. And that is a major source of consumption of these commodities. So that is one factor. Then the projections of our monsoon, our predictions of our monsoon are going to be that it is going to be the normal one, and that helps in keeping prices in India in check. So I think from every sort of region or direction, you could feel very much convinced that inflation will remain range bound, so to say. And different surveys are also projecting the sort of inflationary expectations.
He has not had any direct contact, but I can tell he's obviously following the situation very closely and with very great concern. We were very clear in our condemnation of the terror attack that occurred in Jammu and Kashmir on the 22nd, 2 days ago, which killed a large number of civilians.
Good evening. You're watching Reliance Industries special earnings broadcast. We have the bottom line with us. The company has reported a consolidated net profit of 19,407 crore, and this is ahead of the CNBC-TV18 poll of 18,150. So Reliance Industries' bottom line has beat street expectations. On a year-on-year basis, it's a growth of close to about 2.5–3% ahead of consensus expectations. Top line too, at 2.61 lakh crore, is ahead of consensus expectation. The CNBC-TV18 poll was for 2.42 lakh crore. Compared to that, the company has delivered a top line of 2.6 lakh crore. So this is a significant growth seen on a year-on-year basis. Broadly, while we await the segmental detail, what is expected is the retail is likely to do well on a year-on-year basis. Jio will benefit from the pass-through of the July tariff hikes because the company still has a higher percentage of annual recharge customers, which means not just in the July, September, December, even the March quarter will benefit from the tariff hike. So Jio is expected to have a good quarter. Retail is likely to do well as well, and that's going to be the key focus area. On the other hand, the oil and gas, the energy business, both oil and gas and O2C is likely to remain subdued, but we will await details on that. The consolidated EBITDA has come in at 43,800 crore approximately, and that is in line with street expectations. EBITDA margins have come in at 16.8%. Consolidated EBITDA at did I read that? Yeah, 43,832 crore is in line with street expectations. So prima facie, this looks like a good set of numbers, and we're just trying to get some more lines. I think it's the first Indian company to have a net worth of over 10 lakh crore. In 2024, Reliance Industries, a ticker team tells us, was the first Indian company to hit 20 lakh crore in market capitalization. And now it's crossed the 10 lakh crore in terms of a net worth. So milestones for Reliance Industries as India's biggest company continue to pour in.
Milestones indeed continue. You know, you're looking at a net worth of 10 lakh crore after hitting a revenue of 10 lakh crore in the previous financial year, and the market cap, like you pointed out, in 2024 of 20 lakh crore as well. And I'm looking at some of the segments. In the O2C segment, of course, there have been weakness in cracks globally, but Reliance has, done better in their domestic business out there. What, according to me, is the toast of these numbers, the retail business once again, because most of the street was expecting, some moderation on account largely of a high base, and at the same time the consumer sentiment. Remember, third quarter we saw record revenues for the retail business, 90,351 crores. Guess what? In fourth quarter, the retail revenues have grown 15.6%. No brokerage was expecting that, and add to that, the EBITDA in the retail business has grown 14.4%. A swathe of brokers were expecting EBITDA growth of anywhere between 10 to 12%, with an outside chance of around 13–14% as well. Some saying, if the growth is close to around 15%, it will be a very big positive surprise and be the driver for the stock as well. So retail definitely shines bright this time around.
What's the EBITDA for retail?
The retail EBITDA growth is 14.4%. The absolute EBITDA is 6,721 crores, marking it the fifth straight quarter of retail EBITDA margins being between 7.5% to 7.6%. So steady margins good revenue growth coming in, mid-teens revenue growth. Remember, value retail so far in this quarter has done well. We've seen about 15-16% growth for D-Mart. We've seen 17% growth for V-Mart retail as well. Trent, even though it's grown at a slower pace than its history, it's grown at around 28% itself. In that, Reliance Retail on a base of 76,000 crores, growing 15.6% is extremely strong. And quarter on quarter, there is a moderation of 2%, but that was totally expected. In fact, what was expected was a lot worse than this, largely because the third quarter is the festive season. So you did 90,351 crores in the third quarter. The fourth quarter, you top it up with 88,637 crores in retail revenue. Well, the street should give 2 thumbs up, at least to the retail business, especially given the sort of growth that the companies reported in both their revenue and EBITDA. Mid-teens sort of growth is higher than most analyst estimates out here.
You know, I was just reading a JP Morgan note, and this is the preview note, and they're emphasizing the importance of retail's numbers in this quarter's earnings. They're saying we're building in a 12% EBITDA growth, but this is the segment most difficult to anticipate due to the recent volatility. Outcomes in retail are likely to be the most significant stock price driver. Growth of 15% or more can be a positive surprise, which is what they've delivered at 14.7%. No.
14.6% is the EBITDA growth.
14.6% is the EBITDA growth. So they're saying of 15%, they're talking about the EBITDA. They're building in 12% EBITDA, but they're saying if the EBITDA growth is 15% or more, it will be a positive surprise. And if it was a mid-single digit EBITDA growth, that would have been a negative surprise. And they keep emphasizing, and this is across multiple, analysts and brokerage notes, that retail is going to be the big stock driver because growth for retail has been subdued. I was just checking. In Q3, EBITDA growth in retail was 9.4%. In the quarter prior to that, it was 1.2%. In the quarter prior to that, that's Q1, it was 11%, which basically means over the last 3 quarters, EBITDA growth for retail was subdued. And that was one of the reasons why the stock was a bit of an underperformance.
So if you look at the retail revenue as well, you have it up on the screen for a trend. The last 4 or 5 quarters, it's been subdued around that 76,000 crores, which is a big number. No 2 ways about that. But it's not grown as much, and that's largely because in the previous year, you had the B2B business come in as well. So there was a high base, and consumer sentiment in general was fairly subdued. The last 2 quarters tell you that, one, not only the consumer sentiment has improved, but secondly, Reliance's own footprint is increasing. Their own foothold in retails are increasing, as are their footfalls. And all of that is amounting to a big growth in their EBITDA in the third quarter as well as the fourth quarter. The reason why the third quarter stood out was because of the festive season. So the street believed that maybe around that 77,000 crores was the norm, and the third quarter was the exception with a 90,000 crore revenue. Well, that stands to be corrected now because the third quarter was not an exception. We see a structural upmove in the quarterly retail revenue. Now it's coming at around 88,637 crores for the fourth quarter as well, telling you that the funk is back in retail's growth. And also, we've seen the EBITDA grow as well. The margin trend comes up for you, steady as she goes. For the last 5 quarters or so, the retail margins are close to around 7.6, 7.5, 7.7% itself. Very, very steady on that base and mid-teens growth. Let's go across to Prakash.
Just one more word. We'll just shine light on the energy business before we go across. Now, while retail has done very well, the consumer business is doing well for Reliance Industries. The energy business has been a tad bit subdued on expected lines. So the EBITDA for oil to chemicals business is down 10% year on year. This is on account of weaker transportation fuel cracks. And even the oil and gas EBITDA has declined by 8.6% year on year. This is on account of lower KG D6 production. And I think there was this one-time maintenance activity that some people were talking about. So it's the consumer business doing very well. In particular, retail, we're still awaiting Geo's numbers, but it's likely to be a good quarter, but still awaiting Geo. So retail done very well. The energy business, both O2C and oil and gas, have seen an EBITDA decline year on year on expected lines.
All right, so let's go across to Prakash. Prakash, so far what we've read from the numbers, it appears that the negatives were expected and the positives were a surprise. What do you make of them?
No, absolutely. I agree and very well explained on the retail side. Retail as a segment is fairly complex and Reliance Retail has actually been evolving itself brilliantly, including having taken tough decisions like closure of stores, stoppage of certain products. And over a period of time, you see the robustness, the way the earnings have kind of grown. The revenue might not have grown significantly this quarter because, as you rightly explained, last quarter had the benefit of the festive season.
But this kind of EBITDA, this kind of consistency in EBITDA, I think is very difficult to haul along. And the other players where value retail has probably started benefiting or contributing more to the business is also something where they've been able to capture that. So they're not skewed towards any one particular segment or a theme which can kind of be very negatively impacting the earnings. So I think it's a brilliant set of this thing. And at this scale, Mangalam, and you know this, this kind of margins, this kind of businesses with EBITDA of 14% plus, you cannot have at scales which are very big. Reliance does not only reach that scale, it's also probably getting itself more capable of scaling up further from here in the right way, because they've learned from the mistakes, they've started following the good stuff. So yes, the disappointment or the softness that was expected, especially on the O2C business, is evident. But the surprise is from the retail, and I'm sure, as Rima would probably add, Jio will also have a decent quarter because of the price hike that would be fully digested and reflective in the numbers. So pretty surprisingly positive set of numbers for sure.
I have to tell you something. If you look at just the segments and look at the retail annual revenue itself, the annual revenue for Reliance Retail is much higher than the market caps of most companies on the Bombay Stock Exchange. So if you look at Reliance Retail this quarter, while it's done about 88,000 crores in revenue, their annual revenue is a lot more. I'm just looking at some of the numbers for Reliance Retail. The annual revenue this year would cross 3 lakh crores, and that is bigger than most market caps in on the BSE. If you look at the annual EBITDA as well, is fairly large. You're looking at an EBITDA of close to around 26,000 crores annually from just one vertical. That again is larger than most companies' sales itself. So Reliance Retail, definitely the value driver. Now the only trigger for Reliance Retail and Reliance going forward would perhaps be, the promised demerger of the companies or value unlocking exercises that would take place in Jio as well as Reliance Retail. So far looking extremely strong, these numbers. We also have Sunny Agarwal of SBI Securities joining in. Sunny, retail is doing well, but what do you make of all the other numbers that have come by on Reliance so far?
Good evening. Obviously, retail seems to be doing well. So anyway, I think we are penciling 10 to 12% kind of sales, EBITDA and PAT growth for the retail business for a full year and as well as for next 2 years. So I think pretty much in line with the expectation number as far as Reliance Retail business is concerned. I think the main growth driver for the company going forward will be the telecom business, where because of recent increase in ARPU and at the same time likely further increase in ARPU tariff by maybe in the second half of FY26. So we believe that the telecom business has a potential to deliver revenue and EBITDA CAGR of close to 15% to 20%, 15% and 20% respectively over the period of next 2 years. Sorry, I don't have details of telecom business as of now, but I'm sure that last quarter, that is quarter 3, the blended ARPU was close to 203 rupees. And for the quarter 4, we were expecting that blended ARPU should be in the range of 206 rupees. So again, in case you have telecom, details of telecom number, it will be great if you can share that number.
No, Sunny, as of now, we don't have the Jio numbers, but even my CNBC-TV18 poll, which was across many brokerages, had thrown up the expected ARPU at 206 crore versus 203 crore that we had in the prior quarter. But the question is, Reliance has been a bit of an underperformer after hitting highs of 1,600, I think, in July. The stock hasn't done too much. Is there enough juice in the numbers to warrant a re-rating or a big up move from here on?
Again, what I would say is that our some of the parts fair value of the business is close to 1,500 rupees with an investment horizon of 12 to 18 months. But again, I believe the trigger from here on for Reliance to move in terms of stock price will be listing of or any guideline in terms of listing of the retail or telecom business. So I think that can be one of the big value unlocking measures as far as Reliance is concerned. Anyways, it was penciling kind of muted growth from oil to chemical as well as EMP business from the Reliance. So I think ultimately a revival in retail business definitely augurs well. I think at least from here on going forward, I believe the stock should start gradually outperforming the broader market.
All right. So, we also have Naveen Kulkarni with us. But Sunny, just before we move on to Naveen, you spoke about the sum of parts fair price at 1,500 rupees. How much do you attribute to retail in the overall scheme of things? And how much do you attribute to Jio, if one was to look at Reliance that way?
So if I look at the Reliance retail business, the value ascribed is close to 600, 620 rupees, and Jio number is close to 500, 520 rupees. So if I combine the entire consumer business, that value comes to close to 1100 to 1150, 1160 rupees.
Got that. Naveen Kulkarni is also with us. Naveen, share your initial thoughts. We have the retail numbers and the energy business numbers. Your thoughts on Reliance's, your first cut, and how would you assess the risk reward for the stock now?
Yeah, so overall the numbers look slightly better than expectations. The O2C business was anyways expected to be weaker this quarter. But I would say that sequentially I can see some bit of improvement happening, and that is a positive. So there is some scope for, I would say, that upgrade which comes in the O2C business, although the business continues to remain in a tough spot globally. However, I would say retail business as well as the telecom business both have done well. Retail business, of course, we were not expecting, we were expecting a decline on a sequential basis. From that perspective, the numbers look quite okay. So they are again better than expectations. Jio, of course, the numbers are good. So overall, I would say that broadly the numbers look better than expectations. Some scope for upgrade is there. So probably we can say that there is a little bit of potential that is coming across, that we could see some bit of re-rating happening from here.
All right, we take that point. Prakash, just to complete that point on Reliance Retail scale, FY25 revenue for Reliance Retail has been 3,31,000 crores. 3,30,943 crores to be specific. And that's, if it was a listed entity, then 3,31,000 crores as a sales itself would be higher than almost all the companies in market cap. Only 20 companies in the market right now have a higher market cap than 3,30,000 crores. Reliance Retail EBITDA for FY25, 25,094 crores. Guess what? You have the other players, DMart, for instance, annualized EBITDA close to 5,000 crores. Trent has annualized EBITDA of 2,500 crores. You have all the others. Put all of them together, they will still be a sum total of 10,000, at best 11,000 crores. So Reliance's annual EBITDA for the retail business is 2.5 times the entire industry put together. And sales, 3,31,000 crores, is equivalent to market cap of all but 20 companies in on our bourses. So definitely, if the value unlocking were to be announced soon, it would be quite a company. I mean, by its own measure, it could be a $100 billion company.
So, Mangalam, I think interestingly, if you give it a multiple of EBITDA or price to sales, whatever you want to, it'll be so significantly large, and then just come down to a 25% float on that. And you know how Herculean the task is to come with that kind of a float in the market. So you need the market environment to be really robust and positive to be able to sail through for such a big float. And that's precisely where timing or timelines will be very important in this case. It gives the opportunity for a lot of global investors to participate in a listed space, in listed entity of one of the fastest growing retail markets in the world. So, you see this when you go to Europe and places, you see how retail has actually had a decay over the last many years. The consolidation that's happened, the number of players has come down, and nobody is as big as what they used to be. This is exactly where Reliance starts offering a very good proposition. And there could be some comparables with Southeast Asia maybe, but my sense is it's going to be, and Mr. Ambani in one of the AGMs did say that retail is going to be the future growth engine for the company, and that's exactly how it's panned out. So, just tells you that don't miss a single word on from the AGM speech as it happens after 60-30 days. So, it's interesting that retail and the consumer business, as even Sunny was explaining, is finally ended up dwarfing the original business of O2C and now energy, right? So it's crazy the way the energy business can also start scaling up at some point once hydrogen starts getting into commercial phases. So I think there's no reason for any of the businesses to be looked in askance or looked at with any kind of skepticism in terms of growth potential. What retail has shown you, and you mentioned this earlier, that the scale at which they now operate, they can only grow from here. It's not that they've reached a level where you start seeing stagnation come through, or some saturation of market segments. In fact, there's much more that they're doing in all the themes, in all the segments. So pretty wonderful the way it's set up. I mean, the numbers don't speak the way the story is turning out to be more beautiful than what the metrics will tell you.
No doubt. The scale of retail is astounding. But remember, retail has an EBITDA of 7.6%.
Yeah.
The Geo business has an EBITDA of more than 50%.
Yeah.
So in terms of an EBITDA contribution, for Geo, at least last quarter, I don't have the EBITDA for this quarter, was about 15,500 crore. And for Reliance Retail, this quarter, the EBITDA is about 6,700 crores. So in terms of top line, it dwarfs the other consumer business, that's the digital or the Geo business. But in terms of EBITDA, the telecom business commands higher margins. By the way, we have the Geo ARPU and the subscriber numbers, and they've come bang in line with expectations. So subscriber base stands at 488.2 million subscribers. This is an expansion of 6.1 million subscribers on a quarter-on-quarter basis. ARPU for the company stands at 206 rupees, 206.2 rupees. This is an improvement of 1.4% quarter-on-quarter, and on a year-on-year basis, it's an improvement of 13.5%. So this is the residual impact of the tariff hike that we were talking about. So, the Geo performance has been driven by a good subscriber addition of 6.1 million quarter-on-quarter and an ARPU expansion. And ARPUs for the company have now expanded for the third consecutive quarter, benefiting from the July tariff hike. Nitin Soni is now with us from Fitch Ratings. Nitin, okay, we'll get to Nitin in just a bit. But Sunny, you were waiting the Geo numbers. We still don't have the, at least the top line and the EBITDA, but the subscriber and ARPU gives you a picture, and the ARPU is bang in line with your expectations at 206.2.
Yeah, definitely. I think so. We were penciling a number of 206 and slightly better than expectation as far as ARPU is concerned. And again, going forward, what we feel is that maybe second half of FY26 is when we can see one more round of tariff hike from all the telecom players, and that should further contribute to the growth during FY26 and 27. So on a blended basis, we are penciling close to 10 to 11% kind of annualized tariff hike during FY26 and FY27 period. So the blended ARPU should ultimately move from current exit rate of 206 to maybe 240, 244 rupees over the period of next 2 years. So again, I'm again repeating the same thing that telecom business is something which will be one of the key growth driver as far as EBITDA is concerned for the bank for next 2 years.
While we speak about Reliance Retail, don't lose sight of Reliance Consumer Brands. Basically, the FMCG, verticals that Reliance had seeded through their own brand, some of the acquisitions and all of that the company did. The consumer brands have actually become the fastest growing FMCG company in India. In the second year of operations itself, Reliance Consumer Brands has achieved a turnover of 11,450 crore sales in their second year of operations. And just to give you perspective, it took Nestle almost 60 years of operations in India to go ahead and cross that 10,000 crore mark. It's almost at par with annual sales of established FMCG companies, the likes of Britannia, etc., when it's crossed that 11,000 crore mark in its second year of operations itself, making it among the largest FMCG companies in the country, second or third only to the likes of HUL, ITC and the others. So among the top 5 FMCG companies for sure, and in its second year of operations itself. Campa, they had said in the last quarter that we'll do about 1,000 crores of sales in FY25. Seems like they've achieved that with the consumer brands having done close to 11,450 crores. But one thing that everyone would nitpick about is that Reliance Consumer Brands sell only in Reliance stores, and as a result of which they are getting that scale. That's not the case. In fact, they said that they've continued to expand their reach to general trade outside of Reliance stores as well, and that in this period has grown 3.5 times. So obviously on a low base, their expansion beyond Reliance's own network itself has grown and at a much faster clip than everyone else. So 3.5 times year-on-year growth sales in Reliance's own consumer brands. Retail footprint, 19,340 stores is what they have. Digital and new commerce continue to contribute 18% of the company's sales, and their own brand sales. Everyone's talking about their own brands growing in proportion to the overall sales in the company, and that supporting the margin. That itself has grown by 30%. So overall, retail sales grown at 15%. Consumer brands for Reliance, 11,450 crores in terms of annual revenue. General trade growing 3.5 times, and own brands sales growing at twice the pace of overall retail sales.
Okay, so for those of you who've just tuned in, let's do a quick summary of Reliance Industries Q4 numbers. The company has reported a strong quarter. The company's top line has come in at 2.6 lakh crore. This is ahead of consensus expectations, 2.61 lakh crore. We were working with 2.42 lakh crore, but for Reliance, the EBITDA is most important, and consolidated EBITDA at 43,832 crore is an improvement of 3.1% on a year-on-year basis. Here, you can easily break that up into two parts. It's the consumer business, which is retail, digital doing well and contributing to the growth. Retail EBITDA up 14.4%. The digital EBITDA, which encompasses Jio in itself, is up 18.5%. But on the other hand, the energy business has been slow, impacted by weaker transportation fuel cracks, lower KG-D6 production. So the O2C EBITDA has fallen 10%, while the oil and gas EBITDA is down 8.6% year-on-year. But on the whole, the EBITDA is still strong and coming in line with expectations. But the street will cheer the retail performance, which has come in at 14.5% in terms of the EBITDA growth. And this was seen as one of the big factors why Reliance Industries can re-rate in terms of a share price. Jio has performed in line with expectations. The margins for Jio have actually come in pretty strong at 53.9%. This is ahead of expectations. Subscriber growth robust. And subscriber growth was lacking for the company. In the prior quarter, it was just about 3.3 million. In the December quarter, they had lost subscribers by more than 10 million. So the fact that they bounced back with a 6.1 million subscriber addition in Q4 is a positive. And ARPU addition, that's the pricing, continues to tick up for the company. And also, this is the quarter where the company has crossed 10 lakh crore in terms of a net worth. Just quick final words coming in from our experts. Prakash, your thoughts on Reliance Industries share price over the near term?
So I think these numbers do support a lot of interest, and there's been a little bit of that accumulation that has started since March, if you notice, in a lot of domestic institutions. Of course, FIs haven't been active, but as and when their money keeps coming back, I'm sure there's a lot of allocation that would come to this underworn name. The other thing that will happen after these numbers is people will be, very keen on understanding what's the plan for the future from the AGM notes, and that AGM will become very quintessential to understand timelines or intent in terms of any kind of a demerger of one of the businesses, whether it's Jio or whether it's the retail business. So I think the market will start anticipating a lot of triggers to it, but the negativity that was around the slowdown in the O2C business, the challenges that we faced in the quarter gone by, seem to have been completely offset by the growth. And remember, I mean, ARPU of 206 is, and the EBITDA margins that you mentioned, I think 53.9. The last time you had that 53% mark was when the price hike happened, right? So it's just that we've started coming back to a stage where it's maturely come to subscriber addition and a combination of higher ARPU. So that also will get re-rated. All said and done, it'll probably be back to its 1550, 1600 zones at some point in time. But Reliance don't anticipate it will move on Monday. It's always something that kind of takes time for that build up. But yes, I think definitely the downslide is, if not completely stopped or likely to stop, it's probably been paused for the moment given these numbers.
All right, take that point. Sunny, your target price already is 1,500 on the stock on Monday. Basis these numbers, what do you think investors should do? Buy it?
Yeah, I think definitely. I mean, if somebody has got a investment horizon of more than 12 months, definitely it's a buy in a long-term portfolio with a price target of 1,550 to 1,600.
Right, gentlemen, thank you so much for joining in for this exclusive special coverage of Reliance Retail's earnings. Seems like from the
Reliance Industries.
Reliance Industries earnings, retail included. Retail, of course, was so good that, you know, I couldn't take my eyes off that itself. But, you know, the short point is that the weakness was already expected and the positives are a surprise.
Okay, so Reliance Industries delivers in Q4. And with that, we're going to call time on this show. Thank you very much for watching this special coverage. We'll be back with more news and updates. Don't go anywhere.
We very much appeal to both the governments of Pakistan and the government of India to exercise maximum restraint and to ensure that the situation and the developments we've seen do not deteriorate any further. Any issues between Pakistan and India, we believe can be and should be resolved peacefully through meaningful mutual engagement.
Wasn't happy with it, and we're in the midst of talking peace and missiles were fired, and I was not happy with it. That's what I'm putting a lot of pressure. You don't know what pressure I'm putting on Russia. They're dealing. You have no idea what pressure I'm putting on Russia. We're putting a lot of pressure.
Can you maybe tell us?
We're putting a lot of pressure on Russia, and Russia knows that, and some people that are close to it know, or he wouldn't be talking right now.
Wall Street ends the week in the green with the benchmark soaring nearly 1% while the mid-caps outperform. Hello and welcome to another edition of Editors Roundtable. Over the next 30 minutes, we'll decode the week's market action. We'll put the spotlight on the IT earnings. I am Rima, and with me are Nigel, Nimesh, Prashant. And joining us here in the newsroom is Hiren Ved, Director and CIO of Alchemy Capital Management. Hiren, great to have you here with us.
Thank you.
Hi guys, another week of gains.
Yeah, towards the end we actually gave up a bit. So
we gave up a bit, but we still clocked in about.
It's been a good week. Yeah, it's been a good week because because of the expiry as well. I think it helped the momentum. Now we need to see how May series pans out. Big earnings will come. Earnings have started disappointing too at some level at the margin. So yeah, need to see how it pans out. But yeah, April was a very good series. I mean, and honestly, but you know, I was talking to a lot of fund managers and investors. A lot of people have missed out as well in this rally. Not many could participate, and you know, could have anticipated such a big move of 2,000 points, 2,200 points in last 10 days. So there is a bit of miss out feeling as well.
Well, that's right. From October to February, you had 5 series when the bears were on top. Yeah. And suddenly the bulls have pulled back in the last 2 series or so. Sell-in may and go away. Will that play out? Or will the bulls build onto those gains? That's something that we'll be focusing on.
Let's ask Hiren as to what is he doing. Hiren, you've been investing in this fall?
We were consistently investing in the fall, right? So, to that extent, we benefited from this,
sure.
Very smart rise that we saw from the lows that we've seen. Again, I mean, we don't try to take so much a call on the market as much as the underlying stocks that we own. So when markets fall and correct, it gives us an ability to buy more. But I think Jan-Feb were definitely, the swiftness of the fall was fairly dramatic.
Yeah.
And the breadth of the fall was also fairly dramatic. But I think we bought all through that fall.
Okay. This is the only fall, Hiren, you think, this year, or you'll get one more round?
Difficult to say.
What happens is when you're not, as Nimesh said, when you're not able to buy first time, not you, but then you're thinking, ek aur aayega to lunga.
This time you got the second one. You got 21,900, then you got 21,700. Now,
But Hiren, the local risk factor which has emerged this week was the Pelgam terror attack, right? So how do you expect, how worried are you about that? And, should investors be cautious?
I think it's natural to be cautious because, quite ghastly from a humanitarian perspective, and I think India will and should respond at every level, whether it's diplomatic, economic, and also potentially military, right? The problem with something like that is you don't know how long it lasts, what the escalation is going to be. But if you go back and look at all historical such events, by and large, you've had a knee-jerk reaction and then markets have usually clawed back, right? Unless obviously you have a very long-drawn geopolitical issue, which I don't think, it's very difficult to predict something like this. But it's quite natural that people might sit on the sidelines for a while to see ki kya ho raha hai, let's see, what's happening. And then normalcy will return. I mean, I personally feel that the level of global support that India will get this time around will be of a very different order than all the previous events where we had to go it alone, so to speak. And that could be a big difference, in my opinion.
The problem, though, is, even with all the military support, it's a country with, very unlikely hopefully, we need to respond. But at the end of the day, it's like it's a pretty much a failed state, right? I mean, what do you do? But a failed state with nukes. So
correct.
That's the problem.
And there I feel, Prashant, that, while our response will be adequate, but India has never been irresponsible in that sense, right? Because I'm sure that the leadership, the political leadership, has a much broader viewpoint of the economy and the country, rather than, we can't act like ruffians on the street, so to speak, right? So I think we've always conducted ourselves with a level of maturity, and I think that will continue. But we also need to communicate that, we can't put up with
show
this
strength
bullshit,
as well,
right?
absolutely. Hiren, so let's just get back to the market. What have you bought? Give us a few things that you've done. Maybe that'll give us a segue into specific sectoral discussions. Give us some ideas.
So I think, Prashant, we don't change our portfolios too much, frankly. But if you really look at what has happened, I think that we did get an opportunity because of the tariff issues where sectors like pharma, sectors like IT, corrected quite sharply. And we selectively actually added to our exposure there, right? because too often have we seen that the markets are too consumed with a near-term narrative of saying, okay, now, there could be a potential tariff on pharma, so, all stocks get hammered. But as more mature long-term investors, we have to understand that no sector loses a competitiveness because of something like this. And now it's a different factor that we are seeing a lot of dialing down of that, fear as well, right? And the same is the case with tech as well. Though tech is a little bit more serious in the sense that there genuinely is uncertainty and, it will impact growth. But then there are always outlier companies which tend to do better when the general industry is not doing well. So you get to have an opportunity. The other area which we found interesting was the whole capex investment story, which had slowed down in the last 6 months, right? And stocks corrected thereafter. Our belief is that there are certain sub-segments which will continue to grow irrespective. And again, the market is giving you an opportunity because the last 6 months were not great or the last 2 quarters were not great, but you are really looking beyond 2 and 3 quarters. So there is always something to do in the market. So I think to put it very simply, we went counter-cyclical to every temporary narrative which was seeming to be challenging and bought and doubled down on those sectors actually.
And IT actually, I was just looking at returns for the week. I mean, lots of stocks are up 10, 12, 13%, but for the year, of course, they're still in pain. So pharma, IT, and pockets and capital goods.
Yeah.
Essentially. One phenomenon I've noticed, I don't know if you guys have noticed, and I spoke with the Nomura team, it's a very stark difference. All the economist folks are all very bearish, but as they say, economists were, that's their job. But the market folk are also not, actually the difference is not so much markets and economists. The global guys actually are all very, very circumspect about what's going to happen about growth and hits to growth. Whereas locally, when we speak to and interact with fund managers, it's slightly more bullishness. Do you sense that at all? At least that's what I feel when I read and speak with, and we do on to global.
I guess we both are doing our jobs. The global guys are worried about global macro. I can understand that, but I think there is, there is also a feeling that perhaps India will come out tops in this whole geopolitical trade tariff environment, because our problem is not as big as what the US has with China. And usually we end up with a collateral damage. This time we might end up with a collateral advantage, right? So I guess that is also a little bit of that underlying stuff, that the principal trade adversary is not India actually, it's actually China. And does that open up some opportunities for Indian sectors and Indian companies to even more deeply get aligned in global supply chains? It could be quite interesting, right?
Like the word, collateral advantage for India. But let's talk about IT, because that was a sector which looked challenged till last week, but has rebounded very smartly. Up more than 7% for the Nifty IT index this week. But bear in mind, till last week, the index was down 25%, sharply underperforming. And plus, there were lots of shots in the system which got corrected. And then the FIs came back in the market, and FIs historically have favored IT stocks along with banks. So that could have also added to the buying. But the point that Hiren was making, that there are outlier stocks, and the outlier stocks, so far at least, were always the persistent Coforge's emphasis. And once again, the numbers so far that we've seen seem to be that back the winners, back the stocks which are showing growth, because there is momentum there. So from the Midcap earnings pack, you had Persistent and Emphasis both came out with their numbers. Persistent was a big beat, 4.5% top line growth. Emphasis met street expectations with 2.9% growth. The others, whether it's an LTIMindtree, LTTS, Cyan, Tata Elxsi, all disappointed market expectations. Coforge, though, is yet to report numbers, 5th of May, and that stock is up nearly 40% in the last 1 year. Large cap IT also came in for a lot of buying. So whether it's Infi, TCS up nearly 5%, HCL Tech soared 10% this week, And the key reason appears to be the free cash flow yield has now turned attractive after the decline in share prices. And for FY27, the free cash flow yield for these large cap companies will come up. It's close to about 5%, and nearly 6% for a company like Wipro. So that could have aided the buy. That said, the outlook still remains uncertain. And I'm just going to quickly wrap up with the guidance shared by the companies, which gives you an indication that FY26 is going to be a tough year. Growth is still, missing. Infi is guiding for 0 to 3%, HCL Tech 2 to 5%. Wipro's Q1 guidance, not full year, Q1 guidance was minus 3.5% to minus 1.5%. LTTS is guiding for double-digit growth, but that includes the acquisition. If you strip that out, again, we're talking about a low single-digit kind of a top-line growth. And Cyient has abstained from giving a revenue guidance, citing uncertainty. And they've also pushed forward their margin aspiration. They've lowered it and pushed forward the date by which they will achieve it. So, Hiren, you spoke about the outlier stocks, right? Will you continue to back them? Because so far, the outlier stocks were what? Your emphasis, Persistent and Coforge more than the others.
Actually, it's quite interesting because it's precisely during times like this that you really get to know who's executing in a tough environment. And therefore, when times get better is when those stocks actually deliver far better returns, right? So the men and the boys, when the sector is growing, everybody is growing. Somebody is growing more, somebody is growing less. But when the sector is on the back foot, and then you have a few outlier companies that can grow, that tells you that, there are some outstanding management teams who are continuing to execute because the environment is the same for everybody, right? Yeah. And I think that, this is a sector, as you rightly mentioned, even if there is no growth, at least in the large caps, people have the safety of quality and cash flows and buybacks and, payouts and stuff like that. But if you're a growth investor, then I think you have to look for those outliers.
And you want to talk about anything you like there?
I wouldn't take names, but we do have a couple of outliers who...
One outlier management we often discuss internally is Coforge.
Coforge, yeah.
And we've always, whenever we have him on Bazaar and...
you try to poke him a little bit more, he says, no, I'm as confident. I'm even more confident than that. So
outstanding confidence in terms of just, the ability to execute.
Exactly.
So, as Rima said, the numbers are on fifth.
Yeah. Persistent is the other one, which has been delivering quarter after quarter of very, very strong growth. And it's been rewarding to all the shareholders.
Towards the end of the week, Hiren, we had numbers come in from Maruti, and there were a couple of one-offs out there. But you all have chose the auto sector as a theme that you all would play by a very niche play. So you all are focusing on the premiumization theme out there. How much of it do you think is already in the price, or do you think it has a longer runway from here on?
I think in autos, on the two-wheeler side, we have exposure to Eicher.
Yeah.
On the four-wheeler side, in some of our small cap funds, we have an exposure to a company called Force Motors.
Force Motors, yeah, that's what I was referring to, yeah.
Yeah. It's an early bet. We believe that it's a company which has got great products. It's also a great way to indirectly play the premiumization theme because they manufacture engines for BMW and Mercedes. And if you look at the history of any automotive OEM which has delivered returns or value over a long period of time, it's all about products. You need a killer product, right? Hero Honda was made on the CD100.
Yeah.
Bajaj was made on the basis of Pulsar. All great companies have great products. We think Urbania is a great product that Force has. And it's relatively, out of the radar, not too many people talk about it. And again, I want to give full disclosure that we and our clients own it in our portfolios. So, this is not a recommendation. But we think that there could be an opportunity there.
With the full disclosure, you want to at least tell us the IT stocks that you own, since we spoke about it? With the disclosure, no recommendation.
We do own KPIT.
KPIT. Well, that's been a big outperformer, but it's just, I think the auto ER&D slowdown has slowed down the growth rates, but it's still growing pretty
Rima, IT stocks hit out of the park. Who else hit out of the park this week? Mr.
Me? Why?
Mr. Nime,
Yeah.
Street Chatter.
History chatter.
So
Sami,
we'll
361.
361, and I think there are a couple of more coming. So we'll take a quick commercial break here, and we'll discuss some of those deals which have been announced and what else is on the anvil. Stay with us. Okay, welcome back. You're still with us here on Editors Roundtable, and we're in conversation with Hiren Ved, just sort of wrapping up the week and, of course, what lies ahead. And, as I said, Nimish, you had a couple of wins this week.
Smashing it out of the
Well, let's
Sami
see.
and 361.
Yeah, so some deals went right. Sami went off very well. And it's a good deal, actually. GIC putting in money. At least there will be an institutional holder now. So that worked very well. Which was the other one? I forgot.
361, UBS.
Correct. So again, 361. Let's ask Hiren. What's your view on the whole, wealth management space? We saw the first big delivery in MNC came in and bought into 361. Nuvama is another good play.
I think it's a great space. It's a growing space. Yeah. Incidentally, I think what's interesting about this space is that the real strong guys are actually Indian companies, right? Because there was a time when you had the Stanseys and the Cities and the Barclays of the world, who've been kind of post the global financial crisis in India have been on and off, on and off.
It's like the broking sector, right? I mean, the foreign guys are all sometimes here, sometimes not here.
Correct.
It's the Indian guys who've
And it's now really the Indian brands, the the Nuvamas, the Kotaks, the IIFLs, the Motilals of the world, who have built these franchises, and rightly so. And as our bhaiya used to say, ladki sundar hai to aayenge, to ab gore aa rahe hain sab stake lene Indian wealth management companies mein. So I think it's a great sector. I think there is a lot of wealth created. I mean, post-COVID, we've seen an explosion in market cap. Entrepreneurs are selling their businesses. They are monetizing. They have wads of cash, which they don't know what to do with. And that's where the wealth managers come into play.
That's exactly what the UBS, team told me, that, now if they are not in India, even though they are the #1 in Asia, the India pie, if they miss out, the ranking changes very fast because of the size and the sheer amount of deals that India is doing right now.
But also, Nimish, if you see the data, right, in the last 5 or 10 years, and I don't remember, but the fastest growing billionaires have been in India.
Correct.
So this is the growth market for wealth. Right.
Absolutely.
So they have to come.
So what about the other capital market plays? Anything that you have an exposure to?
We have exposure to both the exchanges, which are listed.
Okay.
We have exposure to wealth managers.
Okay.
And in fact, within financials, we have a larger exposure to capital market plays than the typical lenders or the banks.
Okay. But do you think now it's time to shift from this to the lender? Just purely from a tailwind point of view. We put out a piece, Hiren, suggesting that, normally we've learned this in the companies as well. A change of guard leads to re-rating. Just with the new RBI governor at the helm, the Nifty bank is up 15% from the Jan lows.
Correct.
And he's done a lot of corrective measures, right?
Yeah, so I mean, it's for us, it's not either or. Okay. It could be both, right? So we do have lenders exposure. And I agree with you that the macro for the banks and the NBFCs have substantially changed.
Right.
And I think RBI has, the new RBI governor has made a big difference in terms of easing regulation.
Easing liquidity.
Easing liquidity massively, right? Which should aid in growth. And the balance sheet tightness that we were seeing, I think that's something of the past. So you will see the sector perform much better this year.
Hiren, in pharma and capital goods, again, with full disclosure, what do you own? I mean, just to give a sense.
Pharma, it's largely CDMO. So, we have, our largest exposure is to Divi's, which is the boss of the sector.
It's done well?
It's done phenomenally well,
What about this GLP-1 kind of, I mean, Divi's is a play in a way.
Yeah, I mean, it's a large growth opportunity. I don't think we are playing it just because of GLP-1. GLP-1 is one big opportunity that is in front of these companies. And I think, in general, CDMO as a sector has a long runway for growth in India. I think India's competitive advantage is very, very solid.
Yeah. And what about capital goods? I mean, what's the...
So there, largely our exposure is to power transmission area, right, where we think there is a lot of runway for growth because, with renewables, with data centers, with power required, you have to build the grids. And incidentally, India is also globally competitive. So a lot of the Indian electrical power goods companies are also exporters. And, we've already seen 2 wars being played out globally. At some point in time, those wars will stop, and rebuilding of, their infrastructure and electric power lines and all of that has to happen. And that will only feed into bigger export demand going forward from here. So these are some areas that, we continue to like.
Okay, out of time. Hiren, thank you very much for
so much.
joining in. Enjoy your weekend, folks. We're going to call time on this edition of Editors Roundtable. Thank you very much for watching.
मुस्लिम सिख ईसाई आपस में है भाई भाई कश्मीर को बदनाम करना बंद करो बंद करो
कश्मीर को अमन अंजाम देने में यहाँ के हॉस्पिटैलिटी इंडस्ट्री का भी उतना ही हाथ है। ये सब जगह मैंने एम्फेटिकली बोली है।
We want justice. We want justice. We want justice. हिंदुस्तान हमारा हिंदुस्तान हमारा
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart?
Hello and welcome to India Business Hour. I'm Ashmit Kumar and here are the headlines that we're tracking this evening. India and Pakistani forces exchange fire briefly at the line of control as tensions rise after the Pelgam terror attack. Indian Army sources say Pakistan initiated the firing. Army Chief General Upendra Dwivedi is in Kashmir as United Nations calls for maximum restraint. Reliance becomes the first Indian firm with a net worth in excess of 10 lakh crore rupees as it turns in a resilient fourth quarter performance across all key segments. Revenues jumped nearly 9%, driven by strong growth in its digital services and retail businesses, which offset a subdued performance in energy businesses. Net profit rises over 6%. Jio's average revenues per user jump over 13% to more than 206 rupees.
Maruti Suzuki misses estimates in Q4, profits down over 4%, revenue growth is below expectations, margins contract by 180 basis points annually. Sensex and Nifty gain 1% this week despite a sell-off on Thursday and Friday. Nifty manages to hold above 24,000. Midcap index up 2% this week. China denies any trade negotiations with the US once again. This after President Trump claims officials from both nations have been meeting each other. China tells US to abolish the tariffs if it wants a resolution to the tussle. Apple is seeking to import most of the iPhones it sells in the United States from India by the end of 2026. Sources say the company is aiming to accelerate the shift beyond China to mitigate